front, US front as well, the Dow futures, Nasdaq futures yesterday also we saw that they were trading in the red. And what is the Nifty implied open indicating on that front? We're indicating a 90-point downtick as of now for the Nifty implied open. So seems like a screen of red that's coming across Asia, and that's what we're expecting in India as well. Now on to that update, right? What's happening on the West Asia front, which is causing this worry on the street as well. As a stalemate for a peace between Washington and Tehran continue, US President Donald Trump has warned Iran that the clock is ticking for a peace deal. The post on Truth Social added that Iran better get moving or there won't be anything left of them. The president's warning comes after he had a phone call with Israel's Benjamin Netanyahu, Prime Minister of the country, as well as in terms of the conflict between Iran is what they discussed. Meanwhile, Saudi Arabia says that it intercepted 3 drones that were launched from Iraq space. The country warned of its right to respond at the right time. Meanwhile, UAE also responded to the damage to one of its nuclear facilities and was determining the source of the attack as well. Okay, on that note, how has all this actually impacted our commodities market? What are we keeping an eye out on in terms of gold, oil? That continues to be a concern as well, right? In terms of the prices. To get us all of that, let's go across to Manisha Gupta, who's joining us this morning. Good morning, Manisha.
Morning, Vinaya. Thank you for that. Well, yes, the crude oil prices clearly have surged further, and we are holding above $110 a barrel at this point in time. As you were mentioning, there are various statements from the U.S. president suggesting that Tehran is running out of time to secure an agreement. And there are reports from Iran media that the negotiations remain deadlocked, with the U.S. offering no tangible concessions. The markets also are looking at Russia facing its biggest attack from Ukraine, the biggest in a year, by the way, and that also adds to the geopolitical concerns there. Energy infrastructure in the Persian Gulf was targeted over the weekend. So there are various things that happened over the weekend and the statements coming in as well, which are supporting the crude oil prices. But what we also are looking at a very sharp decline when it comes to metals because of the same reason. The crude-led inflation and the fact that the monetary policies from various central banks could change has led to a decline in metals. So you have gold, which is declined 4% in the previous week, is trading at a 6-week lows. Silver fell 8% on Friday, has continued to decline today in Asia. Copper prices, well, they fell nearly 5% on Friday, have opened 1.5% lower in the international markets right now. So everywhere that you look, barring crude oil, the metals, the other commodities have opened on a weaker note.
Okay, Manisha, thank you so much for that, for highlighting what we should keep an eye out on in the world of commodities. But let's move on. And the BRICS summit in New Delhi has ended without a joint statement after the members failed to reach a consensus of the Iran war. However, member nations called for a comprehensive reform of the UN, including Security Council. Now, speaking at the press conference, Iranian Foreign Minister Sayed Abbas Araghchi has clarified that the Strait of Hormuz is open and all vessels can pass, barring vessels belonging to the nations fighting against Iran. Listen in.
The Strait of Hormuz is open and all vessels can pass except the vessels belonged to those countries who are in war with us, who are fighting with us. Those vessels who want to pass should obviously coordinate with our military because of the mines and obstacles which exist. So we will guide them to pass, as we have done for a number of Indian vessels, and we help them to pass. The safe passage of all vessels is our policy and in our interest, and we are ready to help those who want to pass safely and securely.
Now, moving on, the Ukrainian and Russia update, what's happening there, right? Ukraine has launched one of the biggest drone attacks on Russia's Moscow region, killing at least 5 people. Russian officials described the attack as one of the largest drone barrages of the war. Ukrainian President Zelensky defended the strikes, calling them entirely justified and saying that they were a response to continuing Russian attacks on Ukrainian cities. Moscow claims its air defense shot down more than 1,000 Ukrainian drones over the past 24 hours. Also note, an Indian worker was killed and 3 others injured in this attack. Okay. On that note, we're actually going to move into a very short break. Then after the break, we'll come back. We'll talk about how the overnight cues are going to be impacting our Indian markets. Stay tuned in. Welcome back to Power Breakfast on CNBC TV 18. Now let's talk about how those overnight cues are going to be impacting our Indian market. We have a team of research joining us to set you up for trade, tell you which are the important stocks to watch out for in the trading session. And first up, Vivek, seems like those one-day blues, and we'll see red more than the blues across the screen today. That's the expectation this morning?
Good morning. You're absolutely right. So, what you're actually saying is that given the fact that we actually seen quite a muted and a weak handover from US markets over the weekend, and there has been a lot of escalation as far as rhetoric is concerned of the geopolitical tensions. We've actually seen Asian markets, GIFT Nifty, all indicating a sharp gap down start for our own markets. Now, the other big worry continues to remain the US 30-year Treasury. The yields have now moved to a one-year high, and that led to a bit of a sell-off as far as US markets are concerned in the week gone by. Brent prices continue to remain a key monitorable. Brent prices have spiked once again and now hovering around the $110 a barrel mark. Asian markets, the GIFT Nifty, all indicating a gap down start. Now, when you're talking about the week gone by, markets actually managed to snap a 2-week gaining streak, and they ended with significant cuts in the week gone by. And the sectors that were impacted the most, of course, were the Nifty IT pack, continued fears as far as a takeover as far as AI is concerned of most of the software as a service is something that the entire street is concerned about. And along with that, the realty pack too, that saw a bit of a bounce, saw significant selling pressure emerge. When you're talking about Friday markets ended a very volatile trading session with cuts. In terms of individual stocks, Tata Motors passenger vehicles, that was an outperformer given the kind of margin expansion the company saw in Q4. And when you're talking about the top movers on the downside, Muthoot Finance, some worries about NPA, worries about spreads, as well as Voltas, very weak Q4, something that dragged those stocks lower. In terms of what is it that we'll be watching out for in today's trading session, well, earnings season continues. IOC as well as Afcons Infra among the key companies that will go ahead and report their results today. Earnings reaction, keep an eye out on the metals pack, Tata Steel as well as SAIL. Domestic markets have done very well for both of them. Power Grid, quite a muted quarter. It'll be important to see what the management says in the Q4 conference call today. It's a significant top-down miss as far as Power Grid is concerned. KEC, NCC, NSPC, LJVN, all of these stocks will go ahead and react to the results today. Keep an eye out on the entire insurance pack. A very large deal has been announced. When you're talking about Prudential taking over Bharti AXA, ICICI Prudential will be the stock in focus given the fact that Prudential will need to pare down their stake to almost nil. So overall, a muted trading session is what is in store for us today, at least at the open.
Okay, Vivek, thank you so much for that. And since we started the show, if you look at it, we were down 90 points. Now the Nifty implied open is indicating a 115-point decline. But which are the important stocks that we're keeping an eye out on this morning? Let's go across to Ria for that. Good morning, Ria.
Well, good morning. First, taking stock of all of the earnings that have come out over the weekend. Starting off with Tata Steel, the quarter four EBITDA has come in at 9,829 crores, above estimates, and the standalone volumes for the company have gone up by around 11% compared to the previous year. For Vodafone Idea, the ARPU has grown about 1% sequentially, and apart from this, ABG, which is the promoter of the company, is going to infuse around 4,730 crores in the company via warrants. And analysts say that this is lower than expected, and it's unlikely to prove prove any meaningful cash flow relief to the company. For Power Grid, for their Q4 numbers, that has been largely below estimates. The revenue has gone down by around 5% compared to the previous year, and EBITDA also seeing a decline of nearly 11%. For Hindustan Copper, the revenue has gone up by around 58% compared to the previous year at 1,156 crores. Margins have expanded quite significantly to nearly 54% versus around 36.4% in the previous quarter. For SAIL, the sales volumes have come in at 5.32 metric tons, and the EBITDA has come in at around 4,409 crores, above the estimates that we were working with. For Premier Energies, the strong growth has continued in Q4 this time around, led by strong execution for the company. Revenue has gone up by around 38%, and net profit also seeing an expansion of around 64% compared to the previous year. For Gland Pharma, revenue seeing an increase of around 22%, better than the estimates of around 15 to 16% growth for the quarter, and net profit also seeing a very sharp increase of 86% compared to the previous year. For Delivery this time around, the revenue has seen an increase of over 38%, and EBITDA margins have also expanded to nearly 8% versus around 4.5% compared on a year-on-year basis. But moving away from the earnings, Indigo is expected to be in focus today, as Delhi has cut its VAT on the ATF fuel from 25% to 7% for 6 months amid the West Asia crisis, and Mumbai has also cut this tax from around 18% to 7% for the next 6 months.
Okay, thank you so much for that, Ria. But let's move on and talk about the cues in the world of F&O. We have Sudarshan, as always, to take us through all of that. Good morning, Sudarshan. Friday, we managed to hold on to 23,600. Which are the key levels today? Because as of now, it's a red start.
Good morning, Vanessa. That's what's on Friday. Even if we closed in the red, it was not a bad day of trade because amid volatility, Nifty managed to hold to the levels about 23,600. But the problem is that cues have turned negative. All the indicators you talk about, rupee, you talk about crude, you talk about 10-year bond yield, whether it's India or US 30-year bond yield is now highest in a year, and even commentary is not looking that great. So we'll have to track all that, and because of these cues, GIFT Nifty for us is indicating a sharp downtick, currently indicating that we might open with a gap down or we might open with a cut of more than 100 points. But talk about FIs flows on the Friday also, we have seen FIs buying in the index futures of more than 1,300 crore. In the stock futures, they were sellers sold almost 1,200 crore. But look at the short reduction. They have reduced short positions by more than 8,000 contracts for second consecutive day. On Friday, reduction was more than 10,000. Friday, it's more than 8,000. Now, FI's longs exposure is at 12%, short exposure 88%. On the options data, put side 23,400 and 23,500 remain the most active put options. On the call side, 24,000, 23,900 were the most active. So it tells you that broad range for Nifty remains from 23,400 to 23,900. So for Nifty to go higher, it has to hold to the levels above 23,400. That's the reason I've taken the support 23,400, resistance 23,900. Two stocks remain the best, SAIL and Keynes Technologies. And so the stocks that have been reacting, whether it's fresh longs or fresh shorts, Vodafone Idea has been long unwinding, and there is also a news flow. Muthoot Finance after Q4 earnings has seen fresh shorts, and Bharti Airtel has been seeing short covering.
Okay. Sudarshan, thank you so much for that. So that's the cues that we'll keep an eye out on in the world of F&O. But let's just take a look back in terms of the US market, right? Wall Street ended with sharp cuts while oil prices and treasury yields jumped as a two-day Beijing summit between President Trump as well as Chinese leader Xi Jinping ended with few major announcements. Now, key indices, Nasdaq, S&P 500, Dow Jones, all closed with cuts of over 1%, but S&P 500 held on to finish higher for a seventh straight week. What happened on Wall Street? Let's go across to CNBC's Brandon Gomez, who's here to give us that wrap. Brandon.
President Trump left Beijing Friday after his summit with Xi Jinping and announced that China has agreed to buy about 200 Boeing jets, with the potential for as many as 750 planes. The Chinese government has yet to comment, and neither has Boeing, which typically waits for customers to announce completed deals. If the orders are finalized, it would be Boeing's first major Chinese deal in almost a decade. In recent years, Boeing has basically been shut out of China amid trade tensions with Washington. And with the summer months approaching, Ben & Jerry's ice cream may soon have a new owner. Reuters reports Blackstone and CD&R are among private equity firms exploring a bid for its parent, Magnum Ice Cream Company, just months after it was spun off from Unilever. Magnum is facing challenges from consumers opting for healthier choices amid the boom in weight loss drugs such as Zepbound and Ozempic. That's what's happening here in the U.S. Back to you in Mumbai.
Thank you so much for that. But let's move on. And Jefferies chief market strategist David Zerwer says that the U.S. economy is resilient despite the negative action from rates and energy. Listen into what he had to say.
Guts of this economy, which is being driven by a productivity-led positive supply shock, is not getting derailed by a little bit of move on the negative demand side from rates or the negative supply side from energy. These are small shocks in the context of this very large productivity shock that we have been talking about now for many years, not just many quarters or many months. So I think the underlying guts of this economy are just showing through the negativity. And that's the positive story here. That's the read. I would argue that if we went back to Feb 27th, none of this ever happened. And oil was back at $65. And we had 3 rate cuts priced in for the next 12 to 18 months, which is where we were, 1 in June, 1 in Sep, and then 1 sometime next year. The market would be well over 8,000 in the S&P, well over 8,000, another 10% from here. So I'm taking a lot of positive out of this price action that we've had for the last couple months.
Also, U.S. Energy Secretary Chris Wright says that a deal between U.S. and Iran can be struck soon and says the U.S. military can force the reopening of Strait of Hormuz, but would rather make a deal. Listen in.
So dialogue's going on with Iran. Everyone knows where this is going to end. This is going to end with the Iran nuclear program being dismantled and free flow of traffic through the Straits of Hormuz. That could be a deal with Iran that's struck in the next few days, and that could happen relatively quickly. If Iran continues to hold the world economy hostage, the United States military will force the reopening of the Straits of Hormuz. But that's not trivial to do. We've done the early steps on that, but better is to get a deal. We didn't go in with a specific agenda to change the government of Iran. That's up to the Iranian people. We went in to reduce Iran's ability to wreak havoc on global energy markets, on the Middle East economy, and ultimately threaten the U.S. and our allies in Europe and Asia with nuclear weapons.
Shifting focus as the Federal Reserve Chair Jerome Powell's term comes to an end, Kevin Walsh is set to take over the reins. Former Atlanta Fed President Dennis Lockhart and former St. Louis Fed President James Bullard outlined the key challenges ahead for the incoming Fed Chair. Listen in.
Kevin Walsh has the mother of all tricky navigation challenges in the coming weeks and months. On one side, he's got the president. David has mentioned that, of course. On the other side, he's got an increasingly hawkish committee. The well-noted 9 words that Powell used in his last press conference, that the committee, the core of the committee, or the central tendency of the committee had moved to neutral, tells you that the committee is of basically cut or hike mind. And that's going to be a difficult committee to convince to cut interest rates.
With yields running up in recent trading, I think the market's wondering if Kevin Walsh is going to be willing to signal that he's will take action to contain inflation if the situation rises. Now, I do think there's a path for him, I think, where he can say, hey, I don't really like giving forward guidance, so he could take out the words that have been construed as forward guidance from the committee as the dissenters wanted at the last meeting. And he could also claim truthfully that the committee already reduced rates 75 basis points, so the committee's in pretty good position, and this would show the market that he's willing to take hawkish action despite everything that's happened. So I do think it's a test, though, and all chairs get tested in their first 6 months.
Okay, on that note, we're going to step into a very short break. Up next, we get you more in terms of news and updates on the other side, so stay tuned in. Thanks for staying tuned into Power Breakfast on CNBC TV 18. Now let's move on. And in a landmark achievement accelerating India's journey towards technological leadership, Tata Electronics has forged a partnership with the Dutch semiconductor powerhouse ASML to establish the country's first front-end semiconductor fabrication plant in the state of Gujarat. The Dutch chip-making equipment maker's technology will support Tata Electronics' planned 300mm semiconductor fabrication plant in Gujarat, the companies said in a joint statement. The signing of the agreement between the two companies was witnessed by Prime Minister Narendra Modi and Prime Minister of Netherlands, Rob Jetten. The announcement comes as PM Modi embarks on a five-nation tour to strengthen India's strategic ties. Moving on, Prime Minister Narendra Modi is currently touring in UAE and Europe from May 15th to May 20th. He has visited UAE, Netherlands and Sweden thus far, and with his visit to Norway and Italy on the radar this week. The Prime Minister's visit to Netherlands marked the elevation of strategic partnerships with two countries, inking of a 17-pack partnership on chips, defense and more. The Netherlands visit also witnessed the return of 11th century Chola dynasty copper plates that we saw. Meanwhile, his visit to Sweden witnessed the marking of history as he became first Asian leader to receive Sweden's Royal Order of Polar Star. Okay, and with that, we're absolutely out of time with this edition of Power Breakfast on CNBC TV 18. Nifty implied open is still indicating a red start for our Indian market, so watch out for that. But to take you through all that action, we have Bazar Morning Call coming up next.
Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC TV 18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazar Morning Call. We are coming to you live from the CNBC TV 18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Mangalam and Nigel. Guys, hi. Morning.
Hi, morning. Over the weekend, we were hoping for some sort of de-escalation. Maybe oil prices come lower and all of that and stuff. We kickstart a new week, $111 per barrel on Brent, and the GIFT Nifty indicating a 100-point downtick.
That's right. Things in a bit of a tizzy this morning. It looks like a bit of a challenging session up ahead, but you can't rule out some hope, right? Hopefully Trump, climbs down a little bit, which hasn't happened till now. And hopefully we see some measures on the domestic front as well that could help that sliding rupee and, boost up the economy a little bit. But otherwise, a bit of a challenge ahead.
Bit of a challenge because we're up. Friday oil prices were up 3.5%. Yeah, they're up another percent this morning as we come in. So that's the backdrop. Let's just start with that, which is oil. $111 a barrel, 101 plus actually. So you may wonder what's happened is basically the fact that nothing has happened. And that is the reason why prices are up. The stalemate continues. It's neither peace nor war. So it's like a no man's land. Now, over the weekend, President Trump warned Iran that, and this was a Truth Social post, he said the clock is ticking. The fact that, well, if they don't come to the table and start negotiating and they better move fast, there won't be anything left of them. So more rhetoric, more sort of, over-the-top kind of comments, threats, whatever you want to call it. Time is of the essence. The post is up on your screen as I speak. Now, there were also reports which said that Trump's top aides have drafted plans for a return to military strikes if a deal can't be reached. I mean, this, even as we ended Friday's session, this was the fear as we went into the weekend, maybe the US the President Trump is going to flex one more and then we will see what happens. But so far it's not happened. It may happen anytime. In the UAE, just to sort of, close the loop on the situation there, in the UAE, drone strikes sparked a fire on the edge of a nuclear power plant on Sunday. Remember, Iran has said, well, it's not us. UAE said it's Iran. That back and forth continues. UAE, of course, called it an unprovoked terrorist attack. So, it's so far. By the way, there have been reports that countries like UAE, Saudi, etc., they've carried out strikes within Iran, which were so far not reported. It was looking like Iran was striking countries around in that Persian Gulf region for retaliation against US, using those countries as a base to attack Iran. But over the last 1 week or so, it's emerged that countries like Saudi, etc., have also carried out strikes. Well, Iranian Defense Ministry saying Iran stands fully ready to repel any attack. So there's more kind of sort of that military element, at least a little bit more. And I think that's also the reason why prices are up a little bit. US equities, that's the other thing. They saw a leg down. So S&P was down about 1.2%. NASDAQ was down 1.5%. Remember, the S&P is, actually US equities broadly are up 10% on the year. That's great because they've had a fantastic 2025 and they started 2026 on a pretty good note. Nvidia will report numbers on Wednesday, and of course Walmart reports on Thursday. That is this week. The other big story was global bond yields, which actually all soared. And this is not exactly great news for equities. So look at the US, right? The 10-year was up 11 basis points. It ended at about 4.59%. It's the largest rise on the US 10-year in over a year. The 30-year in the US, 5.12%. 9 basis points higher. You look at the UK. UK 10-year ended 18 basis points higher. It's the highest since 2008. There are country-specific reasons for in UK, Prime Minister Starmer's position is being challenged, and the candidate is more expansionist in terms of his fiscal policy. The Japanese 30-year, that also surged to near 30-year highs. So a bunch of reasons. I'm not going into specifics there, but these are all large developed markets, and bond yields are surging, which sucks money away from other markets, other regions. Dollar index also saw a surge higher. That's on Friday. So about 0.48% up to about 99.30. It's not as if we needed that because, the rupee's been under pressure in any case. So we are around 96 odd to the dollar. And of course, I put out a piece on Editors Roundtable as well. What is the street talking about? 5 steps which perhaps potentially we could see. We'll see. But, if the global backdrop does not change, and when I say global backdrop, I basically mean oil. If that does not change, the pressure is not going to go away on its own. Something will need to be done. The Nifty, by the way, on Friday failed to cross the 23,800 level on the upside. So, we ended slightly below it. The immediate resistance becomes Friday's high then, which is 23,839. And the support on the downside, if we stay below this level, below the 23,839 level, is 23,153, which is nothing but the gap zone. The last time around the market came to these levels. So started to come to these levels. So 23,839, 23,150 odd is the range broadly, but very, very near term. GIFT Nifty will give you a quick sense of how we're likely to start. It's about 80, 90 odd points lower, at least with an hour, just less than an hour to go for the pre-open session. Nigel has walked across the wall with the futures and options positioning and how we are looking. Nigel, over to you.
Well, thanks for that, Prashant. I think we'll be lucky if we start off with a cut of only around 100 points. I think we're in for a deeper gash just to start with in today's trading session because the markets are in a bit of a tizzy. Geopolitical issues, they are weighing as Trump has warned Iran, the clock is ticking. Crude oil prices remain elevated while the 10-year bond yields have spiked. And globally, as you mentioned, bond yields have spiked up as well. In summary, the troika that we look at, Brent, the yields, as well as the dollar index, they're not favoring the Indian markets this morning. And the street is waiting some kind of measures to stabilize the Indian rupee, which has been sliding one way. The question is, when do we hear these measures? Because measures are due. Does it come in at 96, 97, 98, or, is there a different plan in place? But some kind of stability in the Indian rupee, that's something that the equity markets are looking at very, very closely. In terms of flows, it was mixed. The DIs turned sellers, the FIs turned buyers as well. Maybe that was a bit of a one-off, so we'll have to see how this trend goes because the FIs largely have been sellers. But they went ahead and they bought in cash markets and they covered some shorts as well on index futures. So if you pull up that chart, you'll see there was a swing factor of close to around 9,000 contracts or thereabouts. And it was evident in Friday's trading session. There were some shorts that were covering out positions, and that's precisely what happened. So that's the covering that I'm talking about, close to 9,000 contracts in terms of a swing factor. The short positions continue at around that 88% odd mark. Now, if you look at it, the problem is, we are seeing signs of short covering. Because you pull up the FI chart on the short side, the number of contracts on the short side have come down by close to around 20,000 contracts approximately. While the clients, they are unwinding some positions on the long side as well. But that outsized bounce that we were hoping for, once the shorts start covering, that's actually missing. And that's a little bit disappointing because you have shorts in the system. You're hoping that they get squeezed out. Now they're unwinding some short position, but you're not seeing that outsized bounce, which is a bit of a worry. In terms of levels that we're looking at, we should look at the options data. 23,800 call, that's seeing aggressive writing. The premium has come down to approximately 100 rupees approximately. And those puts that were written in the previous trading session, they have actually unbound some positions. So in terms of levels, going by the call writing that we're seeing at higher levels, the 20 DMA that comes in at around 24,000 odd, that's a very, very stiff resistance mark that we're looking at. But on the downside, you'll be hoping that last week's low, in fact, holds out. That comes in at around 23,263 or thereabouts. So markets in a bit of a tizzy. We're in for a bit of a challenging trading session. We'll have to hear something on the global as well as on the domestic front because otherwise the markets are set to open up a bit on the back foot.
Take that point indeed. Markets are set to open up in the back foot, and what takes place from there will be extremely crucial to track from here on as well. So good to get in Ed Yardeni, the president at Yardeni Research. Good morning, Ed. The interesting part is that the street was hoping for some sort of de-escalation given the sort of spike that we've seen in the US bond yields. Do you think they're now comfortable with the bond yields being higher above that 4.5 mark?
Well, I think that it's interesting to see that bond yields spiked up on Friday. That was the day that Fed Chair Kevin Warsh, the new Fed Chair, it was his first day in office. And I think the concern in the bond market is that the Fed Chair has been saying that he wants lower rates, which makes no sense in the current economic environment. And I think it's becoming increasingly clear that the bond market is pushing the Fed to move from its easing bias, not to a neutral bias, but to a tightening bias at the June meeting. And that will probably be followed by a rate hike at the July meeting. I think right now what we're seeing is the bond vigilantes are sort of taking control of the global bond market, waiting for central bankers to take the inflation problem more seriously.
Ed, hi, morning. Prashant here. You think Kevin Walsh will be allowed to do this?
No, there's no way that he can be a lone dissenter. It's very, very unlikely that he will be a lone dissenter. He's going to have no choice but to join. I think a consensus at the FOMC has to be that the easing bias is long overdue to be replaced by not a neutral bias, but by a tightening bias. And I think he's just going to have to go along with the flow. Otherwise, he's going to look, I mean, it would be a terrible way to start as a Fed chair, dissenting from just about every other vote.
Yeah. The move in UK, Japan, these are idiosyncratic country-specific stuff, Ed, or is there a US read-through here as well? The yields which saw big moves.
Well, it's definitely a global bond market sell-off. Bond yields are going up around the world, particularly in developed countries with large deficits, combined large deficits with increasing concerns that the Strait of Hormuz is going to remain closed for longer. The longer it stays closed, the more the bond market's going to conclude that interest rates are going to have to be higher for longer. I'm really relatively comfortable with the bond yield in the U.S. being somewhere between 4.25% and 4.75%. There's a chance that it could get to 5%, which is where we were briefly in 2023. I think that would be an extraordinary buying opportunity. I do think that it's interesting to see that the price of oil has stayed around 100. I know it's about 111 on a Brent basis, but it's extraordinary. It's not even higher. And I suspect some of that is the fact that China's economy is not doing all that well. The latest data on China suggests that retail sales are extremely weak.
Hi, Ed. Good to see you. And Ed, the Indian markets have underperformed, but with this yield spiking and the kind of move you're seeing on the dollar index as well, flows to the emerging markets will be really, I mean, they'll desert us. What is your view on that? How do you see flows moving globally?
Well, the reality is the emerging market stock index, the ETFs, for example, the EEM and the EMXC, excluding China, they were very strong until last week when South Korea and Taiwan's indexes took a dive. Clearly, the emerging markets indexes, ETFs, have been pushed higher by the AI trade as seen in South Korea and Taiwan. And both of those look like they need to come to a rest here for a while. So the emerging markets overall as a asset class may underperform for a while. I think, look, it would actually be a healthy thing if the markets took a break here, and I think they will. And I'm talking about sort of a rest rather than an actual break in market indexes. We did have a pullback earlier this year. We could have another pullback into the summer, but I still think that once things settle out, we're still in a bull market in stocks in the U.S. and globally.
All right, a quick word on the U.S. market. You've got those levels bang on. In fact, the levels are coming sooner than what you were anticipating as well. Yeah. What's the outlook with regard to the S&P 500? You normally have a level out there. And a quick word on KOSPI. Everyone's talking about this earnings growth and the likes. Some are believing it's not very structural in nature. But still, that market's available at sub 10 times. Your view on the KOSPI as well as the U.S. markets. Please go ahead.
Yeah, good point. I mean, we've had an earnings-led melt-up is what I call it, which is a lot healthier than a valuation-led melt-up. It's more sustainable. But some people are already questioning just the validity of the earnings. Some of those earnings have actually been the AI companies having stakes in other AI companies and all those prices going up. So it kind of feeds on itself. And I think that's sort of a concern here. Well, last week I changed my number for the S&P 500 to 8,250 by the end of the year. Maybe I made a top, but I don't think so. I think the earnings are there to justify the market continuing to move higher. It did get up to 7,500 on Thursday. On Friday, it only sold off 1.2%. And here, all of a sudden, everybody's talking about the end of the world and all kinds of bond crashes and calamities. I think this will be a short-term buying opportunity again, particularly in the U.S. stock market.
Right. Just to carry forward what Prashant had spoken about with regards to what Kevin Walsh would be allowed to do or not, how does all of this unravel? Because the bond markets are saying a certain thing, the president's saying a certain thing, and amidst all of this, there is, the uncertainty around the war and geopolitics. How does all of this unravel according to you?
Well, Kevin Walsh is a very smart individual, and he knows markets, he understands markets, and I think he understands that what the bond markets are telling him is that he's actually got to pivot towards a hawkish stance. And if he does that, there's actually a better chance that bond yields will stop going up if the Fed takes over and acts responsibly with regards to inflation. No one wants to see a repeat of what happened in 2021, 2022, when the Fed was 3 to 6 months too late in tightening. And I think I won't be surprised. I mean, it's quite possible, and I won't be surprised if the Fed actually raises rates by a quarter at the June meeting, just to get the message across that they get it, that they're concerned about inflation. They want to take charge of it. They don't want to let the bond market do all the heavy lifting.
Okay, 8,200. That accounts on the S&P in terms of the target. Ed, that accounts for the Anthropic IPO, the OpenAI IPO. That is 8,200 post those mega IPOs or going into it?
Yeah, well, we're going to have some very exciting IPOs for sure, between SpaceX for sure.
Yeah.
I think that'll juice up the market quite a bit. I think it'll bring a lot of investors that maybe have been on the sidelines getting excited about the future. The future is exciting still, notwithstanding the short-term anxieties.
Absolutely. Well, it's been incredible. And, here's a stat, Ed. The S&P has added $30 trillion in value since ChatGPT came out. We talk about seminal moments, and we use that term around loosely. Well, I think that was a seminal moment, right? 30 trillion.
Yeah, well, Prashant, a trillion here, a trillion there. Before you know it, it's real money.
Thank you very much. Great speaking with you. Appreciate your time here. And it's always good speaking with you. We'll take a break. We're back. We are just a quick tease out of the interactions lined up. 8:35, the management of KEC International joins us to talk about the fourth quarter numbers. 9 o'clock, we have Rakesh Arora of GoIndiaStocks.com to discuss the trends in the metal space. 9:20, Sanjeev Prasad of Kotak Equities talks markets, stocks with us. 9:35, Solar Industries Management with us on fourth quarter, but more importantly, the outlook. Medanta does the same at 9:45. Outlook in focus towards the end of the program. The management of Arvind joins us to discuss their earnings and the outlook going forward.
Welcome back. This is Bazar morning call as we brace ourselves for what could be a tumultuous Monday. The GIFT Nifty indicating about 100 points on the downside with 111 on Brent right now. There are a lot of stocks which are on our radar, and as always, our team is with us here. CNBC TV18's list of top stocks for the day. Let's start with Nigel, Tata Steel. How do the numbers look, Nigel?
Well, Tata Steel's numbers actually are good. The street was sniffing a good set of numbers, and that's precisely the case. Just to summarize it, the realizations improved across the board. You had better volumes in India on a year-on-year basis, and on a sequential basis, there were better volumes coming in from the Netherlands. And in addition to that, you had losses that reduced in UK. The absolute number is better than what we're working with, mildly so, but that goes down as a bit of a beat. The India business, well, more or less in line. Remember, it got the benefit of better realizations, and input costs didn't spike as much as what was feared. So that's why you had, the EBITDA per ton that improved quite well, both on a sequential basis as well as a year-on-year basis, and it was around 200 rupees better than what we were working with. Moving to the European business, well, it turned profitable. They reported an EBITDA positive number of around $1 odd. We were working with a negative EBITDA number of around $5 per ton. And if you break it up, the Netherlands business, these numbers are in rupees per ton. Well, you have it improved. The Netherlands business improved on a year-on-year basis. On a sequential basis, some kind of tempering down. But the UK business, the losses are reducing, which is encouraging in itself. The cherry on the cake is they've gone ahead and they reduced debt a little bit as well by only around 1,500 crores. But the street likes it. So put everything together, the numbers look good. And for quarter one at least, the EBITDA per ton will improve. I'll chat with the management later today and we'll try to pull out some more details. But for the time being, going with a positive start for Tata Steel or a relative outperforming start. Moving to Sudarshan, Vodafone Idea. The fundraise has been announced, Sudarshan. Tell us more.
Good morning, Nice. So for Vodafone Idea, two parts. First, about the earnings, operational numbers are not that bad. It has seen an improvement after several quarters. Revenue has seen a growth of 2.3% on a sequential basis. Even margin has come in over 43%. It's at 43.1% versus 42.6% last quarter. Average revenue per user, or say ARPU, has increased and it's done better than the peers, and it's up 1% sequentially to rupees 174. And also subscriber loss, that's just 0.1 million. That's the lowest loss that company has seen in last 6 years, or say FY20. Now the second part is the promoter infusion. So board has approved the issuance of convertible warrants worth rupees 4,730 crore, and the price that it will be done at rupees 11 per warrant. So that is done at the discount to the current market price. Now, analysts say that promoter infusion is lower than expected, but what would be tracked very closely is debt fundraising. If it happens, that will be the bigger trigger for the stock. But as of now, the stock has seen a huge run-up over the last few weeks. So just on that basis, I'm going with mild red.
All right. So thanks very much for that. Well, I think let's move on and bring in Vivek now. Vivek, morning. Power Grid in focus.
That's right. Good morning. Power Grid, regulated entity, not too much moves the needles in terms of quarterly results. But despite that, it's been quite a bit of a miss as far as the Q4 numbers are concerned. On a consolidated basis, revenues down by almost 5%. Higher other expenses, close to 1,900 crore, versus just 1,280 crore on a year-on-year basis. And that dragged the EBITDA lower quite significantly. EBITDA down almost a little over 11.5%. Margins too contracting sequentially, 700 basis points dip on EBITDA margins. Profitability higher by 10%, but this is on account of a remeasurement of deferred tax balances, and that actually aided the the PAT this time around. In terms of capex and capitalization, remember between Q3 and Q4, the company gave an upgraded and updated guidance for capex as well as capitalization. FY26 capex at 35,000 crore, capitalization at close to 25,000 crore. Today, 4 p.m., the analyst meet is there. The company will give the final updated number, as well as we will keep an eye out on what is the guidance. Now, another important thing that the company needs to give clarity on is, remember, the deferred tax assets on the book has been reduced by 3,200 crore. So that has gone ahead and impacted the P&L. So it will be important to await clarity from the management of this. But overall, a muted set of numbers, but capex and capitalization continues to remain strong.
All right. Capex and capitalization continue to remain strong. Nigel, Hind Copper and SAIL?
Well, Hind Copper and SAIL, both of them, actually, the numbers look quite good. But keep in mind, the stocks have seen a big run. Now, for Hindustan Copper, it was actually a record quarter that they reported. On the top line, on the EBITDA, as well as the profitability aspect. On the top line, the growth was close to around 58%. We know copper prices have been surging, so they are a direct beneficiary of that. The EBITDA number, the absolute number was up by close to around 130% approximately. And margins, they were, as is doing well, we were heading towards that 50% odd mark. For the past quarter, it's at around 54% odd. So good set of numbers coming in from Hindustan Copper. The higher realizations have definitely offset the higher cost as well. In terms of valuations, well, it's not cheap, right? Because they did an EPS of less than 10 rupees in the past year. So trades at close to around 58 to around 60 times approximately. But Anand Rathi, one of the brokerages that covers it, they are expecting the EPS to nearly double to around 18 rupees, yet the stock trades at around 32 times odd. So the only pure copper play, going with green on this one, the numbers look pretty okay. Moving to SAIL, well, those numbers, in fact, actually are better on an operational parameter. So they got the benefit of better realizations, and input costs weren't as much higher as feared, and even employee cost was actually lower. So the revenue number actually is a small miss because the sales volume is a little bit lower. But what made up for that was the realizations were better. So that's why the absolute EBITDA number was better than what we were working with. We were at around 4,100 crores. It came in at around 4,400 crores. The net profit number as well was better than expected, and the employee cost actually on a year-on-year basis was down by 19% because the manpower itself was lower, and also the productivity has improved out there. The calculated EBITDA per ton came in at more than 8,000 rupees. That's the highest we've seen in multiple quarters, and the net debt number came down. So these numbers look good. The problem is they're being ambitious yet again. Capex plan of 15,000 crores for the next year, and it only gets higher from year on. So the street will be a little bit cautious on their execution capabilities. Numbers good. Fear is, are they getting too aggressive? We'll keep an eye on SAIL going with a positive reaction. Moving to Vinny, she's here to tell us about Premier Energies. Hey Vinny, good morning.
Hi, good morning. So for Premier Energies, we're expecting green year as well. The company actually reported a very strong set of numbers in Q4 FY26. Strong execution is what we've seen. So revenue growth of 38%. Margins, yes, a contraction has come in here because raw material prices have gone up. But versus its peers, it still managed to hold on to its margins. 30% range is what it's in, 30.3% for Q4 FY26. Outlook will be key from here on in terms of margins. While the order book for the company is standing strong, cell production and cells as a segment for them, that's at 58% of the order book, which is higher margins. But they are expanding in BESS as well as ingot wafers. So how does that move in terms of margins? That will be key to watch out for. The company has guided for a capex plan of around 5,100 crores as a part of their overall broader capex plan. And they've also said that they will be raising some funds of around 5,000 crore up to 5,000 crore via various methods. Could be QIP, NCDs. So we'll watch out for all of that as well. But as of now, good set of numbers. They have strong expansion plans that they've given up, they've spoken about in their con call as well. That will be key.
All right, Vinny, thanks a lot for that. Let's go across to Ekta. Ekta, Gland Pharma, how did those numbers look?
Well, yes, Gland Pharma actually came out with a very good set of numbers. The revenue was up over 20% on a year-on-year basis. And you had the EBITDA margins coming at around 29.4%, and the profit was healthy as well. Geographies, USA was up 24%, Europe was up 36%, India was up 28%. Their Senexi arm was EBITDA positive despite a lower top line Q-on-Q. Guidance given by them, 12 to 13% growth in FY27 in constant currency. Ex-Senexi, the margin guidance is 33 to 35%, which is a bit conservative according to analysts. And the next thing is the GLP-1 opportunity, which should be positive for Gland.
All right, take that point. So that's about Gland Pharma. But I'm looking at Delivery. Reported their numbers post-market on Friday, and a very strong performance that has come by. 30% revenue growth, 2,850 crores on the top line is what the company is reported, and the operating leverage benefits obviously visible now. The margins expanded from 5.5% to 7.5%, leading to an EBITDA jump of nearly 80%. And the net profit obviously was flattish on a year-on-year basis, because that's because depreciation that has increased from 142 crores all the way up to 183 crores. So that's a non-cash expense. The key segments of the company, both express and part truck logistics business, that actually did extremely well. 40% growth is what we saw in express. So as a result of which, this vertical did 38% overall revenue growth, with margins coming in at 7.9% versus 4.5%. Stock's done well from lows. Let's see whether that continues or not. But the overhang of fund selling on Delivery always continues. With that, let's go across to Yash now. Yash is also joining us, and this one is on the numbers of ICICI Pru Life. Yash.
Well, over the weekend, there was, of course, this large announcement of Prudential PLC, deciding to acquire 75% stake in Bharti Life Insurance. That would be for a total of about 4,200 crore. The deal happens at about 1.8 times September 2005 embedded value. But this particular transaction is a big negative as far as ICICI Prudential Life Insurance is concerned, because what happens is the Prudential PLC owns about 22%, to be precise, 21.91% stake in ICICI Prudential, and as per the regulations, Prudential PLC can't be a promoter, which means it can't own more than 10% stake in two life insurance companies, which means if it has to do this transaction, it will have to reduce its stake to under 10% in ICICI Prudential Life Insurance. The company in its disclosure has said that they will reduce their holding in ICICI Prudential Life to under 10%. They will seek an appropriate time from the regulators to divest this excess of 12% in ICICI Prudential Life, which will be done possibly through block deals, and that value of divestment would be about 9,200 crore rupees worth of shares in ICICI Pru Life, and that is expected to remain as an overhang on the stock.
All right, it's a large one, right? So we'll see how that gets taken out, or that gets monetized, if, when, etc. is, of course, a question mark at this point. Well, Indigo is the next one we want to focus on. Madhya is here for details. Madhya, morning.
So it's a major relief, for airlines, especially Indigo, that operates flights on the Delhi-Mumbai route. Why? Because Delhi also reduced the value-added tax on jet fuel from 25% to 7%, and Maharashtra also reduced a value-added tax from 18% to 7%. Mumbai and Delhi are the key aviation hubs, and VAT coming down to 7% significantly lowers jet fuel costs for carriers. Fuel accounts for nearly 35 to 40% of an airline's operating cost, and as I said, airlines pay 25% in Delhi and 18% in Mumbai. Now, when that is cut down to 7%, it translates into huge savings for airlines. ATF in Mumbai was priced at nearly 98,200 per ton. That comes down to 89,000 per ton, saving roughly 9,000 per ton. In Delhi, ATF prices were earlier around 1,05,000 per ton, now down to 89,800 per ton, saving 15,000 per ton. Now, a typical Airbus A321 operating a Delhi-Mumbai flight burns roughly 4 tons of fuel. At older fuel prices, airlines were spending over 4 lakh rupees on fuel, just fuel on one such flight. With the VAT reductions now in place, airlines could save roughly 60,000 per flight in Delhi and about 36,000 per flight from Mumbai, purely on fuel costs.
Got it. Okay, all right. Thanks a lot for that, Madhya. Well, here's a quick recap of all the top stocks we covered. The ones with positive news flow: Tata Steel, Hindustan Copper, SAIL, Premier Energies, Gland Pharma, Delivery, and Interglobe Aviation. While stocks with negative news flow include the likes of Vodafone Idea, Power Grid, as well as ICICI Pru Life. That's about all the equity market stocks that we're tracking. But let's go across to Manisha Gupta, who's here to tell us what's going on in the commodity markets. Morning, Manisha.
Morning, Nigel. Thank you for that. I'll start with the crude oil prices. We are holding about $111 a barrel right now. This is after statements coming in from the U.S. president saying Tehran is running out of time to secure an agreement. Iran media, in the meanwhile, is reporting that negotiations remain deadlocked and the U.S. is offering no tangible concessions. In addition to that, we also have seen Russia face biggest attack in a year from Ukraine. It also is about U.S.-China two-day summit ending without a concrete progress towards reopening the Strait of Hormuz. What the markets will watch out for in this week is going to be the U.S. Fed meeting minutes. That is going to be in focus. And then you have loads of data coming in from China as well. But while the crude oil prices are trading in the positive, you have gold, which is trading at a 6-week lows. Silver prices fell 8% on Friday, have started this week on a lower note. Copper fell 5% on Friday. It's trading 2% down in the Asian markets right now. So barring energy, most of the other commodities trading in the negative.
All right, Manisha, thank you very much for that. So it's a quick check as far as commodities are concerned. We'll take a break. We have the management of KEC International to discuss their fourth quarter numbers. Stay tuned, coming up. Welcome back. Were you with us here on CNBC TV 18? Well, just a quick look at the GIFT Nifty before we go any further. And I think the focus this morning is, of course, going to remain on what's happening with oil, which is spiking, and GIFT Nifty is down about 100, and of course, what happens to the rupee as well. I mean, actually, the dollar index has remained all well behaved, and people have been asking the question, wondering, well, the dollar's not going up, why is the rupee going down? Well, you've got the dollar, which actually moved up to about 99, past 99 on Friday in the New York session. So at the margin, perhaps there is that element as well. We, of course, blew past 96 and ended just under 96 on Friday. 95.96 is where we finally left off at. Well, the management of KEC is with us. And let's just sort of bring in the management to talk about the numbers. Fourth quarter was impacted by a 450-odd crore rupee collection spillover. Margins fell about 80 basis points due to operating deleverage, leading to a weaker than expected performance. Vimal Kejriwal is MD and CEO of the company. Mr. Kejriwal, good morning. Great to have you with us here. Thanks very much for joining us. So can you just sort of, before we get into the specifics, fourth quarter, just characterize that for us? Was this West Asia, headwinds, execution challenges? And of course, I mean, if you start by telling us, what's the expectation for FY27 revenue growth?
Well, let me just talk about Q4 first. I think we had, I'll say, 2 or 3 major challenges. One was obviously West Asia, and with 25% of our order book from West Asia, there has been a challenge, especially on the supply chain side. Whether it is steel supply or whether other material supply from China or Europe. So we had talked about it earlier also. So roughly, I'll say around 400 crores and odd, or maybe slightly more or less, has been the revenue impact in March itself. And although it's getting under control, but it's still continuing. So that was one major issue. The second issue, which was in India, was on the labor part of it. We had roughly around 30,000 labor, and they are down to 15,000 now. At the peak, they had gone down to 12. A combination of Holi and all that, but I think the biggest impact was on the elections in Assam and Bengal, where all the labor went back, and they are still not yet back. Few of them have come back. So I think we have got 1,000 people coming back. I think that was one major issue which was there. So these two factors sort of combined. And I think the third piece is that Q4 was slightly weak in terms of the India performance also from the transmission. Because if you look at the way the orders were awarded during the whole year, H1, there were quite less order intake in terms of India T&D. And that's why there was a slowdown in H2 a little bit. And secondly, I think with all the discussions on gridlock, what happened was that there was a huge focus on completing existing projects. A lot of resources were diverted towards completion of the existing projects, leaving a little bit less focus on startup of newer projects. I think to me these are the 3 major factors which led to a pretty subdued quarter 4.
Well, just that labor, the numbers, if you can just run us. What is this is for India, right? The labor issue?
This is for India, basically civil. The transmission needs to be added also a little bit, but in the civil, we had roughly around 30,000 people, down to 12 in April, or in fact, starting with March, because March people first went for Holi, then they did not return because of the SIR exercise and the elections. And even today, we are at 15,000 against the requirement of 30. Wow. So if you take an average, I'll say, I don't think that's very representative, but take an average of around 1 lakh rupees per month of revenue out of the labor. 18,000 is straight away 1 into 180 crores.
Yeah. But why is that? Why is this such a big? Is this seasonal in nature?
So it started as seasonal, basically let's say on Holi and all that. Typically people go and then they come back. Holi and Eid combined. But then with the elections and with the entire pressure on voting and your name getting deleted, etc. So everyone went back. You talk to anyone in Mumbai or talk to anyone in Gurgaon, people don't have houses, people don't have security.
Yeah.
So, yeah.
You expect them to come back gradually, but surely? Or
so
maybe...
out of the 18,000 who have gone Mangalam, at least 3 have come back. The promise was that almost all will come back, but they are coming a little bit slower than what was expected. We still have a challenge even in Q1 little bit. I think they are coming back now. 3,000 have come back, as I said earlier.
Right. So in light of all of this, what can you foresee for this particular financial year? Let's break it down into H1 and H2, because H1 will still be fraught with a lot of the uncertainty that we're seeing. There's still no clarity on West Asia. And obviously, with the Prime Minister's comments coming in with regards to, being a lot more responsible with expenditure, etc., do you think that the government, given its current position, will also not up the ante on capex too much, maintain it?
So a couple of things. One is we have an order book of roughly around 37,000 crores and an L1 of 3,000. So I don't see a growth, let's say anything between 10 to 15% growth will definitely be possible for the year. So I think that's for the entire year. Now Q1 will definitely be weaker. I still expect that we may be flat or may have a slight growth. I cannot say today exactly what will happen. But for the year, I think we are very clear that we will at least do 10%, but it could be anything between 10 to 15%, depending how things pan out. That's one thing. Secondly, you talked about government expenditure. So basically, if you look at our order book, we don't have too much of direct exposure to government. There's hardly any major orders from the government or which come from the budget, except for the around 1,000 crores of order book which we have from water. We don't have a direct exposure that way. So I don't think we are directly concerned or would be impacted by government slowing down the capex in any manner.
Right, but not necessarily the government, but the signaling that it does, and as a result of which, it trickles down. But I take your point. You have a fairly comfortable order book, and execution is something that you're fairly confident on, 10 to 15%, give or take a quarter or two. In terms of inflows, what are you targeting this year? And if you could break that up from T&D, from railways, from the civil, which accounts for nearly a third of your overall business right now, and West Asia, where your order book is still 10,000 crore. Do you expect any more orders to come, given the challenges that are right now?
So overall, this year we were around 25,000 and odd crores in order intake. 27, we are expecting around 30,000 crores of orders to come in. Roughly, I don't have the exact break of each business, but roughly T&D is expected to be around 60%. So around, let's give or take 17, 18,000 will come from T&D, and around 7, 8,000 would come from our civil business. And the rest would be divided between, railways, cables, and renewable business. That's a very broad breakup, I'll say, on the order intake. As far as West Asia is concerned, you're right, we have an order book plus L1 of roughly just about 10,000 crores. And today, we have got a large pipeline of tendering, both in all three places. I'll say we are in Saudi. There are continuous tenders coming up. Then there are UAE, again, bids are happening. There's some large interconnections are going to come now, and Oman. So all the three countries, we are seeing a continuous flow of tender pipeline, tenders happening. So I don't think we are factoring in any slowdown in that business today. I think we have to keep in mind a couple of things about West Asia. What we are also seeing is there are going to be, and we already done a couple of, some rehabilitation orders coming in. Then there will be orders for redundancy. We're already hearing that talk of, do they want to build another channel, between Saudi and, let's say, Bahrain. So there will be a lot of these things coming up on the transmission side also. And third is with whatever problems we have seen on fossil, we are clearly seeing a lot more push on the renewable side, which will lead to renewable as well as T&D.
Just two quick numbers before I let you go, Mr. Kejriwal. One is on your tender pipeline. If you could give us, quantify that, what is your West Asia tender pipeline right now? And as a result of which, how much do you expect to win this year? And the second number is on margins. No problem on execution, no problem on orders. But obviously, costs have increased, labor availability is an issue. So all these things would have a negative impact on your margins, given the sort of raw material price inflation that we've seen as well, right? So on your margins for FY27 and the tender pipeline that you have for West Asia, two numbers.
West Asia, I think it's around 25 to 30,000. 30,000 crores is a tender pipeline today. When I say today, it's for the tenders which we have to quote in the next couple of months. I'm not talking about the annual pipeline. That's number one. Margins to me today, honestly, is very difficult to quantify. Very, very honestly, today, difficult to quantify. We are in touch with most of our clients, especially on West Asia, where the costs are going up. India, so we are receiving positive responses. I don't think we have received a confirmation of any one of them as of now, but they are willing to help you on cash flow. They're looking at it. It also depends upon what sort of force majeure clauses you have in your agreement with them. Labor cost in India is going to be a bit of a challenge because that is not typically not passed through except when tenders are linked to WPI. So wherever they are WPI, etc., you'll get a pass-through in cost. But otherwise, there could be some impact of the labor costs on your margins, definitely.
A couple of 100 basis points?
No, not that much. I see, if you look at a typical civil project for me, labor would be around 10 to 12% of my total project cost. Okay.
All right, take that point. Thanks a lot. That's given us enough to think about and ponder on as we move forward as well. Always a pleasure speaking with you. With that,
thank you, Manglam.
Let's welcome Dharmesh Kant, Head of Research, Chola Securities. Dharmesh, you heard the management of KEC International on T&D, on CapEx, and all these companies. What do you foresee as the opportunity from here on in terms of order wins, in terms of margins, the labor availability, and are there any investable ideas which look compelling at this point in time?
Good morning, Manglam. Thanks for having me for the show. I mean, whatever I heard was more of a concern on FY27, be it, input cost or the labor cost and execution and the orders. So everywhere it was a caution given by the management. I mean, he was not willing to put a number onto the growth guidance, and it was a hopeful growth guidance of 10 to 15%. So it's again a very vague and a wide range of guidance which has been given. So what I expect is once the price correction happens, the valuation comes into a radar of say 25, 27 times 1 year forward PE multiple. From there, a call can be taken. But this year, as the situations prolong and get extended, is likely to be a tough year. And secondly, during the onset of monsoon, most of the labor problem won't be, coming back because they stay back for cultivation and sowing. So this problem is likely to continue into Q1. So Q1, avoid all such companies, wait for the price correction and more clarity to emerge before taking a call on these products. And copper prices, Nigel has been repeatedly pointing out, it's still towards the sky high. 51% kind of a price appreciation happened in copper in CY25 and year till date, both put together.
Got it. Okay, all right. Hi, Dharmesh. Good to hear that you're tracking my commentary on copper as well, and hopefully we get the management of Hindustan Copper, to understand what's the way ahead. Let's talk about a couple of other stocks. Vodafone Idea, the stock has seen a big pop-up in the last few days. Now the fundraise has been announced, maybe short of some estimates. What are you making of it?
Yeah, I mean, it's a mixed kind of a set of numbers which was given by Vodafone Idea. But the silver lining has been, one is there has been upliftment in the outpost. 174 they have gone to in a challenging environment where the Geo platforms and Bharti was unable to lift that despite of our data usage growth. The second good point where the headroom is there, per user GB data per month is around 20.3 or 5 GB for Vodafone Idea, whereas Reliance does 42.3 GB per month per person. So there's they are 50% lower than the usage of GB. As 5G rolls out, I mean 17 circles they have already been rolling out, and ease on the financial burden, they will be able to roll out more products like OTT and the other players. So this will give them a leeway on the output side. So it may touch, even if it touches 200, they are better off. And this quarter numbers, if you look at closely, the operating profit was almost at same levels as the interest cost burden. So that takes care of the cash flow to a larger extent. So to my mind, if you are willing to take a bet on Vodafone Idea for say 3-4 years, and I mean survival is definitely guaranteed for this company. So this fundraise and more product rollouts will see value appreciation coming in. So if you're long term, you're willing to take that chance, then definitely 10, 11 rupees or 9 rupees is a good price point to get an entry into Vodafone Idea.
All right, take that point, Dharmesh. Just take a short break, come back. We'll continue our conversation with you. And also we have with us Mitesh Thakkar and Sudarshan Sukhani for technical trades as usual. Stay with us.
Welcome back. You're tuned into Bazar Morning Call. Well, we are bracing for a bit of a soft start. Crude oil prices are elevated, bond yields as well as spiked up, and the dollar index is stronger. Not a great combination for Indian markets, but let's see how that goes. For the time being, let's hop across to Hormuz. He's joining us to tell us some of those big movers on Friday and some of them that were backed by delivery. Hormuz, morning.
Morning, Nigel. And earnings reactions have been the ones that have been on the extreme all through last week. And Muthoot Finance was one such name among the top F&O losers on Friday. The stock was down almost 6.5%. It was the biggest single-day fall and volumes for the stock in the last 3 months. And in fact, the stock has been underperforming. It's down in 4 out of the last 6 trading sessions. On Friday, we had over 50 lakh shares that were traded. That is 8 times its 20-day average. And 40% of those shares are marked for delivery. So even on the delivery front, the total delivery volumes of 20 lakh shares, which is almost 7 times its 20-day average as well. It was among the most traded Nifty 500 stocks on Friday and down almost 20% from its 52-week high, which is well over 4,000 rupees. Now, Saregama has been one name that has been continuing to surge higher after its results that were reported last week. The stock is up almost 25% in the last 2 sessions. In fact, Friday's volumes were double that of Thursday. The stock had seen double-digit gains on Thursday and followed that up with a, say, 8% up move on Friday as well. But the volumes on Friday were double. Close to 10 crore shares were traded, the highest on record. The 20-day average is only 22.5 lakh shares. Only 3.5% of those were marked for delivery, of course, because of the large elevated volumes as well. So 33 lakh shares for delivery. The 20-day average is only 2.5 lakh shares. In fact, it was the most traded stock on the Nifty 500 on Friday, and the turnover of over 4,000 crore rupees was well above its free float market cap as well for Saregama. And lastly, Welspun Living, similar to Muthoot, but on the positive side, gaining the most and volumes in the last 3 months. A positive reaction to its results. Over 1 crore shares were traded, 5x its 20-day average. A third of those were marked for delivery, so 33.5 lakh shares traded. Here too, almost 5x of the delivery volumes as well on the 20-day average front. And the stock has been up almost 12-13% in the last 1 month, as a result of which it has turned positive on a year-to-date basis as well.
Okay, all right. Thanks a lot for that, Hormuz. Well, let's go across to Ekta. She's here to tell us a little bit about Dr. Reddy's as they've launched semaglutide in Canada. Morning, Ekta.
Morning. Well, yes, the big launch has taken place. They've launched semaglutide in Canada. It is estimated to be a $120 million opportunity for them. The market is expected to remain largely 3 players for the next few months. So this includes Novo Nordisk, which is basically the innovator of the drug, as well as 2 generic players, including Dr. Reddy's. Remember that the Canadian market is split broadly into public, private and cash markets equally. And the healthy launch volumes are expected despite pricing pressure, as per analysts. So for the first 2 quarters at least, Dr. Reddy should be making a good amount of money coming in from the Canadian markets and the semaglutide launch, according to analysts. Now, OneSource would also be in focus because they are the sole supplier to Dr. Reddy's for semaglutide in Canada, and they are also the suppliers to the second company which is slated to launch the generic version of semaglutide in Canada. So that stock would continue to be in focus.
All right. Thanks a lot for that, Ekta. We still have Dharmesh Kant with us. Dharmesh, what's your thought on the pharma space? Because it's been outperforming and, the street believes that better for pharma is ahead of us. And now that in absence of, IT being a strong mover with a weaker rupee, it also acts as a beneficiary of a weaker rupee, the pharmaceutical space. Do you think there are better opportunities here, even after the outperformance that we've seen in some of the stocks?
I think it's more of our trade which is there for the pharma sector. But I mean, it's the other sector which exports around 60 to 70% of the products overseas. And definitely the currency tailwind will play to their favor. But we were looking at aggregate numbers for Q4. There we are seeing a degrowth of 3 to 5%. So on aggregate basis, there has been a degrowth. But individual, there are stocks where things can look, on the brighter side. And to my mind, too much has been made about semaglutide, medicine. There are so many competitors out there. So eventually, down the line, 3 quarters, 4 quarters, it will be more of a rationalization and return to mean levels for most of the companies. So not very gung-ho about these product launches. But having said that, I mean, one can definitely look at, say, a Lupin, which came out with stellar set of numbers. All 3 quarters were very good, though the stock price did see correction post, numbers were announced. So there's a good opportunity out there, and Aurobindo Pharma. These are the 2 companies where I think the valuations are still, on a comfortable side compared to the numbers which they have been reported, and the currency tailwind plays in the favor. But this is more of a trade to us rather than a structural bull trade.
Just picking out some of the big movers from last week, Dharmesh, hi, morning. Keynes was down 30% Friday to Friday. Pine Labs, there was a big block, 23% down. Kalyan was down 18%. And there was a Torrent Power, which was down 15%. This is all last week. Anything strikes out to you?
Yeah, good morning, Prashant. I mean, see, why this all stock price reaction happened was because of the management guidance, which was revised, quite drastically. If some year back, all these companies were talking about 40-50% kind of a growth playing out, and suddenly it drops to 30% or 25% with a shaky kind of texture to even 25-30% kind of a growth. Plus, the input prices for most of them, like Keynes and all, they have been up. And Keynes, for example, Keynes, they were unable to meet their guidance for Q4. I mean, you guys have highlighted that very strongly out there. So these structural, headwinds are still there. Not very bullish about that. One stock which can, again, this is a chance which one has to take is the Dixon Technologies, though the guidance has been 12 to 15%. If Vivo deal doesn't happen out there. But in case Vivo comes through, then definitely this company will go to 30% kind of a growth trajectory. And then I think the pricing will become more of a palatable kind of a pricing. So Dixon is which we are watching closely. In fact, on decline days, we are recommending our clients to get some buy into that. But structurally, I mean, the entire industry, whatever guidance are coming, we are seeing re-rating on the degrowth side on the growth guidance. So bit careful about that.
All right. We'll take a break here. Thanks very much for that, Dharmesh. Really appreciate your time. It's always good speaking with you. We'll come back with more 2 minutes, by the way, to the pre-open rates on the equity. And of course, the dollar rupee opens up as well. So that in focus. Rakesh Arora of GoIndiaStocks.com joins us on metals. And of course, other stuff as well. Stay tuned, coming up. Okay, welcome back. There's just sort of, starting the day with first rates coming up on the equity and the dollar rupee as well. But look at the dollar rupee first. So 200 points lower. This is in line, about 0.9% down on the, GIFT Nifty. The dollar rupee will come up with the first rates. So 96.1650. So about a 0.25% down to begin today's session, straight up. So that is, I guess, the first indication. I was talking to somebody, just anecdotally, I was talking to somebody in the rupee rate space, and I'm paraphrasing, but pretty much the gist of what he said. He said, well, we've never got so much importance in terms of the attention of the market focused on what's happening on the dollar. In terms of a firm view, is there one? I guess not. In terms of how this is going to play out from here, it's just the global screen which needs to stabilize. But just the focus is immense at this point. 9617. Well, Mitesh Thakkar is with us of Bonanza, and Sudarshan Sukhani is with us with their technical trading ideas. Gentlemen, good morning. Great to have you with us here. Sudarshan, you go first. How are things looking? I think the indicative open is about 100 lower. What are the trades on the index first?
Yeah, good morning. Well, things are not looking good. We went and rallied and then faced significant resistance around 23,800, which was the resistance zone. We have retreated from there, and now world markets are not supportive either. So the chances are that we will look for lower levels. There is a trade in the Nifty. Unfortunately, it's on the short side. Consider taking a short position either by buying puts or selling calls, depends on the trader. But take a short position in the Nifty. The stop is relatively wide at somewhere 23,800, and look for a decline towards 23,300 or 23,200. So there is a short trade. I don't give it often, but today it's there.
Okay, all right. There's a trade on the short side. Interesting one, Sudarshan. Before I could ask you if it's time to be brave, you shut me up. You said, nope, it's time to get short. Either get short or buy puts. Mitesh, what about you? What's your take in terms of the index move? By the way, we're likely to start off with a cut of 150 to 200 points as well. So keep that in mind.
Good morning, guys. So I think on Thursday, since Friday I was not there, Thursday I was talking about buying into some put options given the fact that 23,800 would be a difficult hurdle. And we did get a high of 23,840 on Friday, but we have kind of, failed to sustain above that. My sense is that a retest of 23,350 is definitely a stronger possibility. And in case we start breaking below that, 23,100, 150 is my target. Similar to what Sudarshan gave, I think 100 points lower. So yes, I think, in that sense, I would agree. I think we've already have some kind of put spreads on the Nifty for the May expiry, and therefore the immediate outlook on the index is slightly on the negative side.
Right. Individual stocks, what do we do there? Mitesh, let's start with you first.
Yeah. On the stock side, also in line with the index view, I have more of sell calls. So IRFC is a sell with a stop at 100 half for a target of around 95, 94. Chola Finance is a sell with a stop at 1561 for a target of 1515. And also a sell call on Godrej Properties. Keep a stop about 1740 for the short-term sell trade and look for targets of 1660. And one buy call, that's Dr. Reddy's. I think it's also in the news. But the chart structure is slightly on the positive side. So Dr. Reddy's is a buy with a stop at 1315 for targets of 1380.
Right. Sudarshan?
Well, I have one long call, that is JSW Steel, buy with a stop at 1250. CAMS is a short sell with a stop above 800. CG Power is a short sell with a stop above 850. And Persistent Systems is a short sell with a stop above 4785.
Got it. Okay. All right. Thanks a lot, gentlemen, for giving us your calls. Let's turn the attention then to the metals pack. Rakesh Arora, founder of GoIndiaStocks.com, joins us on the show. Hi, Rakesh. Good morning. Good to see you. Monday morning, the ferrous names have actually done quite well with their results. Tata Steel was good, JSW Steel was good, and SAIL was good. The pick of the pack among them, I think JSPL as well is something that you've been quite optimistic on. So what do you make of the ferrous results? And, besides that, is it time to sell these stocks or buy these stocks? They've already seen a good run.
So, Nigel, good morning. Obviously, all the steel companies have declared very good results and which are beaten expectation. And for Q1 also, steel prices are higher than what was the average for Q4 for these companies. So good results will kind of continue into Q1. But I think Q1 should also mark the peak for the margins for the near term. Valuation-wise, I think there's not too much of room. As you would have noticed that, consensus estimates, though they've tinkered a little bit up and after the results, the target prices haven't really moved much up. So valuation-wise, there's not much to choose from. So I would say that, maybe continue to hold on for another 5-10%, but look to pair around Q1.
Okay, and you'll not initiate a fresh buy. If you have a position, you just hold on.
Nigel, we are at closer to peak margins at the moment. So new position is not really recommended at this level.
Okay, quick word. We just had news that JSW Energy was the one that went ahead and sold some stake in JSW Steel. Sometimes when the promoter entity comes to sell some stake, at that time the street gets a little bit nervous. How would you read this? JSW Steel has been a stock that's been adding capacity really well. Their execution has been par excellence, but the stock trades at the upper end. It's the most expensive among the ferrous names that we discuss. Your view on JSW Steel in particular?
So, Nigel, undoubtedly, JSW Steel has been a star performer over the last, 15 years or so since we have been tracking it.
True.
And even now they have, upgraded their capacity target. So they will continue to, be one of the fastest growing steel company. Also, they are one of the cheapest producers of steel. So despite not having too much of captive iron ore, etc., they are able to do margins which are way better. So undoubtedly, JSW Steel remains one of the top, picks to look at. But as we discussed, margins would be picking out in Q1. So, need to be a little bit cautious on the upside.
Okay, all right. Rakesh, talking about JSW Steel over the many years, I recall, I think around 14 years ago or so, both of us having a cup of coffee at ITC when they did that merger with Ispat. That chat for another day. But what about Tata Steel? Some of these companies, they will see some peaking out in terms of margins. But because Tata Steel has such a large exposure to the European side of things, and now the UK's losses will come down, Netherlands in the near term could have an issue, but there is a bit of a turnaround strategy over there. From losses, probably it starts moving gradually towards the black line or the green line with regard to UK. Will you be a little bit more optimistic on Tata Steel, given their deleveraging plan as well that they have briefly spoken about?
So, Nigel, the European assets have become kind of, immaterial, I would say, from a bigger scheme of things, because Indian capacity has expanded quite a bit. And till the time European assets are converted into, more energy efficient and, away from that blast furnace thing, I don't think there'll be sustainable improvement over there. Seasonally, yes, steel prices are going up, so they would benefit. But they are not really, game changer or, driver of value for Tata Steel in a big way.
Got it. Let's turn our attention then to the non-ferrous part of things. Rakesh, what's your view? Nalco came out with a set of numbers. It was actually a little bit disappointing. I think you all were the ones that were quite optimistic on Vedanta's demerger as well. Let's talk about aluminium first. What are you making of, the recent moves? Because now from that supply side, restrictions, suddenly the street is getting a little bit cautious on demand destruction as well. How do you approach the space? I think Vedanta Aluminium will be listed as well. If you have a rough range that stock gets listed at as well.
So, Nigel, aluminium, definitely it's trading at way beyond its fair value. So the fair value for aluminium is around $2,600. We are closer to $3,600.
Okay.
And as I've been mentioning in my interviews that in second half, there's almost 1 million ton of extra capacity coming up in Indonesia. And over the medium term, when I look at the Chinese aluminum producers are all moved into Indonesia. And in next few years, they are planning 10 to 15 million ton of new aluminum capacity. So I won't be too bullish on aluminum over here. I would rather, recommend to book profits on aluminum stocks at these levels.
Rakesh, hi, morning. I had a macro-ish question to link it to the metals space, right? The one macro trade which, people like Paul Tudor Jones and others, etc., here in India as well, those are the big macro guys have all had it. It was pretty strong belief, at least recently, about a week ago, and I'm sure it's still the same, is that the dollar is headed down. It started a big cycle down. That typically is a pretty constructive environment for metals broadly. Do you believe that, Rakesh?
Yeah, I mean, because all metals trade in dollar, whatever said and done. So, weak dollar leads to better realization for all the, in local currencies. So that is supportive environment. I think the bigger macro picture is AI demand. So that has been the key driver for, base metals over the last year or so. And so that is where, one needs to take a call whether, investments we have will slow down, what is going to happen. And that is going to really drive the valuation, or rather the prices of, more specifically copper from here on.
Okay, got it. Rakesh, we'll leave it there. Thank you very much for joining us. Good speaking with you. And it's a pleasure having you here. Well, I think let's just get the 9:10 calls out of the way. It's 9:11 actually, so maybe a minute late. Sudarshan is back with us. Sudarshan, what do you have?
Well, I have CG Power, which is a sell CG Power with a stop above 850.
Okay, and Mitesh, what about you?
I will choose a sell on IRFC for targets of around 25.
Okay, two cells, CG and IRFC. Gentlemen, thanks very much for that. We want to revisit Vodafone Idea, and Sud is here with exactly that. Sud, morning.
Morning, Prashant. So for Vodafone Idea, two parts. First, talking about the earnings, it was operationally a healthy set of earnings. Company has seen a revenue growth of 2.3% on a sequential basis. Even margin has improved and it has come at 43.1%. Average revenue per user better than the peers. It has seen an improvement of 1% sequentially to rupees 174. Even subscriber loss was just at 0.1 million. That's the lowest loss that company has seen in last 6 years, or say since FY20. The second part is the promoter infusion via convertible warrant. Now promoter is going to infuse around 4,730 crore, and that will be done at rupees 11 per warrant. It's at a discount to current market price, and stock has seen a huge run up over the last few weeks. But analysts believe that this infusion is lower than expected. But following this now, what will be tracked very closely is debt fundraising. If that happens, it will be a huge positive for the company. But for now, it can be a minor negative.
Right. Thanks very much. It's run up quite a bit, right? I mean, so there is that. It started slightly lower in the pre-open session. Let's look at ICICI Pru Life as well. Yash is here to tell us why that is going to be in focus as well. Yash, take it away.
Well, a deal in another insurance company is what is having a negative read-through for ICICI Prudential Life Insurance. First, I'll speak about the deal itself. Prudential PLC has announced acquisition of 75% stake in Bharti Life Insurance. The total amount for this 75% stake would be about 4,200 crore rupees. Prudential PLC transaction will value Bharti Life Insurance at about 5,600 crore rupees. And out of this entire 4,200 crore rupees, 3,500 crore rupees would be paid as an initial cash consideration and 700 crore on fulfillment of certain conditions. As far as the valuation itself is concerned, this transaction will value Bharti AXA Life Insurance at 1.8 times September 2025 EV. As far as Prudential PLC is concerned, it will acquire about 60% of the total 75% stake from Bharti Life Ventures and 15% from 361. Now, why does this have a negative read-through for ICICI Prudential Life Insurance? That's because Prudential PLC owns about 22% stake in ICICI Prudential Life Insurance, and as per regulations, one particular promoter cannot have more than 10% stake in two life insurance companies, which means that to start this new venture with Bharti AXA, Prudential PLC will have to pare down its stake in ICICI Prudential Life Insurance by about 12%. This is worth 9,200 crore rupees, and possibly it will be done through various block deals in coming days. Also, another negative, the bancassurance tie-up with ICICI Prudential has with Standard Chartered PLC, that will also be a key monitorable once Prudential PLC moves out of ICICI Pru Life. Remember, Standard Chartered gets about 5% of the total AP to ICICI Pru Life.
All right, Yash, thanks very much for that. So first rate starting to come up anytime now. 160 down on the Nifty in the pre-open. The Sensex is down about 400. So what do we have? We look at indices, look at the Nifty and how the 50 stocks are starting. And then we'll look deeper as far as individual names in the broader market go. We're down about 0.9, 24,400, 24,430. The Nifty Bank at about 53,100, 53,050. So coming up with some more pressure, 1.2 lower. The mid-cap index is down 1. The small-cap index is also starting with about a 1% cut. So uniform 1% lower across the indices, if you want to look at that. The Nifty 50 heat map will come up, gives you a sense of where we are starting. And should be all down mostly. You got JSW Steel, which is up, Wipro, which is up, Infi, WIP, TCS, and Dr. Reddy's are higher. And the IT index was down 6% week on week last week. So there is a bit of a lift coming through there, but I'm not sure if there's anything beyond that. Power Grid, Tata Steel, Shriram Finance, Adani Ports are stocks which are starting the day down. So it's, overwhelmingly lower this morning. 230 down, about 1% pressure coming through on the Nifty. Mangalam.
Well, if you look at the mid-caps, it's all earnings. If you look at some of the top gainers, we do have Hindustan Copper, as Nigel pointed out, Solar Industries as well, good performance coming in. But look at ICICI Pru Life, 8% lower. Amberent is the other one, which is down about 6%. And we are seeing some decline in delivery, despite a 30% jump in revenues and EBITDA doing well as well. Ekta spoke to us about Gland Pharma. That stock straight off the bat up 10%. And we are seeing, some bit of decline in Crompton Consumer as well. Remember, Yash had broken the story on Friday of a possible deal with Ultratech. That stock currently lower by about 3% post perhaps the management commentary that has come in, reply that has come in on that. Symphony down about 7% on numbers. Bajaj Electrical is down about 6%. And jewelry stocks continue to see a bit of sell-off. PN Gadgil down about 5% as well. All in all, it's a weak day of trade, but look at Godfrey Phillips. There, it was a good set of numbers coming in. 6% volume growth, a lot of price growth, the EBITDA doing well as well. But it will be very interesting to see whether this sustains or not, because one, the stock has already seen a 30% up move in the last 40 days or so. And secondly, the management has said that FY27 will be a lot tougher than FY26, given the steep rise in taxes that we've seen. But by and large, a weak start to trade, earnings-led big moves. 2,000 stocks in the red for about 500 in the green.
Well, that's right, Mangalam. And Vodafone Idea's fundraise doesn't seem to have enthused investors because they were expecting more. So that stock, in fact, is down close to 3.5%. From the broader market, struggling to find a few winners, but I found a few. Finiotex Chemicals, that one has opened up with a gain of close to around 5%. So the numbers, I think, came out there. So that stock, in fact, up and about. Finiotex Chemicals is the one I'm talking about. Cupid as well is mildly higher with some gains out there. The other one that we're looking at is Hindustan Copper. Actually, it's building on some gains, so pretty good because the street is optimistic about this year's numbers. So that one comes up for you on the screen. Plenty of earnings reactions, though, on the downside. Bajaj Electricals is down. Ratna Money Metals as well as lower. Symphony as well as lower. Mangalam had alluded to some of this. VIP, the big turnaround is awaited. For the time being, the stock has opened up on the back foot. That's down close to around 5%. I recall when the stock had deal was announced, the stock was more than 400 rupees, I think, VIP. That's seen a sharp decline. But there are some good, solid winners. Valiant Organics, that stock is up close to around 8%. Volume's not very, very high on that one. Gland Pharma up 10%. Street has taken note of those numbers. And Bodal Chemicals is up close to around 5%. Net, a weak start, but at unexpected lines, going by the kind of cues that you have. Geopolitical tensions and rising crude oil prices. Not the recipe that the bulls were looking forward to.
Okay, well, yeah, it's easier to count what's up rather than what's down at this point. Premier Energies is up about 3%. I think we did mention Gland, right? Gland is up 11%. We'll speak with the management of Solar Industries in just a while. So Solar Industries is up 3% as well. And by the way, Solar has got very large volumes at this point. So it's a 500 to about 3% gain coming through on Solar right now. So actually, Solar doesn't come up like this with volumes, but it's the third largest volume-led gainer on the NSE right now. So that is the picture at this stage. Let's just look at on the downside. I think we've counted most big ones. Keynes, of course, the casualty continues, right? I think over 30% now in the last 6 days, Keynes Tech. So 3170 or so. So just a one-way outflow. Amber is down 6% now. And we've been talking about how MTAR, of course, has been an absolute ripper this year and last year. So it's still up 190%, by the way. It's just that it's pulled back from about 7,700 to about 7,000. So it's lost about 10% from the highs. That's it. But still just a absolute wealth creator starting 2025. Okay, let's welcome in Sanjeev Prasad, who's with us, Managing Director and Co-Head at Kotak Institutional Equities. Sanjeev, good morning. Great to have you with us here. Thanks for joining in. The macro picture, of course, is tough. To your mind, let me just start with what you think can happen. I mean, the government's taken some steps to shore up the rupee. Do you think there is more coming? The street's talking about a lot of stuff. What, to your mind, looks most plausible?
The issue is clearly higher crude oil prices and the resultant negative impact on just about every macroeconomic parameter as far as India is concerned, whether it is current account because of higher crude prices, obviously will have much higher current account deficit. For example, if you look at our own numbers, we're looking at $95 per barrel average now compared to 85, which we're looking at until last week for FY 2027. So that means looking at a current account deficit of 2.5% of GDP, which is about $100 billion. So that's clearly a big negative. The question is, what can the government do to fill this hole? I mean, there's no immediate remedy, right? In the sense, exports cannot go up immediately. Non-oil imports are not going to come down immediately. Capital flows are, extremely weak at this point in time. So there are not too many options left, but to somehow try and curtail demand, which the government has been trying to do through a combination of appeals to the public to reduce consumption in various ways, work from home, etc. And raise prices. That will result in some amount of more judicious consumption, I would assume, of oil. The other pain point is obviously gold imports. As the government has increased import tariffs by 9%. Hopefully, that results in some amount of gold imports coming down. But beyond that, I don't know, honestly, what else can the government do? Because you're beset by extremely tough global environment. The composition of exports, imports cannot change dramatically. So it's a tough one, right? Next steps, ultimately, the government will have to look at, how much can be passed on to the consumer in the form of higher retail oil price of diesel and gasoline, and which can lead to further reduction in some demand. But beyond that, I don't know whether the government look at more harsher measures of, a lot more controls in a way in terms of people taking out money out of the country, etc., etc.
So just two points. One, how much more in terms of price increase are you factoring in, Sanjeev? That is one. And second, not in terms of curbs, but attracting dollars into the country through maybe there was some reporting around maybe a dollar bond issuance through state entities, that kind of thing.
First of all, on the price increase, if you look at the gap between what is required versus where the retail prices are, it is actually pretty high. I mean, if you go by the government on numbers of the fact that the OMCs are losing about now 25,000 crores per month compared to 30,000 crores before the 3 rupees per litre price increase, you have to have a price increase of the order of about 20 rupees per litre. Obviously, that's not going to happen. Doesn't look like, at least in the short term. Maybe half of that, that is what we have assumed for the time being. By end of June, we have taken that assumption, but it's up in the air, right? It's ultimately the government's call, how much it wants to absorb versus how much it wants to pass on to the consumer. So we have taken 10 rupees per litre. Price increase by June, 3 rupees has been done. Now, again, the issue over here is it does impact inflation, right? If you look at the weight of petrol in the CPI basket, 4.5%. So a big increase will result in higher inflation. On top of that, higher diesel prices will lead to higher transportation costs and so on and so forth. So, you have to also be cognizant of the inflation angle. So somewhere the government has to manage between pressure on the fisc versus pressure on inflation and, some pain for the households. It's not an easy task at hand, but obviously the government will have to do the best it can. Coming to other measures, honestly, Prashant, I don't know whether it is such a good idea to be raising money through bonds, etc. at this point in time, for the simple reason it may not be easy to start with. For the simple reason, if you look at the fact that your 2-year GSEC rate in the US, bond rate in the US is about 4% now. 10-year is about 4.5%. You will have to have at least, maybe 2.5-3% premium over that in real terms for money to really come into India. So whether if you want to borrow money at 7% dollar rate, I am not very sure about that. It's pretty expensive proposition. So I think the hope is, this thing is obviously this thing comes to an end pretty quickly and oil supplies start to normalize. But assuming that doesn't play out over the next few weeks, then the government has very little option but to probably raise price a little bit more and hope that demand comes off a little bit more. And release there's some pressure on current account and POP on the one side and fisc and inflation. It's a combination of all the three which will get hit, right?
It's the same logic for like a 2013 style FCNR, right? Because it's too expensive. That's, I'm assuming. I mean,
expensive, and I don't think things are that dire. I mean, at that point in time, obviously the foreign reserves were far worse
Okay.
The economy was far smaller and so on and so forth. So I don't think we need to take such drastic measures. Small, gradual price increase over time, hopefully, will probably address this issue.
Yeah, and the 10 rupee price hike is the total price hike, just to clarify. So 3 is already done. You expect out of the 20 to plug the entire OMC losses, perhaps we will see a total of 10.
That's right, yeah.
Got it.
I mean, that's what we assume. We don't know, to be honest with you. I mean, that's assumption for now. But as I said, you have to manage between the risk, inflation, and how much you want to pass on to the consumer and how much the oil company can absorb, right? Ultimately, there are 3 stakeholders. You have the company, you have the consumers, and you have the government. Between the 3, you will have to, bear the burden ultimately.
So, no, just to get that number correct, because the government had also cut the special additional excise duty by about 10 rupees. 3 rupees has been passed on to the consumer. So that's about 13 rupees, right?
That is after the 10 rupee per day
Got that.
Liter cut in excise duty and all that stuff. Even after that, the oil company is losing roughly about 25,000 crores per month. And if you divide that by the total consumption on a monthly basis, about 12.5 billion liters, you get to about 20 rupees per liter loss, which the oil companies are bearing for now.
So what does the investment environment look like to you right now, given the sort of tough macro environment that we're facing? Because, on the one hand, the government is looking at curbing demand in a way that there would be inflation, etc. The themes that were doing well are not likely to do well going forward, given, again, the rise in prices and as a result of which slowdown in the business in general. Have our valuations begun to reflect that, or there's still further downside from here?
If you look at the overall market, Nifty 50 index price doesn't look too bad. It's about roughly 18.5 times on a 1-year forward basis, which is quite decent. Having said that, there are 2 things you need to keep in mind over here. The first point is that the earnings composition on a 1-year forward basis is looking very different from what used to be historically. A lot of incremental earnings are actually coming from some of the low P sectors like oil and gas for obvious reasons because of higher crude prices. And from metal mining, again, because of higher global metal prices. So that is the challenge, and these are typically low P sectors, I would assume. And second thing is a lot of derating which has happened in the Nifty is also coming from significant derating in the case of the IT sector, the large cap IT sector names. And I assume there's a reason for that. Obviously, all the worries around AI. I am not sure that goes away in a big hurry. And the other segment of the Nifty 50, which has taken a big knock, is the multiples of the private sector banks. Some of it justified, some of it probably not. Obviously, having pressure on NIMs in the last 12 months, given the rate cuts, more competition from the PSU bank. But at least the valuation become a lot more attractive, I would say. But beyond that, if you look at other sectors, like the capital goods, pharmaceuticals, most of the consumer related names, autos, consumer staples, consumer discretionary, etc., there the multiples have hardly derated. So that's how challenging the market. Overall market looks okay, I would say. Not too bad valuations, but it's just coming given the combination of earnings has changed for the worse, I would say, if I can use that term. More coming to low P sectors and also derating in some of the large cap private banks and IT service companies.
Hi, Sanjeev. Good morning. Good to see you. Sanjeev, what about the FIs? Now we have got an additional headwind for us. You've got the macros that are not looking too good. When things were not that bad, they were deserting us, selling lock, stock and barrel. Can something be done to attract them back? Because we have, numerous times over the last, 18 months, we have discussed their holding in India is dipping. The outflows have been, moving up. Is there something that can be done, to convince them that maybe Indian markets could be a better place? What is your take? What are the measures that you would recommend?
Well, ultimately FIs will come here if they expect to make money, right? So yes, valuations have become okay, but as we discussed last time, you have at least on paper far stronger earning growth in most of the other EM markets, whether it is South Korea or Taiwan, all because of the AI-related excitement. and also in, let's say, Brazil because of high commodity prices. So as far as India is concerned, on an absolute basis, it doesn't look too bad, but you have other markets which are trading at far more attractive valuation and far higher earning growth. So I don't know whether anything changes really fairly quickly, in the sense, suddenly people start getting more skeptical of the entire AI trade, which results in more attention coming back to India. So assuming that does not happen, we have to fend for ourselves. Only thing I can think of is maybe some leeway on the capital gains tax as far as foreign investors are concerned. I mean, do keep in mind the fact that India is probably the only major market which actually has a tax on foreign investors. None of the major emerging markets or DMs have actually a tax on foreign investors. Obviously, we have tax on the local investors, or that is capital gains tax. Now, whether India is going to consider that or not, it is obviously the government's prerogative. It is for the government to decide. Can that help? The current environment maybe a little bit, but as I said, the more important thing is, just the sheer excitement around some of the other markets is far higher, and India is getting ignored in the process. Unfortunately, the performance hasn't helped, right? If you look at the calendar year-to-date performance of Indian market, it's down 20% in dollar terms. Again, that MSCI EM is up about 20%, slightly above 20%. And within that, Korea is up 70%. It's like completely insane. Taiwan is up 40%. And you have now, three companies in the MSCI EM index whose combined weight is now 30%, by the way. And India's weight has come down to around 12%. I mean, one company, TSMC, is actually higher weight than India together. So I don't know what is the short-term solution over here. I mean, tax is one thing, but other than that, you only have, for better valuations and, something changing in terms of the narrative, which is currently driving excitement around other market, which is AI and commodities.
The one thing that kept us, our decline limited and has sponged the FII selling is the DII buying. With things looking a little skittish as we look forward, do you think there is a risk that that comes down as well? The incremental sales that institutions have to do could get tougher, and that could provide a further downside risk or open that up?
So far, the retail investor has been very optimistic, bullish in the market. Call it whatever, despite almost now 2 years of pretty much no return, right? If you look at the weighted average NAV of all the equity mutual funds, we have actually gone back to June 24 levels, by the way. So we are pretty much 24 months no return. If you look at the NAV of small cap and thematic sectors, mutual fund that is, we are down significantly. Only the mid cap segment does slightly better. But despite that, the retail investor is still positive, which is a good sign in the sense, from a market perspective, that is. But the important thing is how long will they keep faith in the market, which has given them hardly the returns in the last 2 years now. If you look at the other way, that is the SIP returns on XIRR basis, the returns have been pretty mediocre since, I would say, now middle of 2023, by the way. If you have consistently put money in the market all the way from middle of 2023, your returns would have been sub 5%, by the way. Huh? But having said that, the retail investor is still bullish. So let's hope you see a quick resolution of the Iran-US West Asia war before the retail investor starts to get more worried.
Yeah. So basically just wait it out, right, Sanjeev? There's no other way. As you began by saying, no easy, quick remedies to correct the situation at this point. Any initiations or anything, Sanjeev, which really stands out like a shining star? Otherwise.
So what? Stock, you're saying?
Yeah, stock.
Not at this point in time. I mean, there are always ideas you can look at, but it's a tough market.
They say ideas, good ideas, and they come from the depths of despair, right, Sanjeev? So, but it's got to be matched with low valuations, which I think, as you would agree, has not happened, not to the extent that you would like or anyone would like.
See, it is there, and I would say some of the large cap space actually. Some of the private banks are actually looking very decent. HDFC Bank, let's say if you take out the value of the non-bank business, is about 1.6, 1.7 times. ICICI Bank itself is down to about probably low 2.1 or so. Tax is about 1.6. So the valuation-wise, they are looking pretty decent. Obviously, the concern here is that, if the war were to continue for long, then credit growth and credit cost both could, turn marginally negative compared to the current pretty decent situation. But if it's a short conflict, then I don't see any reason why any of the parameters of the bank should deteriorate significantly.
Yeah.
Beyond that, to be honest with you, we have to be very, stock specific, I would say, more look at the very bottom of ideas. And at this point in time, I'm actually quite okay with, let's say, the telecom sector, some of the pharma names. Slightly more, I would say, defensive tilt, where there is maybe some downside protection, but assuming things continue to be fine for those sectors, the upside is actually still pretty reasonable for like a Bharti or Indus Tower, Pharma like a Cipla. Yeah, so you can still find some ideas here and there, but it is honestly a bit of a struggle.
Okay, all right, Sanjeev, always a pleasure hearing your thoughts. Things a little bit jittery as of now. Hopefully the next time you join, well, things will be a little bit improved, both on the macros as well as for the Indian.
Fingers crossed, yeah.
Lovely. That's all we can do. Live in hope. Thanks, Sanjeev. Well, let's move on, though. Let's talk about solar industries. It reported actually a good set of numbers. It was a beat on all fronts, and even the guidance looks pretty good. To discuss this and more, we're joined by Mr. Manish Nuwal, the MD and CEO at Solar Industries India. Well, Mr. Nuwal, good morning, and thanks a lot for joining in. First of all, congratulations to the founders of the company. I believe earlier this year or a few months ago, you all were conferred with the Padma Shri Award. So congratulations to you, and the entire family as well as the team at Solar Industries. That said, let's focus on the way ahead. 14,000 crores of revenue guidance bifurcated for us. How much of that will be, international defense as well as domestic defense? If you could break that up for us. Other businesses as well as explosives. So just give us some color on that front, because we have that 14,000 crore number. For defense, on the whole, we have it as around 4,500 crores. But split it up for us between international as well as domestic.
Yeah. So out of total 14,000 crores, we are expecting that international business should grow by around 35% and should cross 5,000 crore revenue mark. And at the same time, domestic should also do better. And the growth rate will be around 35%. As far as defense is concerned, we have given a guidance that this year we should cross the revenue by, say, around 4,500 crores. And out of that, around 70% will be for the international markets.
Got it. Okay. All right. Got that. Thanks for clarifying on that, Mr. Nuwal. Now, Coal India, they put out a release that ammonium nitrate prices have moved up. So explosives cost of production will move up as well. Will this impact your cost? Because that will be an input for you, right? And margins as well. Also, if you could help us out, what is the duration of the pass-through of these higher input costs for you? And how does it compare with in the past?
So if you remember a couple of years back when the commodity cycle started moving up significantly, so we were getting suffered because of this price rise. But of late, because of the new changes in the contractual terms, the escalation is now on monthly basis. So whatever price increase will happen in ammonium nitrate, it will be passed on to the customers. So by and large, most of the customers have that kind of contractual terms.
So it's now monthly. Earlier it was what, quarterly or 6 monthly?
Yeah, it was earlier quarterly basis. Now it is monthly. And in this special situation, we have requested and the customers have agreed to pass on either increase or decrease on 15 days basis. So we are not very much impacted at the moment.
Right. So Mr. Nuwal, just to confirm all that you earlier said, your margins at this 26-27% band continue, right?
Yeah, like last year, we have achieved around 27%. And in this financial year, we just ended at around 28%. We expect that because of the improved defense business and international as well, we expect these margins to continue even at these elevated numbers.
So 28% sustains, right?
Yeah.
Okay. And this 35% revenue growth that you've guided for, nearly half of that comes in from volumes and the other half comes in from prices.
Yeah, we have given a guidance that this year we should grow by 40%, which is around, say, 14,000 crores. And mainly the growth is coming from defense. As far as explosive market is concerned, around 20% to 22% should come from price rise, and around 15% should come from the volume. So it can vary by 2-3%. So by and large, explosive business should grow by 35%. And defense, we have already given a guidance, should grow up by 70% in the coming year.
Right. That's basis the orders that you have on hand and the execution that you've planned. Mr. Nuwal, you know, a large part of the defense business obviously will be supported by the Pinaka as well. But I just wanted to understand the Bhargavastra, which is currently under trials. Were that to come, how big an opportunity would this be for you, and by when do you expect this?
So like we have been shared on various platforms as we are developing this product, and this can be a game changer for our company, and definitely will help the security, providing security solution for our country. So it's in development stage. We are expecting that in this year, we should complete all the trials and development related to this product. As far as opportunity is concerned, it is too early to speak on the number side, but definitely it will be a big boost for our company's performance.
Would it be as big as Pinaka, bigger than Pinaka? We just wanted to understand because...
So whatever estimation we can do at this stage will definitely fall short, but it will be definitely bigger than Pinaka as we move forward.
So, got it. Mr. Nuwal, good morning. The field trials you'll complete this year.
Yeah,
that is
we should
FY27.
we are expecting the trials to complete in this year. So the commercial run should start from either next financial year, maybe defer by 5-6 months. So in defense program, development cycle, whatever we have achieved is quite fast. And in next 2 years, we should reach to the commercialization stage.
Okay, and you don't want to put a number to it in terms of any indication that you have, you know?
It's too early to give any number, but like I said, it will be bigger than Pinaka program for us.
Okay, so that's the headline. It's bigger than the Pinaka program for you in terms of the ordering you expect. For those who don't know, the Bhargavastra essentially is like it's a multi-layer micro missile anti-drone system, right?
Yes.
Which is, I mean, so we are dependent on Russia for some of their systems. So this kind of is a replacement to that?
It is too early to speak on these sensitive issues on these platforms, but definitely this product will provide a good defense mechanism, defense product for our security solutions. So let us wait for some more time. We will speak more on this as we move forward. So our aim is at this moment is to complete the trials. So that is what we are focusing at this stage.
So what is the Pinaka size for you annually right now? I mean, just
as of now, it's around 500 to 550 crores on annual basis. And one of the product under the same family is guided Pinaka rocket. We have participated in the RFP, and we expect orders in this financial year. So that will also help us to do a revenue of around 700 to 800 crores on annual basis from the next financial year.
Okay, and you're saying this is going to be bigger than that. So that's the expectation.
It's too early, but definitely it will be as big as Pinaka.
All right, Mr. Nuwal, you have generated a lot of wealth for investors as well, but the street will like to know what is the next course of action, right? I recall when you all started this defense business, it was very small, and now you're talking about 4,500 crores. Is there a particular scale where you'll maybe want to list this entity separately, the defense vertical? Is that a thought that's come to your mind at some scale?
We have not put thought to this direction, but as we move forward, if it is required and if it creates wealth for our stakeholders, definitely we will look towards that.
Any scale you have in mind, 10,000 crores or something?
No scale at this moment.
Okay, let's clear out a couple of other issues then. Premier Explosives, that's another small company. I believe that it's in the market. I recall many years ago, I think one of the Nuwal family members had bought a small stake in the company at maybe more than 10 years, 12 years ago, if I'm not mistaken. There's reports that suggested that Premier Explosives is on the block. Are you interested?
So like I said, we have already migrated from a simple explosive company to the energetic company. Now we are developing platforms on our own. So our capital allocation strategy, whatever we have made, is adopting new technologies, creating more platform-based product at this moment. So we are very much focused on these initiatives.
So you're not interested in Premier Explosives as of now. Is that a clarification?
I can't say that, but definitely our focus is towards creating platforms, new products on our own.
But you do have a 2,000 crore rupee capex plan, and you've acquired a company in northern India to strengthen your footprint also. So obviously, when all these things are happening and you are growing, this would make sense, right? I mean, you have cash on the books. You obviously have capex plans. You have growth ideas.
So let's see. We will come back on this later.
Is the valuation a problem?
I can't comment on this.
Okay. So we've gone on for a goodish bit about this. One final question from my end. For last year, I think you've done around 1,800 crores of net profit. Various brokerages believe that FY29, this profit number will more than double towards 3,900 to around 4,000 crores. Going by the pipeline, going by the way you're evolving the business, do you think it's gettable from around 1,800 crores of net profit? You move closer to around 4,000 crores by FY29.
So there are a couple of things on this point. First, like we have already given guidance that in the coming year, we should grow by plus 40%. And definitely margins will be in the same level. And if we maintain a growth of around 25% year on year, definitely we are not far off from these numbers.
Okay. All right. We'll leave it there. Thank you very much. Good speaking with you. And you know, the solar industry stock, I would normally say it's gone to the moon, but in this case, it's gone to the sun. 40% this year. And so it's absolutely been unbothered by what's happening elsewhere in the markets, etc. So it's done absolutely phenomenally well. We'll take a quick break. The management of Medanta, the hospital company, with us on the other side, the quarter gone by and the outlook as well. Stay tuned. Coming up. Welcome back. The market's looking tough, but I'll tell you what, the companies that we have on our program today, but you just heard from solar industries. I mean, they're largely in the, not largely, but about 35% defense. It's a company which has done phenomenally well, stock which has done phenomenally well. The next company is a hospital company, also largely unaffected by all of the tough macros, etc., secular kind of growth. So I'm talking about Medanta, and they reported a strong set of fourth quarter numbers. Revenues have seen a robust Y-on-Y growth with highest ever quarterly total income of about nearly 1,200 odd crores. Margins softened a little bit during the quarter. Naresh Trehan is Chairman and Managing Director of the company. Pankaj Sahni is Group CEO of the company as well. Mr. Trehan, Mr. Sahni, thank you very much for joining us. Great speaking with both of you here. Dr. Trehan, if I can start by asking you, sir. By the way, I see an upgrade from JP Morgan this morning, the JP Morgan analyst this morning on Medanta, on the back of the numbers. And their thesis is that, the next couple of years is going to be about sweating your assets which you've built out and not so much about setting up new hospitals. All of that has been pushed out to FY30 and beyond. So, Dr. Trehan, if I can start by asking you, sir, let's start with the Noida asset. Could you give us a sense of, when will that start to show numbers for you? When will you break even? And then go on to some of the other big hospitals.
So you see, what's happened in Noida is that we started only two quarters before, and the losses have taken a dramatic downturn in the sense that we are doing very well now. And we are anticipating that by the end of the next two quarters, we'll turn positive. So the growth rate is quite good. The traction is in the community is very good. The patient load is increasing by the day. So we don't have any anxiety about the fact that how successful it'll be. I think it's needed there. The quality that we have, by the benchmark that I want to tell you about is that 7 years in a row, we have been declared as the best private hospital in India by Newsweek International, which does a survey of 28 countries. Not only that, we are in the first 150 hospitals of the world. So we have stuck to quality. We have stuck to our integrity. We have stuck to the patient care. And that's basically our USP, that wherever we are rolling out, we are doing it with the same ethos, with the same quality of care that patients will get. So we have no anxiety about how well Noida is going to do.
And so you're essentially saying by the second half of this financial year, it'll break even. Losses have come off significantly, and the ramp up thereafter. And will you go to the 20% plus kind of margins, EBITDA margins, by when?
By end of the year or mid next year, next financial years, we would hit those numbers. I have no doubt about that.
Okay.
We have a very, very robust set of doctors who are extremely experienced, top of the pile, and so there's no anxiety as far as we are concerned.
Right. Dr. Trehan, I have a slightly broader question here, and this is emanating from a lot of the research that was done in developed markets where a lot of investment, financial investment went into hospitals, etc. The cost cutting that took place for companies to generate that sort of return did eventually result in some sort of decline in the care for patients. Do you think that cycle may come about in India as well, given that a lot of PE investment has got into this place at higher valuations? So to justify returns, there would be cost cutting which would be done, and that may at some point start impacting patient care?
So you please understand, Medanta's philosophy and our way of doing work is totally related to the highest end of care that a patient can get anywhere in the world. We always have stuck by quality, and the mantra is very clear. If you are the highest value that you can provide in your services at the reasonable cost with the best results, no matter what happens, patients will seek you, and you don't have to cut costs, you don't have to cut corners. And that way, the patient is your main focus. The focus is not the bottom line. But the bottom line comes very, very healthy if you take care of patients. For a long time, I've had the belief, if you take care of the patients well, with the latest technology, with respect and affordability, they'll break the door down to get to you. So there is no question that if you stick to quality, you'll do well. if you are indulging in activities which are like related to cost cutting, quality not being your prime goal, then you may have problems. So I don't think that there is any reason to have anxiety for us, because our core values are the same, and we will stick to it.
Yeah, no, that was the question was not for you, but I mean, as an industry and what's happening there. Mr. Sani, if I can come to you now, there were regulations recently, right? I mean, in terms of the height restrictions on hospitals perhaps being removed, and you can sort of build higher. Is that expected to have are there implications for capacity addition for you at Medanta? Mr. Sani, can you hear me? Well, I don't think he can hear at all.
No, sorry.
Dr. Trayan, you want to take that, if you heard me?
Yes, I will answer that question. So what has happened is, in the NBCC code, you could build up to 45 meters for hospitals and only put critical care and patient services up to 30 meters. Rightfully so, the code has been reworked to say you can go up to 60 meters and your patient services can be up to 45 meters, so that this leads us to be able to increase capacity in our projects that are coming up. And we always have this whole plan to optimize the kind of technology that we put in. If you can amortize it over a larger patient base, it actually brings your cost down. It increases your efficiency. It increases the ability of the patient to get prompt services, and it also obviates the need of cutting costs because you amortize it over a larger base.
Yeah. So
it helps. Definitely helps.
It definitely helps. But too early to kind of tell us if this is, in your, are you going to be sort of using this straight away? I mean, now that the code has changed, say, for example, in Gurgaon or elsewhere?
Of course. No, Gurgaon is already 60 meters.
Yeah.
But now, as you know, we have 4 greenfield sort of hospitals coming up, which you know about, one being Varanasi, the other being Guwahati, there is in Delhi and also Mumbai. So all these, the replanning of all these hospitals is being done as we speak, because it only increases the efficiency of these projects that are coming out of the ground now. So it will help, most definitely. It will also improve our ability to provide the services to a larger base of patients. Right. So, as you know, we have an aging population. We do have demands going up, although we are making efficiency more and more the core of how you serve the patients. And also the fact that with the newer technologies, the patients can be served better with less invasive procedures, and that is where the growth is coming for all of us.
So when you Dr. Trayan, when you replan across 4 hospitals, in terms of just say bed additions, what are we looking at now with these changes compared to earlier? Because you said you will replan with these relaxations which have come in.
So we will have, like we are about 3,600 beds today. In the next less than 4 years, I would say, we will be close to 7,000 beds. So it does help us to add another 600-700 beds that were what we were planning according to the old rules. So this will help, and then we have many other areas that we are looking at. So it will help to provide the services at a lower price point to the people because of the efficiency that will increase in building more number of beds and spreading the cost over very expensive equipment. As you know what's happened to the dollar.
Right. We take that point. Thanks a lot, Dr. Trihan, for joining in. Mrs. Sani as well. Unfortunately, we couldn't speak to you because of the audio issue, but wish you all a very good luck for the expansion plan and the path that you're on. And regulatory changes obviously helping you increase your beds by about 600 to 700 as against earlier anticipated. But let's address the news of the morning. JSW Energy has sold stake in JSW Steel, which is a CNBC TV18 news break, which is confirmed 2.5 crore shares via a bulk deal. Sharath Mahindra, who's a joint managing director and CEO at JSW Energy, joins in. Thanks a lot, Sharath, for joining in. 2.5 crore shares. Can you, tell us why exactly did you do so? Because this gives you a gross proceed of close to around 3,150 crores. Is it because of debt reduction, or is it because you wanted to, raise some cash for your own capex? If you could give us a sense, the rationale, and are there any other assets that in the coming days we could see you monetize?
Thanks. Yes, see, it has multiple reasons. This is basically a strategic disinvestment. Actually, this value, our holdings in JSW Steel shares are sitting in our net worth for quite some time, which has not been giving the returns except the dividend. So actually, sale of our shares in JSW Steel actually provides us the capital and which will pursue to our growth plans, and also to ensure that improved return on capital employed for us going forward. And also actually this will result definitely in the debt reduction also. When we closed the year, the debt level, the debt was in excess of 68,000 crores. This reduces by, which improves our debt to EBITDA numbers also by more than 30 basis points, which brings us more comfort and gives us a headroom to continue at the momentum, our growth momentum.
30 basis points is not a big move, right? I mean, your net debt was close to around 64,000 crores. You assume that net proceeds from this, X of taxes, etc., gross proceeds is close to 3,150 crores. Net proceeds would be to the tune of anywhere between 1,800 to 2,100 crores. That still doesn't move the needle much, right? What are the further debt repayment plans?
See, the thing is, we are right now, when we ended the year, if you see our net debt to EBITDA at about 5.96 number, and if we remove the construction work in progress related debt, we are at a comfortable level of 5.2. That is how the rating agencies also see that the work in progress, which is the debt related, is going to give the returns once the project gets commissioned and capitalized. So we are comfortable, but yes, as we have earlier said also, going forward, continuing the growth momentum, and by FY30, to this ratio to be, including the construction work in related debt, to be debt to EBITDA levels of 5, which is a comfortable level which we feel in an industry which is 3:1 debt to equity business, wherein you have to maintain the growth momentum.
Right.
So we feel that this proceeds which we have generated will definitely give us a comfort, and the leverage will definitely be down.
All right. And any other quoted, unquoted assets, investments, non-core investments that you have, which you believe you will monetize over the next few days?
Not really. Nothing. We don't have.
All right. And you spoke about growth, right? But there are still a lot of concerns around renewable energy, capacity addition, timelines. What is the quantum of capacity additions that you've targeted in FY27?
Yeah, before we start, we see that we started the year FY26, which ended at about 10.8 gigawatt, and we ended the year at about 13.4 gigawatt, adding about 2.6 gigawatt, both organic and inorganic. And this entire growth was in the renewable energy space. 1.3 gigawatt through acquisition, and 1.3 were our own greenfield projects which got commissioned, which are available for the FY27. In FY27 also, we have started the year well. We just informed the market 2 days back that in first 40 days, we have added 250 megawatt of capacity, which is all RE capacity, wind and solar combined. And we will continue this, and we are looking for a capacity addition in the current year, FY27, of almost 3 gigawatt.
And, you did speak about no further sale of assets, but you still want to improve your debt position or your net debt position. A part of that could also be through fundraise. And you have, perhaps an enabling provision for a QIP. Do you have the timeline on that? Is there an update on it?
No, we are evaluating. That is the reason in January we have taken the board approval and the shareholder approval for raising funds up to 10,000 crores through various means. So we are evaluating. But right now, if you see that we started the year with almost 10,000 crores of cash with us. So we are comfortable to continue the capacity addition what we have planned in the year. But yes, we evaluate the market, and when we feel the timing is right, we will definitely be coming for the fundraise.
Sorry, the board resolution lasts for a year, right? If I remember correctly.
Yes,
so
correct.
By when do you, decide on whether you want to raise this or not?
See, this is the approval which we have is till this December 26.
Right.
So maybe prior to that, and in case we feel we don't need, then we can definitely go back to the board and take the extension. But we are evaluating before December, whenever the market is right and when the needs are there, we'll definitely be, we are looking seriously on this.
Where do you feel, you should be? I mean, do you think you will raise it, or do you think you will extend it? The reason why I ask is not because whether you need the money or not, because also the market is a little iffy right now, right? So for the same 10,000 crore, you'll have to give a lot more equity than what you would have to if the market was in a better position.
Yes, see, the thing is, definitely, as we see that we have given the guidance of reaching net debt to EBITDA of almost 5, and we know that we are right now, after this bulk sale of JSW Steel shares, we are still in the range of 5.67, 5.68. So we feel that there is definitely a room where we are working on to further go downward and without compromising on the growth momentum. So definitely we are looking for the right timing, and as I have indicated that maybe before December, we are definitely looking for a fundraise.
Right. Thank you for joining us, Mr. Mahendra. Prashant here. I just had a more basic kind of sort of I'm just pulling back a little bit and looking at the bigger picture here. So it's for you, sir, in terms of the fuel mix, how much is thermal?
See, as I told you that in terms of capacity, we see that 13.5 gigawatt capacity. Now, in fact, when we have added another 250, so close to about 13.7, 13.8 gigawatt, 5.7 gigawatt is thermal capacity in terms of the megawatt capacity. But in terms of generation, if you see, it is still about close to about 50-50 generation because of the lower plant load factor in the RE space.
And in RE, it is what is the mix in RE?
In RE, the mix is that we have hydro power also. We had just commissioned on 7th May first unit of 50 megawatt. Including that, we are close to 1.7 gigawatt and about 6.1 gigawatt of wind and wind-solar hybrid all put together.
I see. The question I had essentially, Mr. Mahendra, is, and this is not about you, but basically for anyone who operates coal-based power plants, right? There's a bit of a mismatch here. Not mismatch, I mean, I guess everybody goes through the same, other countries will also go. We have a lot of renewable capacity, solar especially, which is coming up, right? I think about 155, 160 gigawatts already there. More is being added rapidly. So daytime, even now, when you see daytime demands peaking, right? The peak during the day hitting new highs, etc. It's not a problem because there is so much renewable. But the point is, we don't have battery to store that power in the evening. So evening you need coal, evening you need thermal for base load.
Yes.
So how is that? And then at some point there'll be enough battery capacity, etc., which will come up. So what is essentially going to happen to the coal-based power plants? I mean, in the interim as well, because you can't shut down coal plants during the day and then operate them during the night. So there is that transition mismatch, whatever you want to call it. Yeah.
Yes, this is very correct. We are seeing that when the solar peak is there, the generation between say around 11:30 during the daytime till about 3:30, the solar is at its peak. When we have also witnessed last year, the industry has faced grid curtailment also. But thermal is brought to technical minimum in most of the cases to maintain the grid frequency. But that doesn't impact in terms of the revenue and all for all the companies who have a long-term power purchase agreement where the fixed cost is given based on the plant availability. But yes, we at JSW, knowing that this kind of situation will arise going forward. About 2 years back, we had done the modifications in our thermal plants to even reduce the technical minimum, which generally is said to be 55%, to bring it to even lower levels without compromising on the health of the equipment and the efficiencies. So we going forward, definitely we see, but as you have said, regarding battery energy storage, definitely that quantum has to come to take care of the evening peaks, wherein we are now seeing new peaks coming in and going forward also with almost 5% growth expected. If that continues, there is going to be even increased requirement during peak hours. So battery will take care, but we have to remember that thermal will be the most reliable round-the-clock power supply, because battery can give continuous discharge for maybe 2 hours or 4 hours. Beyond that, it is not, the economics are not favorable. So thermal as the reliable power, with country focusing now on AI data centers, where in reliability is extremely important. So thermal growth story will definitely be there.
All right, that's an interesting explanation in terms of how you're doing it. You've done it 2 years back, brought down the minimum threshold for where you operate these plants at during the day from under 55%. So that's how you're managing it. But it's an interesting space and lots of interest. Thank you very much, Mr. Mahindra, for joining us. Really appreciate your time here on CNBC TV 18. We'll take a break. We're back. Manisha Gupta on commodities and what's happening there. Stay tuned.
It continues to tread lower for the market. Is there anything in the commodity space which is worrying us right now? 100%. It is oil, which is $111 per barrel as we speak right now. Manisha joins in with a roundup of all things commodities.
Well, thank you so much for that. Well, yes, the only thing that has been trading on the higher side has been the crude oil prices. 8% of gains in the previous week, and we are trading a couple of percentage points higher in the Asian markets right now. But I would want to focus on silver as well, because remember, too many policy measures coming in from the government that has been keeping the traders, investors, and the silver industry in India quite on edge. This is, by the way, what we've done in sense of prices. So overnight has been a very strong decline that we've seen come in for silver, 8% of a cut on Friday. We've seen nearly 6% of a decline now coming in for the month of May. For this year till time, it's just about 5% in the positive that the silver prices are trading with. The last 1 year, of course, continues to be a triple-digit percentage return at around 130% there. It is about the strong US dollar index that we are looking at and the rising treasury yields, which are putting an impact on the precious metal side. So gold and silver, both of that trading in the negative right now. The crude-led inflation is yet another thing that various asset classes are watching out, and that could lead lead to tighter policy concerns. Remember, it is going to be the Fed meeting minutes that are going to be released in this week that the street will take further cues from. But I quickly want to get on to what the Indian government seems to be doing when it comes to import of silver. We already have reacted to duty being hiked from 6 to 15%. But on Friday night, there also was yet another notification that came in from the government where India has shifted various categories from free to restricted regime. The imports now require a government nod, a mandatory government nod, if you want to import the silver. So what really has gone in for restriction has been the 99.9% purity bars. It also is about unwrought, semi-manufactured, powder form. All of this now has been restricted. Silver is an industrial metal. Remember, we keep talking about AI and data centers and chips, etc. So silver is an important component within that as well. And that is the reason we are looking at silver prices holding around that $70-75 per ounce mark. Pardon me. What India also has done is that it has, after India has restricted those imports, we've seen Indian markets see a premium. Till last week on Friday as well, it was a discount of around $12, but that seems to have absolutely gone away now. The policy change could shift the markets to actual physical rather than paper trading is what the street believes. And then the silver ETFs, which only accept imported London Bullion Metal Market Association bars, could be looking at some premium going forward as well. Indian silver ETFs also take Hindustan Zinc Limited, Silver Refinery, which is the MMTC, and Hindustan Platinum Association. So all of that silver is also accepted by the silver ETFs. But going forward, with the kind of premium that we are looking at into the spot markets, this perhaps could be an issue going forward. That's exactly what IBJA also says. They do say that banks, qualified jewelers are no longer permitted to import silver bars without a valid license. Also, there is no restriction, by the way, on silver doré import and import of silver granules, as it were. Anyone dealing and accepting only imported silver bars would have tough times, is also the statement coming in from IBJA right now. So as I said, from a discount in the previous week to a premium right now, with so many restrictions coming in for silver imports, it's something that the street will watch out for.
All right, Manisha, thank you very much for that. We will take a quick commercial break here. We come back with the management of Arvind to discuss the fourth quarter performance. We're back in just a bit from now. Stay tuned. Welcome back. I mean, it's a tough-looking screen, but there is things which are starting to move around as well, and market breadth, etc., which was completely one way down. Some signs of life, or if you want to call it that. Amber is taking a hard knock. I mean, just to highlight something which is down 15% on huge volumes, and we'll have more on this coming up in a bit from now. Well, Arvind is with us as well now. Arvind reported numbers. Growth was strong, led by margin expansion across the board. The company is guiding to a 20% CAGR kind of growth after the Dalco acquisition. We had the Arvind management, after the Dalco acquisition, they told us that Dalco gives them about 1,000 crores in revenues with about 17% EBITDA margins. Puneet Lalbhai is back with us, Vice Chairman at Arvind. Puneet, good morning again. Thanks very much for joining us. Prashant this side. Just a quick word on the numbers, right? Advanced materials margins has progressively inched up. Could you give us a sense of what's helping this margin expansion and what's the outlook going forward for the segment?
So if you look at the advanced materials business, this year, this last quarter, there was a very favorable product mix, which led to better than usual margins. The way to think about this business is it will grow at 18 to 20% with a 15 to 16% EBITDA margin. That's the guidance looking forward.
It will continue to grow at 18% with a 15 to 16% EBITDA margin. But, on the Dalco acquisition itself, obviously we had a detailed conversation then. And since then, few questions have emanated as well. And obviously you were, because the nature of the deal was such immediate, that it was difficult for you to get into all the specifics. So just wanted to understand a couple of more things. Since the acquisition, obviously, even though asset-backed is debt-funded, how will it impact your consolidated balance sheet, interest coverage ratio, credit profile in the very near term? And what are the immediate plans to leverage the synergies?
Sure. So as far as balance sheet is concerned, because this was an opportunity that came up and we had to sort of arrange the financing at short notice, we have funded it through debt. However, if you look at our last 4 years, we have consistently worked on, keeping debt at a very low level and comfortable level. And we have plans to bring it back to original level over, say, an 18-month period. Even with the additional debt, we feel we're fairly comfortable with both our interest and debt coverage ratios. So we're not that worried about debt. Synergies, the acquisition gets us into, a new area around automotive and geotextiles. We will explore to build those areas in India. We will take our filtration business to the USA, which uses the same technology. And then we will use the two sort of front-end teams to cross-sell products. So that's how we plan to unlock synergies.
And you'll be able to do so despite the current nervousness around the trade deal, right? And the geopolitical uncertainty.
Yes, I think if anything, this acquisition gives us some cover against that, because now we produce in the US and we don't believe that the trade deal, even with the peak of 50% tariffs, business went on. We found ways to continue selling. So even if there were certain unfavorable positions that come across on the trade negotiations, we will figure out ways and means to sort of address those. As of now, we don't see that as a huge challenge going forward. Geopolitical tensions, on the other hand, are another story. That's more occupying mind space at the moment.
All right. Just to complete the point on this before we move on to other parts of your business, what are the structured milestones that you have to acquire the remaining 39%? What's the preset formula here?
So the preset formula is an EBITDA multiple that's just a shade below the 7.75 that we acquired the 60% stake at. And it will be acquired in two phases, one tranche in 2 years and another tranche in 4 years.
All right. What about business now? You've given us a target on your advanced materials business, 18 to 20% growth with 16 to 17% margins. The overall business, how does that grow in the next couple of years? And what proportion of gains should we expect from the currency tailwind that has come for you?
So there is a currency tailwind for sure, but there is also a dramatic increase in input costs. So if you look at the year, it will be a story of two parts. In the first half of the year, demand is extremely strong. We have very good order books, but we have a dramatic rise in input costs across the board: cotton, yarn, dyes and chemicals, everything that is petroleum backed has gone up very quickly and disproportionately. So while currency will sort of offset some of those increases, we do see margin pressure in the first half till our pricing catches up. What remains to be seen, however, is the second half of the year, which is usually very strong for us. How demand holds up if oil prices remain elevated for any length of time. So a lot of uncertainty, very difficult to guide, on an exact number or an exact growth trajectory. But we've been resilient. We've had a tough couple of years where we've delivered reasonably good results. So we expect, more of the same, and we'll take on these challenges as they come.
Right, but just to put a bit of rails around that, I wouldn't call them guardrails, etc. Your exit quarter was close to around 2,500 crores on the top line with 12% margins. Do you believe that on an annual basis you can do about 2,800 crores, maybe closer to 3,000 crores on a quarterly revenue run rate organically? This is X of the acquisition that you've made, and margins stay around this 10 to 11% sort of mark, given the crosswinds between both, currency as well as the increased input costs. So double-digit margin, is that a possibility?
So if I guide you towards the medium term, I would say all of that is true. We will continue to grow the overall business in double digits. Our margin should expand gradually. Advanced materials should grow at 18 to 20%. However, with such sharp uncertainty at this point in time, it's very difficult to guide for the overall year in front of us. However, the first half, despite all these disruptions, we do expect to be marginally better than last year.
Take that point. That's fair enough. Thank you so much for joining in, and wish you good luck navigating through the path of uncertainty in the very near term, but you are confident in the medium to long term. Always a pleasure speaking with you, Mr. Lalbhai. With that, we'll take your leave on this edition of Bazar with the news that the Nifty is still down about 265 points, 1,000 points lower for the Midcap index, the Nifty Bank lower as well. The only thing that's doing slightly better is the IT pack, which is the only sectoral index which is marginally in the green. We'll take your leave. On the other side, Nigel and me join in for Chartbusters. Gland Pharma delivers over 20% growth across geographies, with the European business growing over 35% in the fourth quarter. Margins also expand. The analysts expect GLP-1 opportunity to add to growth, and as a result of which, the stock is zooming 13%.
Prudential PLC is set to acquire 75% stake in Bharati Life Insurance for around 4,200 crores. In a key overhang by ICICI Pru, Prudential PLC will also cut its stake in the company to 10% from around 20% currently, which could imply share sales worth around 9,000 crore rupees.
Brent crude surges over $110 per barrel on fears of resumption in the West Asia conflict. Oil marketing companies under pressure on the potential of further losses due to higher procurement costs.
Amber Enterprises reports an operationally strong fourth quarter, but the stock plummets close to around 15% as the management in its earnings conference call flags higher copper cost and the possibility of margin contraction going ahead.
Cochin Shipyard's FY26 numbers significantly miss growth guidance. Revenue declines 5% versus the guidance of 15%. Margins, EBITDA, profit, all of them lower, and the stock down 7.5%.
Hello and welcome to Chartbusters. We are coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Nigel. With me is Mangalam. And as you could see to the top of your screen, it's a very, very tricky start to the week. The Nifty is under big pressure. The broader markets as well are seeing a lot of selling. And as we've been highlighting from the morning itself, that crude oil prices have spiked up. The rupee continues to weaken. The dollar index is stronger. And global yields as well have spiked up. That's putting us in a bit of a tizzy. Hey, Mangalam. Tricky times.
Tricky times indeed. And, stocks are feeling a lot more trickier. The ones with any sort of weakness in management commentary has it reeling lower. Amber Ent, just look at that stock. Opened about 6-7% lower. The conference call is just underway. Upasana did tell us that, the management in the conference call did guide for about 50 to 100 basis points sort of impact on the margins because of the current increase in raw material prices and some more. We'll get to Upasana in just a bit for now, but look at that. The street doesn't have it. Down about 16% for Amber Ent. And this at a time when Dixon actually gave us better than expected guidance and the fact that the Vivo deal would happen as well. So that stock's doing okay. And when your peers, do a lot better, then there is a bigger cut that we saw on Amber. But today, to be fair, given the market condition, even Dixon is lower.
Well, that's right. Another stock that's lower is Hind Rectify. Just take a look at that stock. It's down close to around 15% as we speak. Remember, it's had a big run. The numbers on a consolidated basis showed margin compression because they've done some inorganic growth. Though Tata Mutual Fund is putting, I think, around 100 crores at around 920 rupees. But for the time being, the stock is down close to around 15% as we speak. Markets ignoring the news with regard to Tata Mutual Fund coming in. But they're saying that the margin contraction is something they're fearing. That said, let's go across to Texmaco Rail. That stock is reeling under pressure amid weakness, despite a decent set of numbers in quarter four. While the profits jumped close to around 40%, the rail and energy infra business degrew close to around 50%. The company has also announced a strategy to foray into defense manufacturing. To discuss this and more and what's the way ahead, let's welcome the company's MD, Mr. Sudipta Mukherjee, who joins us on the show. Hi, sir. Good morning. Good to see you, Ben. The street is not taking some of this commentary too kindly. Give us a few details, particularly the new foray into defense. Tell us what kind of capacity are you looking at, what kind of investments you're looking at, and what kind of revenue visibility on this front. Say 3 to 5 years hence, what can this business look like?
So good morning, Nigel. So just to before coming to defense, I would like to give you a little bit of quick context that why we are into defense and what all we are doing. And obviously, I will come to your answer. Texmaco primarily has been core businesses was in and around manufacturing, freight rolling stock, foundry castings, and infrastructure, electrical as a rail infrastructure primarily, and also some high-tech components. So if you see that the rolling stock and with all this, we of course find a very decent domestic demand, and we have been the largest supplier and largest manufacturer of freight rolling stocks, and we feel that there will be a good amount of visibility in the coming 5 to 7 years because we as a nation has to catch up on the national rail plan. And it is much more relevant in today's geopolitical context that we move more and more on railway. So other than this, of course, there is a conscious effort by the government to welcome private investment into the sphere. And I'm happy to let you know that today more than 70% of that stake is also with Texmaco. So we have a good amount of visibility in terms of growth of our core business. And you know that Texmaco is the largest exporter of rolling stocks and railway solutions out of India. And we have also a significant growth forecast in terms of our exports so far our rolling stock, our castings, and our components are concerned. Third is there is a infrastructural push by the government, which from the budget records one can fathom. And we are significantly growing there, and both in electrical and the regular signaling and other railway infra. But having said so, a realization in the growth path, what we have seen in this in the trajectory is that we are primarily into a business which is heavily government dependent, and of course there are infrastructure dependent, and it could be sometimes cyclical. So we, as a Texmaco, has a robust growth plan, and we want to grow the company into 3 to 5x. At least 2x in the next 3 to 5 years time. So we along with, of course, strengthening the core business, we also feel that there has to be some more in the diversification. So we call it, other than the core, is adjacencies, and of course some breakout businesses. The adjacencies, of course, we are planning to work in and around some components like wheel sets and getting into passenger mobility ecosystem and into power electronics and propulsion system and all some niche components where we need to develop in India the ecosystem. And defense comes in the breakaway business, which again, we do not want to enter into the commodity sphere. That's why you see that it's a quite wide range we have taken. And 200 crore is not that significant a number. We know that, but it is the initial commitment with which we are getting into. And these would be some differentiated products, which should be government under the Atmanirbhar Bharat and the policy of, already you know that there has been a huge investment for developing and indigenizing the technology. So we are focusing to come around that, and these all could be higher EBITDA businesses and in line with the plan of Texmaco.
Okay, I understand that point. Thanks a lot, Mr. Mukherjee, for laying the business out for us. Just 3 very simple questions. You expect the revenue to double over the next 3 years, 3 to 5 years. So the incremental 4,500 crores that comes in from, over the next 3 years, let's break that down. How much of that comes in from your current businesses? How much of that comes in from your adjacencies, the defense business that you spoke about, and, even the fact that you've entered into mining, mineral value chains, etc. So of the incremental 4,500 crore revenue that you get, how much comes in from the new forays that you're making today?
I would rather make it more simplified with your intention, Mangalo. And in the whole 2x value chain, the core business would contribute around 50-55% by 2030, and the balanced growth businesses will be contributing the rest of it. So if I have to also give you further more indication on the near-term growth trajectory, we do not believe that whatever we have done in terms of revenue last year and EBITDA is the optimum one around core business. On a near term, maybe in the next fiscal, this fiscal, we are targeting the top line and the bottom line in and around the core business to be growing at least 20%. And whatever will be coming from the new businesses will be in addition to that.
All right. So 50-55% will come in from your core business at 2x the revenue in 3 to 5 years from now. The remaining 40-45% from adjacent businesses. Next year, that's what you anticipate? Yeah, obviously, no one knows the future.
And consistency, which is very important.
Right. No, I understand that. And next year, you said your core business should grow at least 20%. Just on both the 3 to 5 year target from now and the next year, what kind of margin trajectory should we work with? What kind of EBITDA are you expecting?
So on the near term, the target for this year is at least at the level of 20% EBITDA improvement. And towards 2030, we should be above mid-teen.
Just a final question. There was a slight flagging off from the auditor. They said that the 700 crore contingency provision that you've created, that was created out of free reserves and shouldn't have been done so. Instead, it should have been done via the P&L. Do you want to explain that?
No, so we don't agree to that because the thought is very sublime. I mean, we once we commit something, we do not want to go back. So you know that the present geopolitical situation, it is always better to be proactive and let us take it as a new normal. Rather than giving a surprise to people, it's always better because as I said that we do a lot of international projects, we are expanding and we are moving towards a significant growth trajectory. And it's which we call as a Texmaco 2.0. It's a transformation journey. So it's always better to be transparent and upfront. And we feel that we have taken a very pragmatic, prudent decision. And we do not know the timeline, we do not know the specificity of all of this. So it's a kind of contingency, and it could be that we have a huge claims also. And sometime it could come as a very good write back and very good news for everybody, all the stakeholders.
Right. If there was a write back, then obviously it will again go in via the free reserves itself and not via the P&L, as you pointed out. But was curious to know how you arrived at the 700 crore rupee provision as against your, last year's net profit of about 200 crores. What went into that calculation? But that conversation for another day. Right now, we are happy with the fact that you are embarking upon Texmaco 2.0. The stock lower in today's trading session, but post results, there was some joy on the street post Texmaco's strategic plan over the next few years. With that, we'll slip into a short break. Another company joins us post this break, the management of Tanga Jewelry, to dive into their fourth quarter performance, gold prices, and gold import outlook. SM Lakshmanan, who joins in. Welcome back. You're watching us here on Chartbusters. The stock on our radar is Tanga Jewelry, and it was a strong fourth quarter performance that came in. In fact, for all the jewelers, the last 1 year was phenomenal. Sharp growth in revenue for Tanga in particular. The foray into Chennai helped them as well, but concerns linger on demand amid higher gold duties and the very near term. So let's discuss, more importantly, the outlook as against the performance with the VP Finance and Accounts, Mr. S.M. Lakshmanan. Thanks a lot, Mr. Lakshmanan, for joining in. What was a strong end to this year, that after we had the Prime Minister's speech and then we had, the steps taken by the government to curb gold imports as well. What's the impact of that been on demand so far? Obviously, on supply, you've maintained that 50% gold comes in from exchange programs, and also at the same time, you are sitting on some inventory which will give you 60 crore worth inventory gains over the next couple of quarters. But has there been an impact on demand so far, ever since the Prime Minister has spoken about postponement of gold purchases?
Good morning, Mangalam. Thank you for the opportunity. Tanga Jewelry Limited has achieved a turnover of 8,499 crore rupees for the financial year 25-26, registering a revenue year-on-year growth of 73%. In terms of volume, gold has increased by 12%, silver volume increases by 21%, and diamond volume increases by 32%. As far as the current quarter is concerned, the financial year 26-27 has started on a good note, and the recent Akshaya Tritiya year-on-year revenue growth has been at 76%. Talking about the recent directives that have been initiated by the Government of India, we stand by the same, and the same are in the national interest. As far as the business is concerned, yes, the customers slowly shift towards the exchange program, and the company is able to see 50% levels of exchange as compared to the historic 25% levels. Anyhow, it is early days, and we have to have the wait and watch approach. The company is hopeful of, at the same time, maintaining a growth momentum as of now, subject to any further unforeseen circumstances.
Hi, sir. Good to see you in. This is Nigel on this side. Last quarter has been good. The bit of challenging times, but I'm sure you have seen such times in the past as well. That said, let's focus on a couple of aspects. What kind of volume growth are you targeting for this year? If you could help us out with that. And in that times, what kind of value growth can we see? So guidance with regard to volumes, value, and SSG growth for this year.
Good morning, Nigel.
Morning,
yes, as of now, not talking about any numbers at the moment, the company is hopeful of maintaining the growth momentum for the financial year 26-27. As you had very correctly said, the last year, the company had done a positive volume growth of 12% in terms of gold. And the company is hopeful of maintaining an encouraging trend for this financial year 26-27. As far as the same store sales is concerned, last year the company had done a 38.18% as compared to the previous year's 18%. So in terms of SSS also, the company looks at maintaining the trend.
Okay, all right. So if you could help us out with some more details, the performance per store in Chennai as well as non-metros, how is that looking? And what is the store addition plan that you see? Have you shut down a couple of stores? Could you give us some clarity on that front?
The Chennai store count as on date is 8, and the Chennai showrooms have been running at 20+% revenue composition of the total revenue. As far as the expansion is concerned, the year started at a store count of 66, and 9 showrooms are expected to be open for this financial year 26-27, all in and around Chennai, as a part of the second phase of the Chennai metro expansion, out of which 2 are getting launched in the first quarter of this financial year in the month of June.
All right. So given that in just 8 stores, Chennai is 20% of your revenue, and next year you plan 9 stores, all of them in and around Chennai, and there has also obviously been a change in the political regime out there post the Tamil Nadu elections. Typically, we see an impact on demand on account of that. So what kind of contribution do you expect from Chennai over the next 2 years once these 9 stores also start to, get optimized?
Yes, as I said, as at the moment, it has been running at a 20+% of the total revenue as a composition on a full year basis. And the Chennai showrooms have been performing satisfactorily well. And we hope to maintain the satisfactory performance amongst the Chennai showrooms in the years to come as well.
So, will your next leg of growth come in from stores in Chennai itself? Or will you continue to add stores outside of Chennai in the non-metros too?
Mangala, the next couple of years, the company is going to focus only in and around Chennai in terms of expansion.
Okay. Okay. All right. Sir, could you give us some clarity on the Tanga Digi app, I believe? Could you tell us how many customers are there? How many paid customers are there? Because that's something that's not discussed very much. How large is it? How large can it become?
Certainly, Nigel, not talking about the numbers about the customer base, the DigiGold has been doing wonders in the company, and more than 50% of the customer advances that is collected by the company is in the digital form, and it keeps increasing year after year.
Could you give us a brief number, sir, on the paying customers?
Sorry?
What is a rough number on paying customers?
It could be around... it could be around 10 lakh, please.
10 lakh, 1 million odd.
It could be around 10 lakh.
1 million odd.
Yeah, and it keeps increasing. And that is the most important point I want to share with.
Right. Do you sense that there could be any more curbs that could be announced from the government? What if, say, there were curbs announced on gold metal loans, as it were, between 2013 and 2015? What is the kind of impact that you think could happen for players like you?
No, as I said, Mangalam, the directives that have so far been initiated by the government of India are in the national interest, and we stand by the same. As far as our customers are concerned, mostly the customers are into the need-based essential purchase category. So we expect the business momentum to continue for the financial year 26-27.
All right, just a final question before we let you go. You expect the business momentum to continue. The last year, you did margins of around 6.5%. This year, if you could give me a target on margins and also non-gold as a percentage of your sales. Because last year, despite gold prices rising, non-gold increased as a proportion of your sales.
Yeah, EBITDA margin stands at 6.79% for the financial year 25-26. And the company would like to keep the EBITDA margin target at a 6+% level, as I had said in my earlier CNBC discussion. As far as the non-gold is concerned, yes, it has increased by 84% the revenue growth for the financial year 25-26. And for all possible reasons, we expect the non-gold revenue growth momentum to continue for the financial year 26-27.
Okay, all right, sir. We appreciate you joining in. Wishing you all the best for the remainder of this fiscal. We'll catch up and we'll get a sense in terms of demand as well as how, things are progressing, because we would like a fixed guidance on the time ahead. All the best.
Thank you, Nigel.
Time to slip into a short break. Come back. We'll continue to focus on markets and stocks that are moving around. Welcome back. Well, as we speak, the markets have seen a bit of a recovery actually from the lows of the day. So that's heartening to see actually, because there's no big incremental news flow. Brent crude prices continue to hover around $112, on a per barrel basis. But I tell you what, the tech space is actually seeing a bit of a recovery from the day's low, which is good. Tech Mahindra is one such stock that has spiked up to the high point of the day. I think we can get that one up. That'll give you a better picture, because that's one of the stocks that's really spiked up. Brent crude prices remain elevated. The rupee is a little bit weakish, but the Indian markets have bobbed up close to under 120 points in the last few minutes. And big boy Reliance Industries should come up for you on the screen. That said, let me get counted. That's up 1% just in the last 30 minutes or so. Well, we'll wrap up on this edition of Chartbusters. Don't go anywhere. The team of Trading Hour comes up next.
Good morning, you're with us here on Trading Hour. We are coming to you live from the CNBC TV 18 Motilal Oswal studios. I'm Hormas Fatakia. With me is Ritu Singh. Manglam Malu will be joining us in just a bit. But of course, after a fairly subdued start to a very busy trading week, the markets are looking to attempt a recovery from the lows of the day, and that is courtesy of IT. The currency continues to make new lows, and that new lows is sparking some recovery in IT. There was some recovery on Friday as well. But of course, after that very, very sharp sell-off that we saw all through last week, so 2 days of gains for IT, and today's move is aiding some bit of recovery from the day's low for the market as well. Ritu, good morning.
Good morning, Hormaz. The weaker rupee, yes, a tailwind for the IT sector for sure, but for the rest of the markets, it's not really looking very good. Look at the breadth of the market. It's pretty negative. You have more than 5 stocks that are declining for every 1 stock that is advancing on the National Stock Exchange. For this morning, it's a cut for about 180, 190 points on the frontline index. The broader markets are faring much worse. The Midcap index is seeing cuts of almost 800 points as we speak. The small cap index also down about 230 points. The bank Nifty again dragging the markets much lower, even though Nifty IT is trying to help on the other side. But bank Nifty is seeing cuts of almost 1.3% as we speak. But let's pull up the rupee as well, 96.30. That's where it's at. This is a new record low. It's, it was down almost 2% last week. It's down 7% this year. And today, again, a sharp downturn that continues. But Hormaz, let's put the spotlight on the top movers in today's market. Lots of earnings-linked reactions also coming in.
Plenty of earnings reactions, actually. And today is the day when, of course, a lot of reports that were coming in on Friday after market hours and over the weekend, they are the ones that are reacting. But look at the index, of course. The 23,500 is that important level that you need to keep an eye out for. Of course, we trade below that, but we are closing in on that again. So it's an almost 150-point recovery from the lows of the day. And that is courtesy of IT. And most of the index heavyweights on the IT sector are doing well today. The very few gainers that the Nifty has is courtesy of the IT names, and that is of course because of the currency hitting new record lows in today's session. Take a look at Oracle Financial, take a look at Coforge, take a look at Infosys, all of them now extending gains. Infosys is now up 1%, Oracle Financial and Coforge are now up 2.5 to 3% in today's session. But take a look at the earnings reactions. Barring a few, most of them are on the negative side, and Amber Enterprises, after some disappointing commentary in the earnings call, is down 15%. KEC International has extended its losses, is down 9%. Cochin Shipyard, of course, after its results, Kotak is expecting a 50% downside on the stock, 6.5% lower here, and NCC too seeing a negative result reaction. Yes, there are some more of them as well, but barring the one name that's bucking the trend is Gland Pharma. 14.5% higher on the stock now, the top gainer on the Nifty 500, while others are extending losses. This one is extending gains. Delivery is down 5%, Tata Steel is down 5%, Power Grid 2 trading with losses of a similar quantum. Among the newsmakers today, ICICI Prudential, of course, the big news that came in on Sunday, 6.5% lower, is looking to recover slightly from the lows of the day, as is SJVN, still down 6.5%. Numbers came in Friday just before closing, and GE Shipping extending its gains from Friday. The one sector that's not doing well, barring of course most of the others, but the big one is the real estate sector. 3.5% lower for Anantraj, 4% for Brigade, most of the others too trading with losses of 2.5 to 3%. And lastly, stocks at 52-week lows. Interarc Building Solutions was down 15% on a day last week. It's extending those losses today. Another 7% knocked off. 7% knocked off on VIP Industries as well. A result reaction at 52-week lows. Not good going for Apollo Tyres and for Zensar as well.
Take that point, Hormaz. Thanks a lot for that. The good part about today's recovery, however, is that, the Nifty is low. It's 23,317, which is pretty similar to what we had seen earlier in the previous week, 23,262 to 23,330. So between 23,250 and 23,350 is where there is some sort of buying that emerges in the market, and that's what we've seen in today's trading session as well. Let's see whether this continues or not, and whether we see another round of sell-off as the day progresses, because both Hormaz and Ritu have been pointing out, there has been no let-up when it comes to Brent prices or the rupee or even earnings for that matter. Shares of Tata Steel, however, they're under pressure despite a good performance in the fourth quarter. Nigel joins in with all the details. Nigel.
Well, Tata Steel's numbers actually were good, and there were the broad reasons that the numbers actually look good were realizations improved across the board. You had better volumes coming in India with a good growth on a year-on-year basis, and on a sequential basis, the Netherlands volumes also improved. And that's what led the absolute EBITDA number to look a little bit better than our poll, as was the case with the margins as well. Focusing on India, which is the big driver in terms of stock price move as well as in terms of the sum of all parts. Over there, just take a look at the EBITDA per ton improvement. Improved to more than 15,000 rupees, and it was close around 200 rupees better than what we were working with. Better realizations played out there, and the input costs that spiked up were more or less taken care of by higher realizations and a bit of operating leverage as well. So no worries out there with regard to India. Moving to the European business, well, it delivered a profit. That's after a few quarters, it moved back into the black. Remember, the poll threw up a number of a European loss of close to around $5 per ton. It came in at a mild $1 per ton positive. And in absolute terms as well, the EBITDA number was positive in comparison to a negative number. On Netherlands, in the rupees per ton basis, well, that skimmed off a little bit on a sequential basis. Year on year, it was better. But the good news is the UK business, the losses are reducing out there. And the hope is that in the second half of this year, we'll actually see, it moving into the green. So that's about the European business. The cherry on the cake was the debt number came down marginally by close to 2% on a sequential basis. And that's going to be another trigger going ahead. Now, the path ahead, the management has said that in FY27, they'll sell close to 2 million tons more than what they'll do, what they did in FY26. And also profitability will improve for India. There'll be some skimming off into Netherlands, but otherwise the European business on the whole will look a little bit better from here on. So net, the numbers actually are good. The stock actually has come in for a bit of profit taking. Otherwise, on all parameters, these numbers look good. And the near quarter as well, that's the Q1 numbers, will look a little bit better than what we've seen in Q4. Back to you guys.
Nigel, thank you for that update there. We'll hear from the management as well later in the day. So it'll be interesting to see what they have to say on the road ahead. But a good quarter for Tata Steel, but falling prey to the otherwise subdued market sentiments. But what was otherwise a fairly okay quarter for Amber Enterprises, but the management commentary was on the cautious side, and the result is that the stock is now down 15%. Upasana is here to tell us what exactly did the management say in the earnings call, as a result of which the stock has declined. Upasana.
Well, the management has indicated for a 50 to 100 bips margin pressure on a temporary basis, on a consolidated basis, due to the heightened input prices pressure that the company is seeing. Now, they've also said that the major chunk of this would be the copper-clad laminates that are seeing a very heightened price pressure, which is used mainly for the PCB business of the company. Now, REC industry, it has been a challenging year, and overall it has been a flat growth industry-wide. And the company has indicated, but currently for the REC segment, Q1 FY27 has started on a positive note. In terms of the volume growth for REC, they are guiding for a 20% growth in Q1 on a low base versus 12 to 13% on an overall full year basis in terms of volume. Now, electronic division, which was the key strong growth driver for the company this quarter, they have guided a strong growth momentum here in FY27 as well, which will be majorly driven by the PCB and bare PCB business. And they are also guiding for a 40% growth in FY27. Railway division, they are guiding for a growth of nearly 30 to 35% in FY27 and FY28. Now, coming to the numbers overall, so if we look at the numbers on a Q4 basis, it has been a beat on EBITDA margins, which is mainly led by the strong performance coming from the company's electronic division. But consumer durable is the main pain point. Here, the growth remains soft, and the revenue growth was just about 6%, with a margin pressure of nearly 40 bips at 7.2%. So overall, that's the key highlight of the result here.
All right, Upasana, thanks very much. So that's Amber Enterprises that's seen pressure in trade today. But on the flip side, Gland Pharma is one of the top gainers in trade today. It's up more than 14.5% as we speak, almost 14.8 after reporting a steady set of fourth quarter numbers. Let's go across to Ekta Batra for more on this one. Ekta.
Thanks for that. Well, yes, Gland Pharma has come out with what has been a steady set of numbers. The revenue is up over 20% on a year-on-year basis. And also the margins have surprised positively, both sequentially as well as year-on-year. So the margins have come in at 29.4% versus 24.4% same time last year, and versus 20% in the previous quarter, or thereabout, 19 to 20%. And the profit too has spiked up because it was aided by a better other income this time round. But if you look at the geographies, the bulk of their business comes from the US. It was up 24% on a year-on-year basis. Europe also did very well for them, which was up 36%. India was up 28% on a year-on-year basis as well. Cenexi, which is one of their arms, has now become EBITDA positive despite a lower top line Q-on-Q. So that has been a positive. And the guidance for the company is 12 to 13% growth in FY27 in constant currency. But ex-Cenexi, the margin guidance is 33 to 35%. So the street is working with possibly the fact that they could surprise on the upside with regards to this particular margin guidance, and that it might be too conservative at this point. Analysts also are estimating that GLP-1 opportunity could be one to target or to look at for Gland Pharma, which could fructify over the next couple of quarters. Kotak is positive. They've upgraded the stock post the numbers.
Right, Ekta, thanks a lot for that. So that's about Gland. Some of the few stocks which are rising, and one of them is Gland. But as we speak, we're seeing some traction in ITC as well. That's recovered about 1.5% from the lows and reports its numbers on Thursday. especially given the sort of outperformance that we've seen from the likes of VST Industries and Godfrey as well. Good performance coming in, even though the outlook for the year remains grim. And as a result of which, the stock has given up most of its gains from the open, down about 4% for Godfrey Phillips. The street is penciling in a good set of numbers coming in from ITC. So we'll note all these recoveries and mark them as a win for bulls, because the market's now made a decent recovery moving towards that 23,500 mark. Reliance is the other stock which has now moved into the green. Take a short break, come back, we focus on the bond market action with Manisha Gupta. Welcome back. You're watching us here on Trading Hour. Let's get to the bond market as promised. Manisha Gupta joins in with all the updates out there. Manisha.
Thank you for that, Mangalam. Well, yes, the 10-year bond yield has seen a jump, as has been the case globally and especially in the Asian markets, where we have seen the US Treasury yields also gain to the highest in last 1 year. The corporate bond yields also have been trading higher. That's how it was on Friday, and that's exactly how we've opened on Monday morning as well. The major reason, of course, comes in from the crude oil prices, now holding above $111 a barrel. Crude prices, remember, have gained 8% in the previous week and nearly 82% now in this year itself. The global markets, equities, all of that is under pressure. And the fuel hike in India in sense of petrol and diesel by 3 rupees also seems to be finding its way in case of inflation. So when you look at that data, it's not just about the Indian inflation numbers that we're looking at the higher side. The Japanese numbers come in today, which are much on the higher side. Australia, China, US, all of these data have come in the matter of last 1 week. And we've seen on expected line, the inflation numbers continue to jump in there. When it comes to corporate bond issuances, then, it is the IDBI Bank board which has okayed the issue of long-term bonds of up to 100 billion. This is for FY27, and majorly much of this money is going to be used for infrastructure financing and, of course, affordable housing. Now, when you look at the overall bond issuances itself, well, Friday was quite a bit higher than what we saw on the previous day. So Thursday was 5 billion, but Friday closed up nearly 29 billion and plus. The secondary market numbers was kind of flat. Friday, of course, slightly lower than what we saw on Thursday, which was 105 billion therein. The oil marketing companies, though, have continued to be in the market, raising money with the commercial papers there. So HPCL on Friday raised 5.7 billion. You had IOC hiking, raising 17 billion, and ONGC Petro Additions also raising 4 billion by the way of commercial papers there. Well, the markets also clearly seem to be reacting to, as of now, of course, the source space reports, but India considering reduction in taxes paid by foreign investors on the country's bonds there. The authorities, of course, are seeking to align policies with what's happening in the global markets and also to support some inflows coming in. So plenty happening in bond markets, but a major clue, of course, is the hike in yields that we have seen.
Indeed, 7.14 now is where the 10-year is currently. Plenty happening in the bond market, plenty happening in the equity markets as well. The Nifty Bank is now back above the mark of 53,000, looking to recover from the lows of the day as well. And along with that is Reliance Industries, that is also contributing to the recovery in the markets. Now 160 points lower still on the index. Of course, just pull up Bharti Airtel. The stock is up for the fourth day running and has now surpassed HDFC Bank in market cap terms to become the second most valued company in the country. So 11.8 lakh crore for Bharti Airtel, surpassing HDFC Bank, which now stands at 11.7 lakh crore. Reliance, of course, continues to remain the most valued company at well over 18 lakh crore in market cap. HDFC Bank, too, off the lows of the day, contributing to the recovery on the index. Take a short break. On the other side, we're joined by the management of Premier Energies to discuss the road ahead for the company. Stay tuned.
Welcome back. 23,482 on the Nifty. It's a 160-point cut. We're still looking at, for the Bank Nifty, a bit of a recovery from the lows, but still trading with cuts of about 600-odd points. Let's bring in Somil Mehta, who's the head of retail research at Mirae Asset Sharekhan, with us now. Somil, thanks very much for your time here. Currently, pretty volatile day. It's pretty much in the red, barring the IT pack, which is holding up. Near-term levels you'll watch out for on the frontline index, and any particular stocks you'd like to call out?
Good morning to everyone. The view is bearish in the medium term, in the short term as well. We've been sliding down, trading below 2040 daily moving average. We are trading below 200 daily exponential moving average. Bank Nifty has broken the previous swing low. All of these signs are a little negative in the short term, in the medium term both. I'll be expecting markets to head down till at least 23,100. That's my first target in the very short term. If we don't sustain around those levels, then the next target would be 22,700. So bearish overall, sell on rise should be the strategy. And on Bank Nifty, I'll be expecting a target of around 52,000 in the short to medium term outlook. I have chosen two stocks on the short side. One is from the PSU banking side, that is Bank of India. Bank of India has broken a small flag pattern on the daily charts, taking resistance at all the short-term averages. Heading down, breaking the previous swing low. I'll be keeping a stop loss around 142, and my targets would be 130. The next stock would be UPL. UPL is a short side as well. UPL has taken a resistance at 200 daily exponential moving average last week, and now again started making lower tops, lower bottom. So sell on this stock with a stop loss around 642, and my target would be 580.
All right, we take that point. Thanks a lot for that. Meanwhile, just keep an eye out on a couple of these mid-cap IT names. They're also spiking right now. Oracle, Coforge, Persistent Systems, all of them are marginally in the green. And remember, these are stocks which had a lot of short positions in the past. So are we seeing some short covering out there or not is a question that we'll get an answer to shortly. Meanwhile, Uno Minda is the other stock from the broader markets which has seen a bit of a spike as well. But let's keep it with earnings. We do have with us Premier Energies, a strong fourth quarter driven by robust execution, capacity ramp up, and healthy margins. All of this backed by a solid order book. So basically, an all-round beat that has come in from the company. So let's discuss the growth outlook, capex plans with Vinay Rustagi. Thanks a lot, Vinay, for joining in at a time when markets are a little skittish. There have been weak earnings. You come as a breath of fresh air with a good performance that you've reported. Let's make that even better with what you have in store for us in FY27. So just give us 4 numbers that you target, in terms of revenue growth, in terms of margins, what's the kind of capex that you've lined up, and at the same time, the order win. These 4 parameters, if you could give us a sense on what one should work with in FY27.
Sure. Thank you for having me. So I think FY27 should be another great year for us. We have an order book currently of about 14,000 odd crores. And bulk of this order book is going to get executed in the year. So which means we have a very good visibility in terms of sales as well as pricing stroke margins. Similarly, in terms of capex, we have a large capex program. We will be spending about 5,000 odd crores on more than trebling our cell capacity, as well as investing in backward integration and new products like storage and inverters. So there's a large capex program going on, which will basically pave the way for growth in the coming years.
Okay, what about the pricing pressure, if any, you're seeing in the market? To be clear, there is no export business here. You're very much concentrated on the domestic market. But, with multiple players that are ramping up, their capacity simultaneously, are you seeing any pricing pressure, one? And, secondly, on your cells, cells are about 58% of your order book. They're also your highest margin product. But you're going from about 1.6 to 7 gigawatts of cell capacity by September. So as the supply, increases, do you expect the realizations to also hold?
Yeah, sure. So just to clarify, our cell capacity currently is 3.6 gigawatts, and it is increasing by 7 gigawatts to 10.6 in the next 4 months. Coming to margins and pricing, so we have to understand, there are mainly 3 products that we sell. One is cells, second is DCR modules, or modules made using India-made cells. And third is non-DCR modules, where we can import the cell and then convert them into modules. Now, the last category, that is the non-DCR module business, is the one which is the most commoditized business. There are literally more than 100 companies competing for that business, and the margins are wafer thin. And our presence in that business is actually very small. Bulk of our revenue and profits come from cell business and the DCR module business, where the value addition is very high. And the margins are very, very attractive. Now, the good thing is that, yes, there are more people coming into the market, but if you see the demand numbers, the Indian market grew by 87% over the last year, which is a fantastic growth. And we expect the growth to continue over the next few years, particularly if you look at, how the Middle East war is shaping the energy balance in the countries and all the various government schemes designed to support growth. So the demand is going to be very, very strong. And then on the supply side, yes, a lot of people have announced entry into the business, but we've always maintained this is a challenging business. It does take a lot of time for investors to raise the capital, complete the construction of their plants, and then ultimately to stabilize their production, which can take anything from 2.5 to 3 years from start to finish. So overall, the demand supply situation, I believe, will be very favorable. and which augurs well for the financial prospects of the company.
Well, in light of that, Vinay, you, as Mangalam also asked, if you could share more light on the kind of orders that you are planning on winning in FY27. Is there an order inflow pipeline that you have? If you could shed more light on that. And of course, how will the margin profile shape up in the new year?
Yeah, so in terms of the, how the order book is expected to evolve, the key thing there is that our capacity, both cell and module, is increasing between 2 to 3 times over the next 1 year. So we obviously have a very strong position in the market, and we will be trying to capture new orders to fulfill this capacity even beyond FY27. Now, like I mentioned, the demand environment in the sector is very strong. There is, in fact, large schemes, whether Surya Ghar Yojana or the Kusum scheme, where we are expecting very, very strong execution in the coming year. Similarly, the corporate market, because of the decarbonization and the net zero initiatives, is also booming. So we would expect the order book flow to remain very strong across the year.
That still doesn't answer the margin question. For reference, there is a brokerage note that I'm reading. They expect margin compression, actually. They expect, this is DAM that saw margins from 30% in FY26 compressed to about 26% in FY28, primarily as both BESS and the ingot wafer businesses scale up. So if you could give us a sense on where you see that. And also, you have a board approval to raise 5,000 crores. When does the street expect that paper to hit the street?
Sure. Okay. So, coming to margins, look, I can't give you any guidance, but, there are a number of factors that are going to influence our margins as we go forward. First of all, like I said, bulk of our order book for the coming year is already booked. So that gives us a very good visibility over our margins, which should be in the region of where we have been historically. Having said that, the business is evolving. The non-DCR business that we have, the market share is going to actually decrease over a period of time, which will support an increase in margins. Similarly, as we integrate backwards into ingots and wafers, that is going to further support our margins, which will be slightly offset by the growth of the battery storage and the inverter businesses and the transformer businesses, which are more of assembly businesses. And typically have lower margins. So I think overall, the outlook for the margins is generally very strong. Coming to your question about fundraising, look, we have a large CapEx program, which we are funding largely through internal accruals and debt. We don't need to raise any more external capital right now. Having said that, this is a very exciting place where there are lots of new opportunities, both horizontal as well as vertical. We are evaluating quite a few of these opportunities, and this is basically just an enabling resolution that we have seen. As in when we crystallize our growth plans and we firm up any new initiatives to be taken up, we will then approach the market for any future funding. But right now, I must clarify that there is no specific plan, either in terms of timeline or amounts, for any future fundraising.
All right, take that point. Thank you so much for joining in. So are you saying that brokerages are underestimating the margins?
Look, it's not for me to say what the brokerages are saying. Like I said, I can't give you any guidance, but I think in general, the demand supply environment in the sector is very strong, and our competitive position as well as the order book is going to support a very healthy performance in the coming year.
Take that point. Thank you so much for joining in and giving us the outlook. We wish you good luck. Meanwhile, just watch for the markets. 23,500 thereabouts is where we are for the Nifty. Bharti Airtel is a stock which is spiking right now. Perfect time to get you the F&O set up right now. The Nifty Bank and the Midcap index are actually pressurizing the Nifty. But from the lows, we've seen recovery led by Reliance, which is a fair weight on the index, Nifty IT index, which is doing extremely well. And alongside that, we just spoke about Bharti Airtel. That too has moved to the high point of trade. Advanced declines still firmly in favor of declines. And we've seen a marginal spike in the India VIX as well. But what does all of this tell you? That at lower levels, there is some demand which is coming in for the market. But at high levels, could there be supply or not is the big question. What makes bulls happy is that for the last 3 occasions, last week and even now, the Nifty lows have been contained around the 23,250 to 23,350 mark, May 12, May 13, and today as well, 23,317 is the low from which we've recovered about 150, 160 points. But there are still call writers who are active at 23,500. Put writers, because of the recovery, have taken heart and written the 23,400 put, premium of 85 rupees, telling you around 23,315, which is today's low. There is support, but 23,500 call writers equally active as well. Premium of 125 rupees, selling you upwards of 23,500 to 23,600. There could be some sort of resistance that will come by, coinciding with a lot of the moving averages as well. But the one pack which is seeing a lot of short covering, we spoke about it shortly, the mid-cap IT space, Oracle, Coforge, Persistence, all of them up anywhere between 3 to 4%, seeing a lot of short positions being covered.
Short covering in IT and continuing to extend gains now are Oracle and Coforge. We started off the day with both of them being around 2.5% higher. They are now 3.5% higher. Persistent Systems too doing well, as is Bharti Airtel. So index heavyweights putting their hand up, leading this recovery. 23,500 now is where it currently stands. Take a short break. On the other side, continue conversation on the markets with Unmesh Sharma of HDFC Securities.
Welcome back. Well, ICICI Prudential Life is reeling under pressure today because of broad-based weakness, but this is also after the promoter entity Prudential announced that it will trim stake in the company to less than 10% versus over 20% earlier. Yash Sen has been tracking that story for us and joins in with the latest.
Well, let's just speak about the deal first. So as far as the deal or the transaction itself is concerned, Prudential PLC's announced acquisition of about 75% stake in Bharti Life Insurance. The total consideration for this 75% stake would be about 4,200 crore rupees. As far as the transaction is concerned, it values Bharti AXA or Bharti Life Insurance at about 5,600 crore rupees. And out of the total 4,200 crore rupees, which has been the value for that 75% stake, about 3,500 crore rupees would be paid as initial cash consideration and 700 crore rupees has been kept for depending on the fulfillment of certain conditions. As far as the valuation itself is concerned, at 5,600 crore rupees, as I said, this values Bharti AXA Life Insurance at 1.8 times September 2025 price to embedded value. Out of the total 75% stake, 60% will be acquired from Bharti Life Ventures and 15% stake from 360 ONE. This particular transaction has a negative read-through for ICICI Prudential Life Insurance, and that's because Prudential PLC's 22% stake in ICICI Prudential Life. As per the regulations, one particular entity cannot be a promoter in two life insurance companies, which means Prudential PLC will have to pare down its stake in ICICI Pru Life to less than 10%. What the company has mentioned in its disclosure is that they will be reducing this stake and bringing it down to under 10% from the current 21.91%. They will seek an appropriate timeline from the regulator to bring down this 12% stake, which will be worth about 9,200 crore rupees. Now, going forward, it all depends on what kind of timeline does the regulator also approve to Prudential PLC to bring down this 12% stake down, because a lot would matter on them to sell this particular stake through various block deals.
Yash, thank you for that update there. Trying to recover from the lows of the day is ICICI Prudential Life. Continuing our conversation on the markets, then Unmesh Sharma from HDFC Securities is now joining in. Unmesh, good morning. Thank you for taking time out. Well, the life insurance space has been abuzz over the last few days. First, of course, now the transaction that has been announced, yes. But, well, a lot has been said about this under-penetration of insurance in the country. That has been this one common theme to push these life insurance companies. But there is nothing much has changed on ground. But do you see this as a long-term opportunity to play this theme, the life insurance space, or do you prefer the general insurance in comparison?
No, so in our model portfolio, we have an overweight position on the life insurance space. I think the name that we are playing it through is SBI Life, where we have a overweight of around 120 bips on our model portfolio. So we do like the space. Longer term, we believe it's a nice structural space. It's like a consumer-ish kind of play to it without having the lending angle to it. So yeah, we do hold a positive view.
All right, Bharti Airtel, what's your view on telecom? Because Vodafone Idea obviously survives over the next 4 to 5 years, given the fundraise that has happened. There is the likelihood of a Jio listing shortly, as it was promised by Reliance in their numbers. And now Bharti Airtel, as we speak, has seen a big spike at days high, at record high, has crossed the market cap of HDFC Bank as well. How do you view this space?
Unfortunately, I cannot talk about it due to some compliance reasons, but yeah, unfortunately cannot comment on telecom at this time.
All right, you can't comment on telecom. What about IT? Do you think the worst is behind us, or maybe we keep getting periodic bounces and periodic scares around artificial intelligence, so it's best to stay away?
Yeah, so look, on the IT space, we've had underweight call for multiple quarters. In the last quarter or so, we cut that underweight to neutral. That has worked only on in very short spouts, to be very honest. One is that it's not getting a lot of help that it usually gets in periods of the currency depreciation, because primarily it is seen as an anti-AI trade. At the same point in time, the anti-AI trade itself seems to be, there seems to be a tussle between the bulls and the bears on that. So what's happened is that with the valuations coming below 20 for most of the large cap names, we believe that and our long-term thought process that finally, in the case of AI transformation as well, there will be implementation partners. We believe the Indian IT space is quite well placed in that sense. So in the short term, we believe that the AI and anti-AI trade will keep things volatile. But at the same point in time, we believe that this is the time where valuations have come. And whenever you've seen this kind of scare come, whether it was the year 2000 or whether it was 2008 or .com, so have you, I think that this is the time to accumulate the space.
Unmesh, would you have the same call on the financials as well? Because of, the recent pressure we've seen on some of these stocks and, these banking names. There is, of course, concern that in the first quarter, we'll start to see some of the impact that we haven't yet seen in the fourth quarter numbers on, what's happening in West Asia. But, near term, do you see a buying opportunity there?
Yeah, so look, in terms of very large financials, because that weight in the index is like 30 plus, what will end up happening is that if you want to build a meaningful position, that you cannot then perfectly time it, because of the impact and the amount of time it in a large portfolio it takes for you to build the positions. What we are recommending is that, yeah, while first quarter commentary is something that we'll keep an eye out for. If you look at some of the private banks, if you net out what are the subsidiary values, you will find that they have come to well below 2 times on price to book. Usually, whenever we have seen, with the exception of the 2008 crisis, whenever the large banks, especially the private sector banks, go below that, even the selective large private public sector banks like SBI, it's usually a great time to buy. We would strongly recommend that you start adding that to your portfolio and getting very close to a neutral weight if you are underweight.
So, Unmesh, apart from these themes that we've already discussed from the insurance space, IT, financials, in the current market with the downturn, what are the other emerging sectors you think that this is the right time to look at?
We believe over a period of time, with the correction of valuation, consumer starts becoming interesting again. Similar to IT, that was another one which remained quite. It was so expensive that it was very, very difficult to buy. I think that is starting to kind of play out. We believe that consumption across the board, with names like Asian Paints, Crompton, Swiggy, Cerna, these are the names, quasi-consumer, so as to speak. These are the names we have overweight in our model portfolio. We are also playing the consumer through real estate like Soba, also some of the autos names. The only one in the very short term that we would probably, even within these names, be a little careful would be to wait and watch on what happens on the monsoon trend. So I think prefer discretionary followed by FMCG, but with a bias towards the urban stories.
Unmesh, the one theme that has been the big talking point has been power over the last month and a half, ever since peak summer demand started to play out. Where do you play this segment through? You play it through the power financiers or the transmission companies or through something else? What's your take here on the power space?
Grid. I think that the transmission is the easiest and cleanest way to do this, because it's not very easy to find renewables. I think with what has happened to oil and gas, I feel that one is that in the short term, we obviously see coal making a resurgence. On top of that, there is things like coal gasification and so on. So you can play those themes, but one way or the other, whether it's renewable, whether it's solar or what have you, we believe that the transmission is obviously the one that we like the best, which is why we have a 2% overweight in our model portfolio on Power Grid Corporation.
Unmesh, thank you for sparing time and joining us today, and look forward to having you more often on the show. By the way, cannot not talk about the markets now. At one point, the Nifty losses were sub 100 points. They are still just 100, so it's a substantial recovery from the lows. It's a 200-point recovery now. And take a look at Tech Mahindra at the highs of the day, 3% higher now. Take a look at Bharti Airtel at the highs of the day, 2.5% higher. Infosys at the highs of the day, 1.25%. And of course, a lot of the other names, HCL Tech has moved into positive territory, as has Wipro, as has Reliance Industries, and very briefly, HDFC Bank too had moved into positive territory, continuing to hover around the flat line and contributing substantially to the recovery on the index. Take a short break, continue with corporate conversations. The management of Dodla Dairy joins in on the other side. Stay tuned.
There's a 215-point recovery that we've seen from the lows, not reflecting the broader markets, though the IT pack doing extremely well. Let's focus to earnings now. Dodla Dairy saw pressure in the fourth quarter margins, EBITDA falling 35% due to higher procurement costs, even as profit after tax was supported by a tax credit, and their Africa business delivered strong growth. Let's discuss all of that and more with the Managing Director, Sunil Reddy Dodla. Thanks a lot for joining in, sir. You know, you spoke about the procurement prices. The last time we spoke, it was in the flush season and prices being high were unusual. Where do they stand at right now? How much of it has been passed on? And given all of this, what's your outlook for the next couple of quarters? Let's take it for the next couple of quarters and then perhaps for the full year.
Thank you very much for having me on the show. Regarding the current quarter that we are in, we are seeing peak summer, so the market side is doing well. We've been having a good traction in terms of volume growth in our VAP, and therefore the overall basket of realization is improving. Procurement prices continue to be at the same rates and not yet started to taper off. Obviously, it's summer, it will start tapering off as we go forward. We are confident that the procurement prices will taper off as we go ahead, because we are seeing volume traction coming from Maharashtra and Karnataka, where the volume growths are coming in terms of procurement. So that's what it is. But also, given the uncertain times between fuel prices and plastic prices, whatever little we have already passed that on to the consumers in March itself. We are hoping and waiting to see once things stabilize as to where they will be to take it forward for the next 2 quarters.
So what happens to your margins in the next couple of quarters and your volumes, sir?
Volumes will continue to grow at in terms of revenue at the 15 to 18% kind for the first quarter, and then the second quarter also will be strong because the summer is strong. Margins we are anticipating will be maybe similar, or maybe for the year it will be more than 1 to 1.5% higher than what we closed at March. But I think the current quarter we can think of it to be a slight improvement over the previous quarter. Same last year.
So you had earlier highlighted to us that you're looking to reach 20 lakh litres a day as your capacity target over the next couple of years. Where does that stand as of now? Do you continue to remain on track for doing so?
Yes, in fact, I think currently our run rate, if you look at consolidated in terms of the sales, has already crossed that 20 lakhs. But that's, of course, the peak summer price that summer volumes that we are looking at. We are very confident to keep on that track as we go forward.
Okay, your value-added product mix, that is, about 297 crores is the revenue in the fourth quarter. It's about 20%, 28% of sales. What is the target? When does it meaningfully start to move the needle? You'd guided that the share will inch up about 1 or 2% annually. Is that the rate you're currently seeing?
Yes, in fact, we have done better in the value-added segment because we had a significant amount of fat that we didn't contribute as an overall part of the value-added, because last year what we had as excess fat, which we sold as bulk, and also from the consumer, we had a little larger sale. This year, because of fat being a little shortage for us, we have reduced our consumer exposure also in fat. In spite of that, we have done well with our value-added growth. And last year, the first quarter, which is good for us, was also unseasonal rain had pulled down the value-added portfolio. This year, first quarter has done extremely well in value-added. I think we have seen almost we're close to a 20%, 28% increase in the value-added growth compared to the same quarter last year. So we are confident this year our value-added will continue to do the 2% rate of growth.
All right, so we'll see 2% per year in increase in contribution. Now, Mr. Dodla, I just wanted to ask you about the Orga feed business and the OSAM business. OSAM business, obviously structurally lower margins. You acquired it last year. What are the margin synergies that we can expect now in FY27 that the consolidation is over? And the Orga feed business, which was high teen sort of margin, has now come down to a lot lower levels. Where does that improve, or where does that settle to?
See, basically, Orga feed business to start with was the 13% that we had earlier as a first year was when we were on a smaller base of operation. I think now we are coming closer to the 11% EBITDA that we were looking at. So the growth in Orga feed is the reason why we will also have some same level of percentage of margins, because now when we're increasing our spread. For example, we operate in Chittor and we are sending the cattle feed to Maharashtra. Till we start off, get the logistics of getting another plant going in Maharashtra and getting the transport benefit as well as the raw material benefit of the local areas, you will find these margins to be fluctuating a bit. But overall, it will continue to do well in terms of the same 10 to 11% margin, maybe a 1% difference in margin is what it will be. But in the terms of absolute numbers, because the volume growth will be significantly higher, it will compensate that in terms of the absolute profitability that we make. As a percentage might be a little lower. Coming to OSAM, we have done well. We have also been able to structurally improve it better. So even in a bad time and the rest of the overall industry has also dipped in profit, OSAM's profits did take a bit, but dip, but we're still at a 3% kind of an EBITDA rate that we are at. And we're very confident that it will come to the same levels of what we're doing as the rest of the Dodla India operations soon in a matter of 3 to 6 months, when we are able to streamline a few more in terms of our own procurement, improving a little more in terms of the volumes that we are going to get there.
So in light of that, sir, do Maharashtra commercial operations begin by FY27 end, and what is the kind of contribution that you are targeting as a percentage of your overall growth?
Maharashtra overall at that time should give us around 10% of our overall growth, because even if you're overall in terms of the consolidated with Africa, OSAM and India operations, if we are closer to the 20 lakh liters, I think year one we can look at anywhere between 10 to 15% of 3.5 lakh liter addition coming from Maharashtra to start with day one.
All right, that's Maharashtra. Just a quick word before we let you go on the Africa business. You obviously did well on the operational front out there. Where does that settle? And we didn't get the annual guidance for Orga feed for this year.
The Orga feed this year, again, we're looking at the same growth rates of around, let's say, 15% growth in terms of the volume and that we look at, and that will continue to be there. In terms of Africa that we're looking at it, yes, it's done well. That's why we have announced another expansion in Uganda, where we're going to enter into the fresh segment. We're confident of getting a 20% growth in the Africa consolidated between Uganda and Kenya and maintain these margins. Also, we're very confident that once we finish our greenfield in Uganda, we'll have further growth in Uganda also. So we think that let's say short term of 2 to 3 years time, I think our Africa business will move up to be around 18 to 20% of our overall revenue, and thereby also contribute a lot more to the profitability also.
All right, Mr. Dodla, thank you so much for sparing time and joining us today. Wish you good luck for the new financial year as well. Take a short break. Back with more on the other side.
Welcome back. The rupee has made new record lows today. It touched about 96.32 against the greenback in trade. Now trading at about, we'll pull up the chart for you, 96.32. That's where it already is. It has depreciated by about 7% so far in this year alone and remains one of Asia's worst performing major currency. The pressure point, of course, remains oil prices, the ongoing West Asia conflict that has pushed up energy prices. Brent crude has been above $100 a barrel for nearly 2 months, and that, of course, is inflating our import bill significantly and adding pressure to the rupee. And at the same time, the dollar itself has strengthened, and of course, the foreign outflows continue to add to the weakness. Both the government and RBI have already taken some steps to prevent more dollar outflows, and more could be on the anvil, as we've been reporting here. But the rupee's sharp depreciation is now also emerging as a major risk to our fuel economics. Now, there's a study that has been done by SPI Research that warns that even a further 2 rupee fall in the currency can wipe out most of the gains from the recent 3 rupee per litre fuel price hike. Now, this report assumes an average rupee level of 94 against the dollar for FY27, with the Indian crude basket averaging $106 per barrel. Now, at these levels, India's landed crude oil cost is estimated at about 9,964 rupees per barrel. And according to SPI, the recent 3 per litre rupee increase in petrol and diesel prices gives oil marketing companies a benefit of roughly 477 rupees per barrel. But a further 2 rupee depreciation, the rupee, for instance, that could raise the crude import costs by around 410 rupees per barrel. So that effectively erodes most of the relief. The pressure on OMCs remains severe. The report estimates that oil companies are currently losing nearly 1,000 crores every day because of these higher prices, although the latest fuel price hike can provide relief of over 52,700 crore rupees in this fiscal. So that's as far as the oil prices, of course, are concerned. That's our macro signal for the day. Keep an eye out for the flashes at the bottom of your screen. The Jana Small Finance Bank Board Meet has approved a fundraise proposal. Remember, last week we had reported that the TVS Venu Group is looking to acquire 9.99% stake in the bank. We'll wait to hear what has come out of that board meeting, but that's an important one to keep an eye out for. It's a fundraise board meeting, and we'll have to see, what has been approved. We'll ask our team to pull up more details on that one as we stand by. We'll get you more details as and when they flow in. But an important one to keep an eye out for, the stock moving up, on the back of that news. So we'll do one thing. We'll take your leave on this edition of Trading Hour. More updates will continue right here. Let me quickly toss it across to our Mumbai studio for more.
The names of the investors who have been issued the warrants are in part of the filing that has just been put up on the exchanges. And that includes the GWC Family Fund Investments, Singularity Large Value Fund, Capri Global Ventures, and Utpal Sheth's name also features in that list. So that is the fundraising that has been approved by Jana Small Finance Bank.
GWC Family Fund Investments basically are TVS holdings, as we found out. They are basically the trading, the investment arms of TVS holdings. They have been involved in various transactions in the past as well. So that's pretty much, I guess, as expected. And the board meeting approval has come by, and the names as well have been taken. But we're out of time on this edition of Trading Hour. You stay tuned to CNBC TV 18. We have halftime report, which comes up next, and will definitely carry the Jana SFB fundraise story forward. Thank you for watching.
Risk of a US-Iran flare-up and an expansion of the Russia-Ukraine conflict spooked the streets. Consumer discretionary, industrials and utilities are the big drags, while IT ekes out gains.
The Aditya Birla Group will invest 4,730 crore rupees in Vodafone Idea via preferential issue warrants convertible at 11 rupee per share. The infusion provides a confidence boost after Kumar Mangalam Birla assumed charge as the chairman.
ICICI Prudential Life Insurance takes a knock after Prudential PLC looks to sell 12% of its 22% stake following a deal to acquire 75% in Bharti Life Insurance for 4,200 crores. With this, Prudential will go solo in India, parting ways with ICICI.
Tata Steel posts a healthy Q4 FY26 on good realizations and offers a positive near-term outlook, but a range of uncertainties around its European operations and low visibility on the medium-term growth sparks profit-taking.
Oil leaps to over $110 per barrel after Trump says the clock is ticking for Iran, and reports suggest US and Israel are readying for aggressive military action. The lapsing of US waiver on Russian crude purchases adds to the mix.
Hello and welcome to Halftime Report live from the CNBC TV 18 Motilal Oswal studio. I'm Ekta Batra, with me is Sonal Bhutra and Vinny Motiwala. Well, it is turning out to be a day where we are seeing profit booking come through, but we're off the lows of the Nifty at this point in time. So the low point of the day was 23,317. So we've managed to recover around 160 odd points from those lows. So just about at around 23,500 levels. For the Nifty. What really is taking the brunt today is definitely the broader markets as well as the Bank Nifty. So we have the Midcap index, which is down around 1.2%, and the Bank Nifty, which is down around 1.3% at this point. Extremely dismal advance decline ratio, 983 stocks advancing to over 3,300 stocks declining on the Bombay Stock Exchange. So that's how things stack up at this point. But there's a lot of news with regards to fundraising, may it be Voda, may it be Jana SFB at this point.
Yes, that's true. And that is happening at a time like this. So maybe FIRs are not pumping in money, but we are getting some updates on how DIRs are funding some of these Indian companies. But, you know, the recovery that we were talking about, as Ekta pointed out, has been sold into. IT is the only green on the screen as we speak. That index is the top gainer and the only gainer in terms of sectoral moves. And that is something which is at least cutting the losses that we are seeing on the Nifty. But we do have the likes of Axis Bank, SBI, ICICI Bank, all these stocks at the day's low, something like an HUL also, and Tata Consumer, ITC. So FMCG and the likes of these banking names are at the day's low, and they are pushing the Nifty lower as well. Of course, we'll discuss about Jana's fundraise in greater detail, but a lot of stocks on our radar today.
Absolutely, a lot of stocks on our radar, plus a lot of managements that we'll have lined up for you all on the show today as well. So let me take you all through what we're seeing today in terms of the lineup. We will be putting the spotlight on Q4 earnings and talk with the management of Symphony as well as Skims to understand the outlook and way forward for the companies. In our Commodities Corner segment, Manisha Gupta will be speaking with Bluestone's founder and CEO Gaurav Singh, and who will take us through what's happening in the world of commodities there. Vivek will also be putting the spotlight on the buzzing stocks and the big movers in trade today, so stay tuned for that. But first up, we'll start with Vivek, who's here waiting by at the wall to take us through the big movers in today's trading session. Vivek, while we are seeing some bit of a recovery in the market, what are individual stocks doing?
Well, thank you so much for that. Extremely volatile trading session. A lot of stocks seeing very sharp moves, largely on the back of news flow or results. First on the list, in the list of gainers, of course, has to be Gland Pharma. Extremely strong set of numbers. Positive commentary coming in as far as the Sensex acquisition is concerned. Stock higher by almost 15%. The other stock that continues to move higher today is Bharti Airtel. That particular stock, seeing market cap surge once again. Capital allocation concerns have been addressed. Stock higher by another 2%. The IT pack, a bit of a rebound after the sharp selling pressure we saw in the week gone by. by. So names like Tech Mahindra, LTM, Coforge, Persistent, all of these stocks up anywhere between 1% to 4%. Two of the shipping names, both of them seeing a sharp up move today, both GE Shipping as well as Shipping Corp, both of these stocks up on good volumes. GE Shipping now up almost 10%. And Carborundum Universal, it was a very weak quarter as far as Q4 is concerned, but the company has gone ahead and shut down a few of the non-performing segments, and that particular stock up by over 4% as that overhang gets cleared. But the list of laggards, quite a few. Amber Enterprises, that particular name, company calls out margin pressure going forward, stock down by 15%. Most of the discretionary names today under quite a bit of pressure, so most of the FMCG names like Godrej Consumer, Umami, Dabur, all of the stocks down anywhere between 2 to 4%. KEC International and a subdued quarter, even though Q4 execution was relatively better, the street doesn't like the fact that the company still has significant exposure to West Asia, stock down by almost 10%. Afcons Infra results will come in later today, but the company has informed the exchanges that it has lost out on 2 contracts in Croatia, that particular stock down almost 7%. And Cochin Shipyard, within the shipyard names, this particular stock clearly quite weak in terms of execution, miss across estimates, and Cochin Shipyard, one of the top tracks today.
Okay, all right, Vivek. Thanks very much for that and giving us all of those stocks which are in focus in today's trading session. Just want to point out that Raymond is in fact at the high point of the day, so it's bucking the trend up around 7.8% currently for Raymond, which has rallied around 14% this year. There was, it's already come out with its numbers. But in any case, that stock, the company did have a management meeting with some analysts on Friday, did participate in a conference. But let's talk about specific stocks then. Amber Enterprises has skid on the back of cautious management commentary. Upasna has been tracking this stock and she tells us why. Upasna, over to you.
Well, the management has indicated a margin pressure of nearly about 50 to 100 basis points on a consolidated basis on the back of the elevated input prices. Now, when it comes to copper-clad laminate, which is one of the key material for the PCB business, company has indicated a heightened elevated input price pressure on that one. Now, overall, if we look at the RAC industry this year has been challenging. Industry-wide is what the company also highlighted, but in Q1 FY27, company says that they are seeing a bit of a demand and it has also started off on a positive note. On the volume front of RAC, it expects a 20% growth in Q1 on a low base versus 12 to 13% growth is what they are eyeing on a full year basis. Now coming to the electronics division, which has seen a robust performance this time around because of the various acquisitions that the company has taken through, it has guided for a nearly about 40% growth in FY27. And lastly, coming to the railway division, the company is guided to grow nearly about 30 to 35% in FY27 and FY28 basis. Now, overall, if we look at the Q4 result, it was a margin beat as compared to the street expectations. The company has reported a strong performance in its electronic division, while the consumer durable is where the softness came through. The consumer durable, the revenue uptick was just about 6% versus electronics, which reported a 21% revenue growth. Railway subsystem reported a 22% year-on-year growth. Now, coming to the margins overall, the consumer durable, there has been a margin pressure down about 40 bips at 7.2%, and this was mainly led by the RAC margin pressure due to elevated copper prices that was seen. And even railway segment, the margin was under pressure due to the higher base. Now, overall, if we look at the company's EBITDA margin, it stands at 8.6% versus what the street was estimating at somewhere around 7.8%. So largely the weakness comes through the company's consumer electronic division.
Okay, the MS companies continue to be under pressure. Thank you so much, Upasna, for bringing us all those details. Let's talk about delivery now. That's the other loser in trade today, down 6%. Manganam is joining us to tell us more. Manganam.
Well, if you look at just the numbers of delivery, they haven't been particularly bad. In fact, there has been a 30% growth in the company's revenue, where the EBITDA also has increased by about 80%. Operating leverage play out happening out there since, the acquisition of Ecom Express. In FY26, the express volumes of the company have increased by about 40% as well. The good part is that, the third quarter volumes versus the fourth quarter volumes, we've seen a growth out there as well. And seasonally, the third quarter is among the strongest for players like delivery. The net profit, however, is lower because of an increased expenditure on depreciation, which is a non-cash expense. And that's something which has kept the net profit flat. The important part, however, Express plus Part Truck Logistics, Express plus PTL, which is the mainstay of the company, then the revenue has grown around 38.5%, and margins have increased by about 4.5% to about 7.9% as well. Nothing in the numbers that speak about weakness. In fact, the management commentary has been fairly strong as well. Double-digit margins by FY29 is what they're guiding for. They've turned free cash flow positive as well. The only possible reasons why the stock is underperforming in today's trading session, apart from the market sentiment being weak as well, and perhaps a fuel price hike, increasing the cost of delivery, and as a result of which reducing demand, would perhaps be two. One, the stock going into numbers was fairly strong from levels of sub 400 in the earlier part of the year. The stock has already risen to levels of 450 right now as well, 10-11% higher despite the cut that we've seen from what we saw at the start of the year. And for delivery, a large part of the holdings of the company have been concentrated by institutions, and periodically we continue to see block deals. And very recently, Nexus Ventures, for instance, sold in the company as well by about 1.5%. They're looking to pair their stake every quarter. So there are a bunch of institutions who at every rise are looking to offload their stake in delivery. So maybe that's the reason, along with the outperformance and the overall weakness in market sentiment, which has the stock lower, despite a fairly strong performance coming in the fourth quarter.
Absolutely, Mangalam, point taken there. But let's also talk about Power Grid. That's another one that's down and out in trade. Vivek is here to take us through the details. Vivek.
Well, that's right. When you're talking about Power Grid, it's actually been quite a bit of a miss as far as the results were concerned. Remember, even though this particular company is actually a regulated entity, there's actually been quite a bit of volatility in the last few quarters, especially when it comes to the P&L performance. And this is largely on account of the fact that there has been significant change as far as the treatment of deferred tax assets are concerned. Now, talking about the numbers themselves, revenues down 5%. It was a miss against the CNBC TV18 poll. Other expenses quite high, coming in at close to 1,900 crore, versus just around 1,280 crore on a year-on-year basis, which has led to a big slip as far as EBITDA is concerned, down almost 11%. Margins have contracted 600 basis points. Profitability higher by 10%. That is because of a remeasurement of deferred tax balances, which aided the PAT in this particular quarter. In terms of CapEx and capitalization, remember, between Q3 and Q4, the company in an analyst meet had gone ahead and upgraded their guidance for CapEx coming in at 35,000 crore and capitalization at close to 25,000 crore. It will be important to see whether in the last month and a half, the company managed to meet both the CapEx as well as the capitalization guidance. In terms of planned CapEx for FY27, close to 82,000 crore split between 2 years, that is 26 as well as 27. Lastly, one important thing that the management needs to clarify, which will lead to significant volatility as far as P&L is concerned, is the deferred tax assets on the book of close to 3,200 crore. The treatment of that will go ahead and impact the P&L as far as FY27 is concerned.
Okay, Vivek, thank you so much for that. But on that note, we're going to step into a very short break. After the break, we'll connect with the management of Symphony to decode their Q4 numbers. Stay tuned in.
Welcome back. You're still tuned into Halftime Report. Further recovery in the markets is what we are seeing right now. It's the Pharma index, which is in the green. We do have the likes of Sun Pharma, Cipla, which have recovered from the lows. The recovery was sold into, but again, it's the Pharma stocks which are leading the recovery from the front again. And some of these IT names, the likes of TCS, be it Infosys, all of these stocks supporting the Nifty from the lows of the day. So we'll keep tracking that story for you. For now, let's talk about Symphony. The stock is under pressure after reporting a weak set of Q4 numbers. Rupesh Shah, Managing Director, Corporate Affairs of the company, is joining us now to discuss the numbers gone by and the outlook going forward. Mr. Shah, good afternoon. Thank you so much for joining in. If you can tell us what went wrong this quarter, and there have been reports of some curbs on compressor imports into the country as well. Is this something which could impact production and supply going forward as well?
Thanks for having me. So March 26 quarter needs to be viewed in view of very high base of March 25 quarter, which was historically highest ever quarter. And that was coupled with unbilled advances as on December 24 quarter. So it is vis-a-vis that. That's number one. Number two, there was also pre-summer inventory hangover at a trade channel level, and hence overall sentiments were also relatively low. So that's what explains about the March quarter performance. Secondly, in the month of April and until now, that is in current quarter, South India, Western India and Central India have performed better and performed good. So including the inventory lying with the trade is not only rationalized, but there have been decent demand, and that is higher than what it was last year during the same time. As far as Northern India and Eastern India is concerned, trade inventory has been rationalized, but in those parts, summer has not fully set in, mainly on account of rain and in between somewhat hailstorms in some parts. But weather prediction, IMD says that starting current week and next week, there is likely to be a decent summer as it has happened in some of the previous years. If so, still we have almost 1.5 months for those markets to go.
Okay.
So that's about the performance. As far as import curbs are concerned, we being into evaporative air cooler as well as associated products, we don't require compressor. In fact, our import component itself is less than 4% of our total bill of material costs. More than 95% of our materials and components we procure domestically. In fact, during COVID time, we substantially converted import from China to domestic procurement, and that's where it stands.
Absolutely, sir. Point taken there. So not much of a concern in terms of the compressor issue. You do not have that. And plus your import content is very less now. Around 4% is what you're saying. So while obviously Q4 is one of those cases that keep it aside. But overall, for FY27 now, what is the demand trend currently? You said some of the regions now will start seeing an improvement. So overall, in terms of growth outlook that one could see in Q1 and for FY27 as a whole, what is your expectation? Because FY26 versus FY25, you did see a decline.
Absolutely. No, so as far as Southern India, Western India and Central India are concerned, they are likely to do well for the rest of the year because of it will be a spillover of the good summer. As far as Northern India and East India, as per IMD prediction, in next 2 weeks, if there is going to be a decent summer, in that case, we are set for current quarter. And in that case, also set as far as summer-related products are concerned for rest of the year. At the same time, also needs to keep in mind our non-summer-related products now constitutes on a standalone basis almost 25% of the top line, which used to be in so low single-digit percentage. These are the products which sell round the year, or they are not dependent upon Indian summer. And on a console basis, our non-Indian summer-related products constitute 49% of the top line. And many of those products we launched in the recent past, despite their one-time advertisement, sales promotion, and launching costs, which is fully booked in expenses. Still, at EBITDA level, those products are generating already high single-digit percentage EBITDA. And some of those products, like large space ventilated cooling, their EBITDA margin percentage is even higher than our domestic air coolers.
So, Mr. Shah, that point is taken. I just wanted to understand then, what can you guide your investors on in FY27 on a standalone basis? You've closed with a revenue decline of 46%. You've closed with a margin which is coming, your EBITDA is down 15.6%, or rather your margin at 15.6%. So just give us a sense in terms of what FY27 might look like on a standalone basis for the entire year. Would it be as bad? Would you be in growth? Would you still be in a decline? And how much would your margins recover?
We believe that certainly it should be better than and reasonably better than FY26. There is no question of decline. That's number one. Number two, as far as margin is concerned, at a gross profit margin level, even in FY26, our gross margin percentage was lower by just 2%, despite all these turmoil and headwinds. And even in current quarter, we expect that another 2-3% at the most tall maybe in gross profit margin percentage. As far as EBITDA margin percentage is concerned, certainly it's a function of economy of scale. So coming to that is the profitability side. As far as the absolute guidance is concerned, as per our IR policy, neither for a quarter, nor for the year, nor for the future years, we give any guidance.
Okay. So, Mr. Shah, when you say reasonable growth, would it be, say, high single digits? Would it be low double digits? I'm not asking you for an exact number, just trying to understand. Also, because you did indicate exports were hit by West Asia crisis. There's no certainty yet on that. So will the domestic business drive growth? The impairment losses, will that continue to come down? And that is something which will improve profits for you?
As far as impairment is concerned, it is completely done. Now there is not a single naya paisa which we can impair. So that is completely behind us. In fact, in the respect of Australian business, which was dragging down our profitability, that is completely out of it. That's number one. Number two, because we have prepaid the Australian loans, long-term as well as short-term, our annualized interest cost itself will come down by about 13 to 14 crore. That's number two. Number three, as far as US business, which is decently profitable, almost in line with Symphony India, and has a great potential, that has been completely earmarked and it has been made a direct subsidiary. And even the proceeds for that will be used to prepay the loan. And as far as exit growth percentage is concerned, unfortunately, I am not in a position to guide as per our IR policy, but we expect decent, reasonable growth as it stands now.
Okay, expecting some decent, reasonable growth going forward as well. And other than the cooling products, non-summer products are also expected to do well. Mr. Shah, thank you so much for joining us on the show, helping us understand what we should expect in terms of trends from the company going forward. But on that note, let's talk about Jana Small Finance Bank. The board has approved the fundraise plan as well. We have more details that have come in. Let's go over to Ritu to take us through all of that. Ritu.
Well, that's right. Jana Small Finance Bank's board, as we have been reporting last week, held a meeting today and it has approved a preferential issue of 1.56 crore warrants at 464.82 per warrant, and that means a total fundraise of 728.5 crore rupees. And there are 6 investors that are coming in through this preferential route. As we reported, the TVS Venue Group, that is the largest chunk. GWC Family Fund Investments, which is part of TVS Venue Group, incorporated in Singapore, is going to be picking up 68.29 lakh warrants. That's about 5.64% stake post-conversion. The second is 2i Capital PCC, which is owned by Shruti Lohia of the Indorama Group. They'll get about 55.25 lakh warrants, which is about 4.57% stake. And the remaining four, Singularity Large Value Fund, ICM Finance, Capri Global Ventures, and Utpal Sheth, they'll pick up smaller tranches as well. But put together, all of these six combined will hold around 13% stake in Jala Small Finance Bank on a fully diluted basis. The conversion window is 18 months. Also remember separately, TVS Motor Company has also now notified exchanges that it has approved a share purchase agreement to acquire 51.6 lakh shares of Jana Small Finance Banks from Jana Holdings, which is the promoter group entity, which will turn out to be a 4.9% secondary stake. Now keep in mind, the RBI regulatory threshold for corporates to own stake in bank, that is capped at 10%, which means it has to be under that. Now, once the warrants that will be allotted are converted and the equity base expands, it'll work out in such a way that TVS's 4.9% stake will come down such that the TVS Venu Group's total exposure in Jana Small Finance Bank with the GWC holdings will remain within the 10% regulatory threshold. It's also worth noting that none of these new investors will get board seats or veto rights or any special control rights. Apart from this, the board has also approved raising 500 crore rupees through subordinated NCDs, which will be classified as lower tier 2 capital. An EGM will be held on the 11th of June and the record date is the 5th of June.
Okay, that's the big deal coming in. Ritu, thanks very much for giving us all of that perspective on Jana Small Finance Bank. In fact, the stock is down around 5% post the news announcement. But remember that the stock has in fact run up 22% just in the past 1 month in anticipation of this particular piece of news. And hence, maybe there is some sell-on news which is taking place at this point in time. We'll do one thing. We'll take a short break. But up next, we'll get talking on the technicals and get you some trading calls. Stay tuned for that.
Welcome back to Halftime Report on CNBC TV 18. As of now, the Nifty is at 23,550 levels. That recovery that we're seeing coming in for the markets as well. Now down 0.3% to 0.4% in the trading session. IT, Pharma, Sonal marked that as well a while ago. That continues to be the trend. But on that note, let's bring on board Rajesh Palvi of Access Securities to take us through more trading strategies. What is he keeping an eye out on? Rajesh, good afternoon. Thank you so much for joining us on the show. We're back about the 23,500. We're seeing a recovery in the market. What are the levels you're keeping an eye out on for Nifty as well as Bank Nifty?
Yeah, good afternoon. So markets are volatile. Nifty able to defend the previous week low in the early fall, which we have witnessed in the opening itself. Nifty has shown some pullback action from the lower level, but broader market is still witnessing supply pressure. Very few select pockets are contributing to this up move. Though Nifty is still consolidating in the range of 23,300 on the downside and 23,500 is the major supply zone. But in intraday perspective, we are able to take out this 23,500 level. If we continues to hold about 23,500, I think some more recovery towards 23,650, 700 we may see in the intraday perspective itself, as some short covering action has been played out in the call writing front, where we have seen some shedding of calls from 25,500 or 23,500 strike. So I think 23,500 needs to keep as a stop loss those who have bought at lower level or buying at the current level. For Bank Nifty, the major challenging level is placed at around 53,800 to 54,000 level. Until these levels are not taken out by the Bank Nifty, I think here setup is likely to behave on the bearish side, and sell on rise would be the strategy for Bank Nifty until the Bank Nifty not able to surpass 54,000 level. So here one can go short if you get opportunity around 53,600, 700 zone for Bank Nifty. Looking at the overall market, I think some of the pocket like Pharma, IT, some buying action in power space, or some select finance NBFC stocks are showing buying interest from the lower level. Moving to the trade setup, I think Pharma is one space one can focus on the long side. Sun Pharma is looking promising. Stock managed to give breakout of its multiple supply zone on the weekly chart. Looking at the structure, we believe that this stock has potential to extend gain. 1940 we are projecting target. On the downside, 1860 needs to keep as a stop loss. On the short side, the PFC is looking weak, as the stock has already broken its near-term support area, and now stock is slipped below to 20-day moving average also. Looking at the data setup, we believe that furthermore short position we could see in this counter. So one can go short in PFC future with stop loss of 439. On the downside, we can see a lower level of 415.
Sure. All right, Rajesh, we've actually run out of time, so we need to leave it on that note. Thanks very much for joining in and speaking with us and giving us all of your trading calls. I just want to point out that there has been an intraday recovery, which has not only taken place in terms of the equities, but the rupee is also off the worst level that we've seen today. So 96.33 was the worst level that we saw for the rupee, and currently 96.31. There was a further appreciation which had taken place on an intraday basis, but now we're back to levels of around 96.31. It's still precariously poised at this point in time. Nonetheless, a bit of a recovery, as you can see, for the rupee. But Maharashtra, Delhi has reduced VAT on aviation fuel to 7%. The reduction comes at a time when airlines are already under strain due to higher input costs. Madhya is here to tell us more about that.
Well, it is a big relief for airlines, especially Indigo, that operates multiple flights on a daily basis on the Delhi-Mumbai route. Mumbai and Delhi are key aviation hubs, and the value-added tax or VAT coming down to 7% significantly lowers jet fuel costs for airlines. Now, fuel accounts for nearly 35 to 40% of an airline's operating cost, and airlines paid 25% VAT on jet fuel in Delhi and 18% in Mumbai. Now, when that is cut down to 7%, it translates into huge savings for airlines. So ATF in Mumbai is priced at nearly 98,247 per ton currently. That comes down to nearly 89,100 per ton, saving roughly 9,000 per ton for airlines. In Delhi, ATF prices were earlier around 1,05,000 per ton and now down to 89,880 per ton, saving 15,000 rupees per ton for airlines. So a typical Airbus A321 operating a Delhi-Mumbai flight burns roughly 4 tons of fuel in one journey. Now, at our older fuel prices, airlines were spending over 4 lakh on fuel for one such flight. With the VAT reductions now in place, airlines could save roughly 60,000 per flight from Delhi and about 36,600 per flight from Mumbai purely on fuel costs. So huge savings for airlines on the VAT reductions in Delhi and Mumbai.
Maybe it will get passed on to the customers as well. Let's see which way things go. But thank you so much, Madiha, for joining us with all those details. That's a big relief coming in for airlines across the country. But it's time for a break. Up next in our Commodity Corner segment, Manisha Gupta will speak to Bluestone's founder and CEO, Gaurav Singh Kushwaha, on the other side. Stay tuned.
Welcome back. Joining us on the show now is Gaurav Singh Kushwaha. He's founder and CEO at Bluestone. Mr. Kushwaha, hi. Thank you so much for joining in. First of all, your reaction to the PM austerity appeal and then the import duty hike and then, of course, various other notifications from DGFT that the gold and silver importers have been dealing with.
Yeah, so I think it's a step in the right direction, given the global uncertainty and the need to manage macroeconomic environment. I think it's a step in the right direction, and we see that as the customers are going to react to that. And what we were seeing already was that over the past 1 to 2 years, as gold prices were increasing, people were shifting more and more towards lighter weight jewelry. The use of exchange was on a rise. So a lot of these measures or these things which actually help us manage our current account deficit better, we see many of these things picking up even further. Old gold exchange we already see is up by around 50 to 70% for us at Bluestone. And I think at a broader industry level also, we see almost a similar trend where people are using old gold more and more to make newer purchases, hence helping with the situation.
Do you see that as a customer behavior going forward as well? I mean, I get your point, the PM appeal and then the fact that the gold prices are so high. Do you see exchange continuing to be at 50, 70% for a longer period? Is that an accepted norm now?
I think it can be, because if you see, households in India have over 25,000 to 35,000 tons of gold, right? So there's enough and more gold which is already sitting there, and people do understand and appreciate that that value has also kind of gone up over time. Now, Indians have a very strong bond with jewelry, right? Jewelry for us is very cultural. For generations, we've had jewelry marking significant moments in our lifestyle, in our for different occasions, people have to buy different kind of jewelry, right? But Indians also view that gold which is sitting in their lockers as money that they can use to buy newer and newer designs. Now what's happening is the behavior is shifting. The behavior is shifting towards lighter weight, towards jewelry that can be adorned almost on a daily basis and so on. So people need to kind of shift the kind of gold that is sitting in the lockers. They need to actually change it or exchange it to buy newer designs that are more that make sense in today's world. And I think that behavior is on rise.
Mr. Kushwaha, also the other thing that seems to be picking up in sense of trends is diamonds and colored stones. What would you have to say about that? Yeah.
So that's absolutely right. In fact, for us also, studded jewelry with diamonds, gemstones along with gold is a bigger chunk. So the broader shift that is happening is people are moving lower in terms of gold weight of gold, and then more and more use of diamonds, gemstone, and so on. And I think these are structurally good shifts because this also helps us with the entire CAT situation, wherein gold has heavy bearing on account deficit, but these other things don't. So in terms of volume, gold import has been coming down. We believe it will come down even further, and the shift towards more lighter weight, studded jewelry, etc., is going to continue.
Mr. Kushwaha, there also are various reports suggesting that even as India imports 700 to 800 tons of gold per annum, this year especially could go down to 400, 500 tons or thereabout. That is where my question arises from. That are we looking at this, because we've done 1,000 tons as well at some point in time. That has come down to 700, 800. Are we heading towards 500 now?
I think with more and more, okay. So I think if the pickup in gold exchange keeps on happening at the rate, or it continues at the rate that we are seeing, and I think there are a few other schemes like gold monetization schemes, etc., which banks provide. I think smart use of those can actually help us reduce our imports to 500, 600 kg ton levels also.
Okay. That's the word coming in there. But, thank you so much, Gaurav, as well as Manisha for joining and Manisha for taking us through that conversation as well. Surely we'll keep an eye out on in the world of commodities. On that note, we're going to step into a very short break. We'll come back with more stock-specific action, more in terms of management. We have the management of Kim's joining us as well post that. So stay tuned in.
Welcome back. Well, for the Nifty, it's still under pressure, but it has recovered from the day's lows. So 23,576 or close to levels of around 23,600 is where the Nifty is at. So we're down around 65 odd points. There has been an intraday recovery which has taken place for the mid-caps as well as the bank Nifty at this point. And there is a marginal improvement which has taken place for the advanced decline ratio. So to put it into perspective, before when we started the show, there were less than 1,000 stocks advancing. Now there are close to 1,100 stocks which are advancing, with over 3,200 stocks which are still declining. So that's where we're at when it comes to the advanced decline ratio. But let's talk about specific companies then. KIMS reported an operationally weak Q4 FY26. But it delivered strong year-on-year growth. The average revenue and occupied bed also did see some amount of a rise. We have Mr. Rao, or Dr. Rao, who's the chairman and MD of KIMS, joining in now. Hi, sir. Thank you very much for taking the time out. I just wanted to start with the operational performance this time. There was pressure. You do have new hospitals which have come on stream. Was that the reason why you did see your margins come below 20%?
Basically, there are two ways you can able to look into that. The mature units, we are performing as we performing at 30% margins. The new units which are coming, because it will usually takes about 4 to 6 quarters to ramp up and show good positive note. So that's why it has been, otherwise the mature units are doing very well. That is a very good thing.
Okay. All right. Just break up the performance of the mature as well as the new units for us. What did that do in terms of, say, margins for both the segments, the mature units as well as the new units? And how many were probably loss-making? And what are you guiding for in FY27? And what would it then do to your consolidated margins as well?
See, all the matured units, we are doing around 29 to 30% EBITDA. That we are doing this year also, this quarter also. Whereas the new units, if we take to the Thane, we are break-even, and Nasik is a little bit of neutral now. So whatever is the operational loss of 3 to 4 crores in this quarter by Thane and Nasik has been set by the Nagpur unit. That means Maharashtra unit is doing well. So the other thing is the Bangalore. In Bangalore, Mahadevapura has been started about 7 to 8 months back. That has been operationally break-even within 6 to 8 months' time. And moving forward, that will show a good growth. The Electronic City has started in December. That will also take about 3 to 4 quarters to take positive EBITDA. So that way, these are all anticipated things. There is no surprises. The only surprise is when we want to go for the insurance empanelment. Initially, we thought about it will take about 1 or 2 quarters. Because of a lot of issues with the GIC changes and the IRDA, and there is a lot of people are applying for the empanelment of insurance companies. They are taking their own time to sort out this. That may take another 1 or 2 quarters. Otherwise, in spite of not having the insurance companies, we are doing very well. That also we didn't anticipate, but we are very happy that they are doing very well. And as far as Kerala is concerned, all the units are doing positive and EBITDA looks good, and it will keep on ramping up since inception of those units. So all the Andhra units and Telangana units, these are all matured units. They are still, even though these are all 20, 25 years old matured units, still there is a growth is going on 5 to 6%. That is also a positive note.
Okay, so even the mature hospitals are seeing 5 to 6% growth. In fact, overall, your ARPOB, which is average revenue per occupied bed and average revenue per patient, has seen a 13 to 14% YOY growth. That has been good. What is the outlook for FY27? What were some of the key drivers that led to this growth? If you can continue this performance in FY27 as well.
FY27, as we actually looking for the historically, we were growing about 18-20% growth. That will continue also in the this year also. And moving forward, next 2 to 3 years also, we plan in such a way that growth we can able to get. The only thing is now the ramp up in these new units will take about to reach to the mature level, about 20, 25%, 30% EBITDA may take about couple of years. But losses will be arrested when compared to the last quarter. There was about 45 crores loss has come down to 35 crores. That would have been come much better this quarter also, because this quarter we operationalized the electronic city, which again has been a burden about 20, 25 crores. So otherwise the 45 crores would have come down to even 15, 20 crores. So moving forward, and these losses will be able to overcome. The second thing is in the coming quarter, we are actually opening about 850 bedded hospital in Kondapur, which is a new facility that we are operationalized 550 beds. Already existing 250 beds in a old facility will be shifted to the new facility. So another 1 quarter, we will continue both this new facility and old facility. So there may be a little bit of dip in that Kondapur unit for the next 1-2 quarters.
Okay.
After that, usually it will be able to take off. There will not be anything. So ultimately, these are all anticipated and we planned in such a way these things has come regularly. Only thing is the insurances are taking a little longer time than what we anticipated.
Okay. So just two quick ones from me. One, so margins by the end of Q4 FY27, can we expect that to move towards the 25%, 24, 25% range overall? And in terms of occupancy for FY27, what is the outlook there?
See, now the EBITDA margins can able to what we have 20% today. We may definitely move on to 25%. There's no issue. And overall, the occupancy as the new units has been ramping up. Whatever is the 60% occupancy will maybe definitely move on to 65, 67%.
Okay. All right. Just before we let you go, Dr. Rao, just wanted to clarify. So you had no contribution from insurance companies this quarter. Is that right?
Correct.
Okay. So all of the patients are either paying cash or they are from institutions, but nothing which is basically from the insurance part. Any
Mostly 80% is the cash, maybe 10% will be other corporates, another 10% who have insurance, but they are getting treated and they are going for the reimbursement.
Okay, correct. All right. Okay, sir. We're going to leave it on that note. Thanks very much for joining in and speaking with us and giving us all of that perspective. So that's Kim's. The stock is down around 4% at this point. We'll take a short break, but a lot more on the markets once we're back. Stay tuned.
Welcome back. Swift recovery from the lows. We are above that 23,600 mark for now. Just 46 points or 40 points down on the Nifty as we speak. Banks, Pharma, IT and some of these consumption names are leading the recovery from the lows. The question is whether this sustains or not, or there is some profit booking from the top. With that, it's a wrap on this edition of Halftime Report. Business Lunch will take all the action ahead.
Stocks recover from the lows of the day to trade almost in the green. The risks of a US-Iran flare-up and an expansion of the Russia-Ukraine conflict keep gains in check. Consumer discretionary, industrials and utilities are the big drags, while IT ekes out gains. The Aditya Birla Group will invest over 4,700 crore rupees in Vodafone Idea through a preferential issue of warrants convertible at 11 rupees a share. The infusion provides a confidence boost after Kumar Mangalam Birla assumed charge as chairman. ICICI Prudential Life Insurance takes a knock after Prudential PLC looks to sell 12% of its 22% stake following a deal to acquire 75% in Bharti Life Insurance for 4,200 crore rupees. With this, Prudential will go solo in India, parting ways with ICICI. Tata Steel reports a healthy fourth quarter on good realizations and offers a positive near-term outlook, but a range of uncertainties around its European operations and low visibility on medium-term growth sparks profit-taking. And oil leaps to over $110 a barrel after Donald Trump says that the clock is ticking for Iran, and reports suggest that the US and Israel are readying for aggressive military action. The lapsing of the US waiver on Russian crude purchases adds to the mix. Good afternoon, you're with us here on Business Lunch. We are coming to you live from the CNBC TV 18 Motilal Oswal studios. I am Hormuz Fatakia, and it is a very, very smart recovery from the lows of the day. The bulls will be the happy campers currently for the index, almost now into positive territory. 23,630, now a 330-point recovery from the lows of the day. So a very, very sharp up move that you have seen from the day's low. We opened lower, fell up to around 300 points, and now have recovered most of that lost ground. The Sensex has recovered over 1,100 points from the lows of the day, and leading that recovery is IT. Of course, the currency plunging to record lows in today's session as well. That has provided a boost to these IT names, and it is led by Midcap IT. The IT index is up 2.5% from the lows of the day. But take a look at the top gainers: Coforge, Persistent Systems, Emphasis, all of them seeing very, very sharp gains now in today's trading session, anywhere between 4 to 5%. Emphasis is up 3%. Coforge is up almost 5% on last check. And Tech Mahindra among the Nifty names is the one that's leading the surge. But the contributions to the Nifty recovery has come from the index heavyweights as well. You take a look at HDFC Bank, that has recovered from the lows of the day. Take a look at Reliance Industries, that has recovered from the lows of the day. And of course, the IT names that are adding to it. HDFC Bank now 0.8, Reliance Industries now just above the flat line, but has moved significantly, recovered almost 20 rupees from the lows of the day. HDFC Bank is the one that's 0.8% higher at the highest point of the day, contributing significantly to the index recovery. Well, I'll just pull up the currency to check whether there has been any further deterioration in that against the greenback. 96.30. 32 was the record low, and now it's a slight improvement, if you could call it that, still at 96.26. So that's the currency. The markets are back in the green now as we speak. 23,650 on the index. It remains to be seen whether that will sustain as we move into the final 2 hours of the trading day. But the one stock that's underperforming today, though, is Tata Steel, one of the multiple negative earnings reactions that you have seen, and this is despite a good fourth quarter. Let's go across to Nigel, who's here to give us all the details. Nigel.
Oh, that's right. Tata Steel's numbers actually are good. The realizations were better across the board, and that definitely helped the numbers. If you're looking at volume, on the volume front, the India business, you had good growth on a year-on-year basis, so that definitely helped them in terms of a top line. And besides that, the Netherlands business as well, on a sequential basis, there was a bit of an uptick in terms of volume. So put that together, that's what led to the numbers looking better. On a consolidated basis, the absolute EBITDA number was better than what we were working with. Let's break it up for you then in terms of geographies. The India business, the EBITDA per ton came in at more than 15,200 rupees. That's mildly better than what we were working with, but much better on a sequential basis as well as on a year-on-year basis. Besides that, the European business was reporting losses for the last few quarters. That reported a mild profit in comparison to a mild loss that was expected. And the reason is the Netherlands business, yes, the profitability came down a little bit, but on a year-on-year basis, it was much better. And the UK business, the losses have reduced out there, which is good news. The realizations clearly have offset any kind of input costs, at least for the past quarter. The net debt number as well came down by around 2% on a sequential basis, and the street will like it. What's the way ahead? Well, the management has guided for around 2 million tons of additional volume to come in FY27 in comparison to FY26, and most of it will come out of India. Besides that, they're saying that in quarter one, the EBITDA per ton for the India business, in fact, will improve, which is good. While there will be some kind of pressure on the Netherlands business, and on the European business, there could be some kind of a move towards the profitability aspect. Net, numbers look good. Commentary is good as well. The stock comment for some bit of profit taking, mainly because the street is questioning whether or not quarter one FY27 will be a peak quarter in terms of profitability.
Still 3% lower is Tata Steel. Nigel, thank you for that update. Barring Tata Steel, there are a lot of other names that are also reacting to their results. Ria is here with a summation of those. Ria.
Well, yes, let's start off with Gland Pharma first. This stock is up nearly 15% in trade today after a very strong set of numbers. Revenue has gone up by around 22% compared to the estimates of 15 to 16% growth, and net profit also up a whopping 86% compared to the previous year. Hind Copper as well has posted a decent set of numbers in this quarter. Revenue has gone up by around 58% compared to the previous year to nearly 1,156 crores, and margins have also expanded quite significantly to over 54% in this quarter versus around 36.4% in quarter 4 of FY25. For Premier Energies as well, good set here as well. The strong growth has continued in quarter 4, led by strong execution this time around. Revenue going up around 38% for the company, and net profit also has seen an increase of around 64% compared to the previous year. For Power Grid, however, this has been a weak quarter for them. The stock is also down around 4% as a result of this. The revenue has declined by nearly 5%, and EBITDA also seeing a decline of over 11% compared to the previous year. Delivery as well seeing a cut of around 5% in trade today. The revenue had gone up by around 38% for the company, and EBITDA margins also expanded to around 7% versus 4.5%. But still, the stock is taking a hit in today's trading session. And Cochin Shipyard, also one of the big losers in today's trading session, down around 5% at this point in time, but it was down around 7 to 8% early in the trading session. The revenue for quarter 4 has declined by around 26% versus estimates of just a 6% decline, and EBITDA has also declined by around 13% versus estimates of 12% growth. So overall, it has been a weak quarter, and the full year performance has also been quite weak for Cochin Shipyard, which is why the stock is down in today's trade.
Ria, thank you for that update. The other one that's not doing very well today is ICICI Prudential Life Insurance. And of course, there is after the promoter entity, Prudential PLC, announced that it will be trimming its stake in the company to just under 10% from the current 20% that they hold. Yash is joining in with more on this. Yash, tell us more.
Well, absolutely. The transaction announced by Prudential PLC, which is to buy about 75% stake in Bharti Life Insurance, which will be done for about 4,200 crore rupees, has, brought some overhang as far as ICICI Prudential Life is concerned. That's because Prudential PLC holds about 22% stake in ICICI Prudential Life Insurance. And with its plans to acquire 75% stake in Bharti Life Insurance, as per regulations, it will have to bring down its stake to less than 10% in ICICI Prudential Life Insurance. That's because the regulations do not allow one entity to be a promoter entity in two life insurance companies. And to be a non-promoter, you'll have to trim down your stake to less than 10%, which means that Prudential PLC will have to sell about 12% stake in ICICI Prudential Life Insurance to be compliant on the regulatory side of it and proceed with the new business venture. This is about 9,200 crores of selling as far as ICICI Prudential Life is concerned, and that has created the selling overhang on the stock today. Of course, Prudential PLC has said that they will reach out to the regulator to understand a time frame in which they can divest its 12% stake in ICICI Prudential Life Insurance. It remains to be seen again what is the kind of time frame that the regulator also provides to Prudential PLC for divestment of that 12% stake. Of course, shorter the duration of that time frame to divest the stake, higher would be the pressure because a limited time allowed to divest its stake. So hence the stock reflecting that particular overhang.
Yes, thank you for summarizing that for us. And now the other one that's under pressure today is Vodafone Idea. The fourth quarter average revenue per user was up sequentially, but there are a lot of other aspects that need to be addressed as well. Sudarshan is here with more details on that. Sudarshan.
So two parts for Vodafone Idea. One set of that company had announced Q4 FY26 earnings, and those earnings had looked operationally okay, and on some fronts it was better than peers. So if you talk about the revenue, it has grown more than 2%, 2.3% on a sequential basis. Even margin has come in above 43% versus 42.5% again on a sequential basis. Average revenue per user has increased 1% on a sequential basis, and it's better than peers, and now it has increased to rupees 174. The heartening part and the most important part in the earnings was subscriber loss. It was at 0.1 million, and that's the lowest loss that company has seen in the last 6 years, or say since FY26. But the other part and the most important part was the promoter infusion, and the promoter is going to infuse almost 4,730 crore, and that would be done via convertible warrant, and it's at rupees 11 per warrant. It's done at a discount to current market price. So that's the reason. And over the last few weeks, you would have seen that there is Vodafone Idea share price has seen a huge run up. So you can say it's today we are seeing a profit booking. But beyond that, what would be tracked very closely is debt fundraising. Whenever it happens, that would be tracked closely. And if that happens, it can take the stock higher again. But as of now, stock today is seeing profit booking.
All eyes will be on the earnings call as well. Sudarshan, thank you for that. Now, in a major relief for the aviation industry, which is reeling under the cost of high fuel prices, the state governments of Maharashtra and Delhi have cut value-added tax on aviation turbine fuel. Madhya is joining in to tell us more about how it will aid savings for a lot of these airline companies. Madhya.
Well, it is a major relief for airlines, especially Indigo, that operates multiple flights on the Delhi-Mumbai route. Mumbai and Delhi are key aviation hubs, and the value-added tax of VAT coming down to 7% significantly lowers the jet fuel costs for carriers. Remember, fuel accounts for nearly 35 to 40% of an airline's operating costs, the single biggest cost in an airline's expenses. And airlines were paying 25% VAT on jet fuel in Delhi and 18% in Mumbai. Now, when the VAT is cut down to 7%, it translates into huge savings for airlines. So, ATF in Mumbai is priced at nearly 98,247 per ton currently. That comes down to nearly 89,100 per ton after the VAT reduction. So, saving roughly 9,000 per ton. In Delhi, ATF prices were earlier around 1,05,000 per ton and now down to 89,880 per ton, saving 15,000 rupees per ton. Now, giving an example, a typical Airbus A321 operating a Delhi-Mumbai flight typically burns roughly 4 tons of fuel. At older fuel prices, airlines were spending over 4 lakh on fuel for one such flight. With the VAT reductions now in place, airlines could save roughly 60,000 rupees per flight from Delhi and about 36,000 rupees per flight from Mumbai, purely on fuel costs. So, major relief for airlines due to the VAT reductions in Delhi and Maharashtra.
Madhya, thank you for that. Indigo also trading lower currently, 1.25%, but some big news coming in there for the aviation space. Take a short break, back with more on the other side. Stay tuned. Welcome back. Now, the U.S. Treasury yields continue their ascent as the global bond market sold off amidst concerns of resurgent inflationary pressures. The 10-year U.S. Treasury yield, which is the key benchmark for the U.S. government borrowing, has surged to its highest level in 15 months. The longer-dated 30-year Treasury bond yield has now reached a two-decade high at 5.14%, while the yields on the 10-year German bond rose more than 2 basis points to reach 3.18. Meanwhile, Japan's 10-year government bond surged 13 basis points to reach 2.73% as well. Now, let's also hear out what Esther George, the former president of the Kansas City Fed, has to say on these rising bond yields.
Whole credibility of this institution, I think, depends on achieving its mandate. And its mandate is low and stable inflation, which they've defined as 2%. So when you go on now a sixth year of seeing inflation run hot, and again, for reasons they couldn't have anticipated, they have to be very attentive to that. And I think you already hear some of that in the most recent meeting they had in April. The two-year bond yields are beginning to go higher. I think it's the market looking for, again, the Federal Reserve to be very sure about its willingness to bring that inflation down.
Now on to updates from West Asia. As a stalemate for a peace deal between Washington and Tehran continues, US President Donald Trump has warned that for Iran, the clock is ticking for a peace deal. The post on Truth Social also added that Iran better get moving or there won't be anything left of them. Additionally, Trump also shared another post on Truth Social featuring an AI-generated map of the Middle East overlaid with the American flag and multiple red arrows pointing towards Iran amidst the escalating tensions between the warring nations. Now, the president's warning comes after he had a phone call with Israel's Prime Minister Benjamin Netanyahu on the conflict. Meanwhile, the UAE reported damage to its nuclear plant after a drone attack and said that it was determining the source of the attack. CNBC's Dan Murphy is here with the latest. Dan.
President Trump told Axios overnight, as you say, the clock is ticking. He also warned Iran will be hit much harder than before if it doesn't come up with a better proposal. So he's now waiting for an updated Iranian offer and says he still believes Iran wants a deal here, but he is not giving a specific deadline. As you say as well, the president now expected to convene his full national security team in the Situation Room on Tuesday, at least according to Axios, to discuss military options. That is part of the reason we have seen oil prices staying well bid at the open today. The other catalyst has also been a sharp uptick in attacks towards the Gulf at the weekend. The UAE Defense Ministry saying a drone strike damaged an electrical generator outside its Barakah nuclear power plant. Two other drones that entered UAE airspace were also intercepted. And this is interesting as well. The ministry is saying that investigations are now underway to determine the source. The UAE has not directly accused Iran, but the diplomatic advisor Anwar Gargash really left little doubt, writing on X that the attack, quote, whether carried out directly by the principal actor or through one of its proxies, represents a dangerous escalation and a dark development that violates all international laws and norms. Of course, the UAE's foreign minister has also spoken with the IAEA Director General, who confirmed that there has been no impact on radiological safety levels as well. Just by way of background, Barakah is a really important energy infrastructure asset here in the UAE. It's actually the Arab world's first operational nuclear power plant. So striking that site, even on its outer perimeter, is quite a significant escalation in a conflict that really already had very little room left for escalation as well. And it also comes at the moment when diplomacy is really supposed to be moving forward as well. And on the diplomatic track, at the weekend we saw Pakistan's Interior Minister in Tehran for talks with senior Iranian leaders. Qatar's Prime Minister also speaking on Sunday with his Pakistani counterpart and with Iran's Foreign Minister as well. So the mediation channels are still open here, but there is very little progress, it would seem, on a deal. And we have also seen that uptick in attacks, which perhaps has left some now questioning whether or not this situation is putting the US, Israel and Iran back on a path towards what could be potential conflict.
Dan Murphy, thank you for those updates there. Numbers from VRL Logistics at the bottom of your screens. 3% downtick in its profitability. Revenues also going up by around 5.5%. It'd be interesting to see the operational numbers that come in. Prima facie, they look like a fairly subdued number. As of now, the stock trading with losses of close to 4%. We'll get you more operational details on the other side of this short break. Stay tuned. Welcome back. Now, Prime Minister Narendra Modi is on a 5-nation tour to the Netherlands, Sweden, Norway, Italy and the UAE, meeting European business leaders yesterday. The Prime Minister pitched a bold investment vision to Europe's top CEOs, underscoring India's resilience and growth potential. Abhimanyu is here with more details on this. Abhimanyu.
Well, the PM had earlier visited the UAE, where a strategic petroleum reserves saw an MOU. Also, different MOUs were signed in the UAE to secure long-term supply for LPG, apart from an investment commitment of $5 billion. Post that, in Netherlands, Tata Electronics and ASML had signed an agreement for a semiconductor fab in Gujarat. The Prime Minister Narendra Modi also said in the Netherlands that the decade is shaping up like a decade of disaster, and if the conditions are not rapidly reversed, a large chunk of the world's population would be plunged back into poverty. Also, several announcements were made during his visit to Sweden, in which the Joint Innovation Partnership for Cooperation in AI, 6G, critical minerals and sustainable mining was also signed. Also, both the countries look to double their bilateral trade and investment in the next 5 years, as well as fast-track the implementation of the India-EU FTA. Also, at an industry roundtable, Prime Minister Narendra Modi had urged Europe's top CEOs to invest in India. Now, currently, the Prime Minister Minister is in Norway, post which he's slated to travel to Italy as part of the five-nation tour. It remains to be seen what further developments are going to take place as part of the ongoing tour, in which several announcements have already been made about investments, about MOUs, and also India and Sweden as well as Netherlands have elevated their bilateral partnerships respectively to a strategic partnership. So that clearly means more synergy in trade and investment, and also possibly more cooperation in critical areas like defense and critical manufacturing. So clearly several deliverables coming out of the tour, but what remains to be seen is what is going to be the degree of investment which is going to flow into India post the five-nation tour.
Abhimanyu, thank you for that update there. Now, it was yet another wild day for stocks in South Korea, and all eyes are on Samsung Electronics. The world's largest chip maker is bracing for a potential strike if the company and its labor union fail to strike an agreement on wages. CNBC's Lisa Kim joins us with more.
Samsung Electronics and its labor union are at loggerheads over wages. The labor union is threatening to go on a strike starting Thursday if their demands are not met. The two sides have resumed wage talks with a government mediator in their last-ditch effort to avoid a strike. And investors are following the development closely as the conflict at the NVIDIA supplier could worsen the global chip shortage. But in a major development earlier today, a South Korean court partially accepted Samsung's injunction request to stop a strike. This means the labor union has to maintain the same level of staffing and operations as normal, even if they choose to go on strike. South Korea's news agency Newsys reports, citing the labor union's lawyer, that they will go on a strike as planned within legal boundaries. Still, the latest court order helped bring back some investor optimism, sending Samsung shares higher by more than 6% at one point. President Lee Jae-myung, who is seen as a union-friendly government, said that on social media this morning that corporate management must be respected as much as labor rights. Yesterday, Prime Minister Kim Min-seok said that the government will consider all options to protect the economy, including emergency arbitration, which would stop a strike for about a month while a government agency steps in to help. South Korean chip makers are powering the country's economy and the stock market despite U.S. tariffs and the Iran war. For CNBC Business News, I'm Lisa Kim.
Lisa Kim, thank you for that update there. It was a wild day indeed for the South Korean stocks. After an initial plunge of around 5%, the Kospi recovered to close the session with gains of around 0.3%. Take your leave on this edition of Business Lunch. From me and the team, thank you for watching. Midcap Radar on the other side.
Good afternoon. Welcome to Midcap Radar live from the CNBC TV 18 Motilal Oswal studio. I'm Sonal Bhutra. With me as always, Vivek Iyer. Massive recovery from the lows. That's the news that we are tracking for now. We are above that 23,600 mark. The Sensex is in the green. Midcaps have surged sharply from the lows, and this recovery is really led by the Pharma pack. We have banks doing really well. And let's see whether we follow through or not.
Right. Good afternoon, Sonal. A very sharp intraday recovery is what's been seen. Most of the heavyweight private financials have staged a smart recovery, leading to the markets going higher in the session. But the mid-cap and small-cap space continues to remain under a little bit of pressure. But a lot lined up on the show, an important corporate conversation as well. So let's start off with the top headlines. Market erases losses to trade near the flat line. Nifty trades above the 23,600 level, with the recovery largely led by the IT stocks, while metals, auto and realty lose ground.
Gland Pharma delivers over 20% growth across geographies, with the European business growing over 35% in the fourth quarter. Margin also expands, while analysts expect the GLP-1 opportunity to add growth going forward. The stock rallies over 12%.
Amber Enterprises reports an operationally steady quarter, but the stock slumps 15% as the management in its earnings conference call flags higher copper costs and the possibility of margin contraction going ahead.
Cochin Shipyards FY26 numbers significantly miss growth guidance. Revenue declines 5% versus the guidance of 15% growth. Margin, EBITDA and profit also decline. The stock slips more than 4%.
KEC International tumbles over 9% in trade as Q4 PAT falls 28% and margins shrink 80 basis points on operating deleverage. The management tells CNBC TV 18 FY27 growth is seen at 10 to 15%, though Q1 remains muted. Well, welcome to Midcap Radar, and what you're looking at essentially is an extremely sharp market recovery that we're seeing. Some of the names that have recovered very sharply, of course, the Nifty is now flirting with the green territory. Some of the names from the broader end of the market that are doing very well, of course, have a look at Policy Bazar. That particular stock has surged to the day's highest point. On the other hand, amidst the market strength, Coal India has slipped to the day's lowest point, and other stock that's underperforming is actually Uno Minda. A conference call over there, despite the numbers being quite strong, Uno Minda has also now slipped to the day's lowest point. Some of the consumer discretionary names are under quite a bit of pressure, names like United Spirits, HUL, Dabur, and even some of the other names like VPL, in fact, has actually moved to the day's highest point. But overall, the consumption pack today under a little bit of stress. Some of the names that have done quite well, ICICI Bank, remember today morning they've come out with a notification saying that they will continue to hold their shareholding in ICICI Prudential Life steady, and that's given a little bit of flip to ICICI Bank. But ICICI Prudential is one particular stock that actually seen quite a bit of volatility, a very sharp intraday fall, followed by a sharp recovery. But it's now time for an earnings conversation. It was a good quarter for Tata Steel. The company's net debt reduced, while Europe's business EBITDA losses also narrowed sequentially. Our colleague Nigel spoke to the CEO and MD, TV Narendran, and started off by asking about their outlook on steel prices for Q1 FY27. Let's listen to the slice of that conversation.
Yeah, steel prices have been moving up for multiple reasons. Firstly, the demand has been strong in India. Secondly, there are cost pressures on the industry, particularly in the last 2 to 3 months. And thirdly, prices have come back from the lows that we'd seen in October, December quarter and continuing till January, February. So we are coming back to 57, which is pretty much what it was about a year back. On our guidance for this quarter is 6,000 rupees per ton higher for this quarter compared to the previous quarter. Whether steel prices will go to 60,000 for the rest of the year, I certainly think it will stay on the higher side for 2 reasons. One is, like I said, the cost pressures. The other is, of course, like I said, the demand is strong. But also a third reason, which is that Chinese steel prices have started moving up again. It's crossed $500, maybe because of cost pressures and also because of the export restrictions that they put in place. So overall, I'm a bit more positive about the industry for this year compared to last year.
Well, that's good to hear, sir. And do you think directionally then the EBITDA per ton moves up from around this 15,000 rupees per ton or closer to around 19,000 rupees per ton? Get a build right now?
I won't give you a specific number, but it will certainly look better this quarter compared to the previous quarter. Not all of the price increases will flow through to the EBITDA because we also have cost increases. Apart from the usual coal prices, etc., the rupee getting weaker, freight rates going up, many consumables going up because of the Middle Eastern crisis. So I think some of the price increases will be eaten up by costs, but overall we expect EBITDA in Q1 for India to be better than Q4.
Let's talk about Netherlands then. The coke Arvind shutdown notice is what you have got. You'll have to now source some part of your coke requirement externally. What is the current gross margin in Netherlands? And because of this external sourcing, what does that come down to?
So, we've got this notice. We have not got any timelines, and we are working with the authorities. We are trying to find the way to do it in a proper, controlled manner. We had already planned that we would bring it down or close it by 2028, 2029. And that's the timeline that we would prefer for a controlled and a planned transition. But that's a conversation going on with the authority. So it's not that we will need to be buying coke immediately, but over the next few years, we'll have to transition to buying coke instead of making coke there. So we will plan on that over the next few years. I think the current impact is also on the direct strip plant, which had been closed for the last few weeks, but that should open in the next few weeks, next couple of weeks or so. That was more because of some other emissions that we had coming out of that plant.
Okay, and Europe has turned into the black. Now you have a bit of a split verdict that's coming out. One is that Netherlands profitability could come down a little bit directionally, and UK's losses could come down a little bit. Do you expect Europe as an absolute number to continue to remain in the black? And if you could help us out with some guidance on the EBITDA per ton on both these two.
Yeah, so if you look at it at an overall level, Netherlands, which was traditionally positive EBITDA, was about minus 500 million EBITDA about 3 years back because of the issues we had with the blast furnace. We moved it to last year, we came to about plus 80. This year we finished at plus 260 or 270. So we moved about 800 million from negative to positive in Netherlands. This year it will be positive EBITDA. It will be, we expect it to be better than what we delivered last year for the full year. Quarter on quarter, there will be some changes because of some of the disruptions. But Netherlands is not going to do worse than the previous year. It will do as well as the previous year is our expectation, if not better. As far as UK is concerned, again, the trend has been in the right direction, may not be as fast as we would have liked it to. So if you see the improvement in EBITDA for the financial year, which is finished, it's about 150 million better than the year before that. Still negative, but better. And this year, we expect it to certainly start moving into positive territory. Q1 will certainly be better than Q4, and Q2 will be better than Q1 because we've got the policy support that we've been talking about for the whole of last year. We got that support in the middle of March.
Okay, so but UK turns into the black towards the end of this year?
Yes, certainly it does. On a quarter basis, yes. For the full year basis, depends on how we do in Q3, Q4. The only uncertainty is what's happening in the Middle East. Otherwise, you would have clearly become positive for the full year this year.
Okay.
But I think we're heading in that direction, and we are hopeful to be there.
Which quarter? Quarter 3 or quarter 4?
Well, we are just now chasing Q3 for sure. We are trying to see if we can be positive in Q2.
Brilliant. Got that. Don't you think it's an ideal time then? If things are looking good, policy support is what you've got in Europe. Isn't it a good time to, try to get some kind of a deal going, maybe bring in a strategic investor, try to, deleverage that balance sheet a little bit and just try to unlock some value since things are actually on the cusp of turning around? Europe, no, I mean Netherlands as well as UK put it together.
No, I think in both places, we are just now focused on the transformation, getting things better and planning for the transformation. In UK, that transformation is already in place. And in Netherlands, we're still talking to the government. So too early to comment on what you're asking.
Okay. All right. What about the net debt number? In the past, we've spoken about $1 billion, debt reduction. For this year, what will you be happy with? There has been some kind of skipping off out there. Operationally, things will look good. And bulk of the capacities, I think, come in from post FY28 onwards. So do you think the debt reduction continues this year?
It does. If you see, we've reduced it by about 2,500 crores, the net debt, compared to what we were in March 2025. So that's 2,500 crores. Plus, we spent about 3,000 crores on acquisitions. We acquired a power plant in Netherlands, which is connected to the steel plant. We acquired the BlueScope part of Tata BlueScope. We acquired BRPL. So we did a few, and that added about 3,000 crores. So if you look at that, 3,000 for acquisitions and 2,500 net debt reduction. We were about 5,500 crores from regular OPEX and CAPEX point of view. So we will continue in that direction. We want to obviously, continue to bring down the net debt, but we also have our ambitions for growth. So we are quite happy that the net debt to EBITDA is below 2.3. We'll try and get it below 2, but we are okay in the 2 to 2.5 range.
Okay, got that. Your competitors, JSW Steel, they have given us a target of 2032 of around 78 to 80 million tons. That's a consolidated entity. At Tata Steel, if I had to ask you for a target for the next 5-6 years, what should capacity look like?
No, I think we've always, there are 2-3 things here, Nigel. One is in terms of optionality. With the existing sites, we can clearly go from 45-50 million, that level. And if we start the Maharashtra side, that takes us to about 60 million. But that optionality is there. I think we are quite focused on growing our downstream as much as the upstream. So the upstream number we had guided was around 40 million. We'll stick to that over the next few years. But I think it's more and more about downstream play for us because we think a lot of the value will shift from the upstream to the downstream, particularly with iron ore costs going up in India, coal prices continuing to stay strong and the rupee getting weak, then costs will go up. So we believe that, our downstream play becomes more and more important. And that's why a lot of our focus in the last year or two has been on growing our downstream, acquiring, some of our JV partners, etc. The other thing is, of course, we want to manage our costs more and more tightly, hence our acquisitions on the cost side, whether it's BRPL, whether it is a JV partner share in TMILL, which we've just announced. So these are all acquisitions which helps us manage costs over the entire value chain much better. So we are going to want to be number one in the attractive segments, particularly automotive, oil and gas, and the retail segment where we have a very strong franchise, rather than chase number one at an overall level.
Got it. Final question before we let you go. India's per capita consumption of steel has moved to around 100 kgs odd. As you'll have mentioned in the past as well, global averages are above 200 kgs. But we have seen various other nations that as they get to this 100 kgs mark, the growth really picks up. What is your outlook in terms of the per capita consumption of steel here in India from year on? What kind of level of growth we should work with?
So, the consumption growth in India has been about 8%, 8 to 10%, and I think it'll stay at that level as long as the GDP is in the 6 to 7% range. India's for a long time struggled with steel consumption growth below the GDP growth rate. I do believe it will be more than the GDP growth rate simply because of the focus on infrastructure spend. So as long as the government continues to spend on infrastructure, the steel growth will be higher than the GDP growth rate. And, 6 to 8%, 6 to 7% GDP growth means about 8 to 10% of steel consumption growth. So if you do the math, then that means the per capita consumption should also grow at around 8 to 10% because the population is not growing so much now.
Okay, that's the word coming in from Tata Steel. The stock lower by 3%, but has recovered from the lows of the day as we speak. Now let's get to our special segment, Midcap Movers. We have Ria to take us to the midcaps that are moving around in trade. Ria, over to you.
Well, there's a lot of stocks moving around in today's trading session. Starting off with the gainers first, we have Gland Pharma, one of the top gainers today, up around 15% after posting a very strong set of numbers in Q4. The stock is also trading with very strong volumes and it's also at its 52-week high today. GE Shipping as well trading with very strong volumes today, up nearly 9 times compared to its 30-day average, and the stock is also up nearly 50% in the last 6 months. The stock is also at its 52-week high as well as its all-time high today. Shipping Corporation also continuing its stellar run over the last 1 year. It is up around 85%. Carborundum as well. The stock has given up some of its gains at this point in trading session, but in the last 2 months, the stock was up around 50%, and the stock has also hit its 52-week high today. Acutaas Chemicals also continuing its very strong run over the last 1 year. The stock is up nearly 2.5 times in the last 1 year. But moving on to some of the stocks that have hit their 52-week low today, there's Apollo Tyres, the stock is also down around 30% in the last 6 months. Kalyan Jewelers as well, down 40% in the last 1 year. Jyoti CNC has seen a cut of around 45% in the last 1 year as well. And even Keynes Technology down around 45% in the last 6 months. And Swiggy also touching its all-time low today as well as its 52-week low. And this stock is also down over 40% since its listing in November of 2024. And moving on to the top losers of today's trading session, there's Bajaj Electric, which has taken a big hit in today's trading session after posting a weak set of numbers in Q4. The stock is also down around 45% in the last 1 year. Cochin Shipyard also taking a big hit today after posting a weak set of numbers in Q4 and for the full year of FY26 as well. Even CE Infosystems, which is MapMyIndia, that stock is also down around 45% in the last 6 months. Gallant Ispat has also tanked around 20% in the last 1 month after going up by around 90% over the last 1 year. And the last stock is PG Electroplast. The entire EMS pack, in fact, is seeing a lot of trading pressure, and the results of PG Electroplast will be coming out tomorrow, and a weak set expected for PG Electroplast, and this stock is also down over 40% in the last 1 year.
Well, thank you so much, Ria, for joining us, giving us a comprehensive list of all of the stocks in the broader end of the markets that are making all the sharp moves today. Well, we now slip into a short break. We'll get you more on the markets and stock-specific action on the other side. Stay tuned.
Welcome back. Well, while the mid-caps are underperforming, a couple of stocks in the broader markets which are surging in trade. Phenotex Chemicals is up 18% as we speak. So that stock at the day's high. So is the Nifty as we speak. So that's just down 18 points for now. We do have Suven Life Sciences, which is up another 17%. GE Shipping is doing really well, 10.5% higher on that stock. Some of these chemical names, the shipping stocks, and a lot of these pharma names doing really well. We do have Marksans Pharma, which is the other stock, which is up around 5%. It's GE Shipping, not GE Power that I'm talking about. So that stock is up around 10%. So big surge across the board as far as some of these stocks are concerned. And of course, Nifty, which continues to surge from the lower levels, is at the day's high as we speak. And banks, we have the pharma names and IT names, which are leading the pack for now. But let's talk about some news updates and some earnings updates as well. Shares of Gland Pharma gained in trade after posting a steady set of Q4 earnings. Let's go across to Ekta for more details on this one. Ekta?
Well, good set of numbers coming in for Gland. Revenue was up around 22% this quarter. There was a margin expansion which took place almost to 30% on a year-on-year basis versus 24% on a same time last quarter, and versus 19% last quarter as well. So there was an expansion with Q-on-Q as well as Y-on-Y. The profit was aided by a better other income this quarter as well. Now, in terms of geographies, their core geography, US, was up around 24% year-on-year. Europe did well, which was up 36%. India also was up in a solid 28% this quarter as well. Senexi, which is one of their arms, in fact, was EBITDA positive despite a lower top line on a sequential basis. The guidance from the company is around 12 to 13% growth in FY27 in constant currency. Ex-Senexi, they are expecting the margin guidance of around 33 to 35%. According to analysts, that's a bit conservative at this point. Analysts also expect that the GLP-1 opportunity could be a big driver for Gland Pharma going forward. Kotak Institutional has upgraded the stock to add with a target price of 2,075. According to them, the earnings visibility has improved based on most approvals in place and near-term patent expiries, as well as the commencement of new CDMO contracts. We've baked in a strong 22% EPS CAGR over FY26-29 based on new launches as well as operating leverage.
Thank you so much, Ekta, for joining us and giving us all of the details on Gland Pharma stock higher by 14%. On the other hand, one stock that's taking on the chin is Amber Enterprises. This on the back of cautious management commentary. Upasana joins in with the key details.
Well, the company in its con call has guided for a temporary margin pressure of nearly about 50 to 100 basis points on the back of the elevated input prices and even currency depreciation. Well, the copper-clad laminate is what the company says has seen a heightened hike in the input prices in the last 1 year and could further strengthen in back of which is the main input used for the PCB business. Now, for RAC segment, this year has been challenging, but the company says that Q1 FY27 has started on a positive note. For RAC, it expects a volume growth of 20% on the back of the high base in Q1 versus 12 to 13% in FY27 in terms of overall volume growth. Now, electronic business, which was the key growth driver this time around, has seen a strong growth momentum, and it expects it to grow nearly about 40% in FY27. And coming to the railway division, the margins were under pressure because of the high base in railways. They have guided that it will grow nearly about 30 to 35% in FY27 and FY28. Now, overall, just giving a glimpse of the company's Q4 result, it was a beat on EBITDA margins, mainly led by the strong performance from the electronic division. But the company's consumer durables saw a soft growth this time around of just about 6% versus the other segments that reported a double-digit, nearly about 20% growth on one-year basis. In terms of margins also, consumer durables margins were under pressure, down nearly about 40 bips at 7.2%, and this margins were mainly led by the RAC pressure that came in due to elevated copper prices. So all in all, we can certainly see the softer demand impacting the company's consumer durable, but electronic division outperformed.
Okay, all right. Big downtick on Amber Enterprises today. Thank you so much, Upasana, for bringing us all those details. Delivery is the other stock on our radar. That one is lower in trade as well today. Manglam, how did the numbers look?
Well, the numbers for delivery weren't particularly bad, which is why, despite being lower in today's trading session, the stocks recovered from the lows. About 30% increase is what we've seen in their overall revenue. And importantly, there's been volume growth quarter on quarter as well. And remember, the third quarter has the festive season. So growing in the fourth quarter over that is a fair amount of positive. If you look at some of the key segments, both the express as well as the part truckload business, together, they've grown nearly 38.5% in revenue with margin expansion. The overall margins of the company have expanded by about 200 basis points as well, which on that base is fairly strong, which explains why the EBITDA has actually grown by about 80%. The net profit, reported net profit, is absolutely flat, and that's because of a higher depreciation expense, which is a non-cash expense. The reason why the stock is lower are two. One is the fact that the street believes that maybe going forward, some of their competitive moats that they have with regards to key clients, using them, and as against that, they wanting to move towards their captive logistics, something that Misho did earlier as well, could be a bit of a business risk. But the company is, said that it's such a thin margin business that important clients starting their own captive logistics makes it a lot more risk reward unfavorable than favorable. The other part, however, is also that there is always supply pressure on delivery with the kind of institutional holding that it has. So at higher levels, we do see exits from institutions, which explains why the stock struggles to go past a certain level, though on its part, it has actually seen a big recovery in the last a few months, where the stock from sub 400, despite the fall today, is staying well above 450.
Thank you so much, Mangalam, for giving us all of the details as far as delivery is concerned. Well, we'll now slip into a short break. We'll get him on the markets and stock-specific action on the other side. Stay tuned.
Welcome back. In the green for the Nifty, up 12 points, 23,656. That's the level for now on the Nifty. Banks, financials, pharma, IT are the green looking sectors for now. The big question whether that sustains or not. Rupee 2 has recovered from the lows of the day. But with that, we'll take your leave on this edition of Midcap Radar. Stay tuned. Your stocks when we return.
Hello, good afternoon. You've tuned into Your Stocks, coming live from the CNBC TV 18 Motilal Oswal studios. I'm Vinny Motiwala. Thank you so much as always for tuning in. Now, in terms of the markets, we're seeing a good afternoon. We've seen a very good recovery come in for the markets as well. As of now, the Nifty is back in the green, slight bit on the green side. Flattish is what we could say, hoping that this momentum continues through the next 1.5 hours of the trading session as well. But as of now, 23,640, about that mark is what the Nifty is trading at. Now, what is leading to these gains, right? Let's pull up the contributors maybe that is supporting the up move in today's trading session. We have the IT names that are doing well. So, Infosys, TechChem, all of them managing to hold on to gains. Apart from that, private banks, ICICI Bank, HDFC Bank, that's supporting the growth. And with that, we're Bharti Airtel in terms of the contributors for the Nifty 50 that's supporting the up move. On the flip side, you have the auto names like M&M, Maruti not doing well, Power Grid, that's been a bit under pressure as well. You have some commentary coming in from Power Grid as well at the bottom of the screens. And this is the company's con call that they are highlighting. They expect new HVDC to materialize over the next 18 to 24 months. That will be key to watch out for. But as of now, Power Grid as a stock is down 3.6% in the trading session. So no support there. But sector-wise, IT, Pharma are the ones that are holding on to greens, and PSU banks not doing too well in the trading session. But this is a show where we solve all your stock-related queries, and we're going to be doing just that with our experts and guests for today. We have Gaurang Shah, Senior Vice President at Geojit Financial Services, as well as Chandan Taparia, Head of Derivatives and Technicals at Wealth Management at Motilal Oswal Financial Services. Gaurang, as well as Chandan, good afternoon. Thank you so much for joining us on the show. Let's get started with the queries then. This first query is coming in from Raju, who's writing to us from Andhra Pradesh. He's holding a few shares of Vedanta. This is at a price of 276 rupees per share, and he's bought this after those demerger announcements that have come in. So he is holding this for a while now since the demerger has come in. What should he be doing with that? Currently, he's making some bit of a profit. The next one, he's also holding Netweb Technologies, and it's at a price of 2,000 rupees. Should they continue to hold both these stocks? Should they book out and get out of the with profits on this one? Gaurang, your view on the fundamentals first for these.
Well, hi, Vinny. Thank you so much for having me on the show. Good afternoon to all your viewers, to you and to Chandan as well. A small disclosure before I go ahead, all recommendations that I'll be sharing with you on the show, Vinny, they are part of our fundamental research team recommendation from a long-term point of view. Our company, Geojit, or myself, we do not have any kind of personal investments, no financial interest, no conflict of interest, but we share similar advice with our clients. They might have their investment interest. So first on Vedanta, I think it would have been a much better position if in case the investor would have bought Vedanta before it went split. However, post-split also, and as a disclosure again, we covered Vedanta before split. We are having a positive coverage after as a standalone. And our sense is that after the demerger, I think all business verticals should do well. Long-term, continue to hold on to Vedanta. On Netweb Techs, and fortunately, Vinny, we don't have specific coverage, but you know, in this sector, Vinny, companies which are able to reinvent themselves and realign with the changes that are happening will definitely do well. And in that case, no specific comments, but Netweb did well. Unfortunately, there was a little bit of choppiness and deeper correction, but now it should stabilize. Won't give specifics since we don't have coverage.
Okay, absolutely. But Vedanta, that's the view coming in there. Netweb, no specific coverage, but industry-wise, Gaurang did mention. Chandan, good afternoon on the technicals. Vedanta as well as Netweb Technologies, what are you seeing here in terms of levels? Vedanta, they bought it after the demerger. So does it merit still continuing to hold? And Netweb, looking at the run-up that we've seen in the last 1 year, 5 years, it's been one of those stocks, you know, every time that word AI comes in, Netweb Technologies is running away in trade. They do have the revenue. But what's the view on the technicals for both these?
Yeah, good afternoon, Mini. Thanks for having me. So first to comment on Vedanta, we are positive on the selective metal counter, and Vedanta is one of the strongest counter which has been making higher top, higher bottom on the monthly chart. However, just 2 days back, it hit the all-time high of 340, witnessed a retracement, but major trend is positive. And we have noticed that role reversal patterns are being formed. That means the previous small hurdles are turning as a support to drive the next leg of rally. So suggestion is continue to hold the position even for short or medium term point of view. 295 is major support. Till that level is respected, I believe buy on decline could continue for the next leg of rally towards 355 to 370. To comment on Netweb, We have seen a corrective move in the last week. In fact, on the daily chart, it has been making lower top, lower bottom. The only problem is just a couple of months back, it made high near 44.80, and this time it made the same kind of level where supply is clearly visible. So I'm worried about any kind of negative pattern formation, but major trend is positive, so that's why decline could be bought. Already we've seen a corrective move from almost 4,500 to 3,800 marks. I believe any decline towards 3,400 to 3,500 could be bought, as major trend is positive for a bounce back move.
Okay, we'll keep an eye out on those levels over there, Chandan. Thanks for that. But on that note, viewers, we have to slip into a very short commercial break. We'll come back with more of your stock-related queries on the other side, so stay tuned in. Welcome back to your Stocks and CNBC TV team. We still have with us Gaurang Shah as well as Chandan Tapare to answer all the stock-related queries. The next query for today, gentlemen, is coming in from Yamin, who's writing to us from Chennai. Holding 50 shares of Godfrey Phillips. Price is 2,215 rupees per share. Obviously, Godfrey Phillips reported their numbers also over the weekend. Good set that came in from the company. But as of now, we're seeing the stock is down 4% in the trading session today. For the long term, should they continue to hold or get out of the stock? They bought it at 2,215, so making some bit of a profit on this one. Gaurang, on the fundamentals first.
Well, so Vinny, there is always a risk involved in these companies, given that very recently we had a reasonable amount of higher price revision, which sent the stock of related sector, that is tobacco, cigarette and tobacco products, manufacturing companies, into state spin. Now, from this sector, we have a positive coverage on ITC. But ITC, as we all know, Vinny, have diversified business. Unfortunately, for companies like VST and Godfrey Phillips, they have focused business that is only concentrated with tobacco products and cigarettes. So future changes in terms of policy and price revision upwards could dent the margin, and along with that on the top line front. We don't have specific coverage on Godfrey Phillips, but yeah, a word of caution is definitely advised.
Okay, word of cautious is definitely advised on this one. On the technicals, levels that they should keep an eye out on for Godfrey Phillips, will they make more profits on this one? Is that a possibility in the near to long term?
it seems that upside is limited as of now. If I look at the price behavior of last 9 days, it had seen a corrective move from 39.50 to 18.50 marks, then witnessed some recovery in last 2 months and again finding hurdle near 24.80. However, it's trading above its 50 EMA, but it almost completed a small retracement bounce, and because of that, some profit booking again can be seen. So one can hold for long term, but on short term point of view, some corrective move can be seen, which can take it towards 2100 to 2080.
Long term is fine, but short term, maybe some volatility, some correction maybe is on the charts there as well. Thanks for that. Next query for today, we have Rajesh, who's writing to us from Hyderabad, and this is an investment query. He's saying he wants to know if it's the right time to invest in Bharat Forge, and he has an investment horizon of 5 years, so long-term investors. Gaurang, Bharat Forge reported their numbers. Optimistic commentary that came in for FY27. 25% revenue growth is what, they're expecting in terms of increase in EBITDA as well. Your view for Bharat Forge, is that the one you would look at, or is there another company?
Well, honestly, Vinny, we've just come out with a sell recommendation on Bharat Forge since our target price were, achieved. And this just happened about a couple of days back. So a good timing in terms of asking the question, because he's not got invested. And if I have to have the liberty to suggest something else, if it is to do with auto ancillary play, then Uno Minda would be a choice. And if you have to play with defense, because Bharat Forge has some part of the business in defense also, then it would be BEL. So you can choose either of them or choose both of them, Uno Minda or BEL. The choice is yours.
Okay, a couple of choices given there by Gaurang. On the technicals, what's the word coming in, Chandan? Is it maybe not the time to look at this one, or enter the stock now?
So the major trend of the counter is positive, and it really did well in last 5-6 years, from 200 to all the way towards 2000 marks. So the trend is positive. However, we are witnessing some consolidative move from last 3 weeks. But as of now, 1830 is major support. If that is broken, one is advised to exit from the position. If that is respected, I believe it can again see the bounce back move. If you're looking for some other name in auto ends, I'm closely looking at Motherson Samvardhan. That looks good. Any decline towards 120, 122 can be bought for an upside positional target towards 140 to 145.
Okay, we'll keep an eye out on Motherson as well. So thanks so much for that. But Bharat Forge also, Chandan did mention some levels, so watch out for that. Let's move on to the next query for today. This is coming in from the IT Pack web, Nirmal Jain, who's writing to us from New Delhi. He's holding 50 shares of HCL Tech. Price is 1,489 rupees. Currently, the stock is at 1,142. So they're making a loss on this one. Now, should they book their losses or continue to hold on to this one? Medium-term and long-term outlook for this, Gaurang?
So currently maintaining a positive view, Vinny, but a word in terms of the past performance that we've seen of IT companies. I'm talking about 5 years, 10 years back. I think that kind of performance will only be seen up to a certain expectation with companies which are going to reinvent themselves and are able to cope up with the ever-changing innovation and technology as far as the entire IT universe is concerned. We had a rude shock in form of Anthropic AI some time back, and now we are hearing a lot of news in terms of newer product launches, etc. Currently, we have a positive coverage. Hold on to it. You got in at 1,400. The stock is trading at 1140, 1150. If you have investable amount, you can add, but a longish time horizon and a relatively pull-down expectation in terms of return.
Okay, we'll keep an eye out on that. But technically, Chandan, does it merit holding on to this one? And is average an option for this at this rate? Because they've bought it at a higher rate. So is it the right time maybe to look at averaging, or maybe they'll get a bit more downside when they can look to average as well?
I think better to wait as of now, because if technically concerned, the stock is given a breakdown and now trading near its 30 months low level. Multiple supports were visible near 1400, 1450, 1350 marks. Those levels were decisively broken. In fact, the counter has been making lower top, lower bottom. Recently failed to surpass 50 DEMA with hurdle near 1450. Nifty IT itself is finding pressure. So weakness is clearly there. But yes, now not advisable to sell at current juncture. Use any bounce to reduce the position. That what I advise. I don't suggest to average, because trend is now changed to the negative side. So any bounce towards 1230 to 1250 can be used to reduce some position here.
Okay. Let's move on then to the next query. We have Meher who's writing to us from Vishakhapatnam. Investment query. HFCL and Sterlite Technologies wants to know if she can invest in both these names for a 5-year time period. Gaurang, your view?
Well, both have an history, Vinny, if you actually go to see in terms of the performance. And of course, with HFCL, I think those who are been in the market for a long time, they know it very well. Unfortunately, we don't have coverage. Well, good. Again, this investor is asking a question before getting invested. We don't have coverage on either of them, HFCL or Sterlite Technologies, but as an alternative investment idea, because she's got a 5-year time horizon, I think Ashok Leyland, or if I can advise a name from the NBFC category, that is L&T Finance. These would be preferred investment ideas.
Okay, preferred investment ideas, not a view on the two stocks that are there, but Ashok Leyland and the other names that Gaurang mentioned. Chandan, your view, is it the right time to enter these stocks on the technical levels? HFCL and Sterlite?
Yeah, it's tough to say right time because as Gaurangji said that these counter have long history. If I look at the bigger time frame chart, 26-year back in 2000, the price used to be at 25.78. However, we have seen a decent run up in last few weeks. But you need to keep in mind that major trend is quite volatile. The beta of the counter may take it to turn on the wider move. If you are taking risk, then only the position can be applied here. As of now, if only technical is concerned, it has immediate support near 122, hurdle it to 155. If 155 is surpassed, then I believe momentum could continue. Looking at Sterlite Tech, here some sort of recovery can be seen. However, again, it has been making higher top, higher bottom on a monthly, weekly chart. But we need to keep in mind that many times the counter moves circuit to circuit. So if by chance it takes a pause, it would be tough to exit the position. So keep the position sizing accordingly. But chart setup looks good. Major support is at 360. Overall, it can head towards 430 and 500 also if the key level is respected in the counter.
Okay, a bit of a volatility maybe could be seen. So be careful when you're investing in both these names. Next query for today, we have Pradeep Patel, who's writing to us from Bangalore. He's holding 5,000 shares of IRFC. And this is at a price of 215 rupees per share. Long-term investor. They're making a loss on this one right now. What should they do? Continue to hold IRFC or sell and book your losses and maybe look at some other names then? Gaurang?
Well, so Vinny, look, both sectors, I'll also like to bring in defense over here. So if you're investing in any company which is in defense or associated with Indian Railways, again, no specific on IRFC since we don't have coverage on IRFC, but you know, the kind of changes and the kind of modernization that is happening with Indian Railways, this is a 3-year, 5-year plus kind of time horizon story. One of the most important things that I was very pleased and happy to listen into was resolving the last mile connectivity with respect to Indian Railways. And this company happens to be a back-end, financier of such projects in India. And there's a lot that is happening. So whenever you invest in railways or defense, have 3 to 5 year kind of time horizon.
Okay. A 3 to 5 year kind of horizon is advisable to have when you're investing in either railway side, related stocks, or even the defense side. Chandan, to you, 215 rupees IRFC, what should they be doing now? Hold or maybe exit?
I think it would be tough to see the price of 200 plus now because the trend is negative. It has been making lower top, lower bottom on monthly chart. Already have seen a correction from 229 to now almost near 95, 96. So trend is negative. In fact, heading towards 150, 120 will be tough. So suggestion is don't average, try to exit on any bounce. If re-rating happens in the entire sector because of any trigger, then only I see the up move. Otherwise, as of now, the price pattern indicates the lackluster move with limited upside. Bounce could be sold. This is what I see in the chart.
Okay, that's a word there coming in for RFC. Next query then for today. This is coming in from Sriram Raghuraman, who's writing to us from Chennai, holding 100 shares of Tata Steel. Price is 111 rupees per share. Stock is trading at 210. They reported their numbers also over the weekend as well. It was a good number that came in from the company. Performance was much better across segments and businesses of theirs. Standalone volumes also were up by 11%. But Gaurang, on the fundamentals, they have a time period of only 1 year that they want to hold on the stock for now. What should they be doing?
That's challenging 1 year with metals, because we know the choppiness and volatility because of the international news flows that impact the metals companies in India. So, and of course, like you rightly mentioned, over the weekend, the numbers were much better than what our estimates were in some places, and the commentary post the numbers was strong. If you have time by your side, and if you can extend that time horizon from a year to maybe year and a half too, it will be better. But again, they got in at a good level. I think 111 they got in, if I'm not mistaken, if I heard that right. And the stock is trading at about 210. So you made a decent return over there.
Okay. If time by your side, then you could do better as well. So already making decent returns, but long-term, long issue is always much better to hold. Chandan, your view on this one as well. 1 year outlook and long-term target that you would give.
Yes, overall view on the counter is positive. In fact, the Nifty metal itself did well. And I believe selective, the ferrous and non-ferrous metal could be in focus. However, in between, some volatile swings cannot be rolled out. That is the nature of the sector and the counter itself. But the good part is on the long term, the counter is holding well above key moving averages. So as of now, till it holds above 185 to 192 zone, major trend remain intact. Even one can go for buy on decline, positionally looking for 235 and then 275 levels in the counter. In fact, 15 to 25% CAGR kind of movement can be seen in the stock given the past performance of last couple of years.
Okay, that's a view coming in there for Tata Steel. But Chandan as well as Gaurang, thank you so much for joining us on this show. That was the last query for today, so thanks so much for that. But viewers, thank you so much for tuning in as well. We're going to be leaving the markets at just 23,600 levels. We've come off from that recovery that we've seen, slight bit of that. But last sort of trade is still left. So you have a closing bell up next to take you through what's going to be happening in the markets, what you all should be keeping an eye on. So stay tuned in.
market headlines. To understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC TV 18 Motilal Oswal studio.
Most of the Asian markets are trading in the red. US President Donald Trump has warned Iran that the clock is ticking for a peace deal.
$111 a barrel, 101 plus actually.
Now, why does this have a negative read-through for ICICI Prudential Life Insurance?
We're down about 0.9, 24,400, 24,430.
The question is, what can the government do to fill this hole? I mean, there's no immediate remedy, right?
We expect that because of the improved defense business and international as well.
Well, yes, the only thing that has been trading on the higher side has been the crude oil prices.
Subdued start to a very busy trading week. The markets are looking to attempt a recovery from the lows of the day.
Cherry on the cake was the debt number, came down marginally by close to around 2% on a sequential basis.
Margins have surprised positively both sequentially as well as year-on-year.
On the volume front of RAC, it expects a 20% growth in Q1.
Now, when that is cut down to 7%, it translates into huge savings for airlines.
Massive recovery from the lows. That's the news that we are tracking for now.
Consumables going up because of the Middle Eastern crisis. So I think some of the price increases will be eaten up by costs.
Exactly 300 points off the low. That is the situation right now. 23,618. Low was 23,314. So that's the Nifty picture for you. This is Closing Bell. We are coming to you from the CNBC TV 18 Motilal Oswal studios. I'm Prashant. With me, my colleague Nigel. Nigel, hi. Afternoon.
Well, hi, Prashant. Feeling much better in comparison to what we saw at the start of trade. We were down more than 200 points. The breadth of the market was dismal with just around 350 stocks that were advancing. Yeah. At least that has corrected itself a little bit. So the Nifty has seen a big recovery from the lows of the day. The number of stocks advancing, have gone up a little bit from around 350. Now we're at around 650 stocks or thereabouts. And even the Midcap index, now we're down only around 0.4%. At the start of today's trading session, we were down close to around 1.5% or thereabouts. So at least a little better from what we saw earlier today.
It can't be absolutely confirmed, Nigel, but I heard from brokers, large brokers, that apparently there's some rebalancing out of a large fund, rebalancing out of Korea into India, some $400 million or so. We'll get confirmation, if so, later today, when we get the flow numbers, foreign flow numbers, etc. But looks like that is the flow activity via brokers that we've understood. Looks like, that's the reason for the big 250-300 point rebound that we've seen. I guess in some way it makes sense because you look at the dollar rupee, it's not as if the dollar rupee has seen a big move higher or anything. The rupee, that is, if we can have that up. So while 300 points on the Nifty, let's just look at the dollar rupee for a quick bit. I think we are still there off a little bit, right? Just a little bit of a taper, but I think within 6 paisa of new all-time low. So 96.2525 at this stage. Well, let me just quickly run you through what's the lineup here. So smart recovery from the lows, Nifty hovering above 23,600, broader market stocks underperforming. Actually market breadth is pretty weak. IT is up. IT lost 6% last week. Today it's up 2%. Pharma is the other one. Actually Pharma, of course, was up last week as well. It was, so that continues. Amber is down sharply. Management, of course, is cautioned on growth, margins, etc. And of course, we'll get you a list of whole host of stocks where we've seen some accidents post fourth quarter numbers, beg your pardon. ICICI Pru shares were down 8% at one point. They're down about 3.5%, so it's a big recovery from the lows. So again, some details coming up there. Gland is still up 14% or so, so that's the other one, which has of course been up from the start. Jana Small Finance Bank, we reported the deal is coming. It was announced earlier today. So Ritu will join us for some details there as well. How should you position yourself is the question. Mitesh is with us with exactly that. Mitesh, good afternoon. Good to have you here. What would you recommend?
Prashant, one in the morning, we were talking about possible downside target on the Nifty, and we did go down to as low as about 23,300. Managed to bounce back from there, which is also the area around the closing low on the hourly charts on the 13th of May. So, but I think the structure has improved. It broadly still looks like a market, which will only get some kind of strength if it starts getting past 23,800, 850 zone. So for the timing, we can assume that it's 23,300 to about 23,800 kind of a range. And the Nifty might just oscillate with a mild negative bias. Of course, closing about 23,800 would add some strength on the upside, and we could see a stronger pullback.
What about stocks, Mitesh?
Yeah. On the stock side, I think, I have a buy on Indus Towers. I think that's been doing well in this falling market. So buy here at the start at about levels of 421 and a target of around 445 or thereabouts can be looked at. And the second stock, which is on my radar, is has already been declining for some time, but still looks could see more profit booking. So LIC Housing Finance, it's recovered from the low, but on a 5-day basis declined a lot and below its averages. So LIC Housing Finance is a sell with a stop at about 553 half and a target of around 530 to about 527 can be looked at.
Got it. Okay. All right. Got that, Mitesh. Thanks a lot. Thanks a lot for that. Well, let's focus on a couple of names then. And just to highlight a few stocks actually from the broader markets, Finutex Chemicals, the stock is locked up 20%. I think it came out with a set of numbers. So the individual stocks actually are doing a thing of their own. I think we should get a couple of more names. Raymond is up close to around 10%. So that as well is seeing a big move. GE Shipping is up close to around 11%. All these stocks, they deserve special mention because it's a market that's actually very, a little bit nervous, and still these stocks are doing well. GE Shipping, Gland Pharma as well. Even Hind Rectifier, the stock was down 15% earlier today. Tata Mutual Fund is putting close to around 100 crores via the preference route in that one. From being minus 15%, actually the stock is now down, I think, close to around 5%. So there's been quite a big recovery from the lows of the day. Now it's down close to around 3.5% or thereabouts. But a stock that's getting hit hard is Amber Enterprises. The stock is down. I recall it being down close to around 15%. It's still under pressure. Upasana joins us to help us out with the key takeaways on that one. Upasana?
Well, the company, its con call, has guided for 50 to 100 bips margin pressure in the short term, mainly because of the elevated commodity prices and even currency fluctuation. Now, the management has guided that the key input, that is the copper-clad laminates used for PCB business, has seen an elevated jump up in prices and might continue to see it in the future. Now, coming to the RAC industry has seen a flat growth this time around because of the challenging and demand environment, but the management is positive regarding the demand trends panning out in Q1 FY27. For RAC, it is guiding for a 20% growth in Q1 versus 12 to 13% growth on a full year basis in terms of the overall volumes. Now, management has guided for a nearly 40% growth in FY27 for its electronic division, which was one of the key growth drivers in Q4 results overall. And in railway division, it has guided that it will grow by 30 to 35% in FY27 and FY28. Now, just giving a glimpse of overall Q4 numbers, it was a beat on margins as what the Street was anticipating. This is mainly because of the strong performance from the electronic division, but the key pain point remains the company's consumer durable, which saw a soft growth. The revenue growth here stood at just about 6% versus the other segments, that is electronics and railways, that saw a double-digit growth of nearly about 20% on one-year basis. Now, coming to the margin performance, consumer durable margin was under pressure, down about 40 bips at 7.2%, and the margin pressure was mainly backed by RAC, which saw a pressure due to the elevated copper prices. And as compared to the other divisions such as electronics, it saw a sharp jump up in margins, nearly about 480 bips at 10.8%. This is mainly because on the account of full integration of 3 subsidiaries, that is Sogini Technoarts, Power One, and even Unitronics. So overall, if we see, the electronic division has outperformed, but the consumer durable is where the pain lies.
Okay, all right. Thanks a lot for that, Upasana. Deepan Mehta, Drexel Elixir Equity, joins us on the show. Hi, Deepan. This was a fancied sector, right? All of a sudden, you're getting various skeletons that are coming out of the closet. And this one, the numbers are disappointing purely because of, the higher input cost. So the industry could have a big runway, but it seems some of these stocks got ahead of themselves, and that's why they come in for profit taking. That said, there is still a good runway. Do you think it's a good chance to buy Amber Enterprises down close to around 15% as we speak?
Yeah, good afternoon, Nigel, and thank you for having me on your show. it's not just that these stocks are also very expensive, and even a slight bit of miss on the earnings or any negative commentary was going to send the stocks into a tailspin, as we are seeing just now. But this, whether it is Amber or Dixon or Keynes Technologies or some of the other EMS, electronic manufacturing services companies, although the long term is good, but you have to navigate through the short term intra-quarterly kind of volatility in their earnings. And I wouldn't want to buy any of these companies just now. I don't think that the volatility in the earnings and the execution risk has been completely priced in. But take for example, Amber, it's a company that we and our clients are invested in. And it's turned out to be such a great value creator for us for the last 5-7 years or so, that we are sitting on a huge capital gains over there. And that doesn't make sense to sell for the on account of just one bad quarter or maybe one more bad quarter. So existing investors sitting on profits, the advice is to remain invested as we are. But for others who have bought recently, better to cut losses and definitely not buy into this weakness, because this underperformance can sustain for maybe a quarter or two.
Just a word on telecom. I think you like Bharti. Deepan, hi, good afternoon. But you had Mitesh just a while back talking about Indus. Yeah, it's a pretty steady stock in a weak market. Even when the Nifty was down in the morning, barely budged. So flattish. So it's done well from. I mean, the range has been 330 to about 440. If you look at that, then maybe we're at the upper end of the range. But any thoughts here? Indus, Deepan.
Well, I was a bit disappointed with the performance of Indus. Last 2-3 quarters have been pretty much flat. And I would have thought that now that the uncertainty around Vodafone has been resolved, we would expect better numbers, maybe increased kind of installations and improvement in the yields. But that's not come through so far. But nonetheless, I think Bharti Airtel came with very impressive set of numbers. And I think that that's the stock to watch out for in the telecom space. We try and, to play the telecom theme through different companies, like say Reliance Industry, because it's got Jio or Indus or Vodafone or Bharti Hexacom. But I think the best way to play telecom is to the largest company, which is Bharti Airtel. And if you remain invested for a long period of time, you get fantastic periods of outperformance. So, and it's such a big company, and I would say risk return profile favors you so much that you can make it as a part of your core holdings, as we are like top 5 holdings, and still remain invested for a long period of time. I think Africa business is shaping up also very well, which was a bit of a drag. So very positive on Bharti Airtel, but as I said, we are invested in it, so obviously to be biased, and that remains the best telecom stock to play.
Okay, got that. I just want to highlight one more name, ICICI Pru Life. It's a pretty large move, was down 8%, has recovered about 5 from the lows. Yash is standing by with what's happened and what to keep an eye out on. Yash, take it away.
Well, a deal happening in another insurance company, reflecting in the performance for ICICI Pru today. Yesterday, Prudential PLC announced acquisition of 75% stake in Bharti Life Insurance for a total amount of about 4,200 crore rupees. Now, that is the exact deal which has put a negative overhang as far as ICICI Prudential Life is concerned. That's because Prudential PLC, which is acquiring that 75% stake in Bharti AXA Life, has 22% holding in ICICI Prudential Life Insurance as well. Now, as per the regulations, one entity cannot be a promoter to 2 life insurance companies, which means in one of the 2 companies, it has to bring down its stake to less than 10%. Now, of course, for the new venture to go through, it will have to, that is Prudential PLC will have to reduce its stake in ICICI Pru Life to less than 10%, which means divestment of about 12% stake when it comes to the company. This is worth about 9,200 crore rupees. And now this particular development creates an overhang, a supply overhang, as far as ICICI Prudential Life Insurance is concerned. There are also concerns on the bancassurance side, how the dynamics of distribution would change with this particular deal. All of that today reflecting on ICICI Pru.
Deepan, Yash, thanks very much for that. In the insurance space, what would you pick?
Well, I think, Prashant, tracking these insurance companies is quite a challenging task, and understanding all the various acronyms and valuing them is very difficult. Either you have a leap of faith and you buy 2 or 3 insurance companies, hold them for a long period of time. In a way, the life insurance companies are being valued on the market cap to adjusted book value, and that keeps on growing by 15-16%. But in my opinion, the better way to play the insurance business would be again usual disclosure we and our clients are invested in a small company called MediAssist. And that does health insurance claim processing. And the numbers have been pretty impressive this quarter. I think after 2-3 quarters, good numbers have come through. It's got certain amount of M&A activity, like gains also coming through over there. And it's a great play on the entire health insurance business. I would even look at PB FinTech, which is a play on the entire insurance industry. I know that from time to time, there are certain controversies around their capital allocation policy and them getting into healthcare business. But the underlying momentum which they're getting in selling insurance per se, and also the Bazar, where they are doing distribution of loans, both of them are shipping pretty well, and it's turning out to be a great compounding story. And I think in the next 2-3 quarters, it should break even in a solid profit. And then 2-3 years down the line, the profits will grow even higher because operating leverage will come into play.
Deepan, what to do with tech? They bounce back in style, but these could be more tactical in nature because the mood is still very somber with regard to tech. But as people are ruling it out, actually it's made a nice, decent recovery in the last 4 trading sessions. And as we speak, Tech Mahindra is up close to 4%. I think Infosys is up close to around 2%. Any view on these names?
The large cap tech is sell on rise according to us. I think that the more and more the way we are understanding this AI disruption, it is clear that small mid-cap companies will ride it far better because project sizes are small. They'll be able to save costs by using AI in-house as well. And it's becoming a great level playing field within the IT services industry as well. And depending upon the capability and client loyalty and marketing, you will find 5 or 6 great companies which will do very well. But the rest will struggle with this entire AI disruption which is taking place. And I think gradually the winners also are emerging. I think you look at the way Coforge or Persistent Systems that come out with numbers, I think they were very, very impressive. We also like another company called Fractal Analytics, although that's corrected significantly from its high. Another company which we are invested as a measure of disclosure, which I think will do exceptionally well. And like that, there are, I think, 2 or 3 companies, certain vertical specialists like Tata Elxsi, KPIT, Tata Technologies, I think they will also do well. So one has to be extremely selective when it comes to tech services companies.
Okay, got it. Let's talk about Pharma then. Shares of Gland Pharma, they're gaining in trade after posting a steady set of numbers. Ekta standing by to run us through a quick breakup of those numbers. Ekta?
Well, yes, it was a good set of numbers coming in for Gland. The revenue was up over 20%. The margins expanded all the way close to 30%. There was a sequential as well as a year-on-year expansion which took place in terms of margins. And the profit was supported by better operational leverage as well as better other income. Key geographies, US was steady. It was up around 24% year-on-year. It's the major market for them. They had Europe, which was up around 36% year-on-year. India, which was up 28% year-on-year. So all of the geographies were firing on both cylinders. And we also had Cenexi, one of their key arms, which in fact was EBITDA positive this quarter, despite a lower top line Q-on-Q. In fact, what they are saying is that ex-Cenexi, the margin guidance for the company is around 33 to 35%. And according to analysts, that might be a little bit on the conservative side. Otherwise, they are expecting a top line growth of around 12 to 13% in FY27 on a constant currency basis. Analysts are also expecting the GLP-1 opportunity to play out favorably for Gland Pharma. Now, in terms of brokerages, Kotak is positive. In fact, they've upgraded the stock to a add with a target price of 2,075. According to them, earnings visibility has improved based on most approvals being in place amid the near-term patent expiries as well as commencement of new CDMO contracts. They bake in a strong 22% EPS CAGR over FY26-29, which is driven by new launches as well as operating leverage.
Okay, got it. Well, let's get in Deepan's view on this one. Deepan, your view, Gland Pharma?
I think that it's recovered a lot of lost ground. Gland Pharma had been a big underperformer last 2-3 years or so. But last 3-4 quarters, we have seen very, very good numbers coming through from Gland Pharma. And it's a top tier player in terms of technology, in terms of the product focus. They are mainly into injectables where at least there is competition a little less. And they stuck to their knitting, and they've done very few acquisitions. The one they did was also problematic, but now they managed to turn it around. But the key thing in Gland Pharma from an investor's perspective is whether they're able to capture anything from the Chinese market. and it's the parent company is Fosun, which is a Chinese giant in pharma. But somehow that synergy benefit has not come through to Gland Pharma. But that could happen. But nonetheless, I think it's now a steady performer, and it's got a great set of new launches also in terms of the kind of approvals which they have got. So I would expect Gland Pharma to outperform for a few more quarters. Rupee depreciation also benefits Gland Pharma considerably, considering that most of its revenues are outside of India.
Okay, Deepan, quick word on solar industries. You know, the market capitalization is more than 1.5 lakh crore. The stock is up even in today's trading session after the big move that we have seen. Last year's profitability was less than 2,000 crores. But as we pushed the management a little today, they indicated that maybe 4,000 crores in the next 3 years of net profit is doable. What's your view on the name? You know, it's moved from strength to strength. Execution capabilities has been par excellence from doing around 10, 11 crores 10 years ago in defense. They're going to do 4,500 crores in defense. Execution has been super, but at these valuations, your view?
No, at these valuations, again, it's a company which we are invested in. So if you're invested even in a high P stock, you remain invested, but for fresh investment, I think the kind of valuation multiple is just too mind-boggling, no matter whatever the prospects are.
Got it. Okay, all right. Thanks a lot, Deepan, for joining in, giving us your view on all of those stocks. Have a good remainder of the day. Well, time to slip into a short break. On the other side, Daniel Morris of BNP Paribas is waiting for us. He'll give us his view on the markets. Stay tuned. Welcome back. Well, the markets have staged a bit of a recovery, though we're still down closer around 50 points or thereabouts. But the fourth quarter earnings has seen stock prices move very, very sharply in reaction to their numbers. Sudarshan's put down a neat list, and he's going to run us through all of those names. Sudarshan, take it away.
So we are almost at the fag end of the Q4 FY26 and for the fiscal earnings. And the reaction has been sharp on both these sides. So I'll start with the large cap names which have reacted sharply to the earnings. And on top of the list is SBI. When it announced the earnings, NI, operating profit, on majority of the parameters, company has missed the estimates. But the one more surprising part was the FY27 guidance. That was also below expectation, and that was one of the reasons why we had seen a sharp fall in the stock. That day it had fallen 7%. Second name, Infosys, and followed by HCL Tech. IT names. Infosys, guidance for FY27 was lower than expected. HCL Tech, it was all-round miss, and that was the reason we had seen a sharp downtick in both the names. Tata Motors Passenger Vehicle, amongst all the PV names, this is one stock. It has the reason. First, India business has been doing well. Now for JLR, worst is behind. And now going forward, what would do well for JLR is the volume growth. Now they are going to launch the new version of Land Rover that will aid the volume, and that was one of the concern for the several quarters. And remember, JLR forms almost 70% of its total sales for Tata Motors PV, and that was the reason why that day stock has moved 5% higher. Cipla, when it announced the earnings, people felt the earnings were below expectations, but it had one-off cost of impairment cost of 42 crore. When that was excluded, earnings were largely in line. But following that, company came with a guidance, especially on the US revenue front, will cross the $1 billion. And that has surprised the street. And also on the margin front, it kind of maintained whatever they have done in FY26. And following that, like next day, Cipla has seen a move of almost 8% higher. Now coming to the mid-cap space, where we have seen a sharp downtick. Keynes Technology had fallen as much as 20%. Over the last 1 year, this stock has been one of the biggest underperformers. Now, despite company coming on the channel, giving the FY27 strong guidance, stock did not recover. It failed to boost the sentiment, and at the end, the stock was down 20%. Muthoot Finance, it's the story of every quarter. Company comes out with the earnings. Earnings are better than expectations, but the reaction we see, downtick in the stock. Last quarter also, if you remember, the stock had fallen as much as 12%. This time too, despite a strong set of earnings, the stock had fallen 6%. Amba Enterprises came with the earnings over the weekend. The guidance and the earnings were mixed, and that's the reason today also the stock is down 14%. And also going forward in the near term, company is saying there can be pressure on the guidance of 50 to 100 basis points. Last name is Torrent Power. Despite a sharp surge in the energy demand, or say power demand, Torrent Power failed to demand failed to reflect in the earnings, and we had seen a sharp downtick. On that day, it had fallen as much as 9%. But we had seen a big uptick also following the earnings, and some of the names was BHEL. There was a huge increase in the order book, and also earnings were largely much better than expectations, and that was the reason that stock has moved higher as much as 10%. Coforge, people thought that the earnings will be below expectations, but surprisingly, amongst all the IT names, this was one stock which reacted very sharply on the upside after the earnings, and not only next day to the earnings, but it has seen follow-on buying, and going for like over the next 2 to 3 sessions, it continued to see buying, and that day it had moved 10% higher. MTR Technology, it has been multi-baggers. Over the last few months, the stock has been moving in just one direction, that is up or almost 200 to 300% higher in the last 1 year, and that day also it had moved almost 12%. Some of the names that had seen big downtick, P and Gadgil. Unfortunately, the day company announced earnings, the same day government came out with the curbing imports on the gold, and that was one of the reasons why that stock had seen a sharp fall down almost 10%. KEC International missed estimates, and because of the order going to the next quarter, order spillover, basically we can say, and that was the reason the stock fallen 10%. Bajaj Electricals and Symphony 2 came with the earnings which were lower than expectations and fallen 8% each.
All right, thanks very much. So it's a quarter of big moves, right, on day one, day zero, whatever you want to call it. But so thank you very much for that walkthrough. You know, the memory lane, but not distant memory, very recent memory, because this is all for the current earnings season in that sense. Well, we have Daniel Morris of BNP Paribas Asset Management. Daniel, great to have you with us here on the program on CNBC TV 18. Prashant this side. You know, so the what's happening globally is that everything with AI is doing very well. Korea, Taiwan, and Asia. US, of course, is it's had a. I think US equities are up 10% this year despite Friday's sell-off. Whereas India has, of course, been a stark underperformer. Daniel, so just start there, if you will. There is lots of stuff can happen which maybe changes the equation. But do you think it's it's getting a bit too much on the AI side, and you will see a rotation out? Korea, for example, has been hugely volatile over the last 2-3 days. I mean, is it nervousness? Is it something very idiosyncratic, Korea specific, or is it a comment on the how far this entire AI, semis chip trade has gone?
Well, we're still believers in the AI trade over the medium term. As you point out, certainly above average volatility in the sector, that's to be expected, certainly will happen again. I would imagine, though, in general, if we do see sell-offs, we would at least consider it as an opportunity to add to our position. I think if we look at the broader trends in the market, they're twofold. So one, despite the war, we're actually moving back towards the trend we had last year, which was, of course, of AI dominance. And from that point of view, India is a bit outside of the picture, given the relatively small share of technology in the index. At the same time, it's not only technology. You've also seen non-tech stocks in the US do well relative to the rest of the world, which also takes us back to an earlier theme of US exceptionalism. For now, at least, we seem to have those two key themes in the market.
So any pullbacks, and actually you're right, I mean, we've had many of these 4-5% kind of sell-offs. If you were to look at a basket of these global AI companies, and actually many, but they all have been bought into, and maybe this one too will. So what? Do you have any specific thoughts on emerging markets, India in specific, Daniel?
It's challenging to find the positive catalyst for India right now. Of course, previously we used to talk a lot about the high valuations. I guess, fortunately, that's a bit less of a concern now, given how the market has performed. That said, I don't know that we would say it is cheap in absolute terms. I think we're going to have to, number one, see us getting past the crisis in the Middle East. Clearly, that's a drag on the country, on the market. And then once we hopefully get past that, we can look for other positive trends. But for now, at least, our expectation is that India may lag behind some of the other markets.
Daniel, good to see you in. This is Nigel on this side. What are you making of the Chinese market and the Chinese economy? Because that anti-involution is picking up steam out there. They're producing less, they're exporting less as well. For one sector that doesn't get hit, or in fact it's a benefit, it's the metal space, because they're producing less steel, they're exporting less steel, which is good from a global standpoint. But how are you reading the Chinese market, which has done pretty well in comparison to the Indian markets? And also, what's your reading of the Chinese economy?
Well, I would frame it perhaps a little bit differently. We see the performance of Chinese equities relative, at least to the rest of emerging markets, as rather disappointing. Now, we have to recognize that's after several years of quite strong performance. So it's okay, perhaps, to take a bit of a pause. That said, if you take the Chinese market and divide it into tech and non-tech, what we see on the tech side is it is not really participating in an otherwise globally positive trend for tech stocks, meaning not just Taiwan and Korea, but also NASDAQ in the US. China's lag behind. And then if you look at the non-tech part of the Chinese market, that's also lagged, which I think takes us to the question you asked about the economic picture. Data, frankly, not all that positive. We just got retail sales. They were down for the month. Credit growth has been slowing. Trade, of course, very positive, but in a sense, that is its own problem because the economy has become very, very dependent on net exports, and we don't see that as a sustainable strategy.
Not a sustainable strategy. Got that. By the way, do you have any view on, oil, Daniel, or, at BNP, if your team has? Generally, the view is now starting to veer to the fact that even if this thing gets resolved, prices are going to be close to above 90 for the rest of the year. Is that a view you share?
I wouldn't hazard to predict what oil prices are going to do. I think the point for us is even if they are a bit above 100, that's not necessarily catastrophic, if you will. Don't forget, we were near 120 a few years ago, post-global financial crisis. They were for many years around 120. So certainly it's an adjustment. For some countries, certainly a painful adjustment. But we don't see the absolute level, particularly in inflation-adjusted terms, as necessarily so problematic. If it does come then that we do see 100 or so oil prices through the end of the year, marginally negative certainly for some areas, but we don't think it's predictive of a recession or anything that negative.
Okay, all right. Daniel, we appreciate you joining in and giving us all of those views. Hopefully the next time we chat, Indian markets will be in better shape. But it appears the markets have just taken off. They're sensing something, maybe some kind of action from the central government, or maybe, in fact, that could be some inflows that Prashant was talking about at the start of the show itself. Hopefully something's turned for the better, because there's a massive recovery from the lows of the day. Remember, this is the net short market. So if you get a spurt on the upside, it could cause those shorts, in fact, to run for cover. Big up move on the Sensex, Nifty. The Nifty Bank, just take a look at that. That's close to 1,000 points from the lows of the day. And the number of stocks advancing have moved to 750. Effectively, from the lows of the day, they've nearly doubled. So there's a bit of a burst on that front. That's it. Let's do a quick check on the F&O markets. Well, today it's important because we went to around 23,300 and we bounced off that. And going by yesterday's, last week's low as well as this week's low, it appears this 23,250 and 23,350. That's an extremely important near-term support. On the Nifty, the PCR has moved to around 1.3, so it's moving towards the higher end of the range. Because even when the markets were down, you were not making any money if you bought the 23,400 put, where the premium had come down to around 50 rupees from around 75 rupees at the start of today. Even the 23,300 put, even if you got the direction right, I'm talking about when the markets were down. Now we've seen a bit of a reversal, and that's where those premiums are down. But even if you got the direction correct, there was put writing at play. So there are participants in the market that believe that the lower levels will get defended given the kind of erosion you're seeing on the premium values out there. Now, this is going to be interesting because the 23,600 call, the premium at the start of today was around 176 rupees. Currently, it's around 100 rupees approximately. Keep in mind, this is a contract that expires tomorrow. So it's going to be very important from a bearish perspective that the Nifty doesn't get past this 23,775 approximately, because at the start of today, that was what the premium was. So the stop loss on the upside will become this 23,775. And after that, you're looking at the 20 DMA that comes up for you on the screen. Very, very crucial resistance mark between the 23,800 to around 24,100. The India VIX, that has cooled off big time from the top, and that's good news. You don't want the India VIX to go to around 20 odd. That, remember, is the fear gauge, so you'll have to keep an eye out on that front as well. Tech has got smashed out of shape. Today, it's come in for a bit short covering bounce. Oracle, big up move on the stock, or open interest down. Coforge, big up move on the stock, open interest down. So clearly, there's a big short covering bounce playing out on both those two. And on BSE, there is fresh buying that we've seen. You talk about a stock being expensive, but you need to stick with the momentum. And it appears that one is seeing delivery-based buying as well as long build-up. So keep an eye out on that one. Big up move in today's trading session. And finally, Keynes, I'll keep a closer track on this one. There is some unwinding of positions, but it's a far cry away from coming out of the F&O band. Maybe as the week progresses, we'll keep an eye out on that front. But some unwinding of positions, stock under pressure. Well, we'll slip into a short break. Nimesh is waiting for us on the other side, though. He'll tell us what's going on in D-Street Chatter. Welcome back. You're tuned in to Closing Bell. You're on CNBC TV 18. The markets have seen a massive recovery. No better time than going across to Nimesh right now to tell us what is he picking up from the dealing rooms. Nimesh, good afternoon. What's your take? I mean, Prashant is talking about probably some flows coming in. What have you heard?
Well, looks like, Nigel, so my sense is the recovery that we've seen in the last 30 minutes of trade, large part of this is because of a very large MOC basket buying at a leading FI desk. So maybe the FI number could look large in today's market. Also to that, there was a large block in JSW Steel, right? Even that would be reflected in the DI number, because it looks like the seller was JSW Energy, but the buyer was a domestic mutual fund. So watch out for that as well in terms of numbers for the institutional data. Yes, as I said, there is a very large basket buying that includes most of the large cap names, that includes the tech names as well. So that's the reason why you've seen a big short covering rally in technology stocks as well in today's market. Technically, 23,400, 23,450 is a level to watch on the downside. That's a very strong support on the Nifty. If that support is taken and you have some good news in terms of some development by the government, you might see a further short covering rally. So that's the sense as far as market is concerned. But today's rally seems to be largely played out on the back of very strong FI buying. The reaction to earnings continue, and that's the trend which is likely. Also, some now that towards the fag end of the earnings season, you will see a lot of blocks coming in individual names. So that's something to track separately from a block perspective. But largely, today's intraday rally seems to be largely backed by a very strong MOC basket buying.
Right. Thanks very much, Nimesh, for that. What about individual names?
So the first stock is Tech Mahindra. I spoke about a short cover rally in IT names, but Tech Mahindra stands out in terms of aggressive buying. I understand that a leading domestic mutual fund is an active buyer today in Tech Mahindra. So watch out for delivery stats. Could be very large delivery-based buying in Tech Mahindra today. Second is GMR Power. Again, while the stock has seen a very large consolidation in the last 1 year, it's been in the range between 100 and 120, 130. But now it looks like some bit of interest is back from larger HNIs, and the flows have resumed at HNI desk. Some large HNIs seems to be accumulating GMR Power at current levels. Third, Bharti Airtel and Indus Tower both stands out in terms of very strong delivery-based buying today. And Indus Tower also keep an eye on any potential creeping acquisition from Bharti Airtel, because now they are technically allowed to do creeping. In February, they did close to 57 lakh shares. Now, I think they can do further. So that's something to track as far as Indus Tower is concerned. And the last is Inox Wind. Within this this space, Inox Wind stands out in terms of very strong delivery-based selling today. So high delivery volumes, but on the sell side in Inox Wind today.
Got it. Okay. All right. Thanks a lot for that, Nimesh. Well, let's go across to Mitesh for some closing trades. Mitesh, first, what are you making of this bounce? I think everyone has been fairly cautious in the markets, but at what point of time this cautiousness will actually take a backseat? Where is the crucial resistance mark?
Yeah, I think, as I said, holding on to 23,300 was positive, but the upside strength will come once we start getting past 23,800. So let's wait for that. I'm still not sure whether we are doing that immediately or not. So for the timing, we'll assume that it's a market which is kind of stuck in this range and will trade kind of range bound bias. But in case you start getting past 23,800, yes, then I think it'll be positive.
23,800 is the next level that we're looking at. Got that. What about individual stocks?
Now I have one BTSC that's from Max Healthcare. Max Healthcare, not Max Logistics. Max Healthcare BTSC with the stock at about levels of 1,050, and I would get a target of roughly around 1,075, 1,080 for tomorrow. And NTPC is on the negative side, STBT with a stop at 390 for targets of 385.
Okay, right. Just one quick word on the IT index, because that's suddenly come to life. Very low interest in that in the index on the whole. But today it's seen a big bounce up, and from the recent low, it's again seen a good bounce. But we saw this the last time around us when it went from around 28,500 all the way to around 32,000, 31,500 ballpark, and then it corrected even more sharply. What's your view?
Which stock is that?
Mitesh, I'm talking about the tech index.
Nifty IT index.
Yes.
Right. I kind of missed that. So Nifty IT, again, extremely oversold, trying to bounce back, but I'm not sure if a reversal is yet. The medium to long term charts remain negative. I think this looks like pullback from the oversold levels. To me, 129,400 is the first level, and then I think in case you cross that, 30,500. But I think that should be it. given the fact that it fell from 39,000 to about 28,000, that will still be a very minute kind of retracement.
Thank you very much, Mitesh, for that. I mean, the story has been, small bounces, bigger falls. And, look at it over the last 1.5, 2 year period. That's what it looks like. But trying to bounce, as it has in the past as well, unsuccessfully from lower levels. So we'll see. Jana Small Finance Bank is in focus. The board has approved the fundraise. We've, of course, reported on this. So it's CNBC TV 18 Newsbreak confirmed. Ritu reported on it. So, she's back with us with what's happened now. Ritu, take it away.
That's right. As we told you earlier, TVS Venu Group is set to acquire a strategic stake in Jana Small Finance Bank. The board, of course, has approved this fundraise of 728.5 crore rupees, which will be done through a preferential issue of shares at 464.82 per warrant to about 6 investors. And the largest incoming investor in this preferential issue as well is TVS Venu Group's GWC Family Fund Investments, which is going to pick up 5.64% stake after the warrant conversion. But, the TVS Venu Group is also coming in through a second separate route, which is TVS Motor Company directly buying 4.9% stake from Jana's promoter entity, Jana Holdings, for about 193 crore rupees. Now, this 4.9% stake in that TVS Motor is buying today, that is calculated on the current share capital. But once all these warrants convert into equity and the share base expands, on that larger, fully diluted base, TVS Motors' effective stake will come down to around 4.26%. So now you add GWC's 5.64% and TVS Venu Group's total exposure will land at just about 9.99%, which is well within the regulatory ceiling. Now, the other 5 investors that are coming in through the preferential route include 2i Capital PCC, which is backed by Shruti Lohia of the Indorama Group. They'll pick up 4.5% stake. Singularity Large Value Fund, ICM Finance, Capri Global Ventures, they will each pick up 0.84%, and Utpal Sheth another 0.21%. And they'll have, of course, 18 months to convert the warrants. Also importantly, it's worth flagging that all of these investors are going to be classified as public shareholders. So none of them get board seats or any kind of veto rights or special control. Now, next, the shareholders, the proposal will be put to vote at the EGM on the 11th of April. The record date is the 5th of June. And as for what next, we have to await the RBI approval, which will be critical for this deal.
Got it. Okay. All right. Thanks a lot, Ritu, for joining in and explaining that to us. The stock has come in for some profit taking, but it's seen a big run in the last 1 month or so. Let's focus on Godfrey Phillips, though the street shows a thumbs down to its numbers, even as the cigarette maker reported an operationally strong set of numbers. Mangalam joins us to break it down for us. Mangalam?
Well, if you look at Godfrey Phillips' stock price move today, it opened about 3.5–4% higher, and as expected, it was down by about 7 to 8% from there, currently sitting with a cut of 5%, and there are reasons for that. One, the stock had already seen a rally of almost 30–35% in the last 40 days, and that's largely because it was a good performance that came in from VST Industries, and the street expected that there would be pre-buying ahead of the big excise duty jump, a big tax jump that will happen on tobacco as well, with effect from Feb 1. So that happened. Secondly, same time last year, there was a high inflation in leaf tobacco, and now that has come lower. So that meant that the gross margins actually expanded from about 40% all the way up to 50% as well. And finally, starting Feb, when the price hikes were made, there was an element of price growth that came by as well. So all in all, the revenue of the company increased by about 13.5%. We saw a jump in gross margins. EBITDA jumped by about 100%, went all the way up from 270 crores to 550 crores. And net profit on the back of that, from 280 crores, jumped all the way up to 520 crores as well. But the internals tell you that the volumes aren't picking up. In fact, the management of ITC also told us that there would be a decline in volumes. This quarter, the company reported cigarette volume growth of 6%, and that's much lower than the annual run rate of over 20%. And add to that, the management has said that the steep increase in taxation in the fourth quarter will make the next year fairly challenging. So last year was very strong for Godfrey Phillips. In fact, it beat street expectations and grew much faster than industry leaders as well. And the stock did well. But now with challenges emanating starting this financial year, and parts of that showing in the last year, along with, a big rally that we've seen on the stock already, meant that the stock would decline from the highs, and that's what happened today.
Mangalam, ITC reports later this week, right?
Thursday.
Okay. All right. Thanks very much for that. So that is the Godfrey Phillips some of the reasons why the stock's down. Starting point, of course, the run-up, as Mangalam points out. I think 96.35, while the equities are seeing some relief, there is no such relief as far as the dollar rupee is concerned. Dollar is pushing higher still at this point. Well, I think Amrish Baliga is with us. Amrish, good afternoon. Good to have you with us here. There's 12 minutes to go for close. You know, let's stick with stocks and sectors. CDSL, Amrish, is the pick today?
Yeah. Because depositories will remain a structural play on India's capital market, and retail participation anyway is increasing. Business model is a mix of both annuity as well as transaction based, and CDSL has 80% market share in terms of number of demat accounts, and we have about 22.5 demat accounts in India. So it's a direct play on market buoyancy. So since the markets have declined, volumes have contracted a bit, IPO flow has reduced, there's been a negative sentiment on CDSL, and I think that's an opportunity. Because even the fees and charges seem to be at the lowest point because they've been reduced continuously in the last few years. So I don't see any further downward revision. So the next market up move should again have CDSL outperforming because I'm estimating about 18% CAGR as far as revenue and EBITDA goes for the next 3 years. So expecting an EPS of about 33 for FY28. And with that, my target price is 1485.
Got it. Okay. All right. Got that, Amrish. Stay with us. For the time being, let's play out some sound bites. Earlier today, we caught up with the management of Solar Industries, the MD and CEO, Mr. Manish Nuwal, after they reported a good set of numbers in Q4. Let's hear out what they had to say with regard to the vision going ahead.
On various platforms as we are developing this product, and this can be a game changer for our company. And definitely will help the security, providing security solution for our country. So it's in development stage. We are expecting that in this year, we should complete all the trials and development related to this product. But definitely it will be a big boost for our company's performance. So whatever estimation we can do at this stage will definitely fall short, but it will be definitely bigger than Pinaka. We have participated in the RFP and we expect orders in this financial year. So that will also help us to do a revenue of around 700 to 800 crores on annual basis from the next financial year. It's too early, but definitely it will be as big as Pinaka.
Well, it was also a good quarter for Tata Steel. The company's net debt reduced while the European business EBITDA losses also narrowed sequentially. Earlier today, I caught up with Mr. T.V. Narendran to understand their outlook on steel prices for Q1 FY27 and other details. Let's listen in to what he had to say.
On our guidance for this quarter is 6,000 rupees per ton higher for this quarter compared to the previous quarter. Whether steel prices will go to 60,000 for the rest of the year, I certainly think it will stay on the higher side for two reasons. One is, like I said, the cost pressures. The other is, of course, like I said, the demand is strong, but also a third reason, which is that Chinese steel prices have started moving up again. It's crossed $500, maybe because of cost pressures and also because of the export restrictions that they put in place. So overall, I'm a bit more positive about the industry for this year compared to last year. But not all of the price increases will flow through to the EBITDA because we also have cost increases. Apart from the usual coal prices, etc., the rupee getting weaker, freight rates going up, many consumables going up because of the Middle Eastern crisis. So I think some of the price increases will be eaten up by costs, but overall we expect EBITDA in Q1 for India to be better than Q4. Moved about 800 billion from negative to positive in Netherlands. This year it will be positive EBITDA. It will be, we expect it to be better than what we delivered last year for the full year. Quarter on quarter, there will be some changes because of some of the disruptions. But Netherlands is not going to do worse than the previous year. It will do as well as the previous year is our expectation, if not better. As far as UK is concerned, again, the trend has been in the right direction, may not be as fast as we would have liked it to. So if you see the improvement in EBITDA for the financial year, which is finished, it's about 150 million better than the year before that. Still negative, but better. And this year, we expect it to certainly start moving into positive territory. Q1 will certainly be better than Q4, and Q2 will be better than Q1.
Well, let's quickly get an Ambrish's view on Tata Steel. Ambrish, what do you make of the set of numbers? They look pretty good, actually. And Tata Steel actually has a tailwind because Europe has announced various protection measures. And because of that, Europe business could turn around. Your view on the name at around 210 bucks?
Yeah, I've been bullish on Tata Steel for quite a while. And today's correction, I see it as a buying opportunity. Again, I think it has fallen because of those expected regulatory headwinds for the Netherlands business. But I think that's an opportunity because after the sort of a move which you have seen, it's been a good correction. So utilize this opportunity to buy at lower levels because, in fact, over the next 4 to 6 months, I see levels of about 260 to 280 for this stock once the next quarter results come out also.
Okay, got it. All right, Amrish, let's squeeze in one more name, Hindustan Copper. We'll try to get in the management, in a couple of days to get their outlook. But it seems they are under-guiding and over-delivering. At least that's what happened in the past year. Stock is not cheap. But if they're going to be guiding for 600 to 700 crores of net profit and deliver 900 crores in the past year, well, the street will continue to be interested. Your view on Hindustan Copper?
That's true. So the expectations would go up. And in case they're not able to meet those expectations, then I think we could see a correction. So at these levels, I would not bet on that. So, for the time being, I would stay out. Those who have can possibly hold on with a stop loss. But to buy fresh at this point of time with an expectation of over delivery, I think could be a mistake.
Would be a mistake. Fair enough. Lots of other sort of broader market moves today, which we are seeing. BSC, it's a new record high. Amrish, you had CDSL on the pack. The domestic flow story continues to be super strong, right?
Absolutely. And I suppose the interest would be quite high, both in BSC as well as MCX, because NSE is on its way for the IPO. So till that time, I think you'll see a decent amount of interest in both these stocks.
Okay, all right. Amrish, stay with us. We're going to wrap up things and come back to you. We've got the indices ending off the lows by quite a bit. Actually, except the small cap index, the Bank Nifty, Midcap Index, Nifty, I think all ending only down, but down very, very small. Third lower on the Bank Nifty. The Midcap Index down barely, 0.1. Small cap index is the only one which ends over a 1%, with a 1% cut, 1.25% cut. The Nifty actually, will we see manage a positive close? 23,647 as far as the Nifty is concerned. IT index, after the 6% fall, the index ending 2% higher, 2.6, 2.7% up, 28,457 on the Nifty IT index today. And of course, lots of moves on the Nifty, Tech Mahindra, Infosys, part of that Nifty rally. But of course, Bharti was also a part of it. There was Sun Pharma, which did quite well. So that is large cap Nifty 50 for you. On the downside, Tata Steel lost. There was Power Grid, which lost. Numbers came in the second half. SBI was down as well. So that is large caps. In the broader space, Nigel, lots of moves, especially, their entire EMS space, once again, under pressure.
Well, that's right. Let's talk about a few winners first. Finotex Chemicals, the shop was closed out there. Stock was up 20%. Gland Pharma up close to around 15%. Raymond, that kept building on to gains. That was up close to around 12%. Keep an eye out on the bottom of your screen. Vodafone Idea as well. The commentary was rather positive on that con call. And the stock has moved into the green. Remember, at one point of time, it was down close to around 4% or thereabouts. Hind Rectifier stock down 15% because of the numbers, consolidated margins getting compressed out there. But Tata Mutual Fund putting in close to around 100 crores. The stock recovered close to 10% from the low point of the day. What else was moving around in today's trading session on rather large volumes? You had stocks like Autoline, but that's a small name. That was up close to around 8% in today's trading session. So net, by the time we wound up, the Nifty at least managed to go home with a tinge of green. Maybe the average price will be somewhere around this green line or maybe a flattish number. But the breadth of the market improved from 350, 325 stocks that were advancing earlier. We go home with around 825 stocks that go home with some green. So all in all, not such a disappointing trading session, but some action on the money market is needed. The Indian rupee needs to show signs of stability, which till now has been missing. The street is sniffing something's got to give, and hopefully for the better. Well, for the time being, we'll wrap up on this edition of Closing Bell. Don't go anywhere. Markets Forward is waiting for you on the other side.
Markets stage a smart recovery from day's low to end near the flat line while broader markets underperform. The rupee hits a record low intraday against the dollar as oil prices surge after US President Donald Trump's latest threat to Iran.
ICICI Prudential Life slips after Prudential PLC plans to sell 12% stake following Bharti Life deal, marking its exit from ICICI JV in India. Meanwhile, Jana Small Finance Bank falls after the board clears preferential share issue to TVS Venu Group, among other investors.
Amber Enterprises flips after management flags 50 to 100 basis points margin contraction despite Q4 FY26 earnings. Gland Pharma, on the other hand, rallies on sharp profit growth, 500 basis points margin expansion in Q4 and brokerage upgrades.
Good evening. You're watching us here on Markets Forward. This is a show where we tell you what took place in trade today while we aim to prepare you for all the data points that will happen in the next trading day. I'm Manglam Malu, with me Vivek Iyer. It's been a dramatic day. We opened fairly lower, sharply lower, and then from there it was a near 300-point recovery that we saw on the frontline index led by the IT pack. The Nifty Bank was lower, but it was the market breadth that had you wanting a lot more, told you that the rally was fairly narrow and benign, because we had nearly 2,400 stocks which ended in the red for about 800 stocks which ended in the green, slightly shy of 800 as well. So the market breadth, that picture comes up for you. That will tell you a better story of the day than just the long-term intraday recovery that we saw in the frontline indices led by IT. Hi, Vivek.
Good afternoon, Manglam. Rightly put. Very interesting trading session on the back of the fact that you did see the volatility end with the Nifty almost managing to recoup all of the losses and very sharp moves that you saw from individual names, largely on the back of results upgrades. But we've got you covered for the next 20 minutes with all the big news and updates and the key developments on Dalal Street, top corporate voices and events to track ahead. But let's now kick off the day's market action. On the show, we have a lineup with the top movers and shakers of the day with Sudarshan Kumar. The stocks of the day were Amba Enterprises, Tata Steel and Gland Pharma. We'll give you the key reasons why these stocks were buzzing today. And last but not the least, we'll delve into the key market events to watch out for in tomorrow's trading session. But first up, let's go on to the first segment of the day. Sudarshan now joins in from the big wall with the top movers and shakers.
We've seen a smart recovery, but the green that you see on Nifty that closing at 23,650 just tell you the half story of the day, because market breadth at the end of the day was still in favor of declines. Advanced decline ratio was 1:3, and that tells you that Midcap index was still under pressure. But one segment that has lifted the market was IT pack. Over the weekend, there is one report floating that top executive for NVIDIA saying that the cost of AI is surpassing the cost of employees. Not sure if that is the reason. It can be one of the reasons, but nevertheless, we have seen a big recovery in IT names. Tech Mahindra was top Nifty gainer, up more than 4%, followed by Infosys. If you go to mid-cap names, Coforge up more than 5%. Similar move seen for Persistent Systems, even for Oracle Financial Services, up more than 4%. There were some stocks that have reacted sharply to earnings. Solar Industries up more than 4%. Company has achieved the guidance that given for FY26 and has given a strong guidance for FY27. Defense, which forms major chunk of its total revenue, is now expected to grow and hit the target of almost 4,500 crore in FY27. Amba Enterprises today saw a downtick of almost 16%. If you thought earnings were largely in line, company came with the guidance in the near term. They see the margin going down and can be a pressure of in the range of 50 to 100 basis points. That was the reason stock has fallen 16%. Cochin Shipyard has missed the guidance across the board. You talk about revenue, margin, order inflow. On every front, company has missed the guidance. That's the reason at one point the stock was down 7%, closed with a cut of 5%. Minda earnings were largely in line, but the guidance that company has given of margin of 11% versus Bloomberg estimates of around 11.7%. That was the reason stock has fallen 5%. Gland Pharma, good earnings, stock closed with a gain of 15%. Lastly, Jana SFA has announced the deal going to issue shares of more than rupees 700 crore, but stock has seen a downtick, closed with a cut of 6%. TVS Motor is going to buy almost 5%, closed with a cut of 5%. Lastly, BSE is expected to enter Nifty 50 and has been seeing buying inflows.
Sudarshan, thanks a lot for that. Let's talk about Tata Steel. Among the earnings that were there today, stock remained under pressure despite a strong fourth quarter. The company expects the higher India prices to actually offset rising costs and help narrow their UK losses in the first quarter of FY27. The management also optimistic about their business turning into the black. Let's go across to Nigel, who joins in with all the details. Nigel.
Well, that's right. Tata Steel's numbers actually are good. The realizations were better across the board, and that definitely helped the numbers. If you're looking at volume, on the volume front, the India business, you had, good growth on a year-on-year basis. So that definitely, helped them in terms of a top line. And besides that, the Netherlands business as well on a sequential basis, there was a bit of an uptick in terms of volume. So put that together, that's what led to the numbers looking better. On a consolidated basis, the absolute EBITDA number was better than what we were working with. Let's break it up for you then in terms of geographies. The India business, the EBITDA per ton came in at more than 15,200 rupees. That's mildly better than what we were working with, but much better on a sequential basis as well as on a year-on-year basis. Besides that, the European business was reporting losses for the last few quarters. That reported a mild profit in comparison to a mild loss that was expected. And the reason is the Netherlands business, yes, the profitability came down a little bit, but on a year-on-year basis, it was much better. And the UK business, the losses have reduced out there, which is good news. The realizations clearly have offset any kind of input costs, at least for the past quarter. The net debt number as well came down by around 2% on a sequential basis, and the street will like it. What's the way ahead? Well, the management has guided for around 2 million tons of additional volume to come in FY27 in comparison to FY26, and most of it will come out of India. Besides that, they're saying that in quarter one, the EBITDA per ton for the India business, in fact, will improve, which is good. While there will be some kind of pressure on the Netherlands business, and on the European business, there could be some kind of a move towards the profitability aspect. Net, numbers look good. Commentary is good as well. The stock coming for some bit of profit taking, mainly because the street is questioning whether or not quarter one FY27 will be a peak quarter in terms of profitability. Back to you.
Moved about 800 billion from negative to positive in Netherlands. This year, it will be positive EBITDA. It will be, we expect it to be better than what we delivered last year for the full year. Quarter on quarter, there will be some changes because of some of the disruptions. But Netherlands is not going to do worse than the previous year. It will do as well as the previous year is our expectation, if not better. As far as UK is concerned, again, the trend has been in the right direction, may not be as fast as we would have liked it to. So if you see the improvement in EBITDA for the financial year, which is finished, it's about 150 million better than the year before that. Still negative, but better. And this year, we expect it to certainly start moving into positive territory. Q1 will certainly be better than Q4, and Q2 will be better than Q1.
Well, sequential recovery both in Q1 and Q2 is what the management of Tata Steel is guiding for. Well, to take the discussion forward, we are now joined by Amrish Balka, who's an independent market expert, and Jay Thakur from ICICI Securities. Thank you, gentlemen, for joining us. Well, Jay, let me come across to you first. A sharp recovery intraday as far as the Nifty is concerned. What are the kind of levels you're working with?
Hi, very good afternoon to you, Vivek and Mangalam. I would say, Vivek, yes, indeed a very good recovery. In fact, what has been happening, if you look at the last 2 days, trading days data, as far with respect to the FI numbers, then we have seen the short covering happening in the index. The net short has actually come down from 2.35 lakhs to approximately 2.15 lakh contracts. So there has been a recovery of almost, or a short covering of almost 20,000 contracts in index futures. Along with that, there has been some buying interest in the equity cash segment as well for the last 2 days. If you see combinedly, it's been positive, right? So that is one thing which I think is creating a support at the lower end, despite all the negative indications from rising crude oil prices to rising bond yields, to somewhat of profit booking in the US markets or the Asian markets too. There has been a good recovery from the lower levels, clearly indicating that around the levels of 23,400 to 300 range, there has been a good support. And even if you look at the options data, 23,400 to 500 relatively has a good open interest build-up. So I think that for tomorrow's expiry, weekly expiry, 23,400 levels should hold out on a closing basis. On the flip side, 24,000 levels clearly seems to be having the highest call base. I think that would be difficult as well to be taken off. So for me, 23,400 to 23,900, 24,000 would be the range for tomorrow's expiry. And going forward too, I believe that, the Bank Nifty has filled the gap, has retraced almost 61%. It has filled the gap around the levels of, say, 53,000 approximately. The Nifty has not, surprisingly, the Sensex has also filled the gap. So the worst case scenario for Nifty, Vivek, once the weekly expiry is done, I think on the downside could be 23,100. I'm not looking the levels below that as of now, because of the good numbers by the FIs, and as well as the VIX has already reached to 2021. I mean, that should be the level. If at all it reverses from these levels, the probability of a recovery is higher.
So 23,600 to 24,000 is the range that you're talking about. Amrish, I have to ask you about the IT space. I mean, we've spoken about this multiple times in the past, and every time, it surprises on both the upside and the downside. Today was on the upside.
Yeah, I think because of that news or the sort of a statement which came regarding the cost of AI exceeding the cost of employees, I think that has given this move up. But I really don't know as to how long it will last. Could be just a short-term sort of a move. So I would not read too much into it unless it's clearly proven otherwise.
Well, Amrish, thank you so much for that. But one stock today that saw significant selling pressure was Amber Enterprises. This after the management flagged close to 50 to 100 basis point margin contraction in FY27, despite strong Q4 FY26 earnings. Upasna joins in with more details.
Well, certainly. So the management highlighted a nearly 50 to 100 basis points margin pressure on a consolidated basis in the near term on the back of elevated commodity prices and even currency depreciation. Mind you that the copper-clad laminates, the management has highlighted, has seen a heightened input prices rise, which is the main for PCB business. Now, overall, our RAC industry has seen a challenging year, but the management has clarified that the demand trends remain quite positive for Q1 FY27. On the volume growth basis, it expects a 20% volume growth in RAC in Q1 on the back of the lower base versus 12 to 13% growth that the management expects on a full year basis. Now, electronics, which was the key growth driver this time around, the management expects a strong growth momentum here with a revenue guidance of nearly 40% in FY27, and railway division, which saw a margin pressure this time around at the back of the low base, it has guided to grow around 30 to 35% in FY27 and FY28. Now, just giving a glimpse of Q4, it was a beat on EBITDA margins as compared to what the street was anticipating. The strong performance came in from the company's electronic division, while consumer durable is where the pain lies. It saw a soft growth of just about 6% versus double-digit growth that was reported by the other two segments of the company, that is electronics and the railway business. On the margin front, consumer durables margins saw a downtick of 40 bips at 7.2%, and this was mainly due to RAC margin pressure due to elevated copper prices. While electronics saw a huge jump up in terms of margins of 480 bips at 10.8%, and railways margins were under pressure as maintained earlier at 580 bips on year-on-year basis. So overall, strong growth on the margin front, mainly led by electronics, but consumer durables is where the pain lies.
Right, Upasana, thanks a lot for that. Consumer durables is where the pain lies. Amrish, on this EMS space, there is Amber, there is Dixon. Dixon gave us good commentary. That stock didn't fall as much as Amber. Now Amber is speaking about weakness in commentary. Do you have a pick here?
Yeah, in fact, the earnings were extremely good, but clearly, I think it was the management commentary which gave way. Again, if you look at it in detail, they are only talking about temporary setback. So from that point of view, I don't see a further major crack from here. Already we have fallen about 15%, today. If you see from the recent highs, about 20% fall. So I don't see the stock really going below that 6,600, 6,800 levels. So I think at those levels, one should be looking to buy from a longer-term perspective, because whatever said and done, I think over the next 2 quarters, I think all this should normalize.
Well, Amrish, completely. Next couple of quarters, you'll wait and watch. But one stock that did very well in the session today was Gland Pharma. This on the back of good Q4 earnings and a couple of brokerage upgrades coming as well. Ekta joins in to decode the Q4 results.
Well, yes, it was a good set of numbers coming in for Gland. The revenue was up over 20%. The margins expanded all the way close to 30%. There was a sequential as well as a year-on-year expansion which took place in terms of margins. And the profit was supported by better operational leverage as well as better other income. Key geographies, US was steady. It was up around 24% year-on-year. It's the major market for them. They had Europe, which was up around 36% year-on-year. India, which was up 28% year-on-year. So all of the geographies were firing on both cylinders. And we also had Cenexi, one of their key arms, which in fact was EBITDA positive this quarter, despite a lower top line Q-on-Q. In fact, what they are saying is that ex-Cenexi, the margin guidance for the company is around 33 to 35%, and according to analysts, that might be a little bit on the conservative side. Otherwise, they are expecting a top line growth of around 12 to 13% in FY27 on a constant currency basis. Analysts are also expecting the GLP-1 opportunity to play out favorably for Gland Pharma. Now, in terms of brokerages, Kotak is positive. In fact, they've upgraded the stock to a add with a target price of 2,075. According to them, earnings visibility has improved based on most approvals being in place amid the near-term patent expiries as well as commencement of new CDMO contracts. They bake in a strong 22% EPS CAGR over FY26-29, which is driven by new launches as well as operating leverage.
Well, thank you so much, Ekta. Gland Pharma ending high by over 15%. Jay, coming across to you, within the pharma space, what's your top pick?
Vivek, definitely, Nifty healthcare and pharma sector overall has been performing or outperforming the overall markets. If you see, in fact, they were quite resilient during the fall as well when the war started, and post that also in the recovery, I think the performance of the Nifty healthcare or Nifty pharma indices relatively have been better. And from here on to my overall bias in these two indices is positive. Almost they're correlated. It's just that in Nifty healthcare, you have the hospitals. And if I have to select one stock based on the risk reward within the F&O basket, it would be Dr. Reddy's. Vivek, I think that there has been significant long additions out here. The stock has been consolidating within this range of, say, 1,400 to 1,100 since almost a couple of quarters now. I'm preempting a breakout from this range, and I think the positional target for the stock would be around 1,600. Right, and the lower side, I believe that 1,200 level should be holding out for this stock. So if you see the risk reward, it's quite in favor of the bulls, and there has been long additions as well from the derivative perspective. So relatively, it looks better.
All right, relatively looks better. Let's talk about another stock which was on our radar. Jana Small Finance Bank approved a fundraise where the board did confirm CNBC TV18's news break, which is that they will issue about 70 lakh shares to TVS Venu Group through a preferential allotment. Ritu joins in with more details. Ritu.
Well, that's right. TVS Venu Group is set to acquire a strategic stake in Jana Small Finance Bank. The board has approved this fundraise for 728.5 crore rupees, which will be done through a preferential issue. The largest incoming investor in this preferential issue is TVS Venu Group's GWC Family Fund Investments. That's going to pick up 5.6% stake. But TVS Venu Group is also coming in through a second separate route, which is through TVS Motor Company, directly buying a 4.9% stake in the bank from the promoters. Now, this 4.9% stake that TVS Motors is buying today, that is going to be calculated on the current share capital. But once the warrants are converted into equity and the share base expands on that larger, fully diluted base, TVS Motors' effective stake will actually come down to about 4.26%. And you add that with the family fund stake, and the exposure will remain at 9.99%, which is just below the regulatory threshold. The other 5 investors that are coming in through the preferential issue is 2i Capital PCC, which is backed by Shruti Lohia of the Indorama Group. They'll pick up about 4.5% stake. Then you have Singularity Large Value Fund, ICM Finance, and Capri Global Ventures that will each pick up about 0.8% stake, and Utpal Sheth another 0.2%. They'll have 18 months to convert their warrants, but also important to flag, all these investors are going to be classified as public shareholders. They do not get any board seats or any veto rights or any kind of special control rights. The EGM is now on the 11th. The record date is the 5th, and RBI approval will be the key one to watch for.
Well, thank you so much, Ritu, for joining us, giving us all of the details on Jana Small Finance Bank, and congratulations on what was essentially a bank on Newsbreak. Ambrish, you heard Ritu. Have you had a chance to look at this particular news development? And within the private financials, what is it that you like?
So in fact, I think as far as Jana Small Finance Bank is concerned, I think this preferential issue will strengthen the balance sheet and should into Universal Bank. So hopefully with this, they should get their permission, which was denied last time. So from that point of view, I think it is positive for, for this SFB. But then if you're talking of the BFI space, I would now be positive on the private sector banks. Earlier I was quite positive on the PSU space. There we saw extremely good move. And post that we have seen a correction. But I think the next move would be mostly in the private sector banks. And in this, I would possibly pick one of the smaller ones, which is IDFC First, where again, we've seen a very decent correction, as well as HDFC Bank, where because of this controversies, we saw that correction. I think that's done. I think we should see levels of about 1,000 plus, possibly over the next 9 to 12 months.
All right, take that point. Thanks a lot, Ambrish. In fact, on that note, we'll thank Jay as well for joining us and giving us your views on a whole host of stock sectors and the way the markets are poised right now. We'll take a short break, come back, get you all the top corporate voices that joined us on the channel today, with all the key market events that you need to watch out for. Trade on the other side. Stay with us.
Welcome back to Market Forward. Well, let's now go across to the top management commentary we received during the day. First up, Solar Industries Management told CNBC TV18 it expects international revenue to grow 35% and cross 5,000 crore rupees in FY27, with domestic business also seen growing at a similar pace. The company expects defense revenues to top 4,500 crore rupees, with nearly 70% coming in from global markets. It adds FY27 margins are seen sustaining at 28%.
All right, Symphony was another stock which was lower in today's trading session, and that's because the management told CNBC TV18 that summer demand, while it remains healthy, April and May are seeing better demand than last year. The imports account for less than 4% of their input costs, limiting the impact of global supply disruptions. But they also highlighted the rising contribution of its non-summer portfolio, which now makes up for nearly 25% of their revenue, up from single-digit levels earlier.
Next up is KEC International. KEC International management says the West Asia crisis cost the company 400 crore rupees in March. However, it continues to maintain a 30,000 crore rupees tender pipeline in the region. The company also said India transmission business performance was weak in Q4, while labor availability remains a key issue in the civil segment. FY27 growth guidance stands at 10 to 15%, though Q1 may remain subdued.
All right, and before we wrap up on this show, let's get you some key market events to watch out for. Upasna Bhatt standing by with all that you need to know for trade tomorrow.
Well, first up, let us look at some of the key important results scheduled for tomorrow. BEL, PI Industries, Z Entertainment, Zydus Life, Dhanuka Agritech, Dredging Corp, Hudson Agro, Zydus Life, along with its board meeting in terms of the buyback, all these counters will be reporting their Q4 FY26 numbers tomorrow. So we'll be closely keeping an eye out on that one. Now, PM Modi to attend 3rd India-Nordic Summit in Norway tomorrow. So that is one of the key important events lined up for tomorrow. Now, on the flip side, let us look at some of the key important global economic data. Japan Q1 GDP data will be out, Europe economic centimeter, and even US the CPI data will be out tomorrow. Now, in terms of central banks, Federal Reserve Goldsby speaks tomorrow night around 11:30 p.m. So we'll be watching out for any economic outlook that will be given tomorrow. And Fed's Paulson will be also speaking at Financial Market Conference tomorrow. Now, in terms of other events, Russia's president will be visiting China from May 19th to 20th, and also Google's annual development conference is also scheduled from 19th May to 20th May. So all in all, looks like quite an power-packed day tomorrow.
Well, thank you so much, Upasna, for listing out all of the key events we need to watch out for in tomorrow's trading session. But with that, it's a wrap on this session of Markets Forward. We will be back with more news and updates on the other side.
Thank you for watching.
Hello and welcome to Business 360. I'm Archana Solanki. Here are the headlines we're tracking this evening. Market stages a smart recovery from lows to close flat. Broader markets underperformed. Rupee hits record low of 96.39 against the dollar. US President Trump says the clock is ticking for Iran to reach a peace deal. Reports suggest he would meet top security advisors to discuss military operations for Iran. UAE cites a dangerous escalation after a drone struck the inner perimeter of a nuclear facility. Oil prices soar above the $110 mark. Oil Ministry says India had sourced Russian oil before and during the US waiver and was importing now as well. The US waiver for India on importing Russian oil ended over the weekend. The Oil Ministry says OMC losses down to 750 crore a day from 1,000 crores after the fuel price hike, adds that no bailout package is on the table. Vodafone Idea board clears plans to raise 4,730 crore rupees from the promoter Aditya Birla Group, approves issuing fully convertible warrants. The telecom company swings to black in the fourth quarter, driven by a one-time exceptional gain from AGR reassessment. Prudential PLC to acquire 75% stake in Bharti Life Insurance for 4,200 crore rupees. The deal values the life insurance company at 5,600 crore rupees. Prudential PLC to also bring down its stake in ICICI Prudential to 10% as per regulatory requirements. A conglomerate led by the TVS promoter group to acquire 9.9% stake in Jana Small Finance Bank via a combination of warrants and secondary share purchases. The deal is estimated to be valued at 500 to 510 crore rupees at prevailing market prices. TVS Motor Company to directly hold close to 5% stake up subject to approvals. Prime Minister Modi in Norway for the penultimate leg of his five-nation tour. India elevates its bilateral ties to strategic partnerships with Sweden and the Netherlands. Tata Electronics and Dutch semiconductor giant ASML sign an agreement to support chip manufacturing in India. V.D. Satheesan takes oath as Kerala's 13th Chief Minister. 20 others, including senior Congress leader Ramesh Chennithala and 5 Indian Union Muslim League MLAs sworn in as ministers as well. Congress top brass including Kharge, Rahul and Priyanka Gandhi were present at the swearing-in ceremony. All right, let's start with the day's market action. The market staged a smart recovery from lows to end flat. Broader markets underperformed. Nifty IT closed higher for the second straight session. Prashant Nair is here with the market wrap.
Well, a sharp bounce from the lows, almost 300 points in total for the Nifty. From the broker community, there was chatter that perhaps there was some outflow from, a market like Korea, which sort of, came our way. We'll find out more as we get the flow numbers, etc. But that was equity, right? I mean, the rupee, dollar rupee, absolutely no relief. We made a fresh record low for the rupee. Past the 96 sort of mark. Bank Nifty also came up a little bit from the lows. Mid-cap and small-cap indices. Mid-cap did see bounce, but small-cap index was still down over 1% lower. So it didn't show up, by the way, if you look at the advanced decline ratio. Declines, number of stocks down, far outnumbering the number of stocks, just counting them in that way. Now, as far as large caps are concerned, I'll start with what was up. The IT index had lost 6% last week. It bounced about 2%, but that's been the story. Small bounces followed by larger falls. We'll see if this time is different. So on the Nifty, TechM did well, Infosys did well, Bharti did well. There was Sun Pharma, which was up and about as well. On the downside, Tata Steel, we had the management with us, Power Grid and State Bank of India also, which were lower. Power Grid, a bit of a disappointment as far as earnings are concerned. The broader markets, the losses coming through in Amber, which was down sharply, Sirma, Keynes, CG Power, Data Patterns, Uno Minda. You had Cochin Shipyard, Garden Reach Shipbuilders, Azad Engineering, which were sharply lower. Godfrey was down, TVS Motor, Force Motors, and some of the AMC companies where ICICI Pru, where there was a large deal, and HDFC AMC, which was down today as well.
Right, thank you, Prashant, for that. On to the currency markets now. Rupee fell to a record low of 96.39 against the dollar. This as higher oil prices stoked fears of rising inflation. The rupee has fallen 7% in 2026 so far. And the top global story we are tracking this evening, US President Donald Trump warns that Iran is running out of time to make a deal as the Gulf regions report fresh drone strikes. Here are the latest developments. Now, tensions escalated in the Gulf region as Saudi Arabia said it intercepted 3 drones that its airspace from Iraqi territory. This came soon after the UAE alleged that a drone strike by either Iran or its proxies triggered a fire near a nuclear power plant. The country called the act a dangerous escalation and said it had the right to respond to any hostilities. Meanwhile, US President Donald Trump expressed his impatience about the continuing stalemate between Iran and the US. In a post on social media, Trump said, and I quote, "For Iran, the clock is ticking and they better get moving fast or there won't be anything left of them." End of quote. Axios reported that Trump will meet his national security team tomorrow to discuss options. However, despite these threats of escalation, US and Iran continue to exchange peace proposals through Pakistan. Reuters has reported that Pakistan shared Iran's revised proposal to end the war with the US. Pakistani officials reportedly accused both sides of, and I quote, "changing the goalposts." End of quote. Fears of escalation have pushed crude prices higher, with Brent hovering around $110 a mark. Traffic at the Strait of Hormuz remains nearly at a standstill. This as Iranian and Omani officials met in Oman to negotiate a mechanism for safe transit in waterway. Iran's foreign ministry has said that the talks are focused on preparing a framework under international laws for the transit mechanism. Back home, oil ministry says India will continue to source Russian crude irrespective of a US waiver. The US waiver for India on importing Russian oil ended over the weekend. The oil ministry says OMC losses down to 750 crores a day from 1,000 crores after the fuel price hike, adds that no bailout package is on the table.
Regarding American waiver on Russia, I will like to emphasize that we have been purchasing from Russia earlier, and before waiver also, during waiver also, and now also. So it is basically the commercial sense which should be there for us to purchase, for OMCs to purchase. So that's my precise answer. There is no shortage of crude. Enough crude has been tied up. Repeatedly, I have told you, and this, whatever waiver or no waiver, it shall not affect our supplies, and all efforts have been taken to that effect.
Now, telecom major Vodafone Idea has swung to black in the fourth quarter, driven by a one-time exceptional gain from AGR reassessment. The company board has also cleared plans to raise 4,730 crore rupees from the promoter Aditya Birla Group. Sudarshan Kumar brings us all the details. Sudarshan, please take us through the company's plans.
So 2 parts for Vodafone Idea. One set of that company had announced Q4 FY26 earnings, and those earnings had looked operationally okay, and on some fronts it was better than peers. So if you talk about the revenue, it has grown more than 2%, 2.3% on a sequential basis. Even margin has come in above 43% versus 42.5% again on a sequential basis. Average revenue per user has increased 1% on a sequential basis, and it's better than peers, and now it has increased to rupees 174. The heartening part and the most important part in the earnings was subscriber loss. It was at 0.1 million, and that's the lowest loss that company has seen in the last 6 years, or say since FY26. But the other part and the most important part was the promoter infusion, and the promoter is going to infuse almost 4,730 crore, and that would be done via convertible warrant, and it's at rupees 11 per warrant. It's done at a discount to current market price. So that's the reason. And over the last few weeks, you would have seen that there is Vodafone Idea share price has seen a huge run up. So you can say it's today we are seeing a profit booking. But beyond that, what would be tracked very closely is debt fundraising. Whenever it happens, that would be tracked closely, and if that happens, it can take the stock higher again. But as of now, stock today is seeing profit booking.
All right, thank you, Sudarshan, for that. We told you first, and now it's official. Jan Small Finance Bank's board has approved a preferential warrant issue to raise up to 729 crore rupees from 6 investors. This includes the TVS Venu Group will acquire 9.99% stake in the Small Finance Bank. Ritu Singh joins us for now. Ritu, please take us through the fundraising plans and who are the other investors?
That's right. Just as we told you here on CNBC TV 18, TVS Venu Group is set to acquire a strategic stake in Jana Small Finance Bank. Now, Jana's board has approved a fundraise of 728.5 crore rupees. That will be done through a preferential issue of 1.57 crore warrants at 464.82 per warrant to 6 investors. The largest incoming investor in the preferential issue is TVS Venu Group's GWC Family Fund Investment. That will pick up a 5.64% stake. But TVS Venu is also coming in through a second separate route where TVS Motor Company will directly buy 4.9% stake from Jana's promoter entity, Jana Holdings, for 193 crore rupees. Now, this 4.9% stake that TVS Motor is buying today, that is calculated on the bank's current share capital. But once all the warrant conversion happens and the equity share base is expanded on that larger, fully diluted base, TVS Motors' effective stake will come down to around 4.26%. So now, if you add GWC's 5.64% stake, TVS Venu Group's total exposure will land at just under 9.99%, which is well within the regulatory ceiling. The other 5 investors that are also coming in through the preferential route include 2i Capital PCC, that is backed by Shruti Lohia of the Indorama Group, which will pick up 4.57% stake, Singularity Large Value Fund, ICM Finance, Capri Global Ventures, they will each pick up 0.84% stake, and Utpal Sheth another 0.21%. So apart from the TVS Venu Group, which will acquire 9.99% stake, the other 5 investors will collectively hold around 7.3% in the bank. It's also worth flagging that all incoming investors are going to be classified as public shareholders. None of them get board seats, veto rights, or any kind of special control rights. The EGM for the approval of the shareholders is on the 11th of June. The record date is the 5th of June. And now, of course, next, apart from shareholders, RBI's approval for this deal will be key to watch out for.
All right, thank you, Ritu, for that. Moving on, Prudential PLC will acquire 75% stake in Bharti Life Insurance for 4,200 crore rupees. Prudential will now have to pare back its stake in ICICI Prudential Life Insurance to comply with regulatory requirements. Shares of ICICI Prudential fell to a 52-week low following the announcement. Yash Jain has more. Yash.
Well, a deal happening in another insurance company, reflecting in the performance for ICICI Pru today. Yesterday, Prudential PLC announced acquisition of 75% stake in Bharti Life Insurance for a total amount of about 4,200 crore rupees. Now, that is the exact deal which has put a negative overhang as far as ICICI Prudential Life is concerned. That's because Prudential PLC, which is acquiring that 75% stake in Bharti AXA Life, has 22% holding in ICICI Prudential Life Insurance as well. Now, as per the regulations, one entity cannot be a promoter to 2 life insurance companies, which means in one of the 2 companies, it has to bring down its stake to less than 10%. Now, of course, for the new venture to go through, it will have to, that is, Prudential PLC will have to reduce its stake in ICICI Pru Life to less than 10%, which means divestment of about 12% stake when it comes to the company. This is worth about 9,200 crore rupees. And now this particular development creates an overhang, a supply overhang, as far as ICICI Prudential Life Insurance is concerned. There are also concerns on the bancassurance side, how the dynamics of distribution would change with this particular deal. All of that today reflecting on ICICI Pru.
Right, thank you, Yash. Moving on, industry veteran KEC Mistry, who had taken over as HDFC Bank's interim chairman after the unexpected exit of Atanu Chakraborty, may get another 90-day extension. My colleague Furkan has more details. Furkan, what's the reason for the extension?
So what we learn is that the financial services veteran KEC Mistry is likely to get an extension as interim chairman of HDFC Bank for a further 90 days. Remember, he was appointed as the interim chair for a 90-day period in March this year after the bank's former chairman Atanu Chakraborty resigned from his position unceremoniously, citing ethical issues at the bank. That term comes to an end in mid-June 2026. However, sources tell CNBC TV 18 that the bank's board and the Nomination and Remuneration Committee are yet to take up the hunt for a full-time chairman because they are waiting for the reports of the independent probes into the allegations leveled against the bank by Chakraborty. The bank had hired 3 law firms to look into these matters, and we learned that these reports are expected in the next 10 days. The law firms, we are told, have reviewed the board notes the minutes of the board meetings and the email conversations between the board and the management over the last 2 years. So the bank's board and NRC will study these reports before proceeding with an appointment of new chairman. Till that happens, they are going to seek an extension for KEC Mistry. It's pertinent to note that the board had decided to go for the reappointment of CEO Shashidhar Jagdishan only after an unqualified report by the auditors and the report from the law firms. The unqualified report has already come in as part of the fourth quarter results. So the only reports from the law firms are awaited. Jagdishan's term will come to an end by the end of October this year. And as per RBI guidelines, the bank should either move to grant him an extension or appoint his successor by the end of May 2026. CNBC TV18 reached out to HDFC Bank and the responses to these two events are still awaited. Back to you.
All right, thank you, Furqan, for that. Moving on, flight operations at Mumbai's International Airport faced major disruption today. This after employees of A1 Airport Services, the ground handling agency servicing Air India and other carriers, launched an unannounced strike. This impacted baggage handling, boarding and aircraft turnaround services. Passengers were also stranded inside the Delhi-Mumbai aircraft for almost an hour due to these disruptions. However, the strike has been called off after employees were assured that demands will be looked into. And time for a break, but coming up next, Prime Minister Modi is in Norway for the penultimate leg of his 5-nation tour. India elevates its bilateral ties to strategic partnerships with Sweden and the Netherlands. Details on the other side. Welcome back. Prime Minister Narendra Modi has arrived in Norway for the penultimate leg of his 5-nation tour after concluding his 2-day visit to Sweden. This is the first visit by an Indian Prime Minister in more than 4 decades. Norwegian Prime Minister received him at the airport in Oslo. Prime Minister Modi will participate in the 3rd India-Nordic Summit and hold bilateral talks with Norway's leadership. During his Sweden visit, the PM held extensive talks with Swedish Prime Minister. The talks focused on trade, technology, defense and innovation. Both leaders agreed to elevate ties between India and Sweden to a strategic partnership. Modi was also conferred with Sweden's highest honor for foreign heads of government. The Prime Minister was in the Netherlands earlier. India and the Netherlands also signed multiple agreements aimed at expanding cooperation across various sectors. During talks with Dutch Prime Minister, Modi said India and the Netherlands ties had witnessed significant progress over the last decade. Addressing the Indian diaspora, Prime Minister Modi said, "The world is dealing with new challenges in the light of conflicts in West Asia and Russia." He also warned of a potential return to massive poverty. Speaking at a business roundtable, Prime Minister Modi added that in times of uncertainty, India and Europe can become strong pillars of stability, sustainability and shared prosperity.
आज के विश्व में जहां अनिश्चितता है, सप्लाई चेन्स दबाव में है, टेक्नोलॉजी में कंपटीशन बढ़ रहा है, ऊर्जा सुरक्षा और क्लाइमेट एक्शन दोनों को चुनौती दी जा रही है। ऐसे समय में भारत और यूरोप मिलकर स्टेबिलिटी, सस्टेनेबिलिटी और शेयर्ड प्रॉस्पेरिटी के मजबूत स्तंभ बन सकते हैं।
Abhimanyu Sharma brings us a wrap on Prime Minister Modi's trip to the UAE, Netherlands, Sweden and Norway.
Prime Minister Narendra Modi has reached Norway and is slated to visit Italy tomorrow as part of his ongoing 5-nation visit. India's bilateral ties with the Netherlands and Sweden have already been elevated to a strategic partnership. Several announcements have been made till now from the Prime Minister's visit to different countries. His visits began from the UAE, where an agreement was signed on the framework for a strategic defense partnership to expand bilateral security and maritime defense. Also, MOUs were signed for strategic petroleum reserves, for LPG supply to India, and also for setting up of a ship repair cluster in India. Apart from this, $5 billion of investment in India infrastructure was committed, apart from a supercomputing facility in India. This was followed by the Prime Minister's visit to the Netherlands, where he and his Dutch counterpart witnessed an agreement which was signed between Tata Electronics and ASML to support the semiconductor fab in Gujarat. Also, bilateral dialogues were held which was focused on green hydrogen, clean technologies and advanced manufacturing. Subsequently, the Prime Minister visited Sweden, where he took part in several meetings with their political leadership as well as with business leaders. A joint innovation partnership for cooperation in AI, 6G, critical minerals, sustainable mining, space and life sciences is being looked at, apart from an India-Sweden tech and AI corridor which will be jointly developed by both the countries. In a roundtable which he held with several top CEOs from different European companies, he urged them to increase their overall investment in India. It remains to be seen how early these investments are going to fructify and how early more units are going to be set up in India.
Right. Thank you, Abhimanyu, for that. G7 finance ministers acknowledged mounting concern over public debt and bond market volatility as they met in Paris. This comes in the wake of a bond market sell-off triggered by fears over inflation risks. U.S. Treasury Secretary Scott Bessent has said that he will call on the ministers to adopt a strict coordinated sanctions regime against Iran. Tensions between Russia and Ukraine continue to escalate after both nations exchanged massive drone strikes. At least 4 people, including 1 Indian, were killed after Ukraine unleashed one of its largest drone strikes on Russia. Moscow soon retaliated and targeted 2 cities in Ukraine, injuring several people. The Russian embassy in India released a statement saying that it mourns the death of the Indian national in Russia. The World Health Organization has declared the Ebola outbreak in Congo as a public health emergency of international concern. The agency said the outbreak, which has seen around 246 suspected cases and 80 deaths reported, does not meet the criteria of a pandemic emergency. However, it has warned that it could potentially be a much larger outbreak than what is currently being detected. Shares of Samsung Electronics jumped over 6% amid hopes of a breakthrough in talks with workers ahead of a planned 18-day strike. South Korean president urged both labor and management to respect each other's rights and reach an agreement. The union is demanding higher performance bonuses and reforms to Samsung's bonus structure. Back home, Congress leader V.D. Satishan took oath as Kerala Chief Minister at the Central Stadium in Trivandrum. This marks the return of the Congress-led UDF to power after 10 years. 20 ministers of Satishan's cabinet also took oath. He is expected to retain key portfolios like general administration, finance and law. Top Congress leaders, including Party President Mallikarjun Kharge, Rahul Gandhi and Priyanka Gandhi Vadra, were present at the ceremony. The Supreme Court expressed reservations about earlier orders which denied bail to Umar Khalid and Sarjeel Imam in the alleged larger conspiracy case linked to the 2020 Delhi riots. The court held that bail is the rule and jail is an exception. Even in prosecutions under the Unlawful Activities Prevention Act, the two-judge bench made the observation while granting bail to a J&K resident in a narco-terror case investigated by the NIA. And with that's a wrap on this edition of Business 360. News and updates continue right here on CNBC TV 18.
We Work India presents CNBC TV 18, The Titans. Co-presented by PhonePe.
I think the performance, the musical performance was uplifting. It was up, and it was bright, and it was lively. Markets, though, have been a bit, what should I say? I mean, the notes have been sort of dark and a little unsettling, and especially public markets. But, you know, we've got people here, true titans, and thanks all of you for being here, part of the panel. And these are people who sort of see businesses. I mean, we talk about public markets all the time. But, you know, in public markets, businesses are already many years old and they've matured and they've attained a certain sort of size, scale, in whatever businesses they're in, whatever categories they're in. But these are people who see businesses far, you know, ahead of, far before they list, you know, in their infancy, when they're starting to build out. So they're the, in that sense, the risk takers. And I think that their capital is very important if we need to sort of fund this, fuel this new investment cycle. And of course, domestic capital base has become very large, even compared to 10, 15 years ago. So once again, thank you very much for being part of the panel. Manish, I want to start with you. Is the music a little dull and unsettling and, I don't know, you know, or is it still, is the music slowing down? If I were to borrow from the phrase from a famous movie.
Is it the music we were hearing right before we started?
The music in markets.
That music was excellent.
That was excellent.
No, first, Prashant, Shirin, thanks for having us. Pleasure being here. Listen, I think the difference between private and public markets is just, you know, what do we do as public market guys are on edge every day. You know, frankly, I don't know what the markets did today. Did it go up or go down? I know it went down, but it's... No, Shirin, I sure would give me all the facts, thank you. But my point is, it shouldn't matter to us, to a certain extent, right? Because we play what I would call is the long game. Not better, not worse, just different. Our lives are relatively simple. We make 3 or 4 investments, maybe 5, 6, at least on the private equity side where we function. Both control and non-control, and it is patient long-term capital. The only things which change when I look at a 25 versus a 26, as I was talking about outside, last year we had buoyancy, right? There was madness in the markets. The public markets were on fire. Sponsor-to-sponsor sales were going up. Strategics were looking at acquisitions. In times like this, remember, our capital is, you know, unlike Rishabh and that's his permanent capital. We are fiduciaries for other investors. And all we can do is be responsible providers of that capital. And hence, in years like last year, we stepped back on new investments given the valuations, but really accelerated divestments and money back to... So last year, to give you a sense, our normal ratio of new investments to exit is about 1 to 1, a little bit more on the exit side. Last year, it was 3.5 to 1. We returned almost $2 billion to our investors. Vishal itself, we had one exit of $1.2 billion. So
I believe that was the most...
But I'm saying that was last year. Yeah. This year, the public markets, as you know, and Shirin reminds us today, it's not a time for the faint-hearted, right? So what do? Your playbook changes. Your level of divestments will go down. Our DPI will not look as good in 26 as in 27. But hopefully, the 20 companies we were looking at acquiring, but always was beyond our reach last year, now will become closer to reach. Now, remember, private markets take time to react vis-a-vis public. We are still 3, 6, 9 months behind. The public markets have corrected, intensively so. The private markets will get there, but the mood is getting pessimistic. I think all of us, from a deployment perspective, would want this pessimism to remain. But remember, our life is about both making good investments, but more importantly, getting exits. So this year, we will probably have a ratio where we'll deploy more money than take out. But at the end of the day, it's a cycle. It's yings and yangs in life. And you have a 10-year window, not a 10-day or a 10-hour window.
That's very well put, Manish. And I think what you said, so private markets will mark to market in that sense in about 3 to 6 months. I mean, that's the lead lag between public and private markets. Just one more question. I mean, you know, in public markets, we talk about all the time, so much anxiety and hand-wringing about why foreign capital is staying away. I mean, actually, why is it actively selling? In Gopal and I were talking about it just outside. What is your sense, Manish? What is the, you know, I've heard lack of AI, taxation, I mean, just valuations, perhaps earnings growth has slowed down. What are the really...
Two very different pools of capital. You have the global investors, for which India is far less relevant today. For multiple reasons. When you have increasing interest rate climate in the US, which people expect, money will flow back. When there's uncertainty, you go towards gold, you go towards markets which are more shorter. Your overall portfolio, you want to de-risk. even our largest investors and global investors have a paucity of capital. They haven't got the distribution in the last 2 or 3 years as they were expecting. China was weak. So if you have an Asia allocation and China has not returned capital, which was the most amount of private equity, things are, so their new deployment goes down in public and private markets. So at least in the public markets, they were drawing capital. The domestic pool, I would say, I would disagree. There is a degree of nervousness. Most of us who think we're good public, we get it wrong. You always sell when the market is falling. You buy when the market is peak. You should do the reverse as usual. So, but I think the overall flows, and again, Sharon will correct me, I'm sure, but the overall flows into the public markets for domestic capital is increasing month on month because of the SIPs. That's the amount of, so if you look at us 10 years ago and you had to price an IPO, we would fly to Singapore and meet with a Fidelity or a Capital or one of those guys. Today, you go to BKC and you meet SBI, HDFC, ICICI mutual funds, and that's how you fix your pricing. That hasn't changed. The level of buoyancy and what they can afford and then negotiating leverage on you when you're doing an IPO also enhances. So I think it's a tempering. I think the tempering is a good thing. And hopefully for us, it'll mean a chance to deploy more capital.
Absolutely. Gopal, you want to comment on the same question in terms of why is foreign capital a little nervous at this point?
You know, first of all, it depends on which music you've been listening to, right? In private markets had a record year last year, even though public markets, there's a liquidation trade in public markets. But in private markets, we saw well over 50 billion, close to $60 billion being invested. And if you look at the source capital of the 60 billion, more than 50%, close to 60, 70% is foreign capital. So foreign investors in private markets continue to buy, while foreign markets and public markets. So this nuance is very important. And I know it's being very simplistic, but if you conflate, say, private markets with a longer term view of the market, then investors with a longer term view of the market, investors like us, I've been investing in India professionally for 35 years. I made my first private investment 31 years ago. India has been a structural bull market for 35 years. And every 4 or 5 years, there is something that happens that gives you a window to buy. And the reason that happens is because we have a twin deficit problem. So whenever the world sneezes, we catch a cold. We should have solved this by now, but we still have a structural vulnerability, right? So every time in the last 35 years, the shock that we get every 4 or 5 years has been a good time to buy. And I think people who see this pattern recognize this pattern. And which is why in private markets, you continue to see investment activity funded by foreign capital, even within public markets, as Manish was saying. While we might be seeing a liquidation by foreign investors, as far as domestic institutional investors. And for a minute, again, while being simplistic, conflate them closer to where India is, and foreign investors have choices, they have other things to look at, they've been buying, yes. But that still leaves a question, why are foreign investors in public markets liquidating? Yes.
To raise a private fund, there should be no problem. Foreign money, if you were to raise a...
Well, 10 years ago, if you wanted to raise a private fund, you only had foreign money.
Yeah.
But what's changed about India is India has become a large economy.
Yeah.
Private equity works in large economies. In large economies, private equity works with both domestic capital and foreign capital. When we started, nearly 100% of our external capital used to come from foreign investors. And now there is so much domestic capital. So it depends on who you're talking to. But I would say that if there is, for new time managers, I think it's much easier to raise capital. Yes, raising money from foreign investors is difficult for everybody except Manish Kejriwal. But in general, I would say there's still a lot of appetite for India, for the Indian story. And there is a growing appetite because India is a savings factory of the world. We are 4% of global GDP. We are 7% of global savings. There isn't enough global Indian savings that is making its way into alternatives. That is changing. And as that changes, this is going to inflate the alternative sector and make it possible for people to raise larger and larger amounts of capital.
Actually, so many public market investors have become not private equity investors, but maybe VCs and so on and so forth. They've all going back and back and back to and maybe that's competition for you guys when you go in for deals, etc. You talked about raising money and how to price an IPO, but perhaps competition for deals also has perhaps gone up because of, I guess, a lot of large, all kinds of investors who are now looking for businesses in their infancy as they're starting out, etc. So that point is taken. Rishabh, just what's your perspective? And I mean, as Manish said, it's permanent capital. So maybe there's a...
Yeah, so, firstly, thanks for having me and pleasure being here today. I think, from our perspective at Sharp Ventures, which is our family office, we are quite focused and, we do a whole bunch of very early stage and then we do some opportunistic mid-stage and late stage. So I think it's flexible capital that we have, but I want to just say that the word family office is a bit abused in the country, and there are not too many real institutions here which are truly family offices, where it's about governance, it's about strategy, it's about discipline, and it's about allocation. Usually most family offices just think about just how to make alpha without depth of thought process. So I think, there's all sorts of capital out there, but I think true long-term capital, when there's enough capital to deploy, I think strategically some of that thought process is missing in the country. So you do get chunks who go into a bunch of funds and top quartile funds, like a Kedara, Gaja, Chris, whatever, the big boys, and then there's a bunch of mid-market and early stage funds. At least, our journey started in 2014. We did like 14 funds in the last, too many funds, but in the last 10, 11 years. And, unfortunately, the DPI, TVPI, it's not been great in the early stage ecosystem, right? And then we had our learnings and then we said that, guys, let's just do what we can underwrite. We can only underwrite consumer, so let's focus on consumer. And I think that's what we've done. And I think for us personally, that's what's been super exciting because, the journey, the next decade will be defined by the 400 million aspirational Indian consumer who will pay and with their wallet, and that aspiration is what we are after. And hopefully if we chase the right entrepreneurs who are betting on the right categories and the right brands, I think those ones will be the winners of tomorrow.
Fair enough. Krishna?
He's being a little modest. His direct investing included a small company called Nykaa, which he put in 10 crores, which I think when he exited was more than 1,400 crores. So he makes the rest of us look like a little foolish. So it's not only permanent capital, it's smart permanent capital. And you should talk about family offices to Harsh uncle and give it, not your dad, Harsh Goenka. And, talk about how good family offices can be.
He has a very different view on family offices. But I think that's a different view altogether that he has, where he thinks that family offices just chill and play golf and go on vacations. I think that too, but I think that's different because those are just investors who just sit and watch. Here, I think, when it's value adding is what you want to do, and you want to truly help entrepreneurs in their journeys and not just be just be passive investors. So I think that's a different pool of capital, and I think that's also needed, by the way, in the country. But that's not who we are.
We Work India presents CNBC TV 18, The Titans, co-presented by PhonePe. presents CNBC TV 18, The Titans. Co-presented by PhonePe.
Krishna, you want to comment on at TVS what's happening and what are you doing? Focused on which areas and what kind of Rishabh mentioned consumer, financial services are the two sort of bedrocks as far as India is concerned in terms of fighting ideas. It has been for the last 20-25 years. Just give us an overview of what's been happening at TVS.
Yeah, we are now in our fourth fund. And interestingly, we've always been a rupee fund. We've raised money in India, invested in India. So taken a lot of pride in doing that. In the fourth fund, I think one of the things that we're seeing is also we are institutionalizing our fund. This was started by Gopal, and now you see more people coming in. So like you see in the market as well, families are institutionalizing in terms of family. Gopal Srivas, yes. Don't give me all the credit. So you see families also putting an institutional setup in family offices, structures and formats in place. And you will see in the market in the next 20 years, significant money is going to move in across generations. You're going to see that quite a bit. There are reports about lakhs of crores going to move in. The second thing that you'll see in the market happening is the PF and NPS money and possibly insurance money, close to 107 lakh crores. A percentage of that will get unleashed into the market. With all that, I think the domestic pool is going to increase quite a bit. And therefore, I think we are quite excited about that. We have, in the first fund, been agnostic of the sector. We've been everywhere. And last fund, we were very sharp, largely in financial services. This fund, we are now into financial services, end-to-end distribution, wealth, insurance, and enterprise technology, and also industrials. And one of the reasons we're moving into industrials is a lot of our LPs from family offices have backgrounds in manufacturing. TVS family also has a lot of background in manufacturing. Plus, we see a lot of opportunities today. People think India has jumped from agriculture to services and the manufacturing is lost. But it seems to be coming back in some places with a big bang. In some cases, I think slowly coming back. So I think that seems three areas of our focus. And we've invested a lot in people and capability capital. We're looking forward to that.
I missed manufacturing when I said financial services and consumer. I just want to ask Manish the AI question, right? I mean, you spoke about the Vishal Megamart. I think it was your single largest sort of transaction, exit in terms of the amount of money that you made on that single deal. I mean, at one level, does it matter how you make money? Vishal Megamart is a fantastic company, well-run company. You went in early, you made a ton of money there. But at the same time, you look at what's happening around the world. And you and I were at an event yesterday where we got sort of presented that anecdote. The three companies, SK Hynix, TSMC, and Samsung, the amount of FII money in these three companies is about $1 trillion. FII stock of money in India is about $750 billion. So it's just, the numbers are insane. So my question is, does it really matter if it's a huge super cycle, maybe the biggest of our generation or two, and it seems to be, in a way, passing us by. I don't know. What's your sense?
Tough question. When you look at AI, you look at it from an investment lens, and you do it from a portfolio lens, right? The numbers globally are crazy. We, at least us, humbly speaking, I can't speak on anyone else or as a country, don't have the wherewithal or the skill set to play the game that the big boys are playing, whether the hyperscalers, whether it's the Amazons and the Googles of the world, whether it's an infra play or an LLM play. What we have learned in 15 years of existence, and with Temasek earlier, is humility. The markets and companies will make you humble. So don't ever go, if that's your guardrail, play within your guardrails, do stuff that you understand well. For us, it is consumer, it is financial services. It's tech services, not technology. We don't claim to know what the guys at Samsung can do. And yes, a bit of pharma and healthcare services, whether it's diagnostic labs. The moment you step outside your guardrail, you do that as a PA investment. You can't do it for the money that we are a fiduciary for other guys. They've given you money to do a certain investment thesis. Suddenly there's a more attractive rabbit running across the train tracks. If you're running after that rabbit, you're going to be hit by the train, right? More likely than not. So you've got to be really disciplined to stay within your guardrails. So to answer your question, AI, our portfolio companies, we encourage them. We have a full team working with them in either ways to enhance revenue or to decrease costs. We're doing both. I'd say we're still learning. We're probably learning more from some portfolio companies like a Purple, and we're transmitting that knowledge to the others and learning a bit more. On the investment side, let's be clear, I'm not investing in any LLMs. I have no strategic advantage, no market. But what we will do is, for example, we bought a controlling stake paying $250 million in a company which is US-based with an India backend, which does data migration. And so it's very boring, old world, but it prepares enterprises to become AI ready. So again, it's not the gold mine that you're running after, because it's very difficult for us to actually find that little thing of gold. But we're investing in the in the picks and the shovels, which can help others reach the gold mine. And we will then mean a 3 to 4x return. We're not used to Rishabh's 100 or 1,000x returns he did in Nika. We're happy with a 4, 5, 6x or a 3 or 4x. And hence the risk return, you've got to be measured and know what you know and play in that. And the stuff you don't know, just keep far away from.
Gentlemen, thank you very much for joining us. The music in markets, public markets may be a little slow, but I think encouraging thoughts from all of you. Thank you very much, Rishabh, Manish, Gopal, and Krishna. Thank you very much.
We Work India presents CNBC TV 18, The Titans. Co-presented by PhonePe.
Hello and welcome to this special show on the West Asia tensions. I am Ashmit Kumar. Now, US President Donald Trump has warned that the clock is ticking for Iran to reach a peace deal. He said that if they don't act fast, there won't be anything left of them. The remarks came after Trump reportedly held a phone call with Israeli Prime Minister Benjamin Netanyahu amid speculation over a potential revival of military action against Iran. Now, reports suggest that the US President Trump could meet top security advisors today to discuss options on Iran. Iran's foreign ministry spokesperson said that talks with the US are continuing through Pakistan as a mediator. Now, according to a Reuters report, Pakistan has shared a revised Iranian proposal with the US aimed at ending the conflict. In an interview with Fortune, Trump said, and I quote, "They are dying to sign, but they make a deal and then they send you a paper that has no relationship to the deal you made. I say, are you people crazy?" End of quote. Now, the situation in West Asia escalated further after the UAE Defense Ministry said that 3 drones entered the Gulf country from its western border. 2 were intercepted while a third struck a generator near the Baraka nuclear power plant in Abu Dhabi, sparking a fire. Now, the UAE called this incident a dangerous escalation, but said that the fire caused no injuries or radiation leak. It also blamed Iran or its proxies for this strike. India, meanwhile, has condemned the attack, calling it unacceptable and urging restraint. Fears of a wider escalation have pushed Brent crude prices above the $110 mark. Saudi Arabia, meanwhile, also claimed that it intercepted 3 drones that entered its airspace from Iraq. Meanwhile, Qatar and Kuwait have condemned the attacks and expressed solidarity with Saudi Arabia over any countermeasures. Iran has announced that the formation of a new body to manage the transit mechanism at the Strait of Hormuz in coordination with Oman. The Persian Gulf Strait Authority will be providing real-time updates on social media platform X. Well, joining us now to take this conversation forward, we have with us former diplomat Mr. Ashok Sajjanhar. Also with us, Anju Gupta, geosecurity expert, as well as Dr. Saido Al-Kinani, a Middle East political analyst and founding director at the Arab Perspective Institute. Ambassador Sajjanhar, let me come to you first. The situation that we have on our hands, Iran insisting that it is still in conversation with the US, saying that it is going through the mediator Pakistan, but at the same time, Donald Trump saying that the clock is ticking, time is running out. Is this, again, a pressure tactic being applied, or is this realistic indication of a realistic conversation between the two sides?
Thank you very much, Ashmit. What I feel is that we are coming close to the precipice because it is, Mr. Donald Trump, he's been launching all these threats and, it becomes, at times it becomes, people start thinking of it like a young boy crying wolf, that, when you keep on crying wolf many times, no one really takes you seriously because, this also gets along with the sobriquet that Mr. Trump has got of Taco, that he always chickens out, he threatens people, he sort of gives ultimatums and deadlines, and he never sticks to those. But as far as this is concerned, I think we are getting very close to, the breaking point. And particularly one of the things is that Mr. Trump has just come back from Beijing. He might have thought that he'll be able to get China on his side to put some sort of pressure on Iran. That has not worked out. He was really not able to get anything out of China. In fact, Xi Jinping appeared to be much more stable, responsible, and not in a mood to relent on any of the asks that Mr. Trump was giving. So the sort of press that he has got is not positive at all. So I think he is also wanting very much, Trump is also wanting very much to do something so that he can demonstrate to the world that he's still in control, he's still in authority, he is, a man of his own word. So I think we are coming very close. And also, in my view, I think Iran is overplaying its hand by not agreeing to any of these issues that we have been that has been speaking about. From all the indications in terms of what offers they have been making to the United States, they seem to be playing them along, not talking anything about any commitments on the nuclear issue, and only talking about opening the Strait of Hormuz because they themselves, Iran itself, is feeling the pain because many of its ships have been turned back, many of its oil tankers have been turned back, so it is not able to generate the sort of revenues that it was able to do earlier when it was stopping the shipping of all the other countries, but its own shipping was going through. So the blockade has been effective to that extent. So I think we are really coming to a breaking point when Mr. Trump has given these threats.
It's interesting. In fact, let me take a cue from one of the aspects that you had raised there, Ambassador, and let me take it up with Ms. Gupta. Ms. Gupta, one of the aspects that the Ambassador was referring to is that Trump had gone to Beijing with a long list of expectations, hoping that there may be some relief with respect to Iran, that China may perhaps apply pressure. None of that have happened last week. Beijing has not agreed to apply any pressure, has not agreed to respond or to help or assist in any way as far as the Hormuz situation is concerned. What position does that put Donald Trump in now, especially while trying to negotiate an off-ramp with Iran?
Good evening, Ashmit and my co-panelists. Thanks for having me on the show. Yes, people were expecting that something important will come out for the Strait of Hormuz, if not to end the West Asia war after Trump-Xi summit. It doesn't appear to have had any impact, but if there were any negotiation, closed doors vis-a-vis, I would say, nuclear issue, that is something we are, I think, going to see in the times to come. It's my assessment that without Russia and China, US may not be able to get a good deal on nuclear program from Iran. And those negotiations and those talks will not come out in the press. Right now, the issue about Hormuz, the Chinese are great at diplomacy and they have made all the right statements that they had to make, and they've been making those statements. But they also said that this war was really unwarranted. There was no need for this war. And even right now, dialogue and diplomacy must be given priority. So President Trump has come back with that open message from the Chinese. I also want to offer one more insight, if you give me half a second. It was also being talked about that because Iran depends so much on imports from Iran, that this naval blockade by US, Trump could have probably thought would be a good leverage in striking the deals that he wanted to. But that also has not happened. If you look at the kind of deals that have not, I would say, happened.
Sure. Ambassador, let me come back to you. You mentioned that we're at a precipice. I want to bring to your attention the one development that we have been talking about, the strike on the nuclear facilities in UAE, the Barakah nuclear plant. Fortunately, the main plant had not been compromised. In the surrounding perimeter, a generator was struck by a drone that was shot. Again, fingers being pointed in all directions as of who's responsible for it. But just the fact that have we crossed that bridge where all bets are off, that all targets will be legitimate military targets going forward, if this is to translate into an escalation, into a resumption of military confrontation?
I think that is the manner in which Iran is trying to use this conflict, because, there have been statements that have emanated from Iran, which seem to suggest that, this is a super nuclear weapon in their hands, the blocking of the Strait of Hormuz. It is a super nuclear weapon. That means, and they are willing to use it. And they have never done this over the last 47 odd years since the Islamic Republic has been in position. Also, they have not attacked any of the Gulf states. And we can see that the frequency and the recurrence and the impunity with which they have been hitting out. And right now there is supposed to be a ceasefire, and anything that is coming at the United Arab Emirates, that is coming at Saudi Arabia, meaning either it is coming directly from Iran or it is coming from the Iranian proxies. And none of that would be happening without Iran giving the green signal to its proxies. So I think as far as Iran is concerned, as I said, this is, in my view, Iran is overplaying its hand because, but the pity of it all is that we see that there are fault lines even as far as the Gulf countries are concerned, the GCC countries are concerned. The United Arab Emirates has gone out on a limb to say that, we are willing to confront the sort of verbal confrontation that we saw in New Delhi during the BRICS foreign ministers meeting between the representatives of Iran and the United Arab Emirates. It has come out in the open what was very much known that was happening behind closed doors, but there had been guarded statements that have been coming from both sides. And right now, meaning none of the others have made comments, such strong comments against Iran, whether Saudi Arabia or Kuwait or Qatar. And even now, when there has been this hit against both UAE and Saudi Arabia, what you mentioned as far as Qatar and others, they have condemned only the attack on Saudi Arabia. So there are fault lines happening there. And the world is also standing as a mute spectator when Iran is also violating the international law as far as the Strait of Hormuz is concerned, because obviously it is a violation of international law, which is Strait of Hormuz should be free for global traffic, maritime traffic. This is a part of international passage. This is a part of the global commons. But I don't see much pressure at all coming on Iran that it should, engage in a serious conversation, serious dialogue. It seems to be, as I said earlier, playing along the United States by just dangling this carrot of the Strait of Hormuz, which is more in it for its own benefit rather than meeting any of the issues of nuclear, whether it should have nuclear capability or so. And I would say that none of the countries, not in the region, but otherwise, even as far as India is concerned, or even as far as China, where Mr. Trump was recently, I don't think any one of them wants a nuclear weapon, Iran. Ashmit.
Right. You've given us a number of talking points. Let's try to unpack them one by one. Let's get in Dr. Al-Kinani. Dr. Al-Kinani, I want to get your thoughts. Again, I was asking the ambassador with respect to the strikes that we've seen on a nuclear facility in the UAE. It's the only nuclear facility, only one of its kind in the Gulf region. Again, the consequences of an attack on the nuclear core could be catastrophic for the entire region. The fact that Iran is willing to toy with that in the build-up to this escalation that we are seeing and that we have seen over the last couple of days, what does that tell you about the level of tensions in the region and how much of a risk Iran is prepared to take when it comes to this confrontation?
Apologies for the earlier disconnect. I think Iran is trying to ensure that it's signaling direct messages to Israel via its attacks against the UAE, given its belief that the UAE is part of the Israeli influence in the region, particularly within the Gulf region. This is the similar association between Iran and the Hezbollah movement in Lebanon, which is viewed by the Israelis as an Iranian attempt in getting closer to the regional neighborhood that Israel believes it should dominate, which takes us a step back in viewing how both regional rivals are having their regional ambitions clashing with one another geopolitically and also sometimes economically. We also have to keep in mind that the war, after the 39 days war, is still going through a few hits there and here as an attempt to ensure each side's ability to continue this war. Even Trump's statements itself is an attempt to be presented that he is still insisting that war is still on the table if the Strait of Hormuz is not reopened according to the US conditions by the Iranians. Now, one cannot deny that most parties involved in this war are heavily aware of the economic consequences and the economic costs of this war to all sides. However, each side is ensuring that they do not want the war to end before the rival has raised the white flag, in order to be able to sell those as domestic supporting points where they're facing domestic accountabilities in each of their economies, but also within each of the political discourses that are challenging the US and the Israeli and the Iranian government about how far this war has gone.
Right. Doctor, what I really wanted to get a sense on is that the fact that Iran is prepared to take that gamble so far, from the military confrontation and the strikes that we've seen, they've been restricted primarily to military targets. There's, of course, been the odd attack on a refinery or on a desalination plant, but broadly, military infrastructure. With Iran toying with the idea of possible attacks even against nuclear facilities, which will have catastrophic consequences for the entire region, does that indicate to you that we're heading down a negative spiral here that could, in fact, lead to grave escalation in the region, unprecedented escalation in the region?
Well, yes, definitely. If they continue to play with the fate and the destinies of the existential security of these nations in the region in the same direction that they're currently heading, then this could definitely lead to devastating consequences. We've already been facing some of these consequences, given that the war that was conducted for almost 2 months has already reflected into enormous consequences towards the global economy. It has even allowed many regional actors in many countries in the region to reshuffle their geopolitical priorities, perhaps reconsider their security agreements globally and regionally, given and knowing that the region is currently witnessing a much more aggressive attempt by regional actors that are claiming to expand their arenas of interest. Most notably, we're referring to Israel and Iran. One cannot deny that the Turkish element is also an alarming flag, where they are viewing how existentialist this conflict is towards their own security in the region and their own interest in the region. But definitely, it's definitely a very unfortunate step back towards the usual agreements about where to not to do towards nuclear facilities.
Right, Doctor. On that note, let's slip into a very short break. We'll continue this conversation with the help of our panelists on the other side. Welcome back. We are still in conversation with Ambassador Ashok Sajanhar, Ms. Anju Gupta, as well as Dr. Al-Kinani. Ms. Gupta, let me come to you. We're hearing, of course, about conversations being had between the two sides. Iran saying that we are still in conversation with the US through our mediators in Pakistan. They now seem to suggest that there's a fresh 14-point proposal that has gone from Tehran to Washington. Like Ambassador was saying initially, that Iran is overplaying its hand. So at this point, what are some of the concessions that you feel that Iran will perhaps have to make to bring Washington on board, to bring Donald Trump on board?
Ashmit, first of all, I want to say that Iran has sent a very strong signal through this attack, which of course neither Iran has claimed nor UAE has blamed it on Iran. But that is something which everybody believes or would like to believe, that it was a strong signal from Iran that should round 2 of US-Iran war break out, that's the way it's going to go. That is the kind of reply that Iran would give, like the first round. So it's a very important signal that we must keep in mind. This is something, it is to actually shape the response that you have asked me about. I think at this stage, given very hectic diplomacy that Iran has undertaken for the last couple of weeks, and that is the reason I think we've seen return to normalcy across the GCC and also in Iran, in terms of airspace being free, air traffic resuming, schools being reopened, etc. That there is some confidence in the diplomacy, notwithstanding this signaling or tough talking, etc., etc. So that's my sense. And Russia and China are firmly in this process. There is no doubt about it, not even iota of doubt about it. Now, after this summit, what immediately can happen, it is within the realm of possibility, is that there may be an understanding on opening the Strait of Hormuz with some condition that Iran might impose, and naturally Iran will remain in control of the Hormuz on the other side, while US will not open the blockade and not withdraw its naval presence, which is to say that if our talks fail, I'm going to impose it again. I think that is within the realm of possibility, the opening of the Strait of Hormuz. This will give a big relief to President Trump, who can go back to his domestic constituency and say, look, I restored it. And from there on, they will start talks about the nuclear program, and which Iran will definitely link to relief of the sanctions. So that can start, but I think something on Strait of Hormuz would come through very quickly. That's my assessment.
Well, that is something, in fact, that of course has been the big point that everyone has been watching to this conflict for, as far as clarity on the Strait of Hormuz is concerned. Iran doubling down on the Persian Gulf Strait Authority, which they now feel will be the authority to charge a toll and to allow ships there. But meanwhile, just on the same point, Ms. Gupta, I'd like to bring in some updates that are coming in from the Iranian news agency Tasneem. It seems to suggest, this news report coming in from Iran, that the Americans have accepted in the new text lifting of Iran's oil sanctions, at least for the pendency of these negotiations. This, of course, coming from an Iranian source, coming in from an Iranian news agency. We'll, of course, have to wait for Washington to confirm that. But nonetheless, there are these reports coming in indicating that perhaps there is some negotiation underway as far as the Strait of Hormuz is concerned. Speaking of negotiations, Ambassador, let me come to you. You had made a reference earlier to the BRICS summit, the Foreign Minister Summit held in New Delhi. There were comments that came from Russian Foreign Minister Sergei Lavrov, who talked about India's role as a long-term mediator. Arakchi had said that he'd welcome any initiatives that the Indian government may want to take in terms of resolution of this issue. Is this a call for action that perhaps Pakistan is not doing an apt job of mediating between the two sides, that perhaps India should take on the mantle, given that it has connections on both sides, with Washington, with Moscow, with Tehran as well? Or is this a trap that New Delhi should actively avoid?
I think for the time being, New Delhi should definitely avoid this because, let's face it, Ashmit, that why did Pakistan initially sort of take up this mantle of, negotiations? Because as far as the United States is concerned, it knows that it can maneuver Pakistan in any way that it likes. It can use it in any way that it likes. And we know that all through Pakistan has been used by the United States, whether it is as far as Afghanistan is concerned, whether it was in the early 1970s to reach out to China, etc. And Pakistan has always been willing to do the bidding of the United States. So they have been falling over themselves to reach out to the United States and to come into its good books. So the United States knew that whatever it told Pakistan, it would do that. As far as India is concerned, definitely it is not, it has its own standing, it has its own position. So it is not going to do anyone's bidding as such as Pakistan is going to do. So I don't think that the time is ripe at this moment. And so India should maintain its contacts with all these countries as we are doing. We have seen our Prime Minister going to the United Arab Emirates, a very short visit, but a very substantive, very significant visit in terms of the decisions that have been taken. Our leadership has been in touch with all the leaders of the region, and also as far as Russia is concerned, as far as United States is concerned. We are going to have the Quad Foreign Ministers meeting in New Delhi. Iranian Foreign Minister Sergei Lavrov, Russian Foreign Minister was there. So we are maintaining our contacts, and we have indicated that the whole issue needs to be settled through dialogue and diplomacy. That is the road we should approach, and come in as and when the time is ripe to pitch in to give our good offices.
So perhaps not the best time for India to come in. I'll just come for a quick closing comment to Dr. Alkinani. Dr. Alkinani, of course, this is a longer play we'll have to see between the two sides trying to resolve this issue. But in the interim, Iran is doubling down on its demand for, of course, an authority that will govern, that will supervise the Strait of Hormuz, will charge or toll. Despite the fault lines within the Gulf region, is there at least a common minimum consensus that they're open to the idea of paying Iran to allow a passage of their oil tankers via the Strait of Hormuz?
Well, I think in the short term, everyone is aware that they do share a common interest in the region for a immediate and a fast solution to the situation. Everyone is also aware that the blockade of the Strait of Hormuz is an outcome of this conflict and not an instigator of this conflict. Accepting in a very fast manner to recognize any form of Iranian sovereignty of an international trade route is in itself a very big challenge, not just for the region, but also on a global scale, given that it, in one way or another, would recognize Iran's ability to control the strait. So it's not only a regional decision, it's also an international decision. It's an international interest. I think negotiations regarding the future of the Strait of Hormuz wouldn't be ended or limited by this war. It's a much more complicated issue, similarly to many of the other issues and files that are complicated that were on the agenda of the negotiations, such as the nuclear program, the future of the Iranian proxy in the region, and many other issues that will not be solved in a week or a month. And that is perhaps why this conflict is becoming much more complicated.
Right, Doctor. Again, no easy answers there. Of course, the wait continues. But as the wait continues, oil prices there, Brent above $110 per barrel mark. But that's unfortunately all the time that we have. I'd like to thank our panelists, Ms. Gupta, Ambassador Sajanhar, Dr. Alkinani, for joining us, for shedding more light on this developing story. And with that, it's a wrap on this edition of News Center. More news and updates will continue right here. Hello and welcome to this very special broadcast right here on CNBC TV 18. I'm in conversation with Mr. Palkiwala, the CFO and the CEO of Qualcomm. He's speaking to us at the new launches about what the India market represents and what the opportunities may look like going forward, a roadmap of sorts as far as Qualcomm here in India in 2026 is concerned. Mr. Palkiwala, thank you so much for hosting us. Big day today, Snapdragon for India. Tell us what's special about today. What are the big takeaways that we can walk away from after today's launch?
So first of all, thank you for having me. It's great to be here. I think we're very excited about the products we're launching. The specific announcements we're going to do is we're going to announce 2 new products for the smartphone industry. These are products that are very much designed with India in mind. These are global launches of these products, right? So we're launching them in India for the global market. But as I said, designed for India, designed in India, and tremendous opportunity. I think what it brings to us is taking these products and selling them globally. But I think there's a bigger story. The bigger story is really how Qualcomm is evolving.
Okay.
We started off as a smartphone company, but now we're the leader in automotive. We are building products for PCs. We're building products for personal AI devices like glasses and watches and hearables and other things. We are also entering robotics now. I think that's going to be one of the largest markets in the world going forward. All kinds of robotics is happening, personal robotics, manufacturing robotics, industrial robotics, and so Qualcomm aspires to be a leader in that. And then, as we've announced over the last couple of weeks, we are entering the data center chip market as well. So lots of technologies that we have really common across all these areas, and we're bringing them to bear in different markets. So that's kind of the backdrop behind the product announcement.
Even as we speak, the government is contemplating, it's nearing the final stages, at least that's what officials within the government tell us, on ISM 2.0, India's Semiconductor Mission 2.0. They're looking at an outlay of over 1 lakh crore rupees. That would be somewhere north of $10 billion that the government is looking to put out for supporting the industry. What would your expectations be from a Qualcomm, from a fabless perspective?
Yeah, so think about semiconductor in 2 parts, really. There's design and there's manufacturing, right? Qualcomm is obviously actively involved in design. And we have, as I said earlier, a very large team here that helps us design. The second part is manufacturing, and where we don't do the manufacturing ourselves, but we can be a very critical and important customer for the manufacturing ecosystem that gets created in India. And we've been already doing that for a while, right? So very close relationship with the Tata Group. There are other companies that we'll be working with as they grow as well. But as soon as the technologies that we need are available in India, we're going to use the ecosystem that gets created. We've also been very closely partnering with the government of India, right? Giving input as the policies get finalized. Because I really do think that Qualcomm will become one of the largest customers for the manufacturing ecosystem in India, and we're just at the beginning of that process.
You mentioned Qualcomm being a fabulous company, partnering with players like Tata's. Can you tell us when can we expect the first made in India Qualcomm chip to perhaps roll out? Any indication, timelines you would want to share?
Not at this point. I think what I'll say is the manufacturing, a lot of manufacturing that Qualcomm does is in incredibly advanced nodes, right? And so as those nodes get built in India with Tata and with others, we'll be standing first in line to use the capacity.
You had alluded to in the very first answer about how data center chips is one area that Qualcomm is betting big on. Tell us about that, and how does that weave into the India story? Over the last few months, we've seen some mammoth commitments by big hyperscalers, even Indian players as well, as to the data center ecosystem. Tell us, you'll be competing with the likes of NVIDIA. How does that look like? And how does the India opportunity look like with the data center boom?
Yeah, I think because we are in so many edge devices, the way we had built all of our technology is high performance at low power, right? If you think about the data centers now, one of the key problem statements is power constraints, right? Data centers are being built next to power plants, and power plants are sometimes being built next to data centers so that you can have the power that's required to operate them. And so Qualcomm is going to bring its unique strength. We're building 3 different parts to our data center opportunity. First is a CPU chip, right? We have arguably the most high-performing CPU in the world, and so we're going to bring them from edge devices to data center. especially as this agentic transformation happens within data center, our CPU chips are going to bring the strengths that are required for agentic AI workloads in data centers. The second is AI accelerators, which has been a vast majority of the market. Qualcomm, we have something called our NPU, which is our neural processing unit, which is extremely high performance at low power. We're going to bring it with some novel packaging that happens with memory for a certain type of workloads. And so that's excited about that. What we also announced at our earnings a couple of weeks ago is we're going to build a custom chip for a hyperscaler that will start shipping to later this year. So a lot of different opportunities. We're exploring all of them at the same time. This is obviously a very, very large market with enough room for multiple players, and Qualcomm is now going to be one of the key players.
As far as the India market, again, predominantly driven by smartphones, the sales, and this is not unique to India, this is seen across a lot of major geographies as well, flat sales, flat growth in sales rather. Is that a challenge for you when you look at in terms of demand outlook?
You know, it's like there's two ways to look at the market. You can look at the units, or you can look at the available kind of dollars, right? And so one of the big trends that has happened in really the global market is the premiumization of smartphones. As people buy new smartphones, they're tearing up. It is becoming, if you could even imagine, it's going to become an even more important device to people's lives than it has been in the past. And so there's been consistent mix shift up within the global unit framework. And so while the total units have not grown, the amount of dollars that are available to Qualcomm has grown very significantly as a part of that process. And so we've seen the benefit of that. Our business, our revenue stream has grown a lot within phones. And so we are very strong at the top of the roadmap, premium chips. Qualcomm is by far the leader in Android. And so we're seeing the benefit of that show up. One of the metrics that I'll always remember is over the last year, there's 24% growth in India for phones over $400, right? And so that's a pretty powerful number. I mean, that's in a flat market, when you see that kind of growth in premium devices, it shows you what the opportunity is.
Speaking of, again, the smartphone market, I want to get a sense as to the dynamic that high memory costs brings to the table.
Sure.
How does that impact you? What is the impact that you're seeing now? What impact you estimate, say perhaps towards the second half of 2026, the impact on OEMs and manufacturers, again, of high memory costs?
So the landscape of the industry is being driven by AI demand within data centers, which consumes a lot of memory. And so what that does is it puts pressure on the memory supply and pricing that's available for things like smartphones, right? And so what we've seen happen as a result of it is the smartphone OEMs have been very cautious in building phones because of these constraints. And so we've seen an impact on our financials over the last 2 quarters. What we did say at earnings is we expect the June quarter to be the bottom and to grow from that point. And so it is an impact, it's an issue that we're dealing with in the short term.
Let's also talk about another area that Qualcomm has been bullish on, which is the auto industry. We've seen in the last few months a digital chassis. That's what Qualcomm has been building. Tell us, how is that journey progressing with respect to India? Are you finding a lot of takers here in the India market? Is there an appetite for such connected features? And are you working with any projections going forward?
So I mean, tremendous transformation in the automotive industry, right? And there's 2 separate trends. There is the electrification of cars. You're building electric cars versus IC. The second trend is digitization of cars, which is you connecting the cars to the cloud. The car experience inside the car is a smartphone tablet-like experience. And then you're adding autonomous driving features to the car as well. And so Qualcomm plays in the second kind of big trend, right? We make chips that connect the car to the cloud. We make chips that enable the experience inside the car and then autonomous driving. Those are very, very long-term trends that is changing incredibly fast. And so it's not just in cars. I think you're going to see it in two-wheelers as well. And Qualcomm is participating, really working with all the leaders in the Indian automotive industry on all kinds of chips, right, for these transformations. So very excited. I think we're going to become one of the key players, if we are not already one of the key players, key suppliers of technology into the automotive industry as the industry transforms. And then I think I'd add robotics as kind of an extension of automotive industry. In some ways, a robot is a car standing up, right? And just like you have autonomous driving, autonomous movement for robotics is an extension of that as well. And so we're going to take our digital chassis products and extend them into robotics. And so super excited about that as really an expansion of our automotive opportunity.
What is the traction that you've managed to find so far with the Indian market? Any big players that you're already working with?
Pretty much everyone. All the big automotive companies are working with Qualcomm. They're using our chips to connect to the cloud. The inside experience within the cars, I mean, the new cars are being launched are tremendous, right? Very, very interesting stuff. So they're all big customers now, and I think it's going to be the case for a long period of time.
And I'll just end with one forward-looking question on one aspect that, in fact, has managed to hit the headlines across the world, and this is about frontier AI models, the likes of Mythos, the likes of GPT 5.5. There are concerns being expressed by stakeholders, whether that's in the banking sector, whether that's regulators, whether that's governments, on what this means. We're learning about capabilities of these models, which are vastly superior to what we have today, extremely efficient at finding vulnerabilities. How much of a concern is that? How are you looking at it?
Yeah, so, all of these technology transformations always come with risks beyond the opportunities, right? And the role of the technology industry is to harvest the opportunities to protect against the risk. And so I think the entire ecosystem very focused on that. Of course, with these new models coming in, that is a great way to know the vulnerabilities in the products that we are making. And so what we would want to do is run those models on our own products, find the vulnerabilities, fix them. There is a risk that comes with it, but to me, that's kind of something you protect against, but focus on the opportunity, the innovation that these models are going to bring.
Do you see Qualcomm being a part of something like a Project Glasswing to understand what this technology can unpack in the days, weeks, months to come?
I mean, all of these frontier models, we're at the front end of testing them, using them, creating products with them, creating products for them. And so that's not going to change. I think we're going to continue to do that.
Well, we're clearly in the midst of exciting times. Mr. Palgiwala, thank you once again for having us.
Thank you so much.
Artificial intelligence is moving from experimentation to scale, transforming how people search, create, code, communicate, and do business. OpenAI's latest launches, including GPT 5.5 and Images 2.0, are pushing AI deeper into everyday workflows with more people, more powerful reasoning, agentic capabilities, and significantly improved multilingual support, including for Indian languages. India is also emerging as one of OpenAI's fastest growing markets with rising enterprise adoption, developer activity, and consumer user cases. But alongside the excitement comes serious questions around deepfakes, misinformation, and also now cybersecurity. Joining us now to help us decode some of these questions is with us Pragya Mishra, who leads strategy and public affairs for OpenAI in India. Pragya, thank you so much for joining us. Thank you for making time. Again, it was a year back that we were having a conversation as to how viral that trend got as far as Ghibli-style images were concerned. Even now, we keep seeing those images cropping up on our social media feeds. Tell us now, when we look at Images 2.0, what's new? Is it also finding traction? And what kind of traction are you seeing here in the India market?
Lovely to be here. Thank you for having me, Ashmit. You're right. Last year was super exciting. Ghibli images were being converted even for every WhatsApp display picture that I saw on my feed. So, you're right. You're kind of transporting me back to that moment where, you had Sachin Tendulkar and such leading Bollywood actors using that style. And, we haven't seen much more different than that actually this year with Image 2.0, which is, far more capable in terms of reading language and capturing Indian context. And so, clearly Indians are using ImageGen in ChatGPT very, very creatively. We are seeing people use it to make much more finished and usable visuals that reflect how they actually communicate across languages, culture, and also everyday contexts. The trends that we've been broadly been saying is people are using it in anime style, fashion studio portraits. How can you also improve lighting on a particular picture? So these are some trends that we are seeing. And that was, I would say, in the early week, 10 days. Now it's also transitioning a lot into specific learning use cases where we are seeing teachers actually use ImageGen to visually describe the concepts that they're trying to teach in class. So, these are the more, I would say, working use cases where people are seeing it to not only look good, but actually learn more effectively.
Fantastic. That's a lot to unpack that you've given us. Let's take it step by step. Let's first talk about the India focus. Can you tell us how big is the user base here, or if India is one of the largest adopters as far as OpenAI is concerned? Some indications, some numbers that you could throw just to establish the role that India is playing for OpenAI.
Yeah, we announced earlier this year at the India AI Summit that India is our rather second largest ChatGPT, user. So, we are hoping sooner than later it's going to become the largest, and I think that's not very far away. But more broadly, the way India uses, ChatGPT, we had released a capability gap report more recently. And, India actually ranks amongst the world's most advanced AI markets, when it particularly comes to coding, data analysis, and also complex reasoning. But this capability is not, I would say, evenly distributed. And so we see AI usage in India remains very, very highly concentrated in a handful of cities, with advanced uses being even more unevenly spread. And so, for us, the real goal is how can we really drive AI diffusion and adoption at scale in a very even manner so that tier 2, tier 3 cities also have the ability to participate, in the AI wave.
The government has rolled out a draft proposal to further tighten the AI labeling norms. The government now says that there needs to be clear and continuous labels identifying synthetic content. Just a word on that, there were already concerns as to how the earlier labeling norms were to be implemented. Now there appears to be further tightening. Does that give you food for thought? Does that give you some concerns, some challenges when you talk to your counterparts in the US?
Look, I think for us, it's very, very important that, safety is kept in mind with everything that we do. And so, AI content should get more powerful, but it should also have a lot of transparency. And so our view has been pretty simple, where people deserve clearer signals about what was made with AI, where it came from, and whether it's authentic. And so we continue to invest in provenance tools and safeguard, while also working towards broader standards with platforms and policymakers. Because this is not just going to happen with our models putting in the right labels on the content that's generated from ChatGPT or OpenAI models, right?
I'll just labor on that point for one more question. As far as the implementation is also something I was meaning to ask you on, that when you have guidelines, rules, which clearly say that there needs to be clear and continuous labels identifying synthetic content, what is clear, what is continuous. We were talking about the voice spot. Will the output from that require certain coded messages at regular intervals? Any challenges in terms of implementing some of these proposed rules?
Yeah, I think, look, we're talking continuously and engaging, with the government to understand all of what you just said, because it's not as straightforward. It needs to be unpacked. Think about you using our models to improve, a picture or a passport size picture to make it look better, which you then want to use, in all other documents. And suddenly that passport size picture comes up with a big label. Now you can't use it anymore, right? So there are legitimate use cases where, very obvious labeling will become a little bit challenging. But I think, this is an open conversation, and the government has been very cooperative. They've been willing to listen and been very flexible. And so we are having those conversations on what is the right balance between making sure that they can go out and catch hold of bad actors if our models or if other technology platforms are also misused, and at the same time, it doesn't take away from the fun and joy of the models.
Fair enough. That brings me to my final question. There was a recent advisory that was put out by CERT-In, which essentially flagged security challenges with respect to frontier models. It specifically named GPT 5.5 as well. The core concern that was put out as a part of this is that these tools are so powerful, so efficient at finding vulnerabilities, that it's time essentially for the industry here to pull their socks up. That's the message that CERT-In was giving out. With these concerns being dealt with these concerns now being addressed at a sovereign, at a national level, is there need for further engagement for companies like OpenAI to work with Indian partners? And how do we address these challenges with extremely efficient and very powerful frontier models?
No, certainly, engagement is always, the first step. As you learn more about how these models are being trained and what are the safety guardrails that we are putting in place, then trust builds, right? And so I think for us, as AI becomes more and more capable, the real focus has to be on how it's deployed safely and responsibly. And these are very, very valid and important concerns. And so as we think about, 5.5 becoming more capable, the focus naturally shifts from, the capability of how they are being deployed, but also how they're being used in a far more responsible way. I think the first, or I would say the three key principles, that we are really looking at so that our models can be deployed safely while we still accelerate, intelligence, is that first we believe in, democratized access. And we are seeing that with 5.5 broadly, that most of the way we've deployed it is that the safety stack is fairly robust. Second, we're committed to really iterative deployment and learning over time. That's been a value of OpenAI from the get-go. Even when we released ChatGPT into the world, the idea was that as these models get more and more capable, do we want to bring in the masses and the community more broadly when it's like, at this stage? Can you imagine if 5.5 was the first AI model you actually interacted with? It would have just been so unnerving for everyone. And so that's why we, have taken users and governments and everyone along this journey from ChatGPT 2 to all the way 5.5. And so this is the way we really deploy so that we can get feedback and we make sure that we are working with governments and communities along the way. And I think third is like we will continue to invest in accelerating, the defenders that help find, I would say, and build resilient software ecosystems across, right? So we work with across, trusted access programs And we're also making sure that enterprises can come in, understand the capabilities, help make sure that our financial sector can be really strong and robust. So we are engaging with government, with enterprises to really talk about the capabilities and make sure that we can be seen as a really trusted partner in this journey, because the models are only going to get more intelligent.
Well, Pragya, always interesting speaking to you, getting more insight on which direction the technology seems to be headed in. I'd like to thank you once again for taking out time on a clearly busy day, and we appreciate this interaction with you, and we hope to stay connected to learn more on this journey, exciting journey going forward ahead in 2026. Thank you once again.
Hello and welcome to Business 360. I'm Archana Solanki. Here are the headlines we're tracking this evening. Market stages a smart recovery from lows to close flat. Broader markets underperformed. Rupee hits record low of 96.39 against the dollar. US President Trump says the clock is ticking for Iran to reach a peace deal. Reports suggest he would meet top security advisors to discuss military operations for Iran. UAE cites a dangerous escalation after a drone struck the inner perimeter of a nuclear facility. Oil prices soar above the $110 mark. Oil Ministry says India will continue to source Russian crude irrespective of a US waiver. The US waiver for India on importing Russian oil ended over the weekend. The Oil Ministry says OMC losses down to 750 crores a day from 1,000 crores after the fuel price hike. Adds that no bailout package is on the table. Vodafone Idea board clears plans to raise 4,730 crore rupees from the promoter Aditya Birla Group. Approves issuing fully convertible warrants. The telecom company swings to black in the fourth quarter, driven by a one-time exceptional gain from AGR reassessment. Prudential PLC to acquire 75% stake in Bharti Life Insurance for 4,200 crore rupees. The deal values the life insurance company at 5,600 crore rupees. Prudential PLC to also bring down its stake in ICICI Prudential to 10% as per regulatory requirements. A conglomerate led by the TVS promoter group to acquire 9.9% stake in Jana Small Finance Bank via a combination of warrants and secondary share purchases. The deal is estimated to be valued at 500 to 510 crore rupees at prevailing market prices. TVS Motor Company to directly hold close to 5% stake, up subject to approvals. Prime Minister Modi in Norway for the penultimate leg of his five-nation tour. India elevates its bilateral ties to strategic partnerships with Sweden and the Netherlands. Tata Electronics and Dutch semiconductor giant ASML sign an agreement to support chip manufacturing in India. V.D. Satheesan takes oath as Kerala's 13th Chief Minister. 20 others, including senior Congress leader Ramesh Chennithala and 5 Indian Union Muslim League MLAs sworn in as ministers as well. Congress top brass, including Kharge, Rahul and Priyanka Gandhi, were present at the swearing-in ceremony. All right, let's start with the day's market action. The market staged a smart recovery from lows to end flat. Broader markets underperformed. Nifty IT closed higher for the second straight session. Prashant Nair is here with the market wrap.
Well, a sharp bounce from the lows, almost 300 points in total for the Nifty. From the broker community, there was chatter that perhaps there was some outflow from, a market like Korea, which sort of, came our way. We'll find out more as we get the flow numbers, etc. But that was equity, right? I mean, the rupee, dollar rupee, absolutely no relief. We made a fresh record low for the rupee. Past the 96 sort of mark. Bank Nifty also came up a little bit from the lows. Mid-cap and small-cap indices. Mid-cap did see bounce, but small-cap index was still down over 1% lower. So it didn't show up, by the way, if you look at the advanced decline ratio. Declines, number of stocks down, far outnumbering the number of stocks, just counting them in that way. Now, as far as large caps are concerned, I'll start with what was up. The IT index had lost 6% last week. It bounced about 2%, but that's been the story. Small bounces followed by larger falls. We'll see if this time is different. So on the Nifty, TechM did well, Infosys did well, Bharti did well. There was Sun Pharma, which was up and about as well. On the downside, Tata Steel, we had the management with us, Power Grid and State Bank of India also, which were lower. Power Grid, a bit of a disappointment as far as earnings are concerned. The broader markets, the losses coming through in Amber, which was down sharply, Sirma, Keynes, CG Power, Data Patterns, Uno Minda. You had Cochin Shipyard, Garden Reach Shipbuilders, Azad Engineering, which were sharply lower. Godfrey was down, TVS Motor, Force Motors, and some of the AMC companies where ICICI Pru, where there was a large deal, and HDFC AMC, which was down today as well.
Right, thank you, Prashant, for that. On to the currency markets now. Rupee fell to a record low of 96.39 against the dollar. This as higher oil prices stoked fears of rising inflation. The rupee has fallen 7% in 2026 so far. And the top global story we are tracking this evening, US President Donald Trump warns that Iran is running out of time to make a deal as the Gulf regions report fresh drone strikes. Here are the latest developments. Now, tensions escalated in the Gulf region as Saudi Arabia said it intercepted 3 drones that its airspace from Iraqi territory. This came soon after the UAE alleged that a drone strike by either Iran or its proxies triggered a fire near a nuclear power plant. The country called the act a dangerous escalation and said it had the right to respond to any hostilities. Meanwhile, US President Donald Trump expressed his impatience about the continuing stalemate between Iran and the US. In a post on social media, Trump said, and I quote, "For Iran, the clock is ticking and they better get moving fast or there won't be anything left of them." End of quote. Axios reported that Trump will meet his national security team tomorrow to discuss options. However, despite these threats of escalation, US and Iran continue to exchange peace proposals through Pakistan. Reuters has reported that Pakistan shared Iran's revised proposal to end the war with the US. Pakistani officials reportedly accused both sides of, and I quote, "changing the goalposts." End of quote. Fears of escalation have pushed crude prices higher, with Brent hovering around $110 a mark. Traffic at the Strait of Hormuz remains nearly at a standstill. This as Iranian and Omani officials met in Oman to negotiate a mechanism for safe transit in waterway. Iran's foreign ministry has said that the talks are focused on preparing a framework under international laws for the transit mechanism. Back home, oil ministry says India will continue to source Russian crude irrespective of a US waiver. The US waiver for India on importing Russian oil ended over the weekend. The oil ministry says OMC losses down to 750 crores a day from 1,000 crores after the fuel price hike, adds that no bailout package is on the table.
regarding American waiver on Russia, I will like to emphasize that we have been purchasing from Russia earlier, and before waiver also, during waiver also, and now also. So it is basically the commercial sense which should be there for us to purchase, for OMCs to purchase. So that's my precise answer. There is no shortage of crude. Enough crude has been tied up repeatedly, I have told you, and this whatever waiver or no waiver, it shall not affect our supplies, and all efforts have been taken to that effect.
Now, telecom major Vodafone Idea has swung to black in the fourth quarter, driven by a one-time exceptional gain from AGR reassessment. The company board has also cleared plans to raise 4,730 crore rupees from the promoter Aditya Birla Group. Sudarshan Kumar brings us all the details. Sudarshan, please take us through the company's plans.
So two parts for Vodafone Idea. One set of that company had announced Q4 FY26 earnings, and those earnings had looked operationally okay, and on some fronts it was better than peers. So if you talk about the revenue, it has grown more than 2%, 2.3% on a sequential basis. Even margin has come in above 43% versus 42.5% again on a sequential basis. Average revenue per user has increased 1% on a sequential basis, and it's better than peers, and now it has increased to rupees 174. The heartening part and the most important part in the earnings was subscriber loss. It was at 0.1 million, and that's the lowest loss that company has seen in the last 6 years, or say since FY26. But the other part and the most important part was the promoter infusion, and the promoter is going to infuse almost 4,730 crore, and that would be done via convertible warrant, and it's at rupees 11 per warrant. It's done at a discount to current market price. So that's the reason. And over the last few weeks, you would have seen that there is Vodafone Idea share price has seen a huge run up. So you can say it's today we are seeing a profit booking. But beyond that, what would be tracked very closely is debt fundraising. Whenever it happens, that would be tracked closely, and if that happens, it can take the stock higher again. But as of now, stock today is seeing profit booking.
All right, thank you, Sudarshan, for that. We told you first, and now it's official. Jan Small Finance Bank's board has approved a preferential warrant issue to raise up to 729 crore rupees from 6 investors. This includes the TVS Venu Group will acquire 9.99% stake in the Small Finance Bank. Ritu Singh joins us for now. Ritu, please take us through the fundraising plans and who are the other investors.
That's right, just as we told you here on CNBC TV 18, TVS Venu Group is set to acquire a strategic stake in Jana Small Finance Bank. Now, Jana's board has approved a fundraise of 728.5 crore rupees. That will be done through a preferential issue of 1.57 crore warrants at 464.82 per warrant to 6 investors. The largest incoming investor in the preferential issue is TVS Venu Group's GWC Family Fund investment. That will pick up a 5.64% stake. But TVS Venu is also coming in through a second separate route where TVS Motor Company will directly buy 4.9% stake from Jana's promoter entity, Jana Holdings, for 193 crore rupees. Now, this 4.9% stake that TVS Motor is buying today, that is calculated on the bank's current share capital. But once all the warrant conversion happens and the equity share base is expanded on that larger, fully diluted base, TVS Motors' effective stake will come down to around 4.26%. So now, if you add GWC's 5.64% stake, TVS Venu Group's total exposure will land at just under 9.99%, which is well within the regulatory ceiling. The other 5 investors that are also coming in through the preferential route include 2i Capital PCC, that is backed by Shruti Lohia of the Indorama Group, which will pick up 4.57% stake. Singularity Large Value Fund, ICM Finance, Capri Global Ventures, they will each pick up 0.84% stake, and Utpal Sheth another 0.21%. So apart from the TVS Venu Group, which will acquire 9.99% stake, the other 5 investors will collectively hold around 7.3% in the bank. It's also worth flagging that all incoming investors are going to be classified as public shareholders. None of them get board seats, veto rights, or any kind of special control rights. The EGM for the approval of the shareholders is on the 11th of June. The record date is the 5th of June. And now, of course, next, apart from shareholders, RBI's approval for this deal will be key to watch out for.
All right, thank you, Ritu, for that. Moving on, Prudential PLC will acquire 75% stake in Bharti Life Insurance for 4,200 crore rupees. Prudential will now have to pare back its stake in ICICI Prudential Life Insurance to comply with regulatory requirements. Shares of ICICI Prudential fell to a 52-week low following the announcement. Yash Jain has more. Yash.
Well, a deal happening in another insurance company, reflecting in the performance for ICICI Pru today. Yesterday, Prudential PLC announced acquisition of 75% stake in Bharti Life Insurance for a total amount of about 4,200 crore rupees. Now, that is the exact deal which has put a negative overhang as far as ICICI Prudential Life is concerned. That's because Prudential PLC, which is acquiring that 75% stake in Bharti AXA Life, has 22% holding in ICICI Prudential Life Insurance as well. Now, as per the regulations, one entity cannot be a promoter to two life insurance companies, which means in one of the two companies, it has to bring down its stake to less than 10%. Now, of course, for the new venture to go through, it will have to, that is, Prudential PLC will have to reduce its stake in ICICI Pru Life to less than 10%, which means divestment of about 12% stake when it comes to the company. This is worth about 9,200 crore rupees. And now this particular development creates an overhang, a supply overhang, as far as ICICI Prudential Life Insurance is concerned. There are also concerns on the bank assurance side, how the dynamics of distribution would change with this particular deal. All of that today reflecting on ICICI Pru.
Right, thank you, Yash. Moving on, industry veteran KEC Mistry, who had taken over as HDFC Bank's interim chairman after the unexpected exit of Tata Chakraborty, may get another 90-day extension. My colleague Furkan has more details. Furkan, what's the reason for the extension?
So what we learn is that the financial services veteran KEC Mistry is likely to get an extension as interim chairman of HDFC Bank for a further 90 days. Remember, he was appointed as the interim chair for a 90-day period in March this year after the bank's former chairman Atanu Chakraborty resigned from his position unceremoniously, citing ethical issues at the bank. That term comes to an end in mid-June 2026. However, sources tell CNBC TV 18 that the bank's board and the Nomination and Remuneration Committee are yet to take up the hunt for a full-time chairman because they are waiting for the reports of the independent probes into the allegations leveled against the bank by Chakraborty. The bank had hired 3 law firms to look into these matters, and we learned that these reports are expected in the next 10 days. The law firms, we are told, have reviewed the board notes, the minutes of the board meetings, and the email conversations between the board and the management over the last 2 years. So the bank's board and NRC will study these reports before proceeding with an appointment of new chairman. Till that happens, they are going to seek an extension for KEC Mistry. It's pertinent to note that the board had decided to go for the reappointment of CEO Shashidhar Jagdishan only after an unqualified report by the auditors and the report from the law firms. The unqualified report has already come in as part of the 4th quarter results. So the only reports from the law firms are awaited. Jagdishan's term will come to an end by the end of October this year. And as per RBI guidelines, the bank should either move to grant him an extension or appoint his successor by the end of May 2026. CNBC TV 18 reached out to HDFC Bank, and the responses to these 2 events are still awaited. Back to you.
All right, thank you, Furkan, for that. Moving on, flight operations at Mumbai's International Airport faced major disruption today. This after employees of A1 Airport Services, the ground handling agency servicing Air India and other carriers, launched an unannounced strike. This impacted baggage handling, boarding and aircraft turnaround services. Passengers were also stranded inside the Delhi-Mumbai aircraft for almost an hour due to these disruptions. However, the strike has been called off after employees were assured that demands will be looked into. And time for a break, but coming up next, Prime Minister Modi is in Norway for the penultimate leg of his 5-nation tour. India elevates its bilateral ties to strategic partnerships with Sweden and the Netherlands. Details on the other side. Welcome back. Prime Minister Narendra Modi has arrived in Norway for the penultimate leg of his five-nation tour after concluding his two-day visit to Sweden. This is the first visit by an Indian Prime Minister in more than 4 decades. Norwegian Prime Minister received him at the airport in Oslo. Prime Minister Modi will participate in the 3rd India-Nordic Summit and hold bilateral talks with Norway's leadership. During his Sweden visit, the PM held extensive talks with Swedish Prime Minister. The talks focused on trade, technology, defense and innovation. Both leaders agreed to elevate ties between India and Sweden to a strategic partnership. Modi was also conferred with Sweden's highest honor for foreign heads of government. The Prime Minister was in the Netherlands earlier. India and the Netherlands also signed multiple agreements aimed at expanding cooperation across various sectors. During talks with Dutch Prime Minister, Modi said India and the Netherlands ties had witnessed significant progress over the last decade. Addressing the Indian diaspora, Prime Minister Modi said, "The world is dealing with new challenges in the light of conflicts in West Asia and Russia." He also warned of a potential return to massive poverty. Speaking at a business roundtable, Prime Minister Modi added that in times of uncertainty, India and Europe can become strong pillars of stability, sustainability and shared prosperity.
आज के विश्व में जहां अनिश्चितता है, सप्लाई चेन्स दबाव में है, टेक्नोलॉजी में कंपटीशन बढ़ रहा है, ऊर्जा सुरक्षा और क्लाइमेट एक्शन दोनों को चुनौती दी जा रही है। ऐसे समय में भारत और यूरोप मिलकर स्टेबिलिटी, सस्टेनेबिलिटी और शेयर्ड प्रॉस्पेरिटी के मजबूत स्तंभ बन सकते हैं।
Abhimanyu Sharma brings us a wrap on Prime Minister Modi's trip to the UAE, Netherlands, Sweden and Norway.
Prime Minister Narendra Modi has reached Norway and is slated to visit Italy tomorrow as part of his ongoing five-nation visit. India's bilateral ties with the Netherlands and Sweden have already been elevated to a strategic partnership. Several announcements have been made till now from the Prime Minister's visit to different countries. His visits began from the UAE, where an agreement was signed on the framework for a strategic defense partnership to expand bilateral security and maritime defense. Also, MOUs were signed for strategic petroleum reserves, for LPG supply to India, and also for setting up of a ship repair cluster in India. Apart from this, $5 billion of investment in India infrastructure was committed, apart from a supercomputing facility in India. This was followed by the Prime Minister's visit to the Netherlands, where he and his Dutch counterpart witnessed an agreement which was signed between Tata Electronics and ASML to support the semiconductor fab in Gujarat. Also, bilateral dialogues were held which was focused on green hydrogen, clean technologies and advanced manufacturing. Subsequently, the Prime Minister visited Sweden, where he took part in several meetings with their political leadership as well as with business leaders. A joint innovation partnership for cooperation in AI, 6G, critical minerals, sustainable mining, space and life sciences is being looked at, apart from an India-Sweden tech and AI corridor which will be jointly developed by both the countries. In a roundtable which he held with several top CEOs from different European companies, he urged them to increase their overall investment in India. It remains to be seen how early these investments are going to fructify and how early more units are going to be set up in India.
Right. Thank you, Abhimanyu, for that. G7 finance ministers acknowledged mounting concern over public debt and bond market volatility as they met in Paris. This comes in the wake of a bond market sell-off triggered by fears over inflation risks. U.S. Treasury Secretary Scott Bessent has said that he will call on the ministers to adopt a strict coordinated sanctions regime against Iran. Tensions between Russia and Ukraine continue to escalate after both nations exchanged massive drone strikes. At least 4 people, including 1 Indian, were killed after Ukraine unleashed one of its largest drone strikes on Russia. Moscow soon retaliated and targeted 2 cities in Ukraine, injuring several people. The Russian embassy in India released a statement saying that it mourns the death of the Indian national in Russia. The World Health Organization has declared the Ebola outbreak in Congo as a public health emergency of international concern. The agency said the outbreak, which has seen around 246 suspected cases and 80 deaths reported, does not meet the criteria of a pandemic emergency. However, it has warned that it could potentially be a much larger outbreak than what is currently being detected. Shares of Samsung Electronics jumped over 6% amid hopes of a breakthrough in talks with workers ahead of a planned 18-day strike. South Korean president urged both labor and management to respect each other's rights and reach an agreement. The union is demanding higher performance bonuses and reforms to Samsung's bonus structure. Back home, Congress leader V.D. Satishan took oath as Kerala Chief Minister at the Central Stadium in Trivandrum. This marks the return of the Congress-led UDF to power after 10 years. 20 ministers of Satishan's cabinet also took oath. He is expected to retain key portfolios like general administration, finance and law. Top Congress leaders, including Party President Mallikarjun Kharge, Rahul Gandhi and Priyanka Gandhi Vadra, were present at the ceremony. The Supreme Court expressed reservations about earlier orders which denied bail to Umar Khalid and Sarjeel Imam in the alleged larger conspiracy case linked to the 2020 Delhi riots. The court held that bail is the rule and jail is an exception. Even in prosecutions under the Unlawful Activities Prevention Act, the two-judge bench made the observation while granting bail to a J&K resident in a narco-terror case investigated by the NIA. And with that, it's a wrap on this edition of Business 360. News and updates continue right here on CNBC TV 18.
and welcome to Startup Street. I'm Ritu Singh, and here are the key headlines from the startup world. Delivery's operating revenue surged 30% in the January-March quarter, growing to 2850 crore rupees from 2190 crore rupees in the fourth quarter of the previous fiscal. Despite strong revenue growth, Delivery's profit remained almost unchanged at 72.3 crores in the fourth quarter. Chip-making giant Nvidia is reportedly in advanced talks to lead a $20 million funding round for Simply Smart, valuing the AI infrastructure startup at about $100 million. Simply Smart said its AI inference platform will be made available on the Nvidia infra. Hearing care provider Hears App is set to acquire Amplifon India, strengthening India's footprint with 420 centers through deal with the world's largest hearing aid retailer. The acquisition adds 240 Amplifon India points of sale to Hears App's network here. The Delhi High Court has told Apple to fully cooperate with investigators in an antitrust case related to the iPhone apps market, not agreeing with its request to put the case on hold while it challenges the law governing antitrust penalties. And Anthropic will brief the Financial Stability Board on cyber risks identified by its latest AI model Mythos. According to the Financial Times, the discussions requested by the Bank of England Governor Andrew Bailey will involve global finance ministries and central banks. Those are the headlines that we're tracking for you today on Startup Street. Now, on what's brewing today, we have cybersecurity startup Exaforce, which has raised a massive $125 million in a Series B round, taking the total funding to $200 million in just over a year. The company says its AI-native platform can help enterprises detect and respond to threats in real time using what it calls a security knowledge graph and AI agents. But in an increasingly crowded AI security market, the big questions are around differentiation, around monetization, scalability, and whether AI can truly tilt the balance back in favor of defenders. So let's invite Ankur Singla, the CEO of Exaforce, for more on this conversation. Ankur, thanks very much for taking the time out and joining us here on Startup Street. You've raised now $200 million in a very short span of time. What does that really say to begin with about the urgency investors are seeing in, the AI native cybersecurity right now, and how exactly will you deploy this money, this $125 million you raised?
Valuations and all the money doesn't matter. What really matters is the business and the end customers. As we're solving a very big problem with the durable moat on the product side, I think that's what the customers care about, and that's what the product delivers. Having the ability, as you said, to contextualize all the security data is the holy grail. And it's an unsolved problem for multiple decades now. The need for solving this has never been more important. If you really look at it, the number of attacks have been increasing. It's 89% up this year alone. And as you know, agents need a lot better data to reason on. If they don't have that data, they won't be able to reason well. And the intersection of these problems will continue to lead to more attacks. And I think that's the reason why we have raised a lot of money, because building these models take a lot of time and it costs a lot of money to train the model.
Yeah. So I'm assuming some part of it, of course, will go into building the models, but I also understand you're looking to scale globally now that you raised this capital. What are the markets that will be the biggest priorities for you, and what kind of enterprise demand are you seeing there?
Yeah, so we started actually working with some of the largest startups that have been growing really fast over the last 1 year. As you know, great startups like Glean, Replit, Function Health, Invisible AI, they've been fast adopters of AI, and they are the ones that actually want to autonomously detect and remediate issues. So we started working with them first, and now we're going to more Fortune 500 and Global 2000 companies, and our goal is to continue growing that over the next 2 years.
I was reading that you say that most security tools reconstruct context after an attack has happened, while what you do is correlate data in real time at ingest. In simple terms for our viewers, why is this architectural shift so important, and what does it achieve?
Yeah, so if you really look at it, I'm not sure if you have given exams recently, but when you were in college, right, if you didn't study the whole year, and you went for an exam, even if it's an open book exam, you'll be flipping through the pages and trying to figure out what's going on, right? And that's really hard. In my view, if you really figure out from as the data is coming in, you fully contextualize it. You fully read through all your books as they're being taught in college. You do much better in exams. Literally, it's as simple as that.
Yeah. Okay. Okay, got that. You're just being a good student and, getting the learning in from day one and not cramming on the last day. But, just to get to the business model, what does that look like? Are customers paying per seat, per investigation, per data volume? And how scalable is the economics as the workload starts to grow as well?
The workloads have been growing. Data has been growing almost actually exponentially over the last multiple years. That trend has not slowed down. So the charging model is actually very simple. It consists of both the amount of data that is ingested, contextualized, correlated, and how much you reason on it. So those are the two things that we measure, and it's not a very complex sales process. The ASP is very high. As you know, enterprises care about their security, and they take all of this very seriously. So our view is that the contextualization of data and ingest of data is the two things that we charge on, and we keep it very simple.
Since your release again says that you're processing millions of investigations already, if you could share numbers around, the revenue growth you're seeing, the customer growth, the retention you've seen so far. I know you're a very young organization, but what kind of adoption rates you're seeing? So some data there that you could share.
One of the things that I measure the team on is when you go into a POC, how often would you win and how often would you lose? So as long as our loss rate is very low, I think that that's the biggest success for the platform and for the team. So our win rates are very, very high. I don't think we have actually lost any POC yet. So that's number one metric I look at. Net retention is too early because it's not even our first year of selling the product, but we feel that the product is very widely used. So that's the other second metric we look at. Do customers come to the platform? Do the users come to the platform every day? And that is a very important metric. We have actually customers who say, I come to the platform 100 times a day. Maybe they're inflating it, but it's actually literally as sticky as that. And that's the second thing I measure on. And the third thing is, are we closing $1 million deals, right? Are we closing multi-year $1 million deals? And we are there.
Okay, so you're not losing, you're closing multi-million-dollar deals and customers are coming back to you repeatedly. But, again, just to try and get some numbers from you, cybersecurity teams are like drowning in alerts and these false positives. Using the platform that you provide, how much faster or how much cheaper can customers operate compared to, say, traditional setups?
Yeah, so typically what we measure is if you look at a customer would actually have a SOC team, a really good SOC team for an enterprise that is growing really fast, even if you take a customer like Glean, would be 15 to 20 people to do a decent job. I'm not saying they're doing a great job, but to do a decent job, that's what you need. That company can do it with 1/10 the people. That's literally how you measure it. And I think that's the best way to look at it. Can we reduce the amount of people required, or can we do a lot more with the same people that you have? That's basically the metrics we ask the customers to look at.
Okay, Ankur, finally, since we have you here, if you were to take a bit of an unbiased view, if I could request you that, because this broader AI boom is also making attacks more and more sophisticated. Over the long term, with the advancements we're seeing both on what's happening on the attacker side and, people like you trying to defend that, do you believe AI will ultimately favor attackers or defenders, say, in the next 5 years?
The only hope I have is if we can't defend, we're going to get killed, all get killed, right? So the biggest hope for the humanity is that we can protect ourselves, we can defend ourselves as the cost of attack keeps going down. We have to keep the cost of defense going down. And the only way you can do that is if you study upfront and not study at the exam time, right? That's what I tell the customers, that make sure you're ready all the time, your data is fully contextualized, you really have agents that can work at scale as the attackers are coming in.
But of course, like you repeat, don't cram at the last minute, but are you also partnering with the smarter kids? Are you, things like Mythos, for instance, I mean, of course, that's not in the market yet, but are you looking at partnerships with other AI companies to, strengthen your systems?
So we have been working with almost all the major AI model providers from day one. Actually, we were one of the earliest users of Bedrock, AWS Bedrock, with Anthropic. So that has not changed. Our partnership and our usage of Anthropic is one of the highest in the cybersecurity space from day one. So our view is that as models keep improving, we'll keep partnering with them, make it a lot better to the end customer.
All right, you're proving out to be the ideal student. And Ankur, we'll be watching your journey here very closely. Thank you very much again for your time here today.
Thank you, Ritu. Good to see you.
All right, we'll move on. And Make My Trip is weighing a listing on the Indian stock exchanges more than 15 years after it first went public on NASDAQ. And as the company eyes coming home, its founder and chairman Deep Kalra says the biggest transformation is already underway, and that's artificial intelligence. From replacing travel agents to building for Bharat in 30 languages, he believes AI's impact on travel won't be big, it will be exponential. Aishwarya Anand caught up with him at the TIA Delhi NCR India Innovation Day. Take a look.
Deep, you've been in the ecosystem for such a long time. Help me understand that, with AI coming into picture today, how are you seeing businesses evolve, and what is the biggest bet that you're making today?
Yeah, I think it's quite fascinating how the internet moved from the desktop to the mobile phone to the app, and of course 5G happened, and now we've got AI. And I truly believe that the AI moment is all those moments, not additive, but actually to the power of. So it's actually exponential. So the impact of AI is going to be massive. I think the best is yet to come for India. Yes, there's a huge AI opportunity, but that we have to tread very smartly on where is it that India can win a game.
Correct.
We obviously have got left behind from what the US has done or what China is doing, but there's an application side of it, there's a services side of it.
Correct.
And I think India has a big role to play in both.
With AI, when we talk about very India-specific innovations, where do you see potentially that could come from? Because, like we mentioned, like China has been ahead of us, US has been ahead of us. But there's been a growing conversation that there needs to be a lot of innovation that comes, and we don't just build on what has existed earlier, but we need something that is very true and very core to the India model. So, what's the lag on that front, and what's the way forward there?
So that is what we have to understand very well. So India is definitely not one homogeneous country. We're very heterogeneous. We've got 30 states, we've got 30 languages. So we have to harness the power of AI with local languages. We have to understand what is needed by consumers in different parts of the country, not just again in the big cities, where in the big cities, if you look at the top 10, 20%, they think no different from the big cities anywhere in the world. It's down the line, what are they comfortable with? The interfaces they're comfortable with, if it's a consumer-facing business, in their own language. Is it going to be text any longer? No, it's going to be spoken. Our form factor is going to change. Yeah, you'll probably have a query box on a wearable that you'll be talking to, or they'll be reading your mind and be able to help you in various tasks. Also in product, you have a lot of AI which is coming in to how product itself can be smarter. Factories and applications there, it's not just robots, it's robotics meets AI, which is changing the whole game. So there's so much to be done in our agrarian industry.
You've been part of the travel industry for a very, very long time. One place where AI can absolutely revolutionize the industry, what do you think? One thing that you're very excited about?
Yeah, I think the role of humans will come down dramatically. Even for complex itineraries where we still think we need people, we do because we haven't experienced how good it can be and more reliable. So I think that's going to change a lot. It's already starting to happen. We have a chatbot called Myra where we're doing a ton of stuff in different languages, but it's just started. Every week there's like a significant improvement and innovation in AI. That's the reality of life. True. Up to 4-star hotels in China, it's only robots at the desk. Your entire front desk experience. So I think we have to be able to appreciate what all can be moved. Yes, we need the human element when it comes to, let's say, the dining aspect when you're traveling, the artisan aspect. That's very important for India. But in the research and booking process, which is ours, we are going all in on AI to see how can the research process, who wants to go through hundreds and hundreds of hotels when they're booking? It becomes complex, but each one of them has to be super relevant. Each one of them has to be something you would have considered after half an hour to 1 hour of search. And then you make the choice. That's what's going to change in a dramatic manner.
So, okay, so then yours industry is one where we will see a lot of job losses happening.
Well, I think different kind of jobs then. I think people will have to do different things. It's not like you will lose one kind of job.
Yeah.
See, a lot of the people who are agents, there's also the skills are very fungible.
Correct.
They go to other industries too. So you will have different kind of jobs.
It's what, 25 years of MMT now?
26 now.
26 now, right? There was a point when you were about to sell the company, but you've come back from it. You have seen COVID, you have seen many, many cycles of entrepreneurship. And help me understand, what's one thing that you look back at today and you feel extremely proud of? One thing that you do have a little bit of regret with? And where do you think history could have been and should be kind of for the journey that MMT has gone through?
Pre-funding, etc. Things were very tough. Our first 5 years were really, really tough. But they tested us, they tested our mettle, they really tested the team. So one thing I'm really proud of is, maybe I can say two. Okay. One is I think we built a brand where people really trust and rely on. Equally proud of the culture we built at the company. Yeah. So the company culture is something, I don't think you can build a great company without a great culture inside. Absolutely. At least I wouldn't have it any other ways. Not too many regrets. I think it's been great. I wouldn't have it any other way. Okay. It's a lasting kind of brand, lasting company. So yeah, I think you have to, I'm clearly an optimist. I like seeing the glass not half full. Here I see it 90% full. And more than 90%, then the cup will spill it over. So 90 is good.
So through all the journey, one advice to the upcoming entrepreneurs here?
If you're taking the plunge, moving from, let's say, a corporate job to an entrepreneurial job, come in with at least a 4, if not 5-year horizon. In India, it takes time to build something of value. And in 2 years, you won't even know. And if you quit, you'll never know what it would become. Yeah. I saw it myself. Had I not lasted those initial 5 years through the toughest of times, we would have never built this company. And so many people give up too early. Come in with a longer term mentality, have the stamina, both financial and mental, to last those initial 4 or 5 years, then you will know. Then the market will tell you, what you built will tell you, are you onto something or not? But at least you would have tried, yeah.
Okay, we'll slip into a short break on that note. But up next, Chinese consumer electronics giant Hisense is targeting a 10% market share in television and 5% in air conditioning and washing machines in the next few years. We'll speak with their leadership in just a bit. Chinese consumer electronics giant Hisense is targeting a 10% market share in televisions and 5% each in ACs and washing machines in the next few years, while also ramping up localization amid supply chain disruptions and geopolitical tensions. The company now targets $150 million in revenue this year, up from $90 million last year, even as the West Asia conflict forces a 7 to 12% price hike across its portfolio. CNBC TV 18's Meghna Sen spoke to Hisense India CEO Pankaj Rana. Take a look at the highlights.
India market, as we know, is quite big, and of course it is growing also in almost all the product segment, be it TV, home appliances or air conditioner. So our plan is to make Hisense as a multi-product company in India. So till last year we were only selling TVs into the India market. This year in February we launched our air conditioner. Now we plan to launch our washing machine. This is one part of the overall what we plan to do in India market. Now on top of it, what we are planning in India market, opening up our channel. Channel means we want to display our product in offline and online channel both. Specifically, as I said, till last year we were majorly selling our product on Amazon and Flipkart, but last 6 to 7 months we have expanding our retail footprints into the India market. We are now, our products, specifically TVs, are present at offline channel, example Reliance Retail, all the 650 plus stores of the Reliance Retail, and in South all big retail chains like Maiji, Nandilat, Satya, they all have started working with us, including the Sonovision.
Hisense recently went for a price hike across most of your business segments like AC, TV, in the range of 7 to up to 12%. So how much of this is directly linked to the West Asia conflict and how much is currency driven?
It's a good question. Actually, maybe 60% or 70% of this impact is majorly because of the geopolitical issues which most of the brands are facing, including us. And some of this part, of course, is related to currency exchange also, because when we start this year, we were hovering around 89 or 90 with respect to the US dollar. Now we are at 97, 96. And if things are not in control, this may go further up. So, but yes, while we pass on this cost to the consumer, frankly speaking, we have not passed on complete cost to the consumer. If I talk about our cost increase as an organization, only on the product cost increase itself is a 14 to 15%. So when I say product cost increase, it means end customer price has to go up around 22 to 25%. But what we have passed on till now to the end consumer is only 8 to 10%. And we are absorbing most of the cost within our organization, so that there is no big impact in our sellout as far as in the market, and also our expansion plan into the India market.
Are you seeing supply disruptions from China due to the West Asia conflict? And what is Hisense India doing to manage this? Are you rerouting shipments or holding more inventory?
You are right. To some extent, there is disruption, but at this moment, we are able to manage this with proactive planning, because we manage in India around 90 days of component inventory or parts inventory into the market or in our factories also. So we are able to manage this situation at this moment. Till now, we are not facing a big situation of rerouting shipments or the maybe containers from here and there. I hope situation will further improve in next few months. But till now, we are able to manage this situation somehow, at least.
So are you planning to, look for alternate routes either in India or maybe other geographies also due to the ongoing crisis?
Yeah, good question. So what we are planning, like some of our parts was coming from outside India, not necessarily from China, maybe from Thailand, from Vietnam or other parts of the world. So what we are planning to do, we plan to do a localization in India. So most of our parts for the air conditioner, specifically like controller PCB, we want to develop controller PCB in India market now. And we are planning to do some compressor tie-up also with the China company within India who can supply us the parts, so that we can control the global supply chain and can avoid most of the conflicts or the issues which can disrupt the business continuity at times. So this is a good, again, after pandemic for most of the organization, this is again big opportunity to learn and make India's government initiative like Make in India, Atmanirbhar Bharat, and based on with our suppliers with whom we are working. So we are trying to do indigenous local manufacturing of parts also, so that in future, if there is any uncertainty, we are able to have less impact due to this in the business continuation.
Right. How has the Q1 of FY27 looked so far for the company? And does, the rise in commodity cost or higher fluctuation in currencies impact your margin?
We follow the calendar year. For example, we follow Jan to December. For us, it is a Q2. Yes, there is an impact. There will be some impact in terms of the consumer sentiment also because of the cost increase of around 8 to 10%. But so far, as you know, that our base in the India market is very small. Our market share are also very small in the India market. For us, I don't see any big impact happening in this situation because we are expanding our product portfolio. We are expanding our channels in the India market. So the growth projected for the Hisense for 2026 in the India market, we should be able to achieve, irrespective of many uncontrollable situations are also happening into the market. So for us, Q2 of calendar year and Q1 of financial year is almost going as per on track.
Right. So if we speak about the top line, how much revenue are you expect to generate this calendar year, and also how much Hisense India is revenue contribution to Hisense Global?
It's a good question. So I'll answer the first part. So last year in 25 calendar year, we did around $90 million in the India market. So this year we should reach around $150 million from the India market.
And with that, we'll wrap up this edition of Startup Street. Thanks very much for tuning in. More news and updates will continue right here on CNBC TV 18. Hello and welcome to On the Record. I'm Shireen Bhan. My guest today is a man who has a pulse check on India's real estate market, but not just India. What's happening in the region is a question that will get addressed from his vantage point as well. $30 billion of assets under management in India since 2014, with a target of touching $100 billion by 2030. Ankur Gupta, thanks very much for joining us here on CNBC TV 18. It's great to have you back.
Thank you very much for having me again, and it's a great introduction. It's a timely topic for us to discuss what's happening across our region.
Absolutely. So let's get started with that. I mean, it's volatile. I think that is an understatement at this point in time. But the larger impact of that, not just on India, but on the West Asia conflict and what it's doing as far as West Asia is concerned, on Asia in general. What is the mood right now?
Yeah. So let's talk about volatility, because that's where we start.
Yeah.
If you look at on a daily basis, everything seems always a little bit volatile.
Yeah.
But if you look at the trajectory in which economies, certainly the economies that you mentioned, from West Asia all the way to Far East, have moved in the last several years, you've had creation of a top 5 global economy in India. We've had a real emergence of the GCC region, the West Asia region, as a global powerhouse of both transactions as well as source of capital. Economies like Japan are seeing growth for the first time in several decades. Australia is on a 3-decade growth trajectory, very good demographics across the region. At the same time, infrastructure or hard asset creation is lagging the West. So if you compare the West versus the East, on a long-term basis, we are still underdeveloped and high growth. That is a perfect storm for any duration of capital to be focused on and to actually use opportunities like volatile markets of today to create large long-term businesses. So very excited about what's happening to the region on a long-term basis, on a mid-term basis, and on the short-term basis, some amazing opportunities coming our way.
So you're not deterred by the headlines at this point in time. You're not deterred by the nervousness. And I'll ask you this in the context of the fact that most people believe that, look, if oil prices continue to remain as high as they are, or perhaps even trend higher, the impact that that's going to have on growth. I get the point that you're making on the underpenetration and underdevelopment as far as hard assets and infrastructure is concerned. But if growth were to slow down in the region, what could that potentially mean for investors like you?
Fundamentally, what's happening to oil prices right now is a shock driven by certain geopolitical events. This is not a change in the way supply of oil should happen in normal course business. There's a lot of conversations around diplomacy, around pacts and deals being made, and it will come to a head soon. And when that is over, you'll have a lot of pent-up growth come through the business channels. So yes, if you look at the market today morning or the newspaper headline from yesterday, it all seems very, very volatile. But let me assure you, duration is what matters in our business. And oil prices will come to a level playing field like they were about 3 months ago. And hopefully in the next 3 months, because this is a geopolitical, it's not a global health crisis like we saw 6 years ago. There's a solution to this. And very soon we'll see the solution play out.
We're yet to see the solution play out. The blockade continues to remain in place. But then let's address the short term, because you said even in the short term, you see opportunities. Where do you see opportunities in the short term, specifically for a market like India?
So in the short term, what happens is people who do not have access to long duration capital need to take actions which they would not take in normal course operations. We invest capital in a large scale, and we have operating ability to back that capital. So what happens when there is global turmoil like this, what we see, your cost of capital goes up.
Yeah.
There is short-term inflationary pressures, and you have to make decisions if you don't have the benefit of large balance sheets to tide over the current prices. That creates opportunities for investors like us. I think that's what I mean, that in the short term, it's an exciting time to be in the market.
i.e. better valuations, more distressed assets that you can go out and pick up at a discount?
I would say we are able to pick up high quality assets at fair valuations.
At fair valuations, is it? What kind of discounts are you now looking at in comparison to the last deal that you just got done?
The markets overall have been soft. I'm not talking about the public markets because public markets are not necessarily always reflective of where large transactions happen. But in the last, I'll talk about the last 3 months. In the Asia region, we've completed more than $10 billion of transactions. We've just announced a very large GCC, built out of a very large GCC in Mumbai, the largest ever in Asia. Almost 3 million square feet of total area that we are going to construct for a very large US bank. Transactions like that don't always happen with players like us that have the wherewithal, both in terms of capital as well as operating capability. I think that really gets magnified when there is overall dislocation in the market.
So do you believe that you're in fact going to see an acceleration of deals and deal making because there is this dislocation that you see today?
See, India is one of the top growth economies in the world. So we've been in the market for 10 years. Every year, our business has expanded compared to previous years. And that's true for when markets were dislocated like they are today. And that has been true when markets were on a very smooth sailing. So we invest for long term, which means our programs are also long term. So I would say that nothing fundamentally has changed in the India growth story. In fact, I would say that with technology coming through the way it has, and the democratization of the technology and faster computing, faster access to large-scale models. With the workforce that India has, our median age is still in the high 20s. That population is more adept to using that technology as a tailwind than actually as a headwind. So today, I am more bullish about the prospects of India than they were 12 months ago.
And that's interesting because that is not the narrative at this point in time. Specifically, if you look at FIIs and FPI flows, I mean, it's been a one-way out of India. It's been exiting India as opposed to coming into India. But you're saying that you're more bullish on India today than you were when you first started investing in India 10 years ago. What are you seeing that others aren't?
See, firstly, we have thousands of people today in India that work for our business. So we get a real pulse from what's happening. 10 years ago, we were the early investors into the country. Today, we have a large business. We have some amazing talent that works for us. We have operating companies that employ thousands of people, as I mentioned. So we get real pulse on the ground. And today, India needs infrastructure build out. India needs real estate build out. India needs more office spaces. India needs more hotels, more warehouses, industrial parks, all of the above. We've had a few more events of global dislocation than we would have imagined, which has led to a global shortage of supply of real assets. Now that gets magnified in a fast growth economy like India. And today when valuations do become reasonable, i.e. transactions happen at reasonable numbers, investors like us can really push the pedal.
And you intend to push the pedal? So is the 100 billion by 2030 on track, on target?
That hasn't changed for us. That hasn't changed for us. In fact, we might be doing it much sooner.
By when do you now get to 100 billion? What does by much sooner mean?
We said 5 years last year. So 5 years from last year is 2030. But compounding effect of our business is amazing. Again, think about which country in the world today offers the compounding at the rate India does, and multi-sector story. India is a financial services story, India is a consumer story, India is a construction story, India is a technology story, services story. India is many sectors put together. Many other large countries have only 1 or 2 sectors coming their way. Yes, we can do a lot more in deep tech. We will do a lot more in AI as a country. But the infrastructure build out of that is something that investors like ours will play. I'll answer your question on FIIs.
Yeah.
Look, FIIs are trading in stocks. So they will obviously, because the barriers to FII movement are very limited, as they should be. Our form of capital is FDI, strategic capital.
Yeah.
We're not just investing. We are investing, we are developing, we are building, we are managing. And we are creating large businesses. And that is permanent capital. That will always create a multiplier effect on economy in the country. And once invested, this capital stays for several years.
I mean, it's actually in the ground.
It's actually really in the ground. So the returns of that, form of capital will change. Private capital will make its way into REITs and InvITs and so on and so forth. But the actual capital is in the ground. It's creating jobs to create the infrastructure, the real estate. Then it's creating jobs when people use that real estate. So it's a real multiplier effect. We saw that in China. Over 2 decades of large-scale development of the critical cities, real estate, malls, offices. That is what today has become the envy of the world in many ways, that it has one of the best infrastructure to push the economy in many different directions. And that's a global powerhouse that India is on its way to become.
And people are looking at factors like the currency depreciation, the swiftness of the currency depreciation, and so on and so forth. And all of those are being factored in as people make those investment choices and investment decisions. How are some of those issues weighing on your mind today?
Look, as I said, we are investing for a long time. Nobody would factor in that currency in India will not depreciate.
4 to 5% was the depreciation that was factored in typically.
And I would say that over the last 3 months, we've seen a real oil shock. As we talked about earlier, it will come to a head. It will hopefully, demand supply will determine the oil prices, then an economic blockade. At that time, the currency will go back to its normal 3 to 5% annualized depreciation, and that's just technical. That's just the differential in the interest rates between India and the currency that is benchmarked, which is the US dollar in this case, and that's fine. In fact, we should use this opportunity right now to really push the pedal on our exports and use the opportunity that the world is providing to us by way of a little bit of advantage on the currency side to push the agenda. We should never let a crisis go to waste. And this is our time for India to really, push its exports agenda beyond the services as well.
And you're right in pointing out that the depreciation has actually helped Indian exports become far more competitive. But, let's address the big bet that you're making in India, and that is the GCC bet, right? 2,100 GCCs in India today at last count. I don't know if they've added a few since I last looked at the numbers. You firmly believe that there is a structural move towards the offshoring model changing to an onshoring here in India, and that's the conviction clearly that's playing out for you, which explains the largest GCC that you've decided to do here in India in Powai. But again, there are question marks in light of AI or what happens to workforces in general, but specifically also what happens to these GCCs. Are you seeing any indications of a slowdown of growth plateauing as far as GCCs are concerned?
You have to differentiate between growth rate and growth, absolute growth. So absolute growth is on a very firm footing. We are seeing more demand from global companies to set up. I wouldn't distinguish between onshoring or offshoring. I would say global capability centers are about global delivery.
Right.
With AI, that model actually gets much more pruned, simply because you can deliver a lot seamlessly with better technology, which is explaining why companies are today more comfortable than setting up their own centers than relying on third-party operators. So that's a shift in the business model. The demand for quality workforce that's available from India has not slowed down. In fact, it's actually magnified. We haven't yet seen the large AI companies, the big sevens or the big 10 from the US, actually creating jobs for their AI businesses directly. Early green shoots. We still are heavily reliant on financial sector, large insurance companies, etc., medical companies, health companies, etc. But imagine the amount of job creation that the AI business directly will have with the trained workforce that we have in the country. While AI is an amazing term because everybody uses it right now, technological advancement has happened for the last 3 decades. It goes through ebbs and flows, but if you think about what Internet 1.0 did, the social internet that almost revolutionized the way people consumed media, and this is another advancement in technology. It needs a massive build out because the compute capacity that was required has suddenly become many times over. But even that will come online over a period of time. It's a $7-10 trillion economy in the opportunity in the world. A large part of that will happen not just in the US, it will happen in other countries as well. So that will all create need for capital in the infrastructure real estate space. Using that is not just going to impact the country that the technology is based out of. It's going to impact the whole world. And India has always proven its mettle.
Do you need more workforce at work, or the work from home conversation is back? It's back after the pandemic because the Prime Minister has put out a nationwide appeal asking companies to consider work from home. It is not mandatory just yet, but we've seen many state governments now issuing their own advisories as well. If this were to translate into, at least for a period of a year, because that's the broad number that he's speaking of mandating work from home, or at least nudging, encouraging people to work from home, what could that potentially in the short term mean?
So again, we have to differentiate what happened 6 years ago with the pandemic to what the appeal was made. This was in response to what's happened in the geopolitical arena with
fuel prices
and shortage and the impact of all of that. And as I said, it will come to a head soon. We all went through a period of time where there was work from home. That was needed because of the pandemic. You needed to create social distancing, but almost all corporations today realize the benefits of working in an office setting. New models are being created. Businesses have been incubated. People have to work together. The way people worked in the past might have changed a little bit. In fact, I would say most organizations today need more square footage per person than they needed pre-pandemic. You have more dependence on social interactions in office today than they did pre-pandemic. So by and large, work from home, even if it was to be mandated in certain cases or encouraged, is a response to a very different aspect, which is about fuel, and that's specific to India again, because of the way our energy markets are today, and that will resolve itself.
So you're not seeing any nervousness at this point in time on account of that?
Absolutely not.
Even as far as the hospitality business is concerned, assuming that your conviction pays off?
We are now in the Leela business itself, more than 20 hotels, more than 10 in the pipeline. So we're going to probably be more than 30 hotels, and across the board, I would say we will do a lot more should the opportunities be available to us.
M&A there as well?
We are a large investor and developer, so M&A is always the way for us to grow, by step functions.
Let's talk about the REIT market as well, and of course that's been something that you've been championing. And 2025 was actually quite an inflection point as far as the REIT market in itself was concerned. What's the story, and how is that playing out, not just for you but as an industry as well?
Look. Our REIT is now more than 35 million square feet, a large enterprise. The regulations in REITs are very, very good in India. And we've always said it that they've taken the best from the world and implemented them in India. The fundamentals are very good. SEBI introduced the classification of REITs into equity, which was always the right thing to do. That led to an expansion of investor universe. We've raised more than $1 billion in our REIT in the last 12 months or so. And I think that program will continue. We'll probably raise capital because capital is the raw material for REITs.
How much are you looking to raise and when?
We just raised about $300 million this month, early part of this month or late last month. And as I said, the opportunity for the REITs for our REIT is immense. So the raw material is capital, and we look to either raise capital or issue units to expand. But the program will continue for decades. US established REITs in the 70s and 80s, and it continued for 4 decades, and we are in the first decade of the REIT market. I'll just characterize the market size. The size of global commercial real estate space, the rent-producing real estate space, is $60 trillion. In the US, is $30 trillion, which is 1:1 their GDP. In India, our GDP is $4 trillion, and our commercial real estate space is probably $400 billion. So we are a tenth of our fair share of GDP. Our GDP will double and double again over the next 10 years, which means we have to first make up 10x and then double and double again. And that's the market potential that we see. We've only seen office REITs and retail come through. We're going to see hotels, either IPOs or through REIT channels. You're going to see more office REITs. You're going to see apartments, industrial. You're going to see warehousing, business parks, so on. And it's a big market. We can open up the market to talk about mortgage REITs as well, to create more financing sources for the real economy. So it's early days, very bullish on the REIT business. We've seen early days that the government is thinking about creating sovereign programs for asset monetization or creation of holding companies which can become REITs in future. So I think the market just started off.
Specifically, since you brought up the government and the government's asset monetization plan, and I think, again, the pushback there has been that there's been a lot of talk but little action. We've seen some action, at least as far as the InvIT side is concerned, but, it could have been a lot faster, it could have been a lot more. What's the ask there, and what's the hope there, more importantly?
The ask is that we are here to help.
Have they asked for help?
In terms of policy matters, in terms of how to do the right things, I think the engagement with industry is very good. I can say about Brookfield and most of the government agencies are supporting the growth of our business, and as a result, supporting the growth of the country. And in that ecosystem, when they have their own programs to launch, it just widens the scope. How we can be helpful, that they have to decide. But I don't look at the past, whether the monetization could have been faster or quicker. That's they're running a country. They have a lot more considerations to take. We are running a small corporation. So whenever they are ready, we are here to support.
With just a couple of hundreds of billions in asset under management, just a small corporation. But, we're also talking at a time where we've got Trump and President Xi in China, along with a whole host of top US CEOs. And since we're talking about comparisons and where India is and the potential for growth, let's talk about this India-China comparison, because very often we see long sort of, comparisons being made, and some of them perhaps don't even hold true in the form of the comparisons being made. But how do you look at the India-China story and how you expect them to play out?
I look at it like the interstellar model, where you have to almost change the time scale and then look at it. Why compare a more maturing demography with a younger country today? Let's look at what happened maybe 20 years ago in China. And that is more exciting. That can we be part of that journey for 20 years in India? Or if you take it back 20 years in the US. So, economies go through their maturity cycle. So what we sometimes do mistakenly is compare today's India with today's China, or today's India with today's US. I don't think it's a fair comparison. Free market came to India late.
Hello and welcome to the Global Dialogue. I'm Shireen Bhan. Two sets of headlines have dominated the narrative in 2026. The war in West Asia, which continues, and of course, all things related to AI, but specifically the prediction of the SaaSpocalypse and what that will mean, not just for Indian IT services companies, but for SaaS companies globally as well. Let's just put some data on the table now. In light of this narrative, we've seen companies here in India, but globally as well, lose significant amount of their market cap. Year-to-date, Salesforce down 31%, SAP down 28%, ServiceNow down 35%. That gives you a gist of what I'm talking about. But to help make sense of where we are today, and more importantly, what the future looks like, joining me now is a man that I last spoke to in 2024, the Chief Digital Evangelist at Salesforce. Valav, always great to have you. Thanks very much for joining us here in India.
It's a privilege. It took too long. It's been 2 years since we spoke last.
And the world has changed in 2 years.
Changing. Quite a bit.
So what has surprised you about the pace, the momentum of the change, Vala? I mean, we did talk about the fact that AI is going to accelerate the tech adoption. It's going to accelerate change as we know it. But this stage and people talking about the fact that 18 months on, people sitting in front of a computer are going to be redundant. I mean, did you anticipate this?
We spoke in the middle of 2024, and since then, Salesforce has become an agentic enterprise. We have 25,000 plus customers around the globe, including incredible innovation happening here in India, becoming agentic, becoming autonomous businesses. I've been in tech 30 years, so I've had the fortune of experiencing certainly the cloud revolution, which Salesforce pioneered when we launched in 1999. We've watched and enabled the mobile revolution. Some argue 2007 with the birth of the iPhone, or the social revolution, the Internet of Things, data and advanced analytics. I have never experienced the velocity, the speed and direction, which has led to the fastest growing product in my company's history is our Agentforce product, our agentic AI solutions capability, and also our incredible opportunity to feed agents with trusted data. So when I look at our data and our agentic business, it's our most successful product lines in the history of the company, and now tens and thousands of companies using it. So yes, you and I think, we did a good job of predicting this agentic future. I think we both talked about the fact that, this could be electricity for the 21st century when we talk about. And it's clearly true that it's the most impactful. Some would argue when we talk about AI, specifically agentic and physical, it could be the impact 10x bigger than the Industrial Revolution at 1/10 the time. That's a profound statement in terms of what's ahead of us. And I think it's only the beginning. So, one of the reasons why I'm so delighted to be here is tomorrow I get to spend time with 2,000 men and women who are changing the landscape of not just India, but the globe in terms of adoption of innovation, adoption of new business models, and really finding ways not only to be relevant, but also thriving and growing in this hyper-converged sense of uncertainty that we're all part of. You mentioned in your opening. I also, as much as I'm excited about the technology, when I think about converged uncertainty, tariffs, multiple wars, climate change, powerful new technology, questioning future of business and future of work. This is a time where you need to be grounded in your core values. You need to learn by first principles, and you need to adapt as fast as you can.
And you have previously said, and we talked about this as well, that if you're not on the forefront of adopting AI, then you do have an existential question to deal with. At this point in time, given where we find ourselves, do you believe that more companies are at the risk of being not just left behind, but facing an existential uncertainty, an existential question than they were 2 years ago?
I do. Right after our conversation, I was inspired to work on my next book.
I'm holding it up here, autonomous.
You're holding it. And the subtitle of the book says, "The Fittest Companies." I'm reminded by Darwin, survival of the fittest. Darwin didn't say you had to be the strongest. Darwin said if you had thick fur, you're more likely to survive the winter. So it was about adaptability. Subtitle says the fittest companies, because I believe now we're talking about digital Darwinism, fittest companies adopt AI-first strategy and digital labor. You're not an autonomous business, you're not an agentic enterprise if you don't have digital labor. So today when we talk about hybrid work, maybe perhaps in the past that would reference where you worked, home or office. Hybrid work today is humans and AIs co-creating value at the speed of need. Your ability to anticipate, your ability to scale, and the level of intelligence that's introduced with an AI system. And again, I'm very deliberate when I say system because this is not a discussion around language models alone. Language models is a component in the system that agents use to create and to be able to reason and to execute complex tasks in business workflows, to adapt and learn with every iteration. That requires a system. Salesforce, that system consists of 4 subsystems, but there's more than just one component that brings this incredible capability to life. And to get back to your question, you're either an agentic business or you're a dying one. You are on a path to irrelevancy if you don't take advantage of this technology. And that's my belief is, rooted in evidence, but I also, being in technology for 30 years, building technology for majority of that, I've never witnessed technology as powerful, as impactful as these waves that we see in artificial intelligence, the predictive use of machine learning, the generative use of machine learning, and now agentic and physical. And what I mean by physical, smart drones, autonomous